Very good morning. I think the lesson for anyone, whether a cricket lover or not, from RCB yesterday is try till you succeed.
Even if it takes 18 years.
Even if it takes 18 years, never give up. I mean, we all love the story of an underdog winning and RCB really making it after 18 whole years. Virat Kohli with tears in his eyes.
And an interesting one for Virat Kohli as well, because it's assumed that this will be his last IPL as well, taking his retirement plans into consideration.
He's fit enough to play a few more.
But has a retirement plan, right?
So. Yeah. So that was exciting last night, but so much to look forward to in the markets, and we'll discuss that. I think today is all about the block deals. 4 major block deals, and we'll pull up those on your screen. One of them you would have heard about on Heard on the Street if you follow that segment that we do right here on NDTV Profit last month, but 4 block deals which go on the floor, including Tata Tech, Indegene, all of those that will put some pressure, not just on those individual stocks, but you might see some pressure on the street, although implied looking like we're going to open in the green.
Green. Absolutely. I mean, implied open in the green is interesting, but what's happening is you're seeing selling at higher levels, right? So that's the concerning area. That range where markets are trading, that is what is actually putting pressure, because you're not seeing any decisive move, Tamanna, that's coming in from a markets perspective as well. So neither the bulls nor the bears are figuring out which side of the table
on the
to
benchmark.
go to.
That narrow range has actually been shifting lower, and 24,600 now forming quite the resistance.
And it's the rate sensitives that will be in focus now over the next couple of trading sessions.
Yeah, absolutely. But let's start off with what's happening in the global. I don't know if you have that graphic for the block deals yet that we were talking about, and if you could just quickly look at that before we move ahead. All right, there it is. That's great. Indegene, 10.2% of shareholding will go on the block. Tata Tech, 2.1%. ABFRL, 6%. And Alchem, 1.4%. News of another couple of blocks out there. So that'll be putting pressure. But from the global markets point of view, something very interesting is happening right now. Trump keeps saying tariffs are going to come, and US markets keeps ignoring him. So this is what's going on. US markets, in fact, have rallied as trade tensions are easing. You saw all 3 indices up in the green, about 0.5% odd on all. The Nasdaq, in fact, rallied 156 points in the US markets trade. Treasury yields have also pulled back after OECD has downgraded US growth to 1.6% for the year 2025 from 2.5% that it earlier was. I thought this was quite alarming. In fact, the outlook of the OECD for US growth in 2026 is a mere 1.5%. They think that tariffs, trade wars, etc. is going to lead to a bit of a recession. Meanwhile, the 10-year was at 4.44%. Now, the White House has confirmed 50% tariffs on steel, aluminum will come into effect from June 4th. Like I said, the street doesn't seem to be taking it very, very seriously at this point. Oil prices, meanwhile, have cooled off after a spike as the Ukraine-Russia war escalates. Brent, however, has remained above the $65 mark. Another thing that I found interesting is the bromance, which seems to be coming about. Elon Musk has torn into Trump's big, beautiful bill just days after exiting his role at the White House. And I mean, look at what he's calling it. He says that, the big, beautiful bill definitely is an abomination. It's outrageous. He's calling it disgusting, all kinds of words there. Now, meanwhile, White House Press Secretary Karen Leavitt has said that we know where Elon stands on it, but we still think it's a big, beautiful bill. So that's where it's going with Musk and Trump. Meanwhile, as far as Asian markets are concerned, let's take a look at how Asian markets are performing. All up in the green. The Nikkei up nearly 1% at this point. I want to pull up the implied for India for you very, very quickly before we move ahead. 48 points in the green. Now, the White House has also confirmed that the USTR has sent letters to trade partners urging them to submit their best offers by Wednesday. Press Secretary Caroline Leavitt called it a friendly reminder.
In the content of the letter, USTR sent this letter to all of our trading partners just to give them a friendly reminder that the deadline is coming up. And they are in talks. Ambassador Greer, Secretary Bessa, and Secretary Lutnick are in talks with many of our key trading partners around the globe, as you know.
All right, special guest in our studios this morning. We're joined by Matt Orton, Head of Advisory Solutions and Market Strategy, but he's in our Mumbai studios today.
Yes, it's wonderful to join in person.
Matt, great to have you here. How are the Mumbai rains treating you?
It's not too bad. It's not dissimilar to Florida, which is where we're based, so it's very similar.
Oh wow, that's quite a comparison. What about what is raining down in the White House? I think it's a tariff a day, pretty much now, or the reminder of a tariff a day. Have there been any scarier words than a friendly reminder for a tariff deadline?
It's always amusing to watch the headlines because I think the headlines signal a lot of the uncertainty that's in the market, but at the end of the day, the actions speak louder than the words. So we saw the 50% tariffs in steel and aluminum. That's not that surprising given that that's a priority, especially after you saw the merger go through with Nippon and Japan. But at the end of the day, I don't think it changes the economic trajectory greatly. We know tariffs are something that we have to live with in this world. I think Trump's been very consistent with where he wants to go, and I think assuming a 10 to 15% baseline tariff is probably the long-term end game of where we'll be, I think is fair. But I think the key thing is that we've taken all of the left tail scenarios off the table. So even though 50% here, threat of tariffs over there, at the end of the day, it's all about trying to get a deal. And I think that's what is consistent. We have July 9 is the deadline with respect to the 90-day tariff reprieve. And I think Trump is trying to apply as much pressure as he can to get some deals in line and worked out so that we can have positive announcements and some momentum and successes that we can signal once we get to that deadline.
Okay. So my question is, of course, in the context of everything that we've seen, suddenly you see the dollar back in the game, right? Overnight you had a little bit of strength come through, but then we've seen a slide from those heady levels of 108 plus for the dollar index. It's below 100 still, and also against a few pairs it's lost ground. What's the future for the dollar? What are the implications for global flows? Because you've seen yields move up. At what point, in your opinion, does that become too attractive to ignore?
Yes, so Alex, my expectation is that the dollar is still in a longer-term downtrend. It's not surprising that we're seeing a little bit of strength after such a prolonged period where it's moved lower. But I think with tariffs in place and with uncertainty that's still on the table, and the likelihood that you still see some foreign repatriation of assets moving back home, you're likely to see the pressure remain in place, which is a good thing for the emerging market complex. So one of the key things I talk to clients about is finding ways to better diversify portfolios. And to me, that's diversification across asset classes, it's diversification across sectors and industries, but also geographies. It's been a really long time since I've had conversations with our clients where there's a willingness to look overseas, and you've seen tremendous returns from a lot of different markets. And I think emerging markets are benefiting and will continue to benefit from a lower dollar and from lower oil prices, which is another reason why India still stands out as one of my more favored markets on the global stage.
So Matt, you're saying India stands out. You are seeing long-term potential. Is the ground story telling you the same thing, that you're in India? Because from an economic perspective, you've seen a strong GDP number. A weaker dollar becomes positive as well. And your global conditions to some extent are favoring investments into the country. If that is the scenario, which bets would you actually look at in terms of sectors and stocks within them?
Yeah, so it's a great layup for the case for India. And I think there is a lot of positivity. So from all of the meetings I've had with company management teams over the past 2 days, I'm pretty enthusiastic about the fundamental prospects of a lot of companies, and I would say larger private banks remain very, very interesting and top of mind for me. The auto sector is increasingly interesting. I think it's not just M&M anymore. I think there's a lot of other opportunities as companies try and build market shares. There's a push for EVs. There's room to build margin into those companies. So those are two areas that I think look interesting. The consumer story in India is a different story. I think that's a more challenged backdrop, especially as you're seeing spending come back. But there's always going to be some outstanding names in there, perhaps those who are more levered to content generation, media. Those might be a little more interesting going forward. But you look at a country that's the fourth largest, soon to be third largest economy in the world, you can't really ignore that, and especially with the RBI likely to cut rates on Friday, that's a really supportive story, I think, of hopefully getting a little bit more of that consumption back, and companies, including banks, can weather that storm very, very well. So I think it's still a very exciting backdrop to be looking at India and making investments, especially if you get some pullback or consolidation.
One follow-up in terms of banks, you mentioned about expected rate cut that could come in, and you still like the banks, but do you think the margins could be pressurized? And if that is going to be the story, which segment of the banking space would you be going for, an ICICI or an HDFC, or would it be the PSU bank, like an SBI?
Right, it's a great question. I would avoid some of the PSU banks. I think an ICICI or HDFC are two names that I like a lot, because the banks are balancing margins and growth, right? So margins are going to be under pressure as rates start to come down. But there's a pretty quick transmission mechanism right now to deposit rates coming down as well. So they're able to weather and navigate that a little bit better. I would expect to see credit growth hopefully start to expand. Business loans have been a standout for some of the private banks as well. And as these companies are able to better mine data for their customers and better penetrate, get them into credit cards, using them more for banking, there's a lot of levers they can pull to preserve margins and still hit some of their growth targets and hit the ROE numbers that I would want as an investor. So I feel pretty confident about their ability to execute.
So just a couple of questions. I think you have a more a charitable view on IT services than most have. You believe that the worst is over. Want to know more about that, considering that the uncertainty is still very much there on what's happening with the US economy. If the US economy is going to shrink, and what the OECD outlook is dismal, to say the least. Do you see IT services actually weathering the storm?
So IT services have just been in a terrible place lately. It's been just destruction of value over the past half year, and it makes sense because of the economic backdrop, like you pointed out. But from some of the conversations I've had with teams over the past week, I think they have projected very, very low expectations. And I think the expectations have been set so low that they can actually beat the numbers that they're putting out. So I think as an investor, it's not so much the absolute, it's the relative movements. It's the derivative of where things are actually going. And so if you can start to see them extract value from areas like Europe, which are actually starting to grow, financials across the world are doing well. And so the IT services business, especially with respect to AI, is doing well. And actually, economic contraction means businesses, in order to preserve their margins, probably want to find ways to have cost savings, manage their workforces appropriately, to which they're going to look to some of these IT service giants to do. So there's still a pathway forward for growth. I think it's a higher risk, but the risk reward, given how low some of these names are, looks fairly attractive to me. So it's a dip your toes right now. As the story hopefully starts to play out, you can add to your positioning, but it's not an all-in bet at this point.
So therefore, I'm guessing you're keeping your ear to the ground and you're trying to understand, and here's my question, in the IT space, would you bet on the companies that have been at the forefront over the last couple of decades, particularly the last decade, or would you venture further and you look at companies that are in new age technology and trying to catch that next wave of services growth? And how do you see revenue profiles change? Do you see the mixes of the service that they provide change, and therefore would you expect certain companies to have a higher revenue trajectory than others?
I think you do. So I think you need to have a combination of both, because the new age companies, those who are much more levered towards artificial intelligence, those are the names that I think are doing well right now and have an immediate path forward for revenue growth, because that's where companies are making investments. When you look at some of the larger names, those are names that bigger companies, bigger contracts are going to come to. So you want to have a balanced approach, but if you're going to look at some of the larger IT services names, you need ones that are not heavily exposed to manufacturing or retail or telco. You want names that are more exposed to financial services, perhaps IT, and that have the ability to help with artificial intelligence too, because that's probably the growth engine, at least in the short to medium term.
Not asking for recommendations, but what's on your list that you're looking at right now?
So Infosys is always on my list, at least of names that I'm looking at. I think they're particularly interesting. Tata Consultancy Services is another name that I think is interesting because they do have a really good AI practice. So I think those are probably the two most important names. Tech Mahindra, I think, is also interesting, but further down on my list of names.
Just wondering, of all the companies that you've met while you're here, any standouts for you, Matt? And what is the one message or the common sort of narrative or message that you're getting in all of these conversations?
So I think the main message to start with is optimism. I think the management teams, although management teams are always optimistic.
They're unlikely to come and tell you, oh, things are really bad. But
Of course, although you're paid to under-promise and over-deliver. So I do always take that with a grain of salt as well. But I think companies that have leverage to, I would say, global growth are all fairly optimistic. So especially companies that have businesses in the GCC, where you're seeing tremendous amounts of money being spent on projects and investments, not only in hydrocarbons, but in artificial intelligence and sovereign AI, those are really, really interesting. And I'd say the one company that I left most optimistic about, that's been on and off my list, but is definitely on right now, is Adani Ports. I think what they are doing with respect to managing the supply chain and trying to find synergies and have that as a sell, I think is really compelling. And the business overseas as well in the Gulf is also very interesting.
So multiple aspects that you're looking at in terms of Adani Ports. In fact, that has been one of the companies that has outperformed in terms of their earnings expectations as well in the fourth quarter. Staying with this infrastructure theme as well, from your last visit to now, I'm sure you've seen a stark change in terms of the developments that are happening. And if you have to look at infrastructure as a space, anything apart that stands out for you that could be an investment bet?
So infrastructure has been more challenged, as you're alluding to. I think the expectations you had right after the election have not come to pass, but there's still growth, right? So there's still going to be top line growth with respect to infrastructure spending, just not as much as I think a lot of people wanted. So as I look at where I might want to be positioned, I think you want to have companies that are exposed to overseas infrastructure projects as well, which is why in Adani Ports, I think, has been able to perform so well. But that area, I think you need to have that additional diversification. When you look within India, companies that are poised to build, I'd say, last mile connectivity to ports, rail systems, that I think is going to continue to be a source of investment. You look at the coastal highway here in Mumbai, that's been an amazing transformation. And there's a number of projects like that that are still being financed.
I'm curious, when did you last come?
So I was here last year, and this before the whole connection was finished. And I drove here this morning from South Mumbai. And having that ability to get here, I was here much faster than expected.
Okay, so you enjoyed the coastal road, and with the rains right now, that's a beautiful view.
Drive.
All right, great to have you here, Matt. Please come back sooner.
Absolutely.
Always more fun to do this in the studio. Matt Orton there for you. But back to what the markets ended like yesterday. They couldn't make up their mind. It was neither here, neither there.
It's actually a very interesting story that's emerging in the derivative space, and we'll talk about that in just a bit. But let's talk about what happened yesterday. And you had foreign institutions once again sold, and this is the third day in a row that they're selling to the extent of 2,853 odd crore on a net basis. Still, for the month as a whole, they are positive. That might just change over the course of the next couple of sessions, though. Domestic institutions buying to the extent of close to 5,900 crore rupees or thereabouts. FIIs have now net sold nearly 12,000 crore rupees worth of equity in just 3 sessions, and as a result of which that texture for the month changes quite dramatically. The Nifty 50 in trade yesterday saw 43 constituents declined and ended at the low point of the day. It in fact dropped about 1.2% from that high point of the day, which was in positive territory, by the way. It bounced from key support of 24,500, and in fact even the broader markets slid from the day's high, but they outperformed the benchmark once more. The market breadth turned on its head over the course of the session and tilted in favor of the declines. It's a beautiful chart there because that indicates to you at what point in the session that the market breadth shifted. Most sectors lost ground, with the energy, oil and gas leading losses. You had realty and defense that continued to gain ground, rising over 1%. Now, the fundraisers as well as stake sales were in focus in trade yesterday as well. A couple of large deals that caught the attention. Yes Bank saw quite a few large trades. It dropped as much as 10% ahead of that board meeting to discuss fundraisers. They have announced that they will be raising funds. Aptus Value has also fallen about 9% or over 9% or thereabouts after that large trade of about 8.8% stake exchanging hands. There were a couple of other deals as well. And today, I think that's really going to be the theme of the session. And let's see how those reactions are at the start, Hiral.
Yeah, it's going to be interesting because that range-bound trade is what is concerning the investors as well, right? If you have to watch out for the key levels in terms of trade today, you are looking at Nifty 50. 24,450 is interesting because a fresh sell-off is possible only if the level of 24,250 is breached. As we mentioned earlier, there's no clear direction that we're seeing in terms of the markets. The texture somewhere is looking weak, though you have your implied open, which is indicating some bit of positivity. Now, if the Nifty manages to move above 24,600, you could see a pullback towards 24,700. And the key support is placed at around 24,500 to 24,400. Talking about 25,050 and 25,080, that is where you're seeing that short-term resistance ceiling. A move above that is going to be extremely positive, but that's where you will see that some bit of pressure coming in and selling comes back. Bank Nifty as well, it's been a very broad consolidation range over the last couple of trading sessions between 56,000 and 53,500. And the short term, structure with regards to Bank Nifty remains constructive. And it's unlike what we are seeing in terms of Nifty 50. So that's the differential between the two. Very quickly, you have, the rate-sensitive sectors that will be in focus as well. And this is ahead of the RBI policy where this will be a third consecutive rate cut that is on the anvil. And that's what the street is looking at. Apart from that, you have Coforge that will be in focus today on the back of the record date for stock split. You have Inox India, Tata Motors and TCS. They will be in focus as well on the back of the dividend record date as well. So watch out for these names as well pretty closely in trade, Tamanna.
I think a few others would be the HDFC Bank sort of family, because the HDB IPO has got a nod yesterday. Remember, 6 IPOs got a nod yesterday, and we'll get you more details on that. But that's one factor definitely to watch. Primary market heating up. Beyond that, I think metals is something that you should watch out for once again, because while the American markets don't quite care what is being said on tariffs, for Asian markets, including India, you might see a bit of pressure on metals, because there is a reiteration that yes, June 4th is when those 50% tariffs come in. 6 block deals will be coming in today. That will be added pressure. That's something we've mentioned, including ABFRL, Tata Tech, Indegene. You had the Ola block deal yesterday. So that's going to be something that will add a bit of pressure. As far as the primary markets are concerned, there is a new listing called Skoda Tubes today. The company's share will debut at an issue price of 140 rupees per piece. It's a 220 crore IPO that was subscribed nearly 54 times on its third and final day. Bids were led by institutional investors, that's about 69 times, retail investors 19 times, and non-institutional investors were about 113 times. Now, the fate of IPOs in the recent past, I would say the last couple of weeks, has not been great. Let's see what happens with Skoda Tubes today. But first, let's get a view from Puneet on what the F&O setup is.
Well, thank you for that and very good morning. In terms of Nifty as well as Nifty Bank, very interesting again where these two trends are. For Nifty, again about 24,675 is where we are. 24,500 of course remains one of the key levels to watch out for, but so does 24,400, where at least a premium of about 132 points on the Nifty 50. In terms of the Bank Nifty, we just slipped marginally below the 56,000 mark. We do continue to maintain 55,500 as one of the key levels, and even though we might break that if due to whatever factors in the banking space, only a very decisive breakdown could impact that support level. So watch out for that one as well. The open interest is up 5% there. In terms of FIs, they've largely continued to maintain a short position across indexes and futures and options. We've seen that yesterday across the board in futures and option data as mentioned. And when you look at the long short ratio, that's actually deteriorated again for the FIIs. Even from a low of 19%, it's now hit almost 16%. The FI position largely at 6,000 crores selling for the FIs, but let's look at the long short position now, because that is the key one. At 16.6%, it's hit a new low over the last 2 weeks. It started off from 34% last Monday. It's down now to 16%, and that essentially means for every 5 contracts, 4 contracts are sold short by the FIs in this particular market. When you finally look at the change in open interest as well, 25,500 and 24,800 remain one of the key levels for the calls, while for the puts we've largely seen 24,600 come up with a new level, but the volumes are substantially lower compared to sometime like Monday this week. So that is a bullish sentiment going forward and something to watch out for as well. Finally, in terms of stocks, in terms of open interest gainers, we've seen short build-ups across stocks. Yes Bank yesterday was under pressure because of a block deal, and hence that short build-up. But interestingly, there's some short build-up being built on Keynes Tech as well, largely maybe because of valuations at 97 times price to earnings, definitely an expensive stock. But overall, in terms of open interest losers as well, we've seen short coverings across stocks like PTM, Cummins as well post its results. Actually, results are weak, but the commentary was very strong, and hence we've continued to see a short covering there as well. So largely, again, a very interesting day in trade, expecting a narrow band to read, and if we can get the GIFT Nifty as well, see where that is indicating an open of 44 points above the 24,700 mark. But again, a very interesting day post the quarterly earnings.
Absolutely. Thanks so much, Puneet, for getting us those details. Now, let's talk about a few stocks that you should watch, and there are quite a few today. I will start in the automotive pack with Ashok Leyland, and it's gotten an order. It's not a very large order, but it's an interesting one, 184 crore rupees from the Tamil Nadu government. The order is to supply 543 BS6 diesel chassis and fully built buses. This is to be seen in the context of commercial vehicle space that is just about picking up. And one would assume that if monsoons are normal, you could see an improvement in volumes in that space. So keep a look at Ashok Leyland, not the largest order, but certainly a positive. Indegene, and I've picked one of the stocks that will be in focus on account of block deals. This is an interesting trade because Carlyle Group is selling about 10% stake, its entire stake in the company, and this is actually for at least 1,420 crore rupees or thereabouts. The floor price has been set at 580 rupees, which is a 6% discount to yesterday's closing price. The book builders or the book running lead managers are IFL Capital as well as Kotak Securities. So expect there to be some movement in the price. There generally is, and we'll speak to our experts to find out whether or not you should capitalize on that if you get the opportunity. Now, the last stock that I've picked, it's an interesting one. Have you ever experienced finding money in your pocket? I guess you can relate that to what HDFC Bank will feel with HDB Financial's IPO. It's not the largest IPO. For HDFC Bank, it's not going to move the needle at all, but it's a thumbs up because it's value unlocking for the company, or for the bank rather. It's set to receive 10,000 crore rupees in an offer for sale, and that money in your pocket reference is with regard to this, because you have 0.7% of the market capitalization of the HDFC Bank, which is 10,000 crore rupees. Where will this go? It is likely to go through other income into the profit, and then proceeding from that into tier 1 capital, which, as you know, is what banks use for growth capital. We've seen the trajectory of loan growth not very high, but this will sit in that tier 1 capital, which incidentally at the end of the fourth quarter rather stood at 17.7%. It's not low by any stretch of imagination. It's not likely to rise very substantially on account of this offer for sale, but it's still a positive from that perspective.
Interesting names, Alex. I think before I go to my stock list, I think we should just address our IEX as well. The business update is just come in, where they've seen the highest ever volumes in terms of the month, and that's the reason why you could see a good reaction in terms of IEX as well. If we can just pull up a 5-day chart in terms of what IEX is looking like, you will see interesting moves because exchanges have been in focus over the weekday. It's been volatile, but that positivity has continued. So watch out for IEX in trade as soon as markets open up. On the business update, monthly electricity traded volumes have gone up around 14%, is what you've seen in the month of May. And apart from that, the highest highest ever monthly volume is what they've seen, an increase of around 42% in terms of a year-on-year number. So strong one there. And the green market has achieved a growth of 47%. Solar is what is picking up. So that's with IEX, but let's understand my list. Wipro, a thumbs up coming in on this IT major. They've signed a multi-year strategic deal with Entrust. Now, Entrust is a US-based global leader in identity-centric security solutions. The contract also involves Wipro delivering AI-powered technology services. In fact, the deal was actually first referred to in Wipro's October 2024 results, though at that point in time they had not really mentioned who the client was. And this is a deal which is a part of the strong deal pipeline. In fact, the company has seen large deal bookings as well of almost $1,763 million. And this is in the fourth quarter of FY25, which is up around 48% on a year-on-year basis. The financial details of this deal are not disclosed, but definitely a positive on this front. The other one from the pharma pack that I have is Sun Pharma, which is a thumbs down because their experimental drug has failed trials. They've announced that SCD-044 did not meet its main goals, and this is a drug that was for trials for psoriasis and eczema, and it was tested in 2 mid-stage clinical trials. Overall, the drug failed to achieve 75% improvement in symptoms, and around 250 patients were tested as well. Overall, the drug was found to be generally safe and well tolerated, and despite safety, Sun Pharma will stop further development. So this is going to be a sentimental negative with regards to where Sun Pharma goes. And very lastly, you have a Zydus Life Science that will be in focus. They're entering the global biologics CDMO business, and that is going to be taken as a key positive. So a thumbs up on this one, for which they've acquired US-based biologics manufacturing facility from Agenus. Apart from that, the cost of the acquisition is around $75 million. That's an upfront money, plus $50 million will be contingent payment over the next 3 years. This gives access to advanced manufacturing capabilities as well as a presence for Zydus in California, which is a biotech hub, so that becomes important as well. And the CDMO business will operate as an independent entity. The company will be exclusive contract manufacturer as well for Agenus, and they will have the first right to negotiate manufacturing for the company. If you talk about the global biologics CDMO market as well, $84 to $85 billion is what it's projected to be by 2034. So a strong one coming in there, and they've also acquired rights for the company's cancer therapies in India and Sri Lanka. So that's a potential business that they're looking at, where they will be paying 5% royalty as net sales upon successful approval and commercialization. So 2 pharma names, 1 positive, 1 negative, Tamanna.
Okay, I have an auto company on top of my list, one which has not been having the best of news. And there is a note today from Morgan Stanley saying that Tata Motors really needs this win, needs a win, and I couldn't agree more. But anyway, on the basis of what they've launched, the new Harrier EV on a new Active Plus platform, it is a thumbs up for Tata Motors. Morgan Stanley is saying they remain equal weight on it with a target price of 715. That's an upside of close to 1.5%. Because they have launched the Harrier EV on its new Active Plus platform. The Harrier EV and Sierra launch, which will come in the third quarter in FY26, will be a key to watch. As far as the ICE engine is concerned, Harrier sells about 5,000 units per quarter. They will need to see how much of EV adds to that. And they say Tata Motors definitely needs a win. Another point that Morgan Stanley makes, which I think is important, is that competition is now going to heat up in the SUV EV space. So that's something which could be a headwind for Tata Motors. But basis on the launch, I think it's a thumbs up for them. Yes Bank, meanwhile, also a thumbs up from my end. The board approved raising funds up to 16,000 crores via debt and equity. The bank will raise 7,500 crores from equity and 8,500 crores from debt securities. Even as there's no clarity right now, what will be the composition of the new board, of course, with the investors coming in. CEAT is the other one, thumbs up. They had an investor day and a clutch of notes on CEAT. So So the big takeaways are that they're targeting the passenger car radial tire market share of 17 to 17.5% versus 16% now. So a clear aim from the management. They aim to grow domestic market share to 13% versus 10 to 12% now. Camso acquisition has strengthened CEAT's position in iron construction tires. Potential margin gains in the second half is what they see, with commodity prices subsiding, and FY26 exports outlook is positive, led by growth in Europe, Middle East after a weak 25, FY25 that is. What is Nomura saying? Nomura maintains a buy with a target price of 3,945 rupees. They expect 11 to 13% revenue CAGR from FY25 to 27 and a high margin off-highway tire mix to rise to 25% by the second half. They say that the stock valuation is inexpensive at 7 times EV to EBITDA. Nuvama has maintained a buy on CEAT, target price of 3,800. They say combination of Camso and CEAT provides a comprehensive coverage of off-highway tire space, building in a revenue EBITDA CAGR of 14, 26% respectively over FY25 and 27 estimate. So that's the word coming in on CEAT. In fact, MK has the highest target price, I think, of the lot, 4,100 rupees on it, saying that the margin revival looks promising. So that's something to look out for. The others which will have a bit of pressure are the block deal candidates. It's raining block deals. Mahima is telling us what's going on.
Right, so it's definitely a day for block deals today, and we have 4 block deals that are expected on the street, 3 of which are cleanup trades. To start with, the 4 block deals, Indegene is the biggest one, where around 1,420 crore is the amount for this block deal, and around 10.2% of equity is expected to change hands. Tata Tech is around 635 crore block deal, and 2.1% of total equity is supposed to exchange hands. So Indegene, Tata Tech, and overall, ABFRL are the 3 cleanup block deals, where ABFRL around 600 odd crores and 6% of overall equity, and Alchem is 825 crore block deal, and around 1.4% promoter stake sale is taking place here. Now let's get to the details of each of these. For Indegene, the total before that, the total value of these entire 4 block deals stands at around 3,480 odd crores. Moving on to the details of these block deals, in terms of Indegene, the floor price is set at 480, which is at a 6.4% discount from its yesterday's closing, and the number of shares that are expected to change hands is around 2.4 odd crores. The next one, let's pull up that Tata Tech. The floor price is set anywhere between 744 to 767 per share. The discount should be anywhere between that 0 to 3% mark. Since this is a cleanup trade, the number of shares expected to exchange hands is roughly 8.5 lakh, and percentage of total equity is around 2.1. Alchem is the next one, where promoter Jayanti Sinha is set to sell around 1.42% equity via the block deal. She currently holds around 2.46%. The current promoter holding stands at around 55.13%. So once this stake sale happens, the promoter shareholding will reduce to around 53.71%. In terms of the overall details, floor price is set at 4850 per share, which is at a discount of around 2.9%, and number of shares that are expected to change hands is around 17 lakhs. Lastly, ABFRL, the total amount is around 600 odd crores, where around floor price is set at 79.5, which is at a 7.6% discount from its yesterday's closing. But here, Flipkart is expected to sell its entire stake sale of around 6 odd %. So this again is a cleanup trade. So all of these 4 stocks will be something to watch out for in trade today.
Okay. So more block deals on the anvil as well, as we're hearing, but of course we'll get you details of that as we see. We'll take a very short break, but let's look at the implied quickly before we get into that break. We're coming back with top trading strategies for you. What should be the levels on the Nifty that you should look at, and what should be the top picks of the day? All of that when we return. The implied on the Nifty, nearly 50 points in the green.
Markets move fast.
And so should your portfolio. Expert insights, real-time stock picks,
Do I buy Ola?
Should I
or
hold
lifetime
ICICI
investment?
CDSL for the long term?
buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind?
Welcome back. You're watching India Market Open, and we've got Somil Mehta and of Mirai Asset Sher Khan, as well as Mayuresh Joshi of MarketSmith India joining us this morning. Gentlemen, it's a little bit overcast and dull and dreary, so I'm trying to lift the mood with a little bit of energy this morning. Somil, give me some good news. Is there likely to be a breakout, or are we likely to languish in this very narrow range that we've been trading in, and we've been shifting lower actually on the benchmark?
There's no good news actually. I still think that the markets are going to be range bound. We've had a very good rally in the last a couple of months, and it's very normal to halt. It's very normal to take a break, stay in the range while the stock specific or sector rotation goes on. There are a lot of stocks which are doing really well, and there are a lot of stocks which are correcting a little bit, and that's the reason we are in the range. Nifty, as we know, it's in a range in last 4 weeks. This is the 4th week we are in the same range between 24,500 and 25,000, and I don't see this range breaking out very soon. I still think that the markets are going to be range bound market. But however, the good news is that we are at the lower end of the range, right? So if we are at the lower end of the range and we are opening positive today, so we will be heading towards the upper end of the range, which is closer to 24,800 than 25,000. So buy on decline should be the strategy. There are a lot of stocks which are really doing well. Previously, we had defense doing really well, and then metals were doing really well. Reality picked up, reality infra picked up, and now other stocks like I think railway and power would be picking up very soon. So sector specific, stock specific would be the focus, not Nifty and Bank Nifty. Similar with Bank Nifty as well. Let me give you levels for Bank Nifty. Bank Nifty 55,000 would be a very, very crucial support, which is the 20 daily exponential moving average, and 56,150 would be a very crucial level to watch out for, which is yesterday's high. Anything above 56,150, I think we are heading towards 56,800. So buy and decline should be the strategy. Focus on more stocks and sectors rotation.
I guess it is human nature and wishful thinking, in situations like this to look for that pocket of sunshine. But what would you pick this morning, Somil? What are your picks?
My picks would be a little bit from FMCG. FMCG anyways is looking good. So Colgate would be my pick. From one from the financial sector as well, M&M Finance. So M&M Finance has broken out of a small triangle pattern on the upside. So stop loss would be 258, target would be 280. Colgate is forming a small ending diagonal pattern on the daily charts. I'm preempting this, and I'll be expecting this pattern to break on the upside. Stop loss would be around 2420 and targets would be around 2600.
That's an FMCG pick coming in, Somil. In fact, let me go to Mayuresh. Mayuresh, good morning and welcome to the show. My first question coming to you is the kind of technical texture that you're seeing between Nifty and Bank Nifty is very divergent. But if you have to look at a fundamental perspective, do you think this is the best time to start looking at banking names? And we have the policy as well, which is on Friday. So what's the setup looking like, and how should you trade the RBI policy?
Morning, Hiral. I think two ways of looking at it. I think the expectation largely is that the central bank might have 2 rate cuts over the next quarter or so, or the next 6 months, a couple of quarters. And therefore, I think that is getting gestated by the markets. A lot of liquidity has already been provided by RBI into the system as well. Having said that, I think the base case scenario for the banking sector as a whole remains constructive based on the fact that the CASA deterioration that we've probably seen for the sector as a whole should largely be behind us. A lot of the larger banks have been very, very careful in terms of their underwriting. And therefore, if you read through the commentaries of banks like ICICI and HDFC Bank, they have been a tad bit more careful, at least in the previous quarter. But I think that should start picking up as consumption and consumer durables along with discretionary starts picking up as well. The MSME, SME woes also should largely be behind us as we head into the second half. And therefore, I think the credit deposit ratios should show signs of improvement with deposit growth also picking up to a certain extent, giving relief in terms of the liabilities as far as banks are concerned. And therefore, strong liability franchises will continue doing well. A lot of banks have done significant amount of provisioning onto their balance sheet. Asset quality deterioration, which has been arrested over the past few quarters, continues to show strength. And therefore, our own sense is that banks might be a sweet spot. Yes, it's a consensus call, but I think earnings might continue doing relatively better compared to the rest of the pack. And as India grows, with government capex coming through, private capex expected to come back, I think the banking system will provide a lot of support. So I think large private sector banks is something that we still remain constructive about. Public sector banks valuations are reasonable, very, very reasonable to say. And again, I think a lot of parameters are also matching them as well. And even select NBFCs, because if you're going through an interest rate cycle, I think the high quality NBFCs, which have a better borrowing mix and better credit ratings, might actually perform well in this environment over the next few quarters.
Yeah. No, another story that should be on our radar is a report which says that the Adani Group is mulling bidding for airport ground service contracts at the Mumbai and Ahmedabad airports after the Turkish firm Celebi's contract was terminated. Anushi is joining us with more details.
Okay, so the interesting development, this is according to the report that we are looking at, is Adani is mulling entering airport ground services. This is after Celebi's exit. Now they are evaluating bids for 2 airports, that's Mumbai and Ahmedabad. So Adani will be the third ground handler of these facilities if it does win the bid which we are looking at. Now do note that Indian regulations require 3 ground handlers for major airports with more than 1 million of annual passenger traffic. So this is an interesting development coming here. Again, if we look why this foray, so this foray is in line with company's strategy of branching into allied sectors of the existing businesses which are already there. Do note that Adani Airport Holdings currently operates 8 airports, which includes the upcoming Navi Mumbai one as well. Now, again, on what has happened so far, company expects to fill this gap post the Turkish operator Celebi's exit, which took place after Turkey had supported its support for Pakistan on the recent geopolitical developments which took place. Celebi operated at 9 airports in India, which included gateway facilities in New Delhi, along with commercial hub of Mumbai as well. So this is an interesting story that we are looking at, and that's why it should be in focus.
All right, thank you for that, Anushi joining in on those details. Somil Mehta and Mayuresh Joshi still with us. Somil, wanted to get your take on some of the private banks, and I know Mayuresh spoke about it as well, but Federal and Yes specifically, also because there's strong fundamental reasons for what's happening here, turnaround stories, new management coming in, that's sort of the lifeblood driving these two stories. How do you see them on the charts?
I think for Federal, definitely very bullish in the medium-term outlook, in the medium to long-term outlook as well. I'll be looking for a target of at least 250, 260 levels from these levels. It has the bounce which we have seen from 172 levels in the last 2 to 3 months. It has been impulsive, a 5-wave up and then a corrective. Then the highs have taken off. So I think this breakout is a very crucial one in the medium term outlook, and I don't see this 182 levels breaking on the downside. So that will be a very crucial level to watch out for as a support in the medium term outlook. And on the upside for Federal Bank, I'll be expecting 250, 260 in the medium term. For Yes Bank, I'm still very still negative on this stock. We've seen low top, low bottom on the medium term charts like monthly and weekly charts. Till the time we don't break above a few crucial levels, like 27 is a very crucial level to watch out for, which is the previous swing high. Till the time we don't close, Yes Bank does not close about 27, 20, 28 levels, I will not be very positive on the stock. I'll suggest to avoid this stock definitely. On the private sector banks, I think Axis Bank, ICICI Bank, HDFC Bank, and Federal Bank. Federal Bank will be my top pick from these ones.
Right. All right. So that's the view on a couple of these private banks. Speaking of private banks, and I know, Mayuresh, you just spoke about them, but specifically on this HDB financial approval for the IPO, I described it. I don't know if you heard it, but I'll repeat it anyway. It's like finding money in your pocket, right? So it's 10,000 crore for HDFC Bank in the largest scheme of things, not going to move the needle. It'll sit in their tier 1 capital, which, for tier 1 capital stood at 17.7% based on their current trajectory of growth. It's not like they need it. What's your view on it?
Absolutely right. And again, I think HDFC Bank has such a huge base, Alex. But again, I think it does incrementally add in terms of value as well, because on a sum of parts, you could probably ascribe certain elements on how HDB Financial would have been functioning. I think it was always assumed to be an element of HDFC Bank. And now, since it's coming through, I think there will be some definite value that can get added. However, it doesn't move the needle. You're absolutely right. I think the core fundamentals obviously are something which are going to drive the price action for HDFC Bank. And in my own sense, again, I think large private banks should do well. So again, anybody holding HDFC Bank should continue.
Right, so that's with an HDFC Bank. But moving on to the auto space, you have a Tata Motors. They've just launched the Harrier EV, currently priced at 21.49 lakhs. In fact, the company's market share has declined as the market has grown. Moreover, as the market expands locally, China's magnet curbs prove to be challenging as well for EV expansion. My colleague Tushar spoke to Tata Motors President Shailesh Chandra about how Tata Motors intends to protect their market share. Let's first quickly listen in to that conversation.
Electric vehicle market is now also getting a bit fragmented with more options coming at different price points at different sizes also. So there are 3 segments I see, sub-segments. One is the city segment, city car segment, which is less than 12 lakh, where you are still getting 250 kilometer kind of a range product. Then you have the mid-size market where all the competition, all the players are positioning their car, which is 20 to 25, 12 to 20 lakh segment. And then you have this segment, which is about 20 lakh. And therefore, there are specific actions that we are taking in all these segments in the short term to increase the value proposition so that it becomes more compelling and it hits the sweet spot of price, range and feature, which should help enhance the volumes in these segments. And this is a new entry into the third segment where we were not present. We have this first product and then later on the Sierra EV will also come. So we have positioned two products in each of these sub-segments. and therefore with that approach in short term also we should be able to therefore grow not only our volumes but market share, and in mid to long term we would further renew the entire portfolio, which should help us in mid to long term come to a steady state market share of about 50%. There's dependency on the rare earth both in the ICE world as well as EV world. As far as we are concerned, I don't see an immediate impact. But SIAM and ACMA both are very closely working with the government. We are getting all kind of support. We are hoping that this gets resolved fast.
Yeah, the availability of rare earth from China, that is becoming a major concern with regards to EV players from a production perspective. But in fact, your Morgan Stanley also has gone ahead and initiated coverage on Tata Motors. The target price very similar to the current market price of the company. But let's understand what's the rationale that Morgan Stanley has with regards to the initiation. Puneet is with us. Puneet, what are you picking up?
Well, thank you for that. So they've specifically also written about the Harrier EV as well. The target price of 715 is what Morgan Stanley says, and there are three key points they're making in this report. The first one, the features as well as lifetime battery warranty is impressive for this particular launch. That's what Morgan Stanley's first view is on this launch. Second key, they've said that the Harrier currently in the ICE, which is the petrol variant, sells almost 5,000 units in a particular quarter. Now, this will of course add to more volumes for the Harrier brand, and it could be positive. But they've gone on to say that the competitive intensity is expected to rise in EVs, especially in the four-wheeler electric vehicle space in this particular year. We've already seen two launches from Mahindra on the private side. We've seen MG come back, as well as Maruti launching the EV in September. So that could be a key one. And the third and the final point, they maintain that they say that Tata Motors needs launches like the Harrier EV and the Sierra to work to be a key winner in this space. So they are largely maintaining a very flattish view as of now, with the target price also 715 rupees per share, and maintaining a key watch on these two launches.
With regards to Tata Motors, very quickly, let me come to Saumil. Saumil, how are you looking at Tata Motors as well as the other stocks as well? Because you did see a good surge that did come in terms of an M&M. What are charts indicating?
I think Tata Motors still remains very sideways. I'm still expecting this stock to consolidate, make a base around these levels, 700, 650 levels, and then break this breakout from this basing out pattern on the upside. But at this point of time, Bajaj Auto, Hero MotoCorp, Tata Motors all look very not interested. Actually, it's still not giving that momentum, or it's not giving that feeling that it would break out from these levels on the upside. It is still on the basing out pattern. However, M&M is looking good from these levels. TVS Motors is looking good. M&M, if we focus on M&M. M&M is a very good short-term trade, medium-term trade, a good support at 29.50, and the next support is at 200 daily exponential moving average, which is around 2800. On the upside, I'll be expecting all-time highs to be taken off, and on the upside, the target should be around 3400 in the medium-term outlook.
All right, on that note, let's slip into a very quick break. Gentlemen, do stay with us. On the other side, we have the pre-open session, more stocks to talk about. Do stay tuned. Markets move fast,
and so should your portfolio. Expert insights, Real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live. Ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Welcome back. You're watching India Market Open. Implied Open is still indicating that 50-point uptick so far. But staying with the auto pack, you have the Class 8 truck orders that did come in. Though you've seen a fall of around 44% on a year-on-year basis in the month of May, the total number has come in at around 12,000 units. Now, in fact, it will be a YOY increase, is 40% increase from the April month number as well. So, year-on-year, though you've seen a decline, a modest recovery that's coming in on a month-on-month basis is what we need to look at as well, because it does provide some bit of a relief as well. Apart from that, if you talk about the 7-year May average, that is at around 18,319 units. So you will have a RK Forging, a Bharat Forge that will be in focus in today's session. Let me in fact very quickly go to Mayuresh and take his view. Mayuresh, muted moves in terms of Class 8 truck orders over the last couple of months, but a slight bit of an improvement that is coming in from April to May. Does this give you relief, number one, and do you think this could be an opportunity to look at any of these stocks?
No, so Hiral, I think there has to be some element of consistency expected to come through, and with the kind of micro headwinds that we are probably looking at, and the uncertainty that still grows, whether it comes to tariffs, whether it comes to the tax policies, I think the businesses there are taking it on the chin, and therefore I think it's in wait and watch mode for a lot of businesses based out of North America, and therefore I think it will be a wait and watch mode as far as consistency in order delivery is given as well. Obviously, I think for a stock like Bharat Forge as an example, I think the diversification in terms of the non-Class 8 trucks getting into defense, the other markets as well is a positive. Similarly for RK Forging, I think they're getting more into machining. So from the commoditized fabrication, they're getting more into specialized fabrication. However, I think it does not change the core fundamental tenets that until the business sentiment probably improves consistently, I think a question of re-rating probably just gets deferred or has a lag effect over the next few months. So I think it's a wait and watch for these things.
Okay, Chandan Taparia joining in. He's Head of Technical and Derivatives Research at MOFSL. Chandan, great to have you on, and a very good morning to you. Of course, Somil stays on with us. Chandan, let's start with what are the levels you're seeing here? Because a struggle really for the Nifty to break out.
Good morning. Thanks for having me. So, market witnessed some profit booking in last couple of trading session. However, Bank Nifty made an attempt to hit the new lifetime high, but momentum was not getting in the bullish side, and it got stuck in a range. Nifty started to form lower top, lower bottom on the lower time frame. But the good part is that still we are in a consolidative phase. However, the put call ratio fell down, and 25,000 call writing is quite active. So because of that, data setup are slightly drifting lower with the market range. But I believe that 24,442, which is working as a key level, again may provide some sort of support to the market to attempt for buy on decline stance. So my entire stance will be whether the market holds 24,442 or not. So with that view, I believe we have to play the range between 24,200 to 24,800 zone with a mixed set of cues on the Nifty index. While in Bank Nifty, I still believe that our performance could continue. However, all major names, including SDFC Bank or ICICI or Axis, got stuck in a range. But upcoming RBI policy could be the key trigger. Here, buy on decline could continue. So more bullish on Bank Nifty with support of 55,000 and the Nifty index as of now.
What are the top picks you're looking at today, Chandan? Anything that you're liking?
Yeah, so first setup is buy on BML, positive on the defense theme. BML has given a consolidation breakout of last 6-7 days. Technically, a bullish pole and flag breakout on the daily chart. So expecting further momentum as this sector is comparatively doing well. So with support of 42.30, one can look for a buying interest towards 44.50 to 4500 levels. Second trading area that will be buy on Federal Bank. Here we have seen a consolidation breakout of last almost 25 weeks. It has given a decisive hold about 205, 208, and momentum is clearly visible with formation of higher highs, higher lows. Even the rollover data was positive with build-up of long positions, so suggesting to buy with support of 206, and Federal Bank can attempt towards 218, 220 marks.
Garden Reach is another one that's interesting. I just want to see what Garden Reach is doing pre-open. Pre-open rates have hit and we'll wait for them to settle. But some early movers that are appearing, including Sterling and Wilson, etc. Garden Reach about 0.5% up right now. So they've signed an MOU with Norway's Kongsberg to build their first ever polar research vehicle for India. Construction of the vehicle will take place indigenously. Vessel will support India's scientific missions in Arctic and Antarctic for climate research, oceanography, and polar logistics. Very interesting, emergence. It's an order value of and actually the order value is not mentioned. Their order book is right now 25,000 crores. I wonder, Chandan, since you talked about BML, is Garden Reach something you're looking at as well?
Yes, so positive on the GRSC, but the stock has gone into the different leg of rally, has been continuously making high tops, high bottom, one of the strongest counter in the entire sector, and the stock is up by around 95% in last 5 months, and we have seen year-on-year basis really from last 4 consecutive years really well from 200 to 31, and I believe still momentum is intact. The stock is making high tops, high bottom. However, risk reward ratio might not favor, but strength is intact, and I believe till it holds about 29.50, one can continue to hold the long position for next leg of rally towards 3,500. So positive view on selective shipping name, and GRS is likely to see the buzz with positive momentum and the strength.
All right. Now, we spoke about this briefly earlier. HDB Financial Services received the go-ahead from the Securities and Exchange Board of India for its initial public offering, and they filed their draft prospectus, of course, in October last year. Who stands to gain? What should you bear in mind? Harsh joining in to tell you all about that. Harsh?
Well, yes, here's all you need to know about the IPO. Let's look at it. Why so much of a fuss? First off, it's a large IPO, so it's a large size, but outside of that, it's an NBFC promoted by HDFC Bank. So that's, of course, the big headline, and HDFC Bank currently holds around 94% in the entity. Let's talk about the IPO details as well. It's around a 12,500 crore IPO. The offer for sale is around 10,000 crore, which HDFC Bank gets, and a fresh issue of around 2,500 crore is what is in store. The price bands, of course, yet to be announced. So something to keep in mind in terms of how valuations will stack up for this one. Incorporated in 2007, a little bit about the company. Retail focused NBFC has around 1,800 odd branches, presence in around 31 odd states. But let's also talk about the book that it has. Around 71% of the loans are secured. So one is it's into the lending business, of course, but outside of that, it does all of these other services for HDFC Bank as well as some of the other group entities, as well as for all of the customers. So sells various products as well. That's the gross loan book as at the end of H1 FY25, mind you, and that's the mix of loans. Enterprise, asset finance, consumer finance. Likely the consumer finance bucket is the unsecured bucket. So that's how it stacks up. Let's look at some key financial metrics. Gross loans have gone from 61,000 crore to around 98,000 crore, which is around a 21% CAGR growth. The net worth also following suit. The ROE has been 16%. It's fallen a little bit in the H2 of FY25, but that's the ROE number. The full year FY25 number is around 14 odd %. The NPA ratio is at around 2.8%. 0.8 odd percent, and the net NPA ratio also at around 0.9 odd percent at the end of FY25, mind you. Let's look at how the income statement metrics stack up. That's how they do. You've seen a decent growth on profitability when you're looking at the H1 number annualized, but when you're looking at the FY25 full year number, you're largely seeing a growth of around 30 odd percent on the bottom line of HDB Financial. Let's also zoom in into what is in store for HDFC Bank shareholders. One is there's value unlocking which will happen, and HDFC Bank will receive 10,000 crore from the OFS, which is around 0.7% of market cap. They also have a reservation of 10%, up to 10% rather, for HDFC Bank shareholders. So that's the sum and substance of this one.
Okay, stay on with us because it's also that time of the morning when we get you the big brokerage call, and the focus today is on Bharti Airtel. Macquarie has come up with a note on telcos with an outperform rating for Bharti Airtel. Harsh is joining us for more details on that.
Well, yes, they've lifted the target price to 2,050 rupees a share, which offers around a 14 odd percent upside. They believe that there's going to be an improved odd of a bull case playing out. They've hiked their bull case estimates as well. I'll quickly take you through it. They reaffirm the positive view on telecom. Higher free cash flow and improving ROIC outlook is what is driving this increase in target price. The bull case, they say, ARPU at 300, apply a 15 times EV EBITDA multiple. The SOTP arrived at is around 2,350 rupees. So substantial upside if you're looking at the bull case scenario. They give this a 40% likelihood in terms of weightage. So a decent likelihood in terms of this playing out as well. The base case too, not too far away, around a 290 rupee ARPU and a 13 time EV EBITDA multiple likely to play out with a target price of 1,920. So even the base case not looking too bad. Factors to look out for, of course, in this one is tariffs and a possible listing of a peer, which is Jio, and that could also be positive for the industry as well as this company in particular, which is Bharti Airtel. The target price implies a 4% free cash flow yield is what Macquarie says. 11 times EV EBITDA at the target price 2,050, 32 times price to earnings is what they ascribe to this one.
Right, so that's with regards to Bharti Airtel. Thank you, Harsh, for taking us through these names. Chandan, let me come to you with Bharti Airtel, Vodafone. How are you looking at these telecom majors, taking into consideration the way numbers have come in? In fact, we did have an exclusive interview with the telecom minister as well, where there are, moratoriums being considered with regards to where AGR dues go as well. But that's the fundamental perspective. What are charts indicating?
Yeah, so if you look at the chart, Bharti and Bharti Exa, both the counter looks quite promising. To talk about Bharti, it has been consolidating the range, and the good part is that supports are intact. We have noticed sustained put writing at 1800 strike, and even in the recent decline, it managed to hold 1800 marks and now trying to attempt the next leg of rally towards 1900. Major trend of the counter is positive. However, in the last month, we have seen a consolidative move. Before that, it really rallied well in the month of March and April, rallied well from 1570 to 1900 marks, and I believe the consolidative move of last 1.5 months could attract the fresh leg of rally. So one can buy with major support of 1800. This time Bharti has potential to rally towards 1900 to 1950 marks on the higher side.
Okay, so Bharti Airtel in focus. Let's look at some of the movers in early trade and look at what's moving there. Techno Electric is something that I see buzzing. On the Nifty, Adani and a State Bank of India showing some signs of action. Okay, that's the Techno Electric stock there. They have been shortlisted as a key vendor by the Indian Railways to manage their data center. So that's the reason that you're seeing that. Apart from that, HUL not doing too badly, nor is Bharat Electric. But if you see at how the pre-open rates have settled, it's looking like a very, very quiet start to the morning. What is that one thing that you would be looking at as an opportunity, Chandan? And for example, would you look at a Sun Pharma at all? The news that they have had to discontinue one of their clinical trials will weigh on the stock possibly at opening. Would you see that as a buying opportunity?
So the pharma counters are not in trend and momentum. In fact, most of the pharma counters are witnessing some selling pressure from higher levels in last couple of days. We have noticed that only two sectors were not performing in the recent market momentum. One is the pharma, second is IT name. So I believe it requires some sort of consolidative move or any trigger which could lead to the counter to higher side. In fact, the stock is trading well below its 50-day exponential moving average. If it holds below 1650, I believe it can open the downside, which can take it to even lower side. So till it remains below 1650, look for 1550 kind of level. But if I have to pick only one pharma, then I believe Glenmark could be on my radar, where I've seen a consolidative move with a decisive breakout above 1470. So buy on decline with support of 1470 can apply in Glenmark, while I'll avoid Sun Pharma. Let it settle down and may find the support near 1550 before going for bargain hunting in the counter.
You know what's interesting over here is you're not seeing a major downtick in terms of Sun Pharma, but a spark in pre-open is indicating a downtick of almost 5 to 6%. So I think Spark also should be looked at pretty closely. We'll understand what the deal is between both of them and if any correlation with regards to the trial that has been discontinued. So watch out for Spark also in trade. But apart from that, Zydus that is in focus on the back of the CDMO business foray that they are looking at, 0.9% higher on this one. Very quickly, Saumil, as the pre-open rates are indicating, anything that comes to your radar, quick 30 seconds.
I would be focusing more on railway stocks like RVNL, IRFC, IRCTC. I think they are consolidating already. However, I'll be expecting a breakout very soon, probably in a couple of days, but today might be the day. So IRFC, RVNL and IRCTC.
Interesting. A rail stock recommendation has been heard after a while. Chandan, any big pick after the pre-open session as we hit rates in 14 seconds or so?
I think better to focus on selective capital market theme and counter for shipping. So look for MCX buy with support of 6750 for target of 7800. Target for 7200. GRSE can be bought for a target of 3300.
GRSE in focus, like we told you. They're going to make ships that can look at explorations in the Arctic Circle. Well, it's blowing pretty cold in the markets this morning. You have an up move, but barely so. Hardly 30 points up on the Nifty. Nothing much happening there. IT stocks are doing okay. Just want to look at what mid-cap and small-cap are doing before we move ahead. Bank Nifty relatively not bad, 0.25% up. Not bad at all this morning, but nothing major. It's a quiet start to the morning. It's going to be all about the specific stocks. We've been telling you this is a stock pickers market now. We've moved into that momentum. Let me pull up the Nifty heat map for you before Alex comes in to tell you what's happening on the broader markets. On the losing side, you have a TCS. You had a pretty good run in the Nasdaq yesterday, but TCS seeing a bit of pressure over there. Sun Pharma, they have had to discontinue a clinical trial of theirs, and that's dragging down the stock, but barely so. I would say it's not a negative advanced decline ratio at all on the Nifty, more green than red. That is heartening. The India VIX also just mildly up and below 17. So everything is set for a positive breakout, but that one push is required. What's moving this morning on the positive side is the Shriram Finance, 1.5%. Yet second consecutive day when it has had a strong opening. Eternal doing pretty well. Bharti, we talked about the Macquarie note on it. It was our big brokerage call of the day. If you saw that, you would have been well prepared for the up move on Bharti. Bajaj Finserv not doing too badly, and a clutch of private banks also moving up this morning, including an IndusInd Bank. So these are going to be on the radar. I'm sure Alex will talk about a federal bank and a Yes Bank and some of those others which have news flow coming in. But the range, as you can see, is fairly narrow, Alex. Nothing major happening on either side. A bit of pressure on metals, like we told you. You're seeing JSW Steel slide down to some extent, but Tata Steel doing okay. Heavyweights also not participating. Very, very quiet start this morning.
Yeah, no doubt. And I guess to a certain extent we were anticipating this, that range continues to be holding. And we're holding above, of course, that 500 mark, 24,500 mark. But the 24,600 mark becomes an important barrier because of the kind of call writing that you're seeing at that level. Let's talk about individual stocks. So actually, before we do that, let's look at the sectoral heat map, just to drive home what we're talking about. And I doubt there's going to be too many big movers, but there's quite a bit of green on the screen, which should give you some heart at this time in the morning. The India Defence Pact continues to march higher. Yesterday in trade, it had 1% plus of gains and another 0.5% higher this morning. Quite a story. Now, what else is moving? Infra as a pack is doing okay. Healthcare is up about 0.33%. No big movers. IT just 0.2% higher. Consumer durables and realty just about flat. So nothing losing ground too badly and nothing gaining tremendously either. Let's take a look at a few stocks that could be moving quite dramatically. And you might have seen some of those updates on the bottom of the screen in the way of the large deals that we were telling you about. And let's pull up those 4 names at the start. Indegene is one of them. It's losing ground on the back of that clean out trade that Carlyle has announced. Over 10% is what they've sold. It should eventually be seen as something positive because that overhang of further sale should be taken out of the picture. Alchem Lab has seen a 1.4% odd stake sale that has taken place. It's down about 0.5% or so. Promoter selling there. ABRFRL is losing ground at the start. It's down about 8.4% as well, and Flipkart selling its entire stake in the company, and so therefore should be watched closely. Tata Tech also losing about 0.75% or so. Let's move on and talk about a few other stocks then. We've got CEAT that should be reacting to analyst meet. A lot of positive commentary coming through from here. Margins improving going forward, certainly something that is seen as positive, and the valuation picture is not looking too challenging. Zydus Life venturing into the biologic CDMO space through an acquisition it is making, up about 0.9% and doing reasonably well. Servotech Renewable, order of 33.6 crore rupees. It's moving quite substantially, but do remember this is not a very large stock, and I would hazard a guess to say that the float is not very large either, and so therefore you could see a very aggravated and accelerated reaction to what is not a very large order. Ashok Leyland also, not the biggest order, 184 crore rupees or thereabouts, but reacting positively, up about 0.33% or so. And finally, Garden Reach Shipbuilders, we spoke about this at the start of market trade. It's doing quite well for itself, up about 6.5%. It's venturing into uncharted territory, breaking ice in the North Pole, and that's doing well for the stock. Tamanna.
Few there. I just want to talk about the block deals. Motilal Oswal has seen about 0.6% of equity change hands, and that stock buzzing this morning. If you can just pull up the block deals, and Motilal Oswal about 3.5% up. All of the other block deal candidates are also seeing action. Tata Tech, that has been executed now, Alchem, Indegene, the biggest one being ABFRL. So these are some of the key movers this morning that we have to talk about as well. Let me just get a quick view from Somil. Obviously, you're going to see selling pressure just because of the sizes of these block deals, but are you seeing opportunities or any of these that you're liking on the charts apart from the block deal aspect playing out?
GRSC looks a little interesting, but overall, if you see, just give me a second. GRSC looks definitely interesting. It has broken out of a good consolidation in the medium term outlook as well, trading about 20-40 daily moving average, high top, high bottom formation. The momentum indicators on the higher degree time frame are on the buy side, so I'll be expecting good momentum on the upside, and higher targets of around 3,600, 3,700 in the medium term outlook. The support would be around. It's a little deeper. The stop loss would be a little deeper because we've seen very good run up. So 2,600 would be a support, and 2,800 would be a support again. So deeper stop losses, but higher targets. 3,600, 3,800 would be our targets in the medium term outlook.
Yeah, with markets. One quick one I want to alert over here is a Spark. Let's just pull up that one on the screens on the back of the trials that Sun Pharma has stopped. Spark is taking a beating to the tune of almost 11 to 12% because Spark is the R&D arm of Sun Pharma. In fact, both the companies will now evaluate the next steps as well with regards to the compound. Mayuresh, yesterday we spoke to Wockhardt as well, but they are indicating the kind of drugs that they are sitting on in terms of innovations. Probably 3 years is what it will take them to come back to that 4,000 to 5,000 crore trajectory, what they saw back then in 2013, 14, 15. And now you're looking at a Sun Pharma, both the counters taking a beating because of one of the failures that they've seen currently. How would you look at this space and your views on both these stocks?
No, Hiral, you have to take it with a pinch of salt because it goes through clinical trials in 3 phases at that. And therefore, I think the kind of R&D expenditure that comes through, specifically in making a specialized pipeline, does take both a time and a cost effort. And there might be overruns on both these elements put together. However, I think if you look at the pipeline that Sun Pharma probably has, that they've put through their press release, a couple of their drugs are expected to go through phase 3 trials and the FDA approval consequentially. And therefore, I think the pipeline that these leadership stocks have created on the specialty drugs, whether it's Sun, whether it's Dr. Reddy, Cipla, is something to be monitored closely. And as approvals come through, the revenue exclusivity with better margins will actually mean better numbers coming through in the next few quarters. Obviously, FDA concerns are there for each of these stocks under consideration, and how they get resolved is going to be a potential trigger. However, I think from the mid-cap space, one stock that we continue holding in our global portfolios is Strides Pharma. And our belief is that the numbers were extremely good. The expectation in terms of the US revenue is actually touching 400 million. They've done 296 million this year, means an exponential growth. They're looking at the nasal spray approval coming through from the FDA as well. Around 15 to 20 drugs expected to come through. Superior margin, strong balance sheet, regulatory markets expected to do well. And therefore, the outlook probably seems a tad bit better off within the mid-cap space, outside the leadership stocks that I probably discussed.
Thank you so much, Mayuresh, for speaking with us this morning. Mayuresh Joshi there, talking about Strides Pharma and some of those other factors. Let me come to Chandan with a question I actually had asked Somil. Some of these block deals, and Chandan, clearly you are going to see some pressure here, an ABFRL, if I look at an Alchem, or Tata Tech, are these buying opportunities by any chance?
So again, let me reply by my way that we are recommended to buy on GRSC, and I have positive view on the entire shipping and defense theme, expecting next leg of rally. However, it has rallied by 7%, but I don't be surprised if the stock hits further 8 to 10% on higher side. In fact, positive on the other shipping name, whether we look at the Mazdok and all. Now to reply on the name which you asked, I believe we have to be very specific in this market scenario, but selective counter from the mid cap and a small cap are on the budge, and those counter could be in focus. However, the name which I prefer in this market scenario could be the Paytm, GRSC, or capital market theme. In fact, we have seen some block and bulk deal in selective names, so those names could be on budge and highlight. And I believe this is a good market for the stock specific approach rather than talking on the index and the broader market perspective.
Okay, so GRSE is good stock spotted this morning, and the zooming 7% up. Paytm not doing too badly. Some news coming in on Paytm as well. Maybe the clouds are lifting as far as the Paytm is concerned. Somil, are you looking at a Paytm with any interest right now?
Paytm definitely. We've been recommending this for a little while. It has broken out of a small triangle, and this triangle target should be much above the previous swing highs of 1050, 1060 levels. So it's crucial supports around 20 and 40 daily moving average, which is around close to 850 levels. So 850 remains a crucial support for the stock. However, on the upside, short-term, medium-term outlook remains positive. I'll be expecting the first targets of around 980, 990 levels, and then 1060 in the medium-term outlook.
Okay, so 197 Communications in news because it's ARM, Paytm Cloud Technologies has incorporated its wholly owned ARM Paytm Singapore. No reason really fundamentally for that stock to do much, but it is seeing an up move there this morning. Chandan, just your view on a Paytm this morning as well, because this is one of the key movers that we are seeing. We also spoke about a Cochin shipyard. Let's also look at a Cochin shipyard because you're seeing defense coming back into play, and a Swiggy if you have any move or any take over there. By the way, your recommendation BEML, your stock BEML is also not doing too badly this morning, Chandan.
Yeah, so in fact, one need to focus on BML now. I believe the immediate surge of 2 to 5% cannot be ruled out given the price scenario. We have given the target of 4,500. I think that is just few minutes away from the current level. So expecting much more higher target in the same. GRSC already recommended. Stock is really doing well. I think it's all set to head towards 3,500. Cochin Shipyard looks good. I believe the major consolidation breakout, major trend is positive. The stock is up by around 37% in last 5 months, making high top high bottom on the bigger time frame. On daily, it has given a consolidation breakout. So with support of 2070, it can head towards 2,200 level. Now to reply on Paytm, we like this counter from last 5 trading session. Technically, it has given a breakout from a triangle formation with hold of rising trend line and key moving averages. So till it holds above 920, I believe positive stance could continue and Paytm has potential to touch 4-digit marks of 1,000 level. So apart from Paytm, I believe most of the defense team, including GRSC, Masgaundo, Cochin Shipyard, HAL, BML, could be buzz during the day.
Quite a lot of stocks there. I added Swiggy in also, but no time to really get that view from Chandan. Swiggy buzzing this morning, 3.5% up on that stock. So is Wockhardt, about 3% up. So some movers coming in. But thank you so much, Chandan and Somil, for speaking with us this morning. We're joined now by a very special guest, Shantanu Sengupta, Chief India Economist at Goldman Sachs, speaking exclusively to NDTV Profit this morning. Shantanu Sengupta, thank you so much for speaking with us. Always a pleasure to have you on the channel and get your views. Let's start with, I think, what has been a very heartening trigger in terms of India's Q4 GDP numbers. How have you looked at it? Some saying that this is also because of pushing down of subsidies. You're going to see some pain in Q1 of FY26. But on the face of it, this was a positive surprise.
Yeah, so there are two ways of looking at growth in India, right? GDP and GVA. So on the GDP, you are absolutely right. The subsidy payout was lower, and therefore you got a net indirect taxes boost, which is why the growth number is looking optically higher. But from the GVA front, which is the supply side or the production side of the economy, which is the first estimation that comes out from the statistical office, that's a solid number. I mean, 6.8% growth is above consensus. We were penciling in 6.7. The construction number has come out very strong, particularly we think because of government expenditure on government capital expenditure being quite high in the month of March. So that is showing good signs in terms of momentum for growth. Undoubtedly, some of this will be pulled back in the first half of this year. That is why for the fiscal year 26, we think that growth will be a shade lower than fiscal year 25.
Good morning, Alex here. We're speaking as the August members of the Monetary Policy Committee start meeting today, and there is wide expectation of a rate cut at the end of the week as well. I'm wondering what you think. 25 basis points is penciled in. And I'm also interested in your idea of how far they will cut from this point, because we've got a few estimates that are talking about 75, 100 basis points more.
Yeah, so we think 25 basis points, not very different from consensus in the Friday meeting release when it comes out. We think there's one more cut after this one, which takes the repo rate to 550. We think it'll be back-to-back cuts in the June and the August meetings. The reason why we don't think the RBI cuts beyond 550 and goes to 5.25 or 5%. Is because if you look at inflation numbers in India on a forward-looking basis, as you head into either the August or the October meeting, when you're thinking about cutting deeper than 550, the 1 quarter, 2 quarter ahead inflation number will look like 4 to 4.5%, which is the Q4 of this fiscal year, and the Q1 of fiscal year 27. Will be in the region of 4 to 4.5% inflation. So as the central bank sees inflation rising, largely because of base effects, into the first half of the next year, we think that they will stay away from cutting deeper. The other point is what I mentioned earlier. If growth is looking slightly better than what consensus expectation was, do you really need to cut that deep? Unless you really think that the world policy uncertainty again increases and growth tapers off in the back half of the year. So we think that they cut once on Friday, once more in the next policy, keep liquidity benign such that overnight rates are below the repo, and monetary policy transmission continues.
Right. Shantanu, good morning. Hiral on this side. You mentioned about the inflation number. Now, if lower oil prices, if that gets on, that is passed on as well to consumers, do you see a potential of inflation easing further below that 4% mark? And if that happens hypothetically, do you see further room in terms of easing?
Yeah, good question. So the lower oil prices can be used by the fiscal authorities in two ways. One, you can either deliver it through the fiscal impulse to the economy, which is non-consumer. So you can spend on everything else, or you can directly pass it on in terms of petrol and diesel price cuts at the pump price level. If that happens, which is not baked into our estimates, you're absolutely right that inflation will come down a tad bit, especially in Q4 of this year. Having said that, we are still looking at 3.5% inflation for the next couple of quarters. And only in the first half of the year, you're looking at somewhere in the region of 4 to 4.5. Given how low the base is for the current quarter, we don't think that inflation can be below 4% as you look 1 year forward. The base will just drive it higher unless you're having core inflation completely come off. So even with the petrol and diesel price cuts, if we were to bake in, we think that inflation will still be in the region of around 4 to 4.5, especially in the first half of the year.
Just a word on that liquidity scenario. We're now comfortably surplus, and the kind of measures I think that the Reserve Bank has taken very decisive in order to facilitate that pass-through of monetary policy. Do you anticipate any extension of the measures that have been taken so far, or do you think that it's now par for the course?
Sure. So monetary conditions in India were tight due to three reasons. One, policy rates were relatively elevated. Two, liquidity was tight. And three, macroprudential regulation had tightened. You've seen number 2 and 3 already easing, and you've seen 2 rate cuts already. On the macroprudential part, you've seen a little bit of easing already, where banks are able to lend to NBFCs again. On the liquidity front, the RBI has already done what it had to in terms of OMOs, in terms of FX swaps, in terms of repo operations. Now you're going to get the dividend of around 2.7 trillion INR, sort of in line with our estimates. We were baking in 2.6, which is going to keep liquidity benign for the next couple of months or so. If required in the next quarter, that is in the second half of the fiscal year, that is when the RBI can come in and inject liquidity. Otherwise, we don't really think the RBI will need to do materially more right now in terms of keeping liquidity further benign. Already, the overnight rates are trading about 20-25 basis points below the repo. And we keep saying that even with just 50 basis points of repo rate cuts, the RBI has effectively delivered more than 100 basis points of easing, because the overnight rate was around 30-40 basis points above the repo rate in mid-January, and today it is trading around 20 basis points below the repo. So you've effectively had about 100 basis points of easing already due to liquidity as well as repo rates.
Shantanu, just want to come back to the India growth question, and of course we'll wait and see what the RBI's growth projections are as well. But OECD came out with its growth projections yesterday. A big drawdown for the United States, a slight shave off for India as well, but at 6.3, 6.2% range, we continue to be the fastest growing economy, at least in the G20 cohort. What do you think could be, in terms of the impact of a global trade war, tariffs, muting of exports, the net effect? How much of an issue is it going to be from an Indian perspective?
Look, we have written about this earlier, that the direct effect of tariffs on India is going to be relatively lower, and the fact that the Trump administration has somewhat softened their aggressive stance on tariffs will mean that the drag that we were thinking about on growth will be even lower. So probably in the region of 10 to 20 basis points is the direct impact. What we worry about a little bit is the indirect impact of elevated policy uncertainty feeding back into investment decisions. I mean, if you look at the quarter gone by, and you look at the earnings releases of many companies, multiple companies have alluded to elevated policy uncertainty, and which can affect investments. If you look at a historical relationship, it can mean almost a percentage point drag on investment growth, which means that GFCF growth can be about 1 percentage point lower, which already would mean a 30 basis points drag on GDP growth, which is what we are baking in for FY26. So that is why our number is also somewhat in the region of where OECD is. We are looking at about 30 basis points lower in terms of GDP growth in FY26 compared to FY25. If the policy uncertainty reduces, let's say by the second half of the year, you have a lot more trade deals going on around the world, as well as India has completed the trade deal with the US. We think that then the drag can be over, and then you can look at a slightly more optimistic growth scenario, which is why our FY27 number is higher at 6.5% plus.
Shantanu, absolute pleasure speaking with you this morning, and look forward to your views after the monetary policy as well. Thanks so much for joining in.
All right, let's go across to the conversation that we're having right now with BOFA. And Neeraj over there, the Bank of America, of course, has ranked India as the second best market for global returns over 3 decades, with its stock compounding trend set to continue. However, BOFA has also cautioned that valuations are stretched amidst risks of slowing global growth. My colleague Neeraj is at the BOFA conference, and he's in conversation with Amish Shah, Head India Research, BOFA Securities. Yes. Hi, Neeraj. Good morning.
Of the stable of and as we sit in the venue of their India Investor Conference, it's an absolute delight to speak to Amish Shah. As he outlines, how does he think India stands in the investing pecking order from his perspective, and what has the conference been all about as well? Amish, great having you. Thank you so much for talking to us, and thank you for having us here.
Thank you for coming.
No, the pleasure is entirely mine. Amish, so tell us, we'll come to the note as well, but I just want to get the rumblings of the conference. I hear from your team and from others that this has been an unprecedented attendance, both from the corporates as well as the investing community. Tell us a bit about the conference. What was the theme showcased or the principal messaging, and what is it that you've told both investors and corporates?
As you know, we restarted our India conference, for the last 3 years. It's only kept on becoming bigger. This year, we are hosting 107 corporates. We have about 450 investors. There are 21 plenary sessions, and there are already 1,500 conversations that have happened between investors and corporates. But we are not stopping. So our conference comes to an end today, but we are continuing for the next 2 days through this week with 6 field trips. So these are investors who want to see the real India. Okay. So they want to go and see a manufacturing facility. So there's a manufacturing tour. Or you want to go and talk to the dealers, distributors on a consumption tour. I'm myself hosting a policy tour where we will have all the key bureaucrats or the policymakers, speak about what are they thinking about, how they want to drive the policy making going forward. So there are 6 different themes across different sectors, and then we will be continuing with those trips as well. Coming to the theme of the conference.
No, sorry, just before we get there. So it's interesting, Amish, that all of this is happening, and this unprecedented India interest, if I can use that term loosely, is happening at a point of time when Amish is telling people that the Nifty's done its course and we don't see much upside. So there is wide India interest despite the fact that the markets may not have near-term gains.
Everybody wants to keep India on its radar. Okay. Back in the time, like let's say if I rewind 5 years back, India's weight in MSCI emerging markets was only about 8.5%. Now it's close to 20%. So it's no longer a market that, even as an emerging market fund manager, obviously as an India dedicated fund manager, you want to know what's happening in India. But even as an emerging market fund manager, 20% is a pretty large weight. We are just a shade below China now. China is about 24%, right? So it is a market of relevance. You may not want to invest immediately, but you want to keep it on your radar. You also want to meet these companies, do your homework, find out what is a price at which you will ideally buy these companies. And if these prices were to come, then you have to be ready to jump onto it, because Indian markets, as we know, is a structural growth opportunity. It won't give you that opportunity for long, so you have to be prepared for it. So absolutely, from an interest perspective, therefore, despite full valuations, and we'll speak about that, definitely a lot of interest right now.
Okay, now the theme of the conference. What is it that you are telling your set of investors who are coming? I heard 450 the number, so that's a very large number. What is it that you're telling investors about? Why is it, or what is it that within India they should see? What's the central theme of the conference?
The central theme is about accelerating growth, and we have named that because we think that we are now all know that over the last 3-4 quarters, growth did come down, and there are a variety of factors to that. The most commonly being spoken about is that there was over tightening of fiscal, there was an over tightening of monetary policy, and as a result that led to some growth come off, and then there was credit growth contracting as well. So a confluence of all of this led to corporate earnings growth coming off as well. But everyone expects the growth to now accelerate because the monetary policy has completely turned its course. We are now talking about lesser regulations, more liquidity, lower rates, and so on and so forth. In fact, there's a possibility for even a fiscal stimulus now because RBI has given dividends which are slightly higher than what the government had budgeted. Crude prices are lower. As a result, government has hiked the excise duties on the petrol and diesel at the pump. That gives additional sources of revenues to the government. So all of this put together, there is therefore a question on whether the government now has a room to go and spend that money and do a small fiscal stimulus on the back of it. So all of these factors put together on the back of the low base of growth clearly means that the growth will accelerate. In what form, how structural, that is all up for debate. But there is definitely a growth acceleration, and therefore the central theme is accelerating growth.
Great. Can I actually just go a bit minutiae for a moment, and then we'll come to how investors are receiving this? What are the conversations like? At the end of Q4, an overarching view is that we might do about 10-12%, what have you, the number, right? And I remember a conversation that we had at our studios when you had come down, when you were saying that the pricing power is not quite there with the Indian corporate right now. So the possibilities of the numbers coming down might also stay. Now my question to you is, what is your stance right now, particularly in light of the fact that, in my view, we have a favorable base effect for Q1 and Q2, and that optically might bump up the growth number, even though in absolute numbers, the EPS may be X or Y or Z. So how do you think about growth, earnings growth, Nifty 50 or whatever benchmark you may want to choose for FY26 now?
Neeraj, as I said, that for the sequentially there will be an acceleration of growth. So to put numbers to this, if I look at Nifty, the earnings growth that it has delivered in fiscal 25 is 5.5%. Now, obviously, you can slice dice it, because if you want to look at optimistically, you will say that let's look at X financials, X energy. Even if you do X financials, X energy, which is generally the sectors that has dragged growth, Nifty earnings growth has been 7% in FY25. And this is nominal earnings growth, whereas the nominal GDP itself has grown at around 10%, right? So corporate earnings for the largest set of Indian companies is lower than the nominal GDP growth. And that is a low base that you speak about. On that low base, in FY26, we are arguing for a 9% earnings growth, which is again a shade lower than nominal GDP growth, or maybe at best equal to nominal GDP growth. There is no large acceleration to it. Now, when we come to the concerns on why we are not so optimistic on markets from a near-term perspective, I would say that markets, as we know, is all about what is already priced in. So when we began this calendar year, for FY26, consensus expectation was 22% earnings growth, because they thought that on a low base, the growth can be quite sharp. We were arguing for 9. We are still at 9. Consensus is down from 22 to 13. So, and then 13 will further, in our view, keep coming down to 9. So in a way, tying up the two things that we've spoken so far, is there an acceleration of growth? Yes, because 5.5 will go to 9. But, is that good enough from a market's perspective? Not really, because 9 is weaker than 13 that markets are already pricing in.
So which is why the upsides are capped. Can these the capping of the upsides change if indeed we see this fiscal stimulus? I believe a monetary policy easing of anywhere between 50 to 100, whatever the debated number might be, is already baked in?
Short answer is that 9 is after budgeting for that fiscal stimulus as well. Okay. Because, while I spoke about the positives of the fiscal math, the concern that we have is that personal income taxes, despite 1 trillion rupees of tax breaks that government has budgeted for, the personal income tax growth budgeted for F26 is 14%, which we think is quite optimistic. We think that in reality that number will end up at about 11. So you will have a slight disappointment in your personal income tax collection, which to some extent will get filled up with the excise duty collections on petrol and diesel, plus the extra RBI and possibly even the PSU dividends. So at the margin, we think that the budget will get balanced, but there is not too much scope to do a large stimulus as of now.
Okay, I'll get to the minutiae, and then I'll want a sense from you about what happens to India in the light of what's happening across the world as well, right? Because I'm sure you have a view there. But since we are on the topic of India, where is it that within this conversation of this 9% earnings growth that you are penciling in, would the outliers be or the beneficiaries be, or the ones which the investors would want to go for be? That list versus where is it that you are anti-consensus, wherein the street might be constructive, or do you believe that those themes may not necessarily give adequate returns, let's say over the next 12 months?
Start with the anti-consensus one first. First of all, I would say that, I would like to believe that our views on market itself is anti-consensus. Generally there is a lot of optimism on India right now, and we are optimistic as well, but not at these valuations, right? And then I would say it's the capex theme. So capex is something that we were for a very long period of time were very bullish. We rode that entire theme from 2020 to 2020 up until August of 24. But August of 24, we completely changed our mind. So from being completely bullish, we went completely bearish. So I cover 14 stocks within the capex space, and we downgraded 13 out of 14 from buys to straight sells. Right now.
Wow, that's 13 out of 14 stocks that Amish Shah covers were downgraded from buys to sell. That whole conversation is something that you can hear ahead on NDTV Profit, and of course on all our platforms, including our YouTube page. But focus on a big story that is breaking right now on NDTV Profit. And remember, we've been tracking the Vodafone Idea developments so closely. Now, we're learning that the government is taking decisive steps to prevent a telecom duopoly, considering options such as a temporary suspension of AGR dues. Discussions are active at the Department of Telecom VLAN with Vodafone, which is now owned 49% of it by the government, and they have agreed that Vodafone will be receiving different treatment than Airtel. Shrimi joins us with those exclusive details.
Clearly a positive news for Vodafone Idea. What we've been given to understand that government is firm on not allowing duopoly in the telecom space. Rather, it's advocating for healthy competition, being a sensitive sector. Now, sources tell us that government is exploring 2 to 3 options to support Vodafone Idea, which has been grappling with financial stress over its pending AGR dues and spectrum fees. After Supreme Court also turned down its recent petition over waiving of, AGR dues towards interest and penalty of around 45,000 crore. Now, couple of options which are under consideration include giving moratorium on the AGR dues in the form of waiver or extension. The another one could be that government may nudge lenders to give fresh credit to Vodafone Idea, and in exchange government may give some concession, aiming to de-risk the exposure in the telecom sector. Now, government has a view that Vodafone case is a bit different from its peers, despite the fact that the other telecos are facing the similar AGR issue. But given the shareholding and the entire structure of the Vodafone, now the government is taking the nuanced approach in the entire relief package. Sources also tells us that DOT, the Department of Telecom, is in discussion and chalking out plan with the other concerned ministry, and that is considering assessing the fiscal and the legal viability of those relief package which is in work at this point of time. And in fact, the performance and the projection of Vodafone Idea is somewhere projecting that it will improve in another 3 to 4 years. That is adding further optimism in the entire plan. So nothing has been finalized as yet, but the sources tells us that soon the government will take some decision in this matter, and we will keep you updated on that.
Yeah, so in fact, I had the opportunity to speak with the Union Minister for Telecommunications, Jyotiraditya Scindia, about what is the government stance on Vodafone Idea. Very interesting feedback from him. Listen in. What's happening with Vodafone Idea. Also, the government's problem, in a sense, because you own 49%, have rescued it several times, and they're coming back for more. In the conference call post results, the CEO, Akshay Mundra, has told investors, and this is something the street is watching, that nothing stops the government from extending more help on AGR. This is their interpretation of what the Supreme Court has said. Is the government in a mood to extend another lifeline to Vodafone Idea?
So I think it's very important, Tamanna, to look at the order. I think one should not talk about what has said or not been said in court, which is not in the order. I think the order of the Supreme Court is what we need to stand by. At this point of time, there is no decision on that issue. As far as government is concerned, the Supreme Court has taken a very clear decision that they have said that they will not entertain such pleas. We have to stand by what the Supreme Court has said, because that's the highest court in the land. If and when the government decides otherwise, all I can say to you is that you will be the first to know.
Sir, the if and when is important from a street's perspective, because the person who runs the company, the CEO, is on record saying that we're asking the government for a lifeline. Is this something under consideration at all? Is it in the realm of possibility? Because they owe you 83,400 crore rupees. They're asking for another bailout of close to 45,000 crore rupees.
I'm not in a position to answer what is in the realm of conjecture. I hold a constitutional position. I am supposed to answer only on what decisions have been taken when we take them. And as I mentioned earlier, if and when we do take a decision, you'll be the first to know.
So, okay, let me just press on another aspect of this. Only because Vodafone Idea is the third private player in the country, there is an argument for not turning the whole space into a duopoly. But on the other hand, it is taxpayers' money which will be used to bail out Vodafone if it needs to be further bailed out. Is there, in essence, an issue with two large players and a duopoly in your view?
Tamanna, I think you've been following me for a number of years. Prior to this, I was in another portfolio where this question came up all the time, and that was civil aviation. Civil aviation is not a duopoly, and neither is telecom a duopoly. We have 4 players in India. There are very few countries in the world, if you actually do a comp analysis of players across the world, there are very few countries that can boast of 4 players that have a national network in their countries. And India stands out as a country that has 4 players.
All right. Piyush Pandey, telecom analyst at Centrum Broking, joins us, and we just want to put the spotlight on Vodafone. I want to pull up the 1-week chart for Vodafone, the 6-month chart, and the 1-year chart. Now, the big elephant in the room, Piyush, has always been, will the government come in and rescue it further? From what we're learning, this is something that is being considered at the highest levels. How does that change things for a Vodafone fundamentally?
Basically, government also understands that duopoly is something which will be bad for the market, and in fact it can lead to frequent price rise and in fact impact customer service also. Like, so we expect that Vodafone can get some sort of relief, and relief can be in the form of like say moratorium. The government can extend the payment timelines by around say another couple of years, or maybe that see I have also a feeling that some year down the line there can also be option of converting some of the debt to equity. And as far as the bank part is concerned, I think it will be slightly difficult for banks to extend further loans, given that Vodafone remains highly leveraged. So most probably, I would say moratorium is something which is most likely. And because see, duopoly is something which will impact even government also, customers also, in fact, and that is how I would put it.
Piyush, good morning. Hiral on this side. When you talk about a moratorium that could be likely from here on, and taking into consideration the way Vodafone has performed in terms of FY25 and the fourth quarter as well, do you think then it is a possibility that Vodafone does get re-rated? And two, it's a chicken and egg situation for a Vodafone because one, they need the moratorium in order to expand. They need the money as well, for which they need business. So what comes first, what comes second, and when do you see that inflection point for the company then?
See, I would say primarily for Vodafone, capex is something which is most important. And unless they implement a significant part of the capex program for next 3 to 4 quarters, they have to start adding customers. So once they start adding customers, I think that will be the most important inflection point. And once that comes in, I think that is the point when stock can get re-rated. When they start adding customers, and this is when I think they can see significant improvement in the growth, revenue and EBITDA profile. But I think that point is still some quarters away. And as far as I would say, of course, for Vodafone, see for the company part, I would say capex is something which is the priority number one, and a debt part is something which remains a big overhang. Over the last few quarters, we have seen that they have rolled out their 5G networks in a couple of cities, and plus their coverage has also improved. So we expect that in next few quarters, their operating metrics should improve further, and they need some support from the government to prevent the sector from getting converted into duopoly, which will ultimately be harmful for everyone. Like, so yeah.
Bottom line, is it a buy at these levels? If you're holding, is it a sell? I mean, there are people, a lot of retail investors who either find themselves stuck in Vodafone or are there with eternal faith that something or the other will happen for them. So what is your advice? Is it a buy, sell or hold call?
See, my rating is reduced on this stock. Like, so fundamentally, I think at the current valuation and for the outlook for the next 1 year, I think it looks somewhat difficult. So if someone has to play telecom sector, I would say Bharti Airtel and then Indus looks better placed. So see, if Vodafone is able to do their capex for the next couple of quarters, Indus Towers might benefit from addition of towers and co-locations. And plus, apart from that, with the weakening of Vodafone, of course, Bharti remains a better play where it is gaining customer and revenue market share.
So again, with everything said and done, Bharti Indus Towers are a better bet as compared to a Vodafone Idea. Thank you, Piyush, so much for joining us on the show and sharing the views as well. So, Tamanna, overall, it's an interesting play. From what you've spoken to the minister, from the exclusive story that Shrimi has put out as well, it's clearly telling you that yes, there is something that is in consideration. The government is not looking at a duopoly, and that is why they are looking at a Vodafone in a very different way with regards to AGR news when it comes to a comparative to another company as well, like a Bharti Airtel. But taking that into consideration, how long will they be able to survive? Because subscriber addition is key.
No, but if you look at what Shmi has put out, she also puts out from government sources saying that the plan that Vodafone has given for improvement is something that they are buying right now. They see an improvement in the next few quarters. And as regards to that interview, I have asked time and again, to the extent that the minister actually said, you've asked me this question from every conceivable angle. But he does not come out and say, no more support to Vodafone.
Correct.
There's no
There's no denial on that
denial on it. So that's, putting two and two together. The other thing that we also learned from Jyotiraditya Scindia is that Starlink's entry is imminent. And we now have the exclusive details. Sources have told us that India has some pretty big asks from Starlink ahead of granting them a SATCOM license. Aishwarya is joining in with more details.
Tamanna, in the run-up to the expectation of Starlink clearing or being granted the license, that's very, very close. Mid-June is what our sources had told us. They should grant the license to Starlink. Now, what we're going to talk about today is entry costs, legal guardrails, and security clauses that have been baked into the LOI. Now, our sources have told us
We'll have to get that back on. I mean, it's almost ironical. We've been talking about telecom and internet connectivity, and our feed has been freezing for the last several minutes. So yes, in terms of actual experience of ways to go. But you know, this is what Union Communications Minister Jyotiraditya Scindia said to me when asked about Starlink.
Starlink today has been given the LOI. What that means is that they're very close to receiving their license. I can say that on record. All players in India, satellite players in India, will then have to go to InSpace and get their approval from InSpace. So that's the second stage. The third stage is that when TRAI has defined the norms for the administrative assignment of spectrum, and that is discussed with DOT, and DOT and TRAI are on the same page, then the spectrum at those rates will be administratively assigned to all players at the same rate. Once that is done, then all players will start offering their services.
Right, so that's the word coming in with regards to Starlink, who will be getting the license soon. But new kid on the block, Skoda Tubes, has just listed on the exchanges. Puneet comes to us with all the details. Puneet, how has the listing been? Right now we're looking at 140 versus the issue price of 140. So interesting, pretty flat right now. But key takeaways overall.
Well, thank you for that. So definitely a flat listing, and largely while the subscription numbers were good, it was expected to be flat based on the company's current market condition as well as the size as well, because it's a sub 1,000 crore company in terms of market cap. But it's a manufacturer of stainless steel tubes as well as pipes with critical sectors such as oil and gas, chemicals, fertilizers and pharmaceuticals being one of the key sectors that use these particular products as well. And definitely as a product they need certification from the companies that operate in. So it does require licenses, and the company claims to be the highest in getting licenses as offering premium products to its customers. The issue price was largely between 130 to 140, which was the upper price band, and it was a complete fresh issue, so of 220 crores in this particular IPO. The subscription based on the size was very high, 19 times in terms of retail and over 100 times in terms of non-institutional investors. But one of the key positives about the IPO was the margin profile of the company has improved substantially over the last 10 to 11 quarters. So EBITDA margin was 11.4% in FY23. That increased to 14.6 in FY24, and in the 9 months of FY25 it was 16.7. So that will be something to watch out for. But definitely as an IPO, a flat listing today, and I think once the company starts coming up with disclosures on the margin profile, that will be something I'll be watching out for.
Okay. All right, so that's the story for Skoda Tubes. I mean, 5% looks a bit dismal, but frankly, Hiral, if I compare what happened with Aegis and with the Leela listing just this week.
I mean, both of them absolutely dismal on the day. Did pick up slightly towards close as well. So that was the story there. Next day was interesting as well. But for how long the upside stays as well is interesting on this front. I just want to pull up the
stock price for both of those listings before we get into the break. Both Scholes and Leela. Aegis Logistics just teetering over the... Okay, Aegis Vopak, that's the stock that we're talking about, just about a rupee up. Not a great fire start to that either, although there seems to be a lot of interest in it. And let's look at Scholes as well, which is the new name for the Leela Group, Scholes Bangalore. In fact, they have some news of a new project in Mumbai, but the stock about 1% down. So nothing much happening there. Our primary market is a tough gig right now, not that easy as it used to be. We'll take a very short break. We're coming back with all the buzzing stocks, and we have a great conversation lined up with none other than Manish Dangi. All of that after the break.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
The markets move fast,
and so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Welcome back to India Market Open. A quick view in terms of what markets are doing after 45 minutes of opening right now. Nifty 50, 0.2% higher. So we've slightly come up from the low levels as well. So there is some bit of positivity. Bank Nifty is going to be interesting because the texture with regards to Nifty and Bank Nifty are absolutely divergent. Right now you have Bank Nifty, which is pretty much on the borderline. But one sector that we are focusing on in today's session are the cap good MNC companies. Now, from the commentary, what Anushi has been picking up is that they've been bracing for tough times with macro uncertainties, and that is what is making them cautious in terms of way forward for FY26. Anushi's detailing the analysis for us. Anushi, what have you picked up, the companies that you're looking at, and do valuations and what the upside or the downside that the brokerages are looking at actually sum up, and what should an investor do?
Thanks for that. So now what we are seeing for these MNC cap goods is FY26 a year where we should be sounding some bit of alarm bells as to the kind of commentary that has come from all these companies that are out there, even considering the geopolitical developments which have taken place. This includes the likes of ABB Cements India as well as Cummins India. Now, what's happening? We'll talk about the first quarter so far, how that has panned out for these, while ABB and Cements did miss estimates. And this is on the expectations of how the revenues and the margins have flowed along with the order growth as well. It's Cummins that did beat expectations, but again, if we look at the numbers, which we'll do that in a short while, it's not in detail that we'll see that the commentary forward is important to keep a track of. Now, what these MNCs have said that they've refrained from disclosing the order book growth outlook for the year. Now, this is considering various factors which have taken place. Firstly, on the Trump tariffs, what this could mean for the companies in terms of order growth is something that we should be watching out for. Another factor is the private sector spending. Now, if you look at the capex, that has still not risen to the earlier levels of where it was at peak. So that is something that we should continue to see. They're also cautious on the overall FY26 order inflows outlook that is there. In fact, if you look at the numbers now to just get a sense on what has happened in this quarter, in the Jan to March period, ABB saw about a 2.6% of a growth while margins had remained flat and PAT growth was about 3.3%. Siemens India did see about, in fact, Siemens and Cummins saw a drop in their margins, 10.1%, 460 basis points of a decline that we saw here, while 21.2% of the margins that Cummins came out with, which reported about a 234 basis of a drop. While even if you look at the revenue growth as compared to the previous fiscals and previous quarters, that has slowed down for both of these counters. Now, a couple of factors in play here. Firstly, the demand normalization, which has taken place for Siemens, of the key vertical that was in focus. ABB India's process automation segment had not performed so well as well. And Cummins India also was in focus in terms of where the margin picture was considered because of one-offs which had taken place last year, along with improve. While the revenue saw about a minor uptick, it was gross margins which was a saving phase. Despite the kind of drop that we had seen a decline. Order inflows that we had seen has narrowed down for ABB India if we compare from the 23 to 25 period. Even the order backlog now at 11% as compared to the 25 to 37% of a growth that we saw previously. Now, in terms of what is happening next, in terms of where the commentaries are for majority of these companies with the order backlog, book-to-bill ratio shrinking down for majority of these companies like ABB India, ABB India has said that the revenues were slightly off the mark due to the macro factors in picture, while Siemens India did say that it was the private sector spending which was weak in this, and even the digital industries was impacted by the inventory normalization which had taken place. Even if we look at the low voltage motors, that segment had underperformed due to the weak demand overall that has been seen. Lastly, coming to Cummins, now this is an important one that we are seeing because if we consider what was happening with the parent company, they in fact withdrew their 2025 guidance given the geopolitical uncertainties which are there. However, Cummins India did note that they would continue on this double-digit revenue growth but still remains cautious on the overall order outlook which is there. Now, if we are talking about how valuations have shaped up for this companies, what has been the trajectory here, if we look at the 3-year average PE and the 3-year PAT CAGR and compare it to the 2-year forward PAGR, we're looking at a substantial difference. 100x was the multiple that we had seen 3 years average, which is almost half to about 56 times. Similarly, for Siemens India, majorly unchanged ratios is what we are looking for the other two counters. But you know what's interesting here is the PAT CAGR growth, 63% of growth now narrowing down to 11%. In fact, if you look at Siemens and Cummins India, we are looking at a negative growth over here. So that is something that we should be keeping an eye out for. But coming to the last part, which is the brokerages, they are seeing a limited upside on all three of these counters with ABB about 2.2%. This is despite the substantial kind of coverage that has Siemens India 1.4% of an upside. And for Cummins India, we are looking at around 6.3% of an upside. So there is the overall picture for these MNC cap goods.
Thank you for that, Anushi, for that really detailed piece on what is happening with these MNC cap good companies. All right, I'm going to move to a conversation we've been looking forward to here at NDTV Profit. Manish Dangi joining in. He's founder at Macro Mosaic Investing and Research. Manish, very, very good morning to you. I mean, so much to unpack and talk about. We're speaking just on the day the monetary policy meet has begun. We'll see the outcome on Friday. We're coming off great GDP numbers. Some of those trade tensions are easing because of the taco trade or whatever you want to call it. But yet, that punch is missing. There seems to be a lack of confidence in the Indian markets right now. Why do you think so?
No, that's good morning, Tama. That's mostly because we've had a little bit of an accident-like situation 5-7 months ago. And so the return of confidence, Tama, takes time, right? And to that extent, if you consider market also is like human being, it sort of goes through its moods. It was too bullish then, and then perhaps in the context of macro is too circumspect today. So it is true that unlike other global peers of ours who have been raging high and have reclaimed the past peaks, somewhat lackluster performance in India. And this is again one more point notwithstanding a decent quarterly performance. So the good macro tariff tantrums are actually to a certain extent out of the window. At least the peak fear is behind us. The local growth momentum has picked up a bit. Valuations are decent. Some parts, just your colleague was telling us about the MNC valuations. Valuations in some pockets are still too expensive in India and untouchable. But otherwise, broadly, market looks decent. And now the monetary policy is likely to ease, have already eased substantially outside of any global stress. The kind of monetary policy easing we've had is somewhat unprecedented, especially from the liquidity standpoint. So all is well right now. It's a little bit of a boring time, so to say, but otherwise nothing sensational. Things are okay.
This is where long-term investors dig in and make money. So all is well is good enough. It doesn't have to be sensational all the time. But I want to come in on what we're expecting from the RBI. And you make the point, Manish, that there already has been easing outside the policy. People are penciling in from a 75 basis point to up to a 100 basis point rate cut this calendar year. Do you think the time is ripe for that kind of push for growth?
I'll give you a sort of a two-part answer to this. Just given the growth inflation context, the growth, given that it's actually picked up a bit, inflation, which is likely going to be 4% or below, mostly thanks to food inflation, you can assume that there is more space than what many are sort of anticipating. This 25 basis point cut is given. Likely another 25 basis point will come in August. But then you could also, moment you start to see that the growth accelerating again, not a sort of a very sharp way, but at least, it's not falling anymore and it's certainly sort of improving its margin. And in the context that the liquidity is raised so much, rates have come off substantially, and there is a lot of transmission happening, Tamanna, as we speak. All of this means that, the case of substantial rate cuts beyond the 50 basis point has actually faded as we speak. Now, that's the one part of the answer. Now, the second part is the more interesting one, which is, I call it Malhotra headset. First time, I don't know if you were in markets, but first time after Jalan, Bimal Jalan in 2003-4, India has a governor, and that's my view, of course, is reading of him, has a governor which actually is okay erring on the side of being excessively dove. So again, we don't know, but had Shaktikanta, Raghuram Rajan or Patel been the governor, we wouldn't have had the easing of the sort that we've had in the liquidity side. A sheer size of liquidity infusion, Tamara, just a half a minute, has been absolutely phenomenal. And that sort of has eased pressure in the financial markets, particularly in the credit market, dramatically. So in a sense, if you were to think of just from a personality standpoint, call it Malhotra headset, maybe this sort of he can tease you a little bit more by an additional 25-50 basis point rate cut. As I said, I think on the side of more easing and being dovish.
I love it. Malhotra headset. And yes, Manish, I was very much around when Mr. Jalan was there. Though I'm not too excited about publicly admitting it, but yes, very much was. And I think that's going to be the big push of what the signal is coming from the monetary policy, something that the market is underestimated.
Absolutely. And to put this into context as well from what Manish is indicating, if this is going to be the scenario and if this is the way that the markets are going to read it, Manish, my question to you will be, how do you see, you're talking about transmission of rates that is already happening, but that's from a growth economy perspective. From there, if the transmission has to happen to the markets as well, what is then baked in and the impact that you will see on the equity markets?
So equities is generally a slow vehicle to absorb monetary policy news. Bonds are a little bit more close neighbors to monetary policy. It's actually, real brothers. And to that extent, I think bonds are picking up substantial easing. Bonds are picking up that, liquidity would stay easy for a very, very long time. And which is why, the short end of the curve actually has sort of pretty much collapsed over the last 3-6 months. So that's on the bond market. Also, you're sort of beginning to see some easing in the credit market. So again, those markets are also proximate to monetary policy and picking up. I don't think equity so far is actually pricing anything, a new normal of sorts as far as monetary policy is concerned. And it's rightly so. The view of an equity headset is going to be somewhat longer than that of a bond guy. And you're not sure for yet, whether this Malhotra headset would actually be in application or not. But my sense is that at margin, you would see, if this, what I surmised in the beginning is, if it is true, you would see rate sensitives actually relatively doing better over the next 6, 12 months, 18 months, as this new reality dawns upon them. But if you ask me if it is pricing in at this point in time, the answer is likely no.
Okay, let me come back to some of the approaches that we need to see in equity. And you spoke, Manish, about how this is a bit of a boring time. But having said that, valuations is not the big pain point, and that is something that we've not seen for the last several quarters, I would say, where enough people are willing to come out and say that, hey, valuations is no longer the problem. How would you approach that opportunity?
So Tamanna, isn't it sad that the best case scenario for us is that that valuation isn't a problem? Wouldn't you like to have a situation in which it's enticing? And it's been so long since COVID that you had this, especially after 2021-22, that you haven't had actually a setup in which you could actually shout out to your friends and colleagues that look, valuations are cheap and you should buy it. And which is why I say that, it's boring because, it's just about there. In Hindi you call gunguna. So, valuation's not a problem. It's not cheap. It's not very expensive, of course. And therefore, run-of-the-course stuff out there in absence of macro market would simply chug along and deliver you 3-4% over bonds. It's not cheap. So therefore, you can't expect sort of a phenomenal profits, from markets anytime soon. So that's how I would think it. Valuations, okay. Again, you are more discerning about this. There are parts of markets are still very expensive. I think the way to look at market, at least in this cycle, would be, I think the expensive valuations would continue to get punished. India is becoming a little bit of a routine market, local flow driven. But I think, fund managers who've been punished quite badly by buying into these valuation at any price assets, over last 2 years, would be super cautious. So that breed would go missing, and therefore a saner market ahead, where people will account for expensive valuation is the one important barometer in dialing in or out of a stock.
I mean, if the BAP days are behind us, buy at any price. That's not necessarily a bad thing. Just your take on the quarter that we saw and where margins are going to go, and I think that's an important perspective because, all right, not as bad as expected. Again, gunguna, as the word that you spoke about, but we should be prepared for a bit of margin erosion.
I would be very surprised, Tamanna, if the current margins don't roll over. In simpler terms, they don't go down over the next 1-2 years. They're very elevated. Post-COVID productivity gains are baked in there. Are still sort of, in spite of very lowly revenue growth, dimish nominal GDP growth of about 10.5%. These margins, you really can't make arguments of these margins, sustaining for long. Almost certainly can't make an argument that, margins will actually expand from here. And so, which is why my base case is that even though the macro tailwinds sort of begin to appear on the horizon, growth begin to sort of look somewhat better than what I myself was expecting 6 months ago. And I was thinking that by Diwali, we would have flushed out the stress and, growth will begin to accelerate. We are in monsoons and we are doing all right. But in that setup, also, the current margins seem super elevated. And I see no fundamental reasons for them to sustain at this point in time. So I think the biggest enemy to stock markets over the next 1-2 years as to why it would not do splendidly well is going to be, I think, Tamanna, margins. Margins are very, very high. At 6% of revenue growth that we saw in 3,500 firms, the current, we're back to pre-COVID revenue growth trajectory, that we had for 7-8 years. Whereas, our margins are actually what they were, post GFC. So I think something doesn't, either the revenue begins to accelerate, which is less likely. I think, margins will roll over is more likely.
So I think, yes, that's going to be an interesting point that we need to watch out for. But Manish, taking this point into consideration, which are the sectors from here on which you see could probably be the potential bets for FY26, taking into consideration a modest growth that we've seen in the fourth quarter so far?
So, okay, my headset is it absolutely top down. I think that the stress in banking and financials, even the NBFCs actually, their liability was sort of ruptured. Interest rates were very high, liquidity stayed very tight for very long, and the NIMs compression were actually pretty significant. The large part of easing has not yet sort of converted into high NIMs, so the banking results weren't as impressive. But my sense is that in 3-6 months' time, it will begin to express. So I think that part of the business, purely, as I said, rate-sensitive business, I think would do decently well. I don't think in this cycle we're going to see major skeletons come out in terms of NPAs. And as the liquidity easing actually converts into lower deposit rates and reasonable NIMs, my guess is that, the financials actually will do all right. I think the other bet that in my mind, I would think is that in the whole AI led, productivity gains in the Indian tech, it is real that, a 10x engineer is becoming real, and I see it. I work with kids who actually do this, and my sense is that that is likely to unleash massive productivity boom in the Indian tech. So again, from a fundamentally, from a construct point of view, I think that part of the business has substantial tailwind. Largely driven by AI. Otherwise, business as usual. Expensive valuations sort of stay off or rotate back into anything which hasn't performed very well.
Right.
I don't think global growth is going to accelerate in a meaningful fashion, nor Indian. So it's a sort of, as we said, Gunguna setup in which these two parts could actually be the dominant part of your portfolio.
Yep.
And then rest, we can, every show, Tamanna, we can discuss, what to rotate into and out of it.
Yes, that would be definitely useful. Thank you so much, Manish, for your conversations today and for always leaving us with some food for thought. I think the Malhotra headset is my favorite phrase from Manish Dangi this morning. It's time for us to wrap up, but we're leaving the markets in a tepid kind of a scenario, slightly better on the broader end, but the Nifty not really showing too much movement this morning.
And I think it's going to be the rate sensitives, Tamanna, that will continue to remain in focus. So real estate, which has seen that up move, probably will continue. But let's quickly slip into a short break. Thank you so much for watching India Market Open. Lots more lined up on the other side. Please stay tuned.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Hi, thanks so much for joining in. You're watching Ask Profit on NDTV Profit, and my name is Alex Matthew. With me is Mahima Vachajani, and we'll take you through the next 1 hour of trade. It's an action-packed show, and we've got exclusive news to tell you about. That's coming up in just a bit. We've also got a conversation lined up with Jonathan Garner to talk about how the global picture is going to affect you as an Indian investor. And we've also got a lot of your questions that will be taken up over the course of the show. So to that end, you see two numbers on the screen. One is on the top. That is the number that you can use to send us messages on WhatsApp, or you can call us on the landline number at the bottom of the screen. But first, before we get to any of those things, or in fact how the markets are looking right now, let's go to an NDTV Profit exclusive. The market regulator, Securities and Exchange Board of India, may take up a number of key proposals on the 18th of June, and there are some that can have an implication for you as well. Charu is joining in to tell you about the details. Charu, what are you picking up?
So the market regulator, Securities and Exchange Board of India, is going to be having its next board meeting on June 18. Now, this was an NDTV Profit exclusive, and there are several key proposals that are up for discussion. For example, demerger of clearing corporations from their parent stock exchanges. Now, this is a proposal that has been in the talks since November last year. However, the stakeholders which will be affected by this proposal believe that the ownership structure should not be changed so much, and some sort of partial ownership or partial stake of the parent exchange should exist in the clearing corporation. So some sort of a tweak can also be expected, but it is a discussion that was supposed to take place in the last board meeting as well. So it's highly likely that something on this could come out. Apart from this, there could be discussions on treating REITs and InvITs as equity for index inclusion, and mutual funds may be allowed to raise equity fund exposure to REITs and InvITs. Apart from that, AIFs could be discussed to offer co-investments under separate schemes, and there are some other key very important areas. For example, NSE IPO, settlement under the NSEL scam for commodity brokers. Apart from that, settlement scheme for brokers who were associated with algo trading platforms. These are also some things which could be discussed. And lastly, SEBI has also been talking about optimum regulation. Now, this is something that does not explicitly require a board meeting to go by, as told by the chairperson also in the last interview. However, there could be some changes and discussions around that as well, and about the code of conflict of interest.
Right, so there are a number of things that you're tracking. I'm sure that you'll get us details on or before the 18th of June. Viewers, you should watch out for that. It's not too far from now. Let's take a look at where the markets are right now, and it's pretty range bound. That has been the case for the last few trading sessions. That continues to be the case today as well. The Nifty 50 trading very close to that 24,600 mark. This is an important one because a lot of call writing taking place at this level, or has taken place over the course of yesterday's session, up about 0.2% or so, 56 points up at this juncture. The broader markets have looked better and continue to look better than the benchmark, but today they are more or less holding along the same lines of what the benchmark is seeing. You have gains of about 0.2% for the mid-cap index, and the small-cap index up about that same level. Let's very quickly take you through the market breadth as well. I wonder where it stands right now, and in yesterday's session there was a flip. And today as well, there's quite a bit of chop and churn. At this juncture, it's pretty much even Stevens between the advances and the declines. And quickly, let's also take a look at the sectoral picture. You have IT that's doing reasonably well today. It's been tic-tac-toe, as we've been saying. One-day gains, one-day losses, gains of about 0.5% for the IT index. Realty index losing a little bit of ground after gaining in trade yesterday, 0.5% lower. And that's really the worst sectoral performer. FMCG not doing too much either. And PSU banks, which have been roaring in trade over the last couple of sessions, cooling off just a tad bit. Of course, a lot of action in the large deal space and a lot of movers as well, Mahima.
Absolutely. And one of the biggest movers is definitely Aditya Birla Fashions today, because it's down 10% as we speak because of the 600 crore block deal which was expected and which is taking place now. The stock is down 10%. Flipkart is the expected seller for this block deal. Flipkart holds 6% and expected to exit completely from ABFRL. The other one is Indegene, where there was a cleanup trade of around 10.2%. The stock is also seeing a downtick in trade today. Sun Pharma Advance is something that's languishing in trade today on the back of the clinical drug trials, which kind of did not go through. So the stock is down around 17% on the back of that. So these are some counters in the red. Some counters that are doing well though. There's Saregama, which is up 7%, probably a technical breakout there. Garden Reach up 5% on the back of an order win. Some other shipping counters also doing well. Ethos on the back of fundraise up 4%. AstraZeneca, Sandur Manganese, some counters doing well in trade today. But with that, let's also welcome in our guest for the day, Vaishali Parekh, Vice President, Technical Research Analyst at Prabhudas Leeladhar, and Rajesh Agarwal, Head of Research at AUM Capital, joining us now. Welcome to both of you. I'll start with the first question, which is from Pakshal Jain, who's writing in from Bengaluru. He wants to know as to which one of these is a better counter to invest in for the next 3 to 4 years between JSW Infra and Adani Ports. Rajesh, I'll come to you on this one. Which one would you prefer and why?
Good morning, Alex. Good morning, Mahima. Good morning, Vaishali. This is a difficult choice, I would say, because both are very good companies, whether it be JSW Infra or Adani Ports. Both are basically into port logistics and both are doing well. But out of these two, at this point of time, purely on valuation parameters, if I have to choose one, I would go with JSW Infra. Sitting on a lot of cash, trying to expand their capacity. They're doing very well, and the numbers have been quite good in the last 2 quarters of the listing and all. So at these levels, I think JSW Infra gives an edge over Adani Ports. Otherwise, Adani Ports is with this kind of capacity and all, it's also a very good buy. But at this point, I would say to wait for some more correction, maybe around 1300 odd levels, that would be a great buy too. So what I would suggest is why not divide your money into both of them?
That's a good point. And by the way, standard disclaimer here, Adani Ports, part of the Adani Group. NDTV Group is also owned by Adani Group, and this is NDTV Profit. Well, we've got Jose joining us from Bengaluru. Jose, thanks so much for calling us. How can we help you today?
Thank you, Alex, for taking the question. My question is regarding Shakti Pumps. On a short-term basis, is it a good time to enter for a short-term basis or based on technicals?
Based on technicals. And you haven't entered yet?
I haven't entered it. I'm just contemplating.
What is it? Okay, so what is the time frame that you have in mind?
2 to 4 months.
Okay. Vaishali, great opportunity for me to come to you for the first question today. Very good morning to you. And would you suggest a fresh entry at this point for Shakti Pumps?
So, very good morning, Alex, Mahima, and Rajesh. Yes, so actually we have been tracking this stock. And in fact, yesterday we were just recommending this to our clients because we've seen the stock from 1400 fall to now making a low of 800 and just consolidating in this range. So for a short-term perspective, I would say, yes, it makes it an attractive buy. Keep a stop loss of 830. It is currently 883. And this can go towards 950 as the first target resistance.
950 is the first target that you can watch out for Shakti Pumps where charts are concerned. All right, the next question is from Rayan, who's writing in from Mumbai. He's bought Nalco 50 shares at 185 a piece and wants to know as to what should be the target that he should keep for the next 1 year as well as 3 months period for this counter. Vaishali, I'll again come to you on this one. What are the charts indicating for 3 months as well as 1 year perspective?
So, well, I think metal stocks are doing quite well. And talking about Nalco, it is showing signs of improvement. So I would say for near term, 3 months horizon, I would say keep 165 as stop loss and look for a target of 210. If this stock has to sustain, and if we are talking about 1 year's horizon, I think this can go towards 270.
So that's it with regards to where Nalco is concerned. Our next caller for the day, Paramjeet, is calling in from Himachal Pradesh. Paramjeet, a very good morning to you. How can we help you?
Madam, I am having 7,000 shares of Motherson Sumi.
Yeah.
Yes. At the rate of 147.
Okay.
Want to know long term as well as short term view.
Okay, I got your point, Paramjeet. I'll take this up with Rajesh. Rajesh, he's sitting on a profit of around 33,000 odd rupees. What's your outlook like for Samvardhana Motherson?
It's a very strong company in auto and ancillary space. The only problem is most of the business comes from US and where we all the kind of problems going on due to tariffs and all. That's for the short term because the gentleman asked for both short term and long term. The short term, there may be a overhang of tariffs and all, any announcement coming from Mr. Trump. would be a overhang on this. Otherwise, for a longer term horizon, the company is very strong, doing very well. The products are well taken by Class A trucks and all. So for a long term horizon, yes, it's a hold from our side, but for a short time, there might be volatility because of Trump tariffs. So if you're looking for a short term horizon, be on a very close watch and keep a stop loss of maybe 140, 145.
That's with regards to where Samvardhana stands. Next question is from Sanjay, who's writing in from Mumbai. He wants to know if this is a good time to enter into Tata Power. Vaishali, I'll come to you on this one. There was an interesting note of Morgan Stanley today from their conference takeaways where they've maintained overweight with a target price of 449 for Tata Power. What they're saying is for solar EPC third-party orders that they have right now, they are expected to complete in FY26. And in terms of capacity expansion also, they're looking at good margin expansion going ahead. What's the outlook like where charts are concerned? Is this the right time to make an entry?
I would say so because, well, it has been very sluggish in its movement, but the near-term support lies at 380 and further confirmation of the stock comes above 400. So once we see the stock closing above 400 levels and sustaining, this is very likely that we can get our targets of 420, 440.
Okay, so that's a view with regards to where Tata Power is concerned. Our next question is from Nina Johnson, who's writing in from Kerala. She wants to know if she can accumulate REC at the current level since the stock is corrected quite significantly. Rajesh, I'll come to you on this one. What are your views with regards to where REC is concerned?
See, considering the power scenario in our country, the shortage and all, I think these companies, REC, PFC, which are basically into funding power projects, are going to do well. Their books have been cleaned and apps have increased and PAs have gone down. And the demand for funds is going to go up because of the capex going on in the entire power sector. The government's focus on developing more on power side, I think these companies for a longer term can do well. And the added advantage is these companies give out good dividends too. The dividend yield is also good. So if you're looking for a long term horizon, maybe 12 to 18 months, yes, it's a good buy. You can go ahead. But short term, being a low beta stock, there won't be much of a volatility. So depending on your time horizon, I would say if you're long term, go buy.
For long-term perspective, buy is the call which Rajesh is giving on REC. Our next question is from Vaibhav, who wants to know whether he should stay invested in something like an Aegis Vopak, where he's purchased 1,000 shares at 225 a piece. Rajesh, not sure if you have a view on this one. It's a fairly recent listing, day before yesterday.
Yes, it's a 2 days listing and not much of a data even on fundamental side with us. But we have gone through the DRHP and all. And at these prices, I think one should better be at least booking partial profit because you never know when profit booking starts coming up. So I would say book partial profit.
Okay. All right. Now, we have been speaking about this for some time. The uncertain global scenario, what global investors are looking at, the focus on India amidst the emerging market pack. And of course, you as an Indian investor are in any case mostly invested in India at this juncture, though that might change going forward. The question you're probably asking is, will there be a sustained shift by foreign institutions back into India? Of course, they've been buying in fits and starts. Jonathan Garner, Chief Asia and Emerging Markets Head for Morgan Stanley, joining us right now, Chief Equity Strategist. Jonathan, thanks so much for joining me today and joining us and speaking to us about this. The question that I have at the start is, how do you parse this data that is emerging from the US? There's likely to be a slowdown in the US and there seemingly is money flowing out of US assets. The understanding is that they're moving into markets like India and China. But is that durable? Is that sustainable?
Yes, so we have a view that the US economic growth is going to slow quite materially down to below 1% GDP growth next year. And what you're starting to see is a reallocation of global portfolio capital after a period of maybe 15 years of US outperformance. on a multi-asset basis. And the markets that have benefited the most from that, when you look at the flows year to date, are actually in Europe. That's the really big change. And out here in Asia, I would say that so far things are somewhat more neutral overall. But there are pockets of interest, and India is certainly one of them, along with Japan, and probably to a lesser extent re-engagement with China, Hong Kong.
So let me take that forward. If we're talking about the implications of a slowdown in the US, in the past, and I'm talking about the last 2 decades, you've had a drop in capital assets as Wall Street falls. So the understanding is that if there is a slowdown, then that would reflect in risk assets in the US. But in India, you've had the emergence of domestic investors that have proven to be a little bit of a base. Do you see this cycle behaving differently from past cycles?
Yes, we do. It's not only in India where you have the SIPs, obviously, but in Japan we have new NISA. We have flows that are ongoing through what's called the Connect program, southbound into Hong Kong from mainland China. So this theme that Asia, what we call Asia's financial acceleration or development of local capital flows supporting local markets, it's actually a pan-Asia theme. And I do want to emphasize that the slowdown in the US that we're anticipating is to do with a couple of things. The trade and tariff policy, which effectively acts as a tax on the US economy, and in addition, the immigration policy, which reduces labor supply. So that's how our economists actually see it. Whereas actually in the rest of the world, we have a much more muted growth impact. For sure, China will be affected by this and will have slower export growth overall. But for India, and we've already seen this in the Q1 GDP growth numbers, it's over 7%, we have a very strong growth profile for this year. So India is not going to exhibit a downside in growth in relation to what's going on in the US. And meanwhile, the dollar weakening trend actually gives policymakers here in Asia a lot of degrees of freedom. They're actually able, and we think this does apply to the RBI, to cut rates. We think there are 2 more rate cuts coming for India this year, even with the Federal Reserve being on hold and US growth slowing. And that is quite unusual.
And there are so many interesting conversations that are emerging from the conference that you're currently holding, but I'm curious about what you think about the opportunity. So I was leading into this question, Jonathan. If there are opportunities because of a global slowdown and a correction in risk assets, where would you suggest deploying? I would assume that these have to be in India, domestic-facing themes, so where would you focus?
Yeah, absolutely. So financials, consumer, discretionary and industrials in India, which are, the majority of market cap. We also are emphasizing financials in other core geographies in Asia, including Japan and to some extent in China. And what you have to be careful about, obviously, are Asian export companies that get caught up in the trade and tariff issues, and where actually currency strength tends to sort of diminish their margins. And so that's not such an attractive feature for export-dominated markets, including, for example, Taiwan. So India, with its very strong domestic growth dynamic, is our top overweight in the region.
Okay. Is there a threat at all to Indian equity? And I'm talking about flows here. We've seen yields in Japan move higher. We've seen yields in the US move higher for various reasons. Do you see a threat in terms of flows and move away from risk assets at all down the road?
Well, if you look at Japan, we actually just held an investor conference in Japan. Reflation and a normal yield curve becoming re-established is the key theme. And certainly those long-end yields in Japan are still well below the equivalent yields, for example, in the United States. And what's really interesting here in India is that your 10-year yields have actually been very stable and broadly declining. So you're not really caught up in this debate about, the shape of the yield curve as it affects the US. And actually there's a sort of multi-asset flow story developing for India on both the equity and the fixed income side, as well as obviously longer term private equity flows. So all of this gives the balance of payments a lot of sort of security and means that the rupee, again, is not as vulnerable in a US slowdown as you would have seen in the past.
What factor, in your opinion, Jonathan, will crude play in all of this? Ultimately, for an economy that is dependent primarily on crude imports, and $65 to the barrel for Brent is a good sign. So, do you see a material shift if that changes, if that picture changes?
Well, and the sensitivity of the Indian economy to the oil price is diminished from what it used to be in the past, and the starting point is a current account deficit relative to GDP that's much smaller than in the past. We tend to think that the Brent oil price will be somewhat softer going forward in relation to OPEC plus production, which is actually currently increasing. And so this actually is another supportive feature for the Indian economy. So these cycles that we used to see maybe 10, 15, 20 years ago, where problems on the external side due to oil price surges or domestic inflationary surges, weaknesses in the domestic supply side here, they really have been going away in recent years, which is testament, of course, to the improvement in CapEx, public and private CapEx, and the fact that you have both a demand and a supply story in India that are moving in tandem together as this economy develops. It's a very exciting story.
Jonathan, I was reading comments that you'd made earlier in the year. Please, tell me if that's changed at all. By my understanding of what you said, you expect that the earnings slowdown is temporary in India, and you expect that to pick up over the course of this year as well. Can you tell me what your base case assumptions are for FY26 and why you're saying that growth will pick up?
Yeah, so we did have a cyclical slowdown last year after the election, and we've now had an easing of policy on the monetary and fiscal side, and CapEx is starting to rise again. So it's likely that earnings growth will reaccelerate, and it's certainly the case that we can be looking at maybe mid-teens earnings growth on a go-forward basis. For our global clients, what they really care about is dollar earnings per share growth over the cycle. And there, India has a very strong story to tell. For the MSCI India index, US dollar EPS growth is averaged around 12% per annum over the cycle. And that's far higher than any other emerging market.
Jonathan, thanks so much for taking the time. Pleasure speaking with you.
Thank you.
All right, so you got some perspective from a global voice talking about the India story and the opportunities here. And I found what he said at the end about the earnings trajectory very interesting, and that there's expected to be an upsurge in the earnings picture, particularly in the context of what we saw in the Q4, and a few companies coming out and say maybe things are not as bad as you had thought they were.
Absolutely, and that goes for every sector probably. In fact, there have been standouts in every sector, and there have been companies that have lagging in every sector. So it'll be interesting how FY26 pans out for all the sectors.
Yeah. Certainly. Let's circle back. And I know that this might be a little bit jarring. We're talking about big picture and then heading back into individual stocks, but this is what the show is all about. It's getting you answers to your questions. We just spoke about Aegis Vopak before we went to Jonathan Garner. Let's take the next question from Piyush Raj, who's writing in about Coal India. He's bought at levels of 441 rupees. He's got 840 shares, and he's incurring a loss at this juncture. So there's quite a bit to talk about, Rajesh, when it comes to Coal India. They have not really hit their production targets, but is this a story that you would bet on? Of course, thermal power not going anywhere.
Yes, I totally agree that thermal power is not going anywhere, and the kind of capacity Coal India has not only in India, but it's one of the largest across the world. With the kind of demand coming out from power sector, we just discussed sometimes back about power in the show only. So I think the prospects are huge, and not to forget the dividend yield is coming to around 6% plus, and that's an added advantage. So if somebody looking for a long-term stable kind of return, Coal India would be a good choice. Our target for next 1 year is 460 rupees. So any dip should be taken as an opportunity to accumulate. If the gentleman's funds allow, we can even add to his position, or else I would say continue to hold.
Continue to hold is the view coming on Coal India. Our next question is from Riku, who's writing in from West Bengal and wants to know if he can buy and hold Reliance Power for the next 12 months. Vaishali, I'll come to you on this one. On the charts, what is Reliance Power indicating?
Reliance Power has got into a very strong uptrend, and it's also our recommendation as a disclaimer. Technically, if you see, it has given a breakout from 55, 56 levels, even on a weekly chart. So I think if it's sustaining well above, and which it is right now, I think I'm looking at a target of 80 to 100 in times to come. That would be my target. So it is a buy, keeping in mind 55 as support. And to those who have bought, please continue holding with the trailing stop loss.
So that's a view on Reliance Power. We have to slip into a very quick break. We've got more time on the other side to take more of your questions, so do stay tuned. Keep them ready.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Welcome back. You're watching Ask Profit, a show that gets all your stock related queries answered. For viewers who's just tuning in, you can either call us or WhatsApp us on the numbers that are flashing on your screen right now. We've got our next caller for the day. Murli is calling in from Bengaluru. Murli, a very good morning to you. How can we help you today?
Good morning to you, and thank you for taking up my query. I happened to observe the interview of HCL chairman.
Okay.
Your channel.
Okay.
And he is sounding quite confident about the future exponential growth.
Right.
And though it's very expensive at the current rate, considering the 2 years at his view,
Right.
I'd like to buy at a current rate of around 250.
Right.
From a long-term point of view, because being one of the almost near monopoly in India.
Correct.
Yeah.
Okay.
What's your view?
Okay.
Long-term view.
Okay, got your
Yes.
query, Murli, and thank you so much for watching those interviews very diligently. I'll take this up with Rajesh. Rajesh, what's your view with regards to where Hindustan Copper is concerned, and do you think this is the right time to make an entry?
See, metals are doing well. The only hangover is something comes out from China that would be a hangover for a short term. But for a longer term horizon, it's one of a good buys in the metal space as such. The reserves are good. They're doing very well. Numbers have been satisfactory. And the best part is copper demand is going up day by day. So demand is going up. They have pricing power. I think one can continue to go long on in copper for a long-term horizon. Next 1 year, we would expect a return of maybe 15 to 18% from the current market price.
All right, Murli, I hope that answers your question. You can buy at the current market price. And it's an interesting play if you think about it, right? Copper is what you need for a lot of electrical appliances, and that's what all of us use. Let's talk about John's question from Chennai. John is writing from Chennai, is asking about Infibeam Avenue, which he's bought at a price of 19.3 rupees per share. He's in the green just marginally, so he's looking for the short-term targets. Vaishali, on the charts, what's the view?
Well, chart, it is showing signs of reversal, and right now it's going through a consolidation phase. So now that he has bought at 21, I think keep a trading stop loss of 20. And I think in times to come, it's a trading strategy. I would look at a target of 24 to start with. We can have a relook once this crosses 24.
Okay, all right. So that's the view on Infibeam. Utsav is calling us from Andhra Pradesh. Utsav, very good morning to you. How can we help you today?
Good morning, sir. We have bought ONGC at 251 rupees, worth of 1,000 shares.
Okay.
Can we hold it for short-term gains?
Okay, I got it. And when you say short-term, how have you defined that, Utsav?
3 months.
3 months.
Holding for 3 to 6 months.
3 to 6 months. Okay. Vaishali, on the charts, it's something that reacts when crude oil prices move, and it has done so. Crude oil prices have been soft and it's moved lower. What is the view right now?
Well, so this is one of the stocks which has been quite a laggard, and it has right now it is showing signs of weakness. So I would say I don't see much of an upside coming in right now. However, if he still insists to hold, keep a stop loss of 230.
Okay, so that's with regards to where ONGC stands. Our next question is from Kathan. He's writing in to ask about Khaitan Chemicals. Sorry, my bad, Satyan. And he's writing in to know about Khaitan Chemicals and wants to know what's the next technical support specifically for this particular counter. I'll come to you, Vaishali, again for this one. What are the charts indicating for Khaitan Chemicals?
So Khaitan Chemical currently at 86 rupees. I think the stock has really surged very well, right from 45 to 85, 86 levels one way. So I would say keep a trading stop loss of 80. And I think this can further surge towards, because it has a weekly chart projection of 95. So that is the target that we can look for.
All right, so that's the view with regards to where Khaitan Chemicals and of course the charts are concerned. Our next caller, Venkat, is calling in from Hyderabad. Venkat, a very good morning to you. How can we help you?
Hi, very good morning. So I would like to know about Bank of Maharashtra. Actually, I bought 440 shares on average price of 65 rupees.
Okay.
So can I, actually I have taken for long term only.
Okay.
So can I average here? Is it, the fundamentals are good? I would like to know.
Okay, I got your question, Venkat. I'll take this up with Rajesh. Rajesh, Bank of Maharashtra, he's sitting on a loss of around 3,000 odd rupees right now. But what's your view with regards to Bank of Maharashtra plus the entire PSU pack?
See, coming to PSU Bank as such, we are very bullish on the entire pack. Balance sheet has been cleaned, NIMs are improving, business is improving, and the best part is after the 2 cuts of RBI, we are expecting 3rd cut to come very soon. So all these are going to help PSU Bank because of their bond portfolio and other things. As far as Bank of Maharashtra is concerned, it's one of the strongest bank in the entire space. If you look at the numbers have been the best in the entire peer sector from the last 2-3 quarters. Almost nil NPAs, NIMs improving, advances have gone up. They're moving into technology. We have a strong buy call into this for a target of maybe 70, 72 odd rupees in the next 18 months. So any dip should be taken as an opportunity to accumulate at these levels too. It's a buy for somebody looking for long term. We have initiated a report last week that just as a disclaimer on this.
Okay, all right. So that's the view on the PSU banking pack and specifically on Bank of Maharashtra. Chitra is writing in from Chennai asking about BHEL and Bharat Heavy Electronics is a name of the counter. This is something that she has bought at levels of 249 and she's wondering whether to hold or sell for a month's view to get a profit. What's the view on the charts, Vaishali?
No, the stock has been trending and right now it's in a consolidation. The near-term support lies at 250. So I think keep a stop loss of 240 and continue with the position and look for a target of 270 if 1 month is the horizon.
Okay. All right. So that's the view on BHEL. Let's take our next caller. We've got Shubha calling us from Hyderabad. Shubha, very good morning to you. How can we help you today?
Good morning, Alex. I'm holding 1,000 shares of Bajaj Housing Finance.
Okay.
I bought it at 150 rupees.
All right.
So I want to know what is the view on that.
And do you have a long-term fundamental view? Is that why you bought the stock?
Yes, I'm looking at long-term.
Okay.
Maybe around 3 to 5 years.
Okay, great. All right. So, Rajesh, on the charts, it is something, not on the chart, on the fundamentals, it is something that has languished a little bit in the recent past. And I guess this can be called a time-wise correction or a consolidation, so to speak, because if you look at the issue price, it's still much higher than that. And so therefore, would you continue to hold? Would you add? Would you use this opportunity to build your position for the long term?
It's a buy from a side. The second largest housing finance company in the last 4-5 years, if you see at the CAGR growth, it's phenomenal. This quarter also numbers have been good. For the full year, AUM has grown up, doing very well. And going forward also, we think with the kind of parentage it has, the company is going to do well. It's a buy from a side. We have a target of around 170 odd rupees in the next 2 years. So it's a buy. One can even add to that.
All right. By the way, I'm sure a lot of you know this, but in case you didn't, the show that comes up next at 11:30 is geared towards giving you a detailed understanding about one company a day. It's called Know Your Company. And the team dives into ITC hotels today. So it's going to be a very interesting one. In fact, my co-anchor is going to be featuring on that show as well because she tracks the company very closely. They'll be talking about what the potential is, what the opportunity is. Actually, why don't you do it? Since you're going to be talking about it, why don't you talk about why we're discussing ITC hotels today?
Absolutely. So it's a very interesting hotel to watch out for. It recently got demerged from ITC. And if we look at the number of keys that the company has, it's the second largest hotel chain in India after IHCL. So one of those factors definitely comes into play because a very interesting hotel to watch out for. Plus the growth target that they have is significantly high. They're going to go at 50x in the next
number of rooms, you're saying?
Number of rooms, yeah. Number of rooms in the next 5 years is what they're penciling in. And plus, the very interesting part here also is that they're moving towards management contracts completely, which will also enhance their margins.
Okay,
going ahead.
don't say everything that you're going to say on the next show.
So you'll have to wait and watch.
If you want to watch more details on that, you know what to do. Tune in to NDTV Profit at 11:30. We're speaking to an analyst today, Prashant Biani of Elara Securities, about whether or not there is value to be found in buying ITC right now for the long term. The questions, of course, are whether or not the addition of capacity will aid the company's top line growth going forward as well. So the next question we're talking about is, or stock we're talking about is BSE. And we got Pankaj writing in, asking for a very long-term view. He's talking about a 10-year view on the BSE. I'm going to ask you a trick question, Rajesh. Do you remember what the BSE Sensex was 10 years back? And would you buy for 10 years BSE?
See, 10 years back, I'm not very sure, but if I'm not wrong, it was around 40,000.
I'll have to check and see whether you're right.
I also have to check because so much of volatility has gone up quite fast in the last 4-5 years or so. But as far as BSE is concerned, we have been recommending this since very long period of time, the last 2.5 years. When it was languishing around 500 odd rupees, it went up to 7,800 come bonus, and now it's trading around 2,800, which is 8,400 come bonus. So it's a very strong buy. At these levels, maybe some amount of correction is due. It might correct, but when you're talking of 10 years down the line, I think these companies, be it BSE, NSE, CDSL, these are platform companies where the capex has already been done. They have huge business potential. Specifically for BSE, if you look at the options market, they have increased their market share into that. Last September, when it was zero, now it has considerable market share with them. They have a whole lot of cash with them, 18% holding in CDSL. They have Star Mutual Fund platform, which is one of the largest mutual fund, presence in GIFT City. So everything goes into the company's favor. The no issues of corporate governance, and the recent development is the Sensex futures, which they have been trying to promote, has been taken up well and is doing very well. So everything goes in favor. The only thing is it's run up quite a lot in the recent past. Maybe some amount of correction or consolidation might happen, but that's for short-term players. If you're talking of long-term, yes, it's a good buy. For long-term holders, I would say.
So it's a good buy for long-term holders is the view coming in on BSE. All right, our next caller, Pradeep, is calling in from Bengaluru. Pradeep, a very good morning to you. How can we help you?
Madam, good morning. See, I am having 150 shares of Reflex Industries
Okay.
at a purchase price of 107 rupees.
Correct.
Right now, the price has gone up around 5 times.
Right.
So I would just like to ask whether I should hold it for another 1 year, because I have a vision of another of 2 to 3 years.
Okay.
So whether I should hold it or book profits, and if I book profits, then whether I can go for Chambal fertilizers.
Okay. And Pradeep, just to understand, when you bought this, did you see the fundamentals of the company, or did you see the technical charts while buying it? You saw the fundamentals?
No, fundamentals, because I'm an investor basically.
All right.
I do it for a long term of 3 to 5 years.
Okay, Pradeep, got your question. I'll take this up with Rajesh. Rajesh, not sure if you have coverage on this one, Reflex Industries. It's basically into eco-friendly refrigerant gases. When I was seeing the technical charts as well, the company has seen significant momentum in the past few months. But in terms of fundamentals, where fundamentals are concerned, what's the view like?
See, coincidentally, day before yesterday, we have given a buy call in this, and we still stick to this. The company has been doing well. They are into refrigerant gas, as you said, Chennai-based company, doing very well. As per the management commentary, they have strong growth plans going forward. In the recent past, they have raised some funds too. There was news of them taking over Gensol's car business, but they have backed out of that. So otherwise, fundamentally, it's a very strong company. For a long-term horizon, maybe one can add on dips. 12-month target, we have around target of 600 odd rupees. So it's a buy from our side, add on dips.
And add on dips is the view coming on Reflex Industries. Our next question is from Sampath Kumar, who is writing in from Kurnool, Andhra Pradesh. He's holding BEL shares at 231. He's bought 201 shares at 231, sitting on profits of 31,000 odd rupees, and wants to know if he can continue to hold at the moment or not. Vaishali, I'll come to you on this one. What are the charts indicating, and what are the supports and resistance levels that you're seeing?
No, I would say BEL is one of the stocks which has really shown a very good run up, and I think it was a one-way rally right from the near-term support of 300 to now 385. So according to me, partial profit should not be ruled out, and if you want to have a disciplined trading, then keep a trailing stop loss of 380, and maybe this can go towards 400, 410.
Okay, so that's with regards to where BEL stands. Our next caller, Ram, is calling in from Chennai. Ram, a very good morning to you. I believe you have a query on Equitas Bank.
Yes, sir.
Go ahead with your query, Ram.
So I have 400 shares on average price of 98 rupees.
Okay.
So can I hold for long term, or can I exit or switch to another bank?
Okay. Okay, I got your point, Ram. I take this up with Rajesh. Rajesh, he's sitting on a loss of 13,000 odd rupees right now. What's the outlook like for Equitas Bank? Should he book losses and switch to some other bank?
See, the numbers have been not that great. The company and the bank is not doing well on operational parameters. I would say the numbers are they are better numbers in the banking space. As I discussed in the show, that the Bank of Maharashtra looks good on all parameters. So what I would say is switch from Equitas to Bank of Maharashtra. That would be a better choice.
Okay, all right. CDSL, now we spoke about BSE, and I think you did mention CDSL in that breath, Rajesh. The question is for you. Venkat from Andhra Pradesh is asking whether to add more to his holding of CDSL. He's got an average price of 1,257, pretty attractive buy price. He's got 10,000 shares, so pretty large quantity. Would you hold on to that? Would you add more?
See, it depends on your time horizon. If your time horizon of 12 to 18 months or even more, yes, you can add to that, because as I said, these platform stocks are going to do well. In case of CDSL, the number of new customer additions has been good. DP is doing well. They are moving into new products also. So I think for a long-term horizon, it's a strong buy. Maybe in the short term, as I said, for BSE also, that there might be some amount of consolidation or correction, just because of the fact that they have run up quite a lot in a very short span of time. Otherwise, fundamentally, they're a strong buy candidate. They have good, strong, undisputed, I would say, business models which only one or two companies. For in case of CDSL, that's only one company. In SDL, that's also unlisted at this point of time. So yes, it's a buy and a hold from our side for a long-term horizon.
Okay, buy and hold from a longer term perspective for CDSL. Our next question is from Teju, who wants to know about Suzlon. His buying price is 66 and number of share purchased is 2000. Vaishali, on the charts for 1 month, what are they indicating?
Well, Suzlon has been doing very well in the recent past, and right now, we are seeing a good uptrend. Keeping 1 month in mind, I think keep a stop loss of 64 and look for a target of 78.
All right. So let's now talk about an NDTV Profit exclusive. And this is the latest in a string of exclusives related to Vodafone Idea. Of course, you probably heard the conversation that NDTV Profit had with the telecom minister yesterday, where he was asked about Vodafone Idea, and he said that he would choose to not comment about any developments as things stand. And then later in the day, we got exclusive information that the government might be looking to throw another lifeline to Vodafone Idea, specifically with regard to the treatment of AGR dues. The latest development has to do with what banks are saying. Are they likely to lend to Vodafone Idea? What are the conditionalities that they're looking at? And my colleague and our bureau chief and editor of banking and economy, Vishwanath Nair, joining us on the phone line to tell us about what he's heard. Vishi, important information that you picked up.
Right, Alex. So the development is clear that the lenders have put their foot down and said that they need that clarity on the AGR dues specifically before they even consider lending to Vodafone Idea any further. Now, what we're understanding is that the major public sector banks are actually in favor of giving loans to Vodafone Idea, provided that the government gives the necessary extension or waiver of the AGR dues that Vodafone Idea owes to the government. Currently, 84,000 crore, nearly 84,000 crore worth of AGR dues are pending from Vodafone Idea, of which the company has sought a waiver of 45,000 crore worth of dues. So the banks are very clear that till we get some clarity from the government on what exactly they're going to do with the dues, we are not really inclined to look at the proposals. But the minute that happens, they will be very willing to extend the loans. And this is, remember, the major public sector bank side of the story and other public sector lenders. In terms of some of the other private sector lenders, it seems that they're still very reluctant to go ahead. We'll have to see, how these pieces fall into the place, and finally how lenders actually end up giving further loans to Vodafone Idea. They need that money from the banks to ensure that even after that AGR dues waiver, their business continues to sustain and they're able to grow their business further. For that, they will need the bank financing, which is crucial. But till the government gives some clarity, banks are going to stay put.
Very important story there, and we'll come back to you, Vishy, over the course of the day, of course, to see if you pick up anything more. And of course, it's sizable information as it stands right now, and we'll see how that pans out for Vodafone Idea. Let me actually go across to Rajesh on this one. Rajesh, Vodafone Idea, it's a company that is flagging, it is losing market share as we speak. Of course, in the fourth quarter, the losses were less than they have had in the past. But they incurred a net loss, and that's because the finance cost was larger than the EBITDA that they earned. So they need a bailout.
Yes, I do agree that they need a bailout because the debt is so huge that even if they continue raising some amount of fund, that won't be even able to service the interest part. And unless this AGR thing is taken care of, I don't think there is any point in, fundamentally any point in investing in Vodafone Idea. Even if you look at the operations, they are lagging to 4G. Forget about 5G being launched in the entire country. The RPUs are the lowest in the industry. You have good companies in the sector, maybe a Jio or a Airtel doing very, very well. So why not invest into that? But yes, for small trading and all, maybe punting, you can take this as a options market where you buy a 6 rupee option in a hope of maybe going to 12 rupees or going to zero. So if somebody's ready to take that kind of risk, Vodafone can be a buy. But fundamentally, it's a avoid from a side.
So that's with regards to where Vodafone Idea stands, and as and when the news comes, we'll keep updating you on the entire Vodafone Idea saga. All right, our next caller, Harish, is calling in from Pune. Harish, very good morning to you. How can we help you?
Yeah, very good morning. I can see news about block deal of Tata Tech flashing on your screen.
Correct.
And my query is about Tata Tech only. Being a retail investor, I did take a largest position of my portfolio in Tata Tech. I have 93 shares at an average of around 900 rupees.
Okay.
So can I, keeping the electronic vehicles future in mind, and Tata Tech into, keeping the advanced features of Tata Motors in mind,
Correct.
what could be the future of Tata Tech, and is it a hold for long term, or what? Please suggest.
Okay, Harish, I got your question. I'll take this up with Rajesh. Rajesh, the block deal that he's talking about is roughly 2.1% of the equity changing hands today, and it's probably a clean deal there. What's your view with regards to where future of Tata Tech stands?
It's have been very surprising that despite being such a good company, doing very well, previously they were catering to a large part of their revenue came from Tata Motors only. Now they have diversified their not only client base, they diversified their product profile also. And despite that, the stock has done nothing on the bourses. I remember on the day of the listing, or 1 or 2 days after the listing, it was quoting at around 1,300, 1,400 odd rupees, and now it's 750. That's almost 50% correction, and there is nothing wrong with the fundamentals, I would say. So it's very surprising the way it has behaved on the market. But for a long-term horizon, I think at these levels, at 750, 760 odd levels, it's a good buy from our side. One can expect at least 15 to 20% return in the next 1 year.
All right, so that's the view on Tata Tech. By the way, as our viewer pointed out, there was a large trade, and some of these stocks reacting quite sharply to those large trades. We've got Sikan calling us from Odisha next. Hi, Sikan. Good morning to you. How can we help you?
Good morning.
Please go ahead.
Hello.
Yes, I can hear you.
I'm holding JSW Energy since last 2 months at 523, and I haven't booked any profit yet. So how much more time I should hold this stock?
Okay. So the stock is currently at 507. Did you have a specific target in mind?
Like 4 to 5% short-term gain.
Okay. All right. So let me go across to Vaishali. Vaishali, he is holding on for gains, and so therefore, is that likely?
So I don't see much of a momentum setting in JSW. That's the one which we are looking at, right? JSW Energy. It's just been oscillating between 480 to 520. The actual strength comes only above 520 levels. So for now, I would say if he is holding, look at 520 levels as resistance, and then see if it goes higher, then continue holding.
All right. It's time now for the rapid fire round, and this is where Rajesh as well as Vaishali, we throw as many questions as possible at you over 2 minutes. The first one is on PNB, and we've spoken about a few public sector banks. Would you buy, sell or hold at 100 rupees per share, Vaishali?
Hold.
All right, the next question is on Quality Power Electricals. Rajan has bought 50 odd shares and wants to hold for the next 3 years. Rajesh, not sure if you have a view on this one.
We don't cover this.
Okay, RVNL, short-term and long-term target. This is for 6 months at the very least, bought at levels of 125. Would you hold, Vaishali?
Definitely hold.
All right, Gillette India is the next counter. Praveen Kumar wants to know if he can make an entry in this particular counter or not. Rajesh, your view?
Bye.
Central Bank of India, 15,000 shares, bought at 40.8 rupees per share. Would you hold at this point? Ishant wants to know. Vaishali?
Hold.
Alcargo Gati is the next counter. The viewer from Bangalore is holding around 150 odd shares and wants to know if he can continue to hold for the long-term perspective. Rajesh, your view?
Sell.
Oberoi Realty, for a period of 2 months, bought at levels of 1,676. Kusuma from Pune wants to know, any price targets? Vaishali, for you.
Yes, so price target will be around 1,900 to 2,000 levels first.
Okay, Vedant has 200 shares of HDFC and wants to know if we can sell and buy Coforge. Is that the right thing to do, Rajesh?
We have an ad call on HDFC Bank. Rather, I would say ad.
Okay, the next one is Servotech. Interesting. Stock in focus today on the back of an order win. Any view on this one, Rajesh? Sunita wants to know. She bought at levels of 125.
Hold.
Okay, Infosys is the next counter. Abhishek wants to know if you can continue to hold from a longer term perspective. Your view, Rajesh? Rajesh, your view?
You said
Yeah.
Infosys, right?
Infosys, yes.
It's a buy from my side.
Okay, Mazgon Dock Shipbuilders bought at 3,512. Short-term view is being sought by Vijay Kumar. Vaishali on the charts?
Well, continue holding stop loss 3,300.
Okay. All right. Thank you so much to the both of you for joining in. Rajesh, Vaishali, always a pleasure having you on the program. And well, that brings us to the end of this edition of Ask Profit. It's been an absolute pleasure bringing it to you from Mahima and myself and the team that put this show together. Thank you so much for watching. Do stay tuned. As we've told you, KYC is up next.
That's huge. That is a biggie. It's out of
गोल्ड ग्लास क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term? Buy, sell or hold?
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? Hello and welcome. You're watching KYC. I'm Harsh Saita. With me is my Varsha Jani, and you wouldn't have guessed which stock we're going to talk about today because it's a sector where the leader, which is Indian Hotels, has done 7.5x since April of 2021. So in the last 4 years, if you would have invested in Indian Hotels well after COVID, Mahima,
Yes.
it's a 7.5 bagger for you, which surely moves the needle for most of us. So that's why this one becomes interesting. It's the most recent listing within the hotel space after the Leela, obviously. But ITC Hotels is the one that we're going to be talking about today. What I want to know about ITC, I want to first understand whether it's a good play within the hospitality space. There are plenty of options. I want to understand whether this one is the good one because the potential is large. The re-rating has been significant. So is this a good time to really enter in the hospitality space? Second one, they're doing a huge pivot. They are moving from the current ownership model towards management contracts. What's the margin upside here is what I want to understand. The third one is free cash flow. What's the kind of growth expectation which one can expect on the free cash flow front going forward? Largely because all of the free cash flow that will come onto the balance sheet will likely be utilized somewhere, because it's going to be capex light in terms of the model that they are adopting. Sustenance of the low capex goal. So hopefully no large capex plans by the company. What do they do with the excess cash therefore? So it's more of the free cash flow that I'm going to talk about. What's the applicability of that? What's the outlook like? How quickly can they grow? I also want to know the basic, right? What's the margin play between an owned hotel and a managed hotel? This is something I have been consistently talking to you as well as trying to understand. But we're not getting a clear answer, and hopefully we'll get an absolutely clear answer, because that pivot from owned to managed is going to be large, and that's why I want to know what the margin profile is like. How likely is demand to exceed supply? We're reading lots of analyst notes which are talking about demand outstripping supply in a large fashion. Now ITC is well placed to ride that wave, but how likely is that to even happen? Because valuations have built in some bit of positivity, but you want to understand the likelihood of that playing out. So all of that and more is what we'll talk about. Let me first start off with what the company does, and we'll start right from the very basic. It's a 50-year-old hotel chain. It was started by ITC Limited, of course, from the cash flow coming in from the cigarettes business in 1975. It now owns and manages 140 hotels. The first hotel was started in Chennai. It's demerged from ITC Limited in Jan of 2025. The ascribed value, Mahima, was around 270 rupees. So currently trading at a discount. So that's the other thing that's very interesting. And it's the number 2 listed hotelier in the country, brand wise as well as size wise, and that's saying something, because India's penetration in terms of hotels is very, very low. So this could well be that play. Let's talk about the models in the hotel industry and what's really led to this large turnaround, right? It's been a significant turnaround, and IHCL has been at the forefront of that. ITC, of course, has ridden the wave because of the fact that a large part of the valuation was captured inside ITC Limited and has now come outside ITC Limited. But firstly is the brand name, is the own hotels business, where the hotel is actually owned by the company. Like for example, an ITC Hotels owns the hotel itself. So it's a capex heavy business. Brand name is owned by the hotel, capex done by the company. So if ITC were to do the capex itself, it's a heavy capex business. The management, marketing as well as operations completely managed by the hotel chain. Let's talk about management contracts now. Owners retain property rights. So there are now two parties. One is the owner, one is the hotel manager and the brand. So the owners retain the hotel rights, the property rights, but the management company, which is ITC Hotels in this case, handles the day-to-day operations. Profits are shared, capex put up by the owner. There's no capex put up by the management company mostly, which is ITC Hotels, and brands are provided by the management company, which is it's branded under the ITC Hotels umbrella. Okay. Anything you want to add here?
Right, absolutely. And as you rightly mentioned, it has a current portfolio of around 140 odd hotels.
Yes.
And the keys right now are at 13,000 odd keys,
yes.
Of which, as per Jeffrey's report, 45 are owned at present and 55 are managed. But this 55 as a percentage will increase. And the margins that you were talking about, we were discussing as to how the owned margins are around 45 odd percent, 35 to 36 odd percent, but the managed margins go up to almost 70 odd percent. So we'll have to see if management contracts go up, how blended margins will go up.
Correct.
In terms of the brands, in terms of before we go on to the brands, we have the target that the management has already given with respect to how they will expand their entire hotel category. They are planning to expand up to 200 hotels. So the total hotels that they will be adding in the next 5 years is roughly 60 odd hotels, 18,000 keys, of which the change in the mix of owned versus managed will go from 45, the owned will come down to 35 and managed will go up to 65%. In terms of...
Mahima, I just want to come in for 1 second here.
Yeah.
Let's look at that graphic one more time and let's flip back to the earlier graphic in current footprint. And this is what really stands out for me.
Yeah.
You look at the number of keys owned, around 5,800 currently in the owned space. In the managed space, it's 7,200. If I flip this forward, what we are seeing is that the ownership share is up only about 10% from now till calendar year 30. But look at the managed number. It's gone up by 4,500. This is where a large part of the re-rating is going to play out. So while it's only a 10% flip, but it's a very, very large, significant size increase that's going to come from here. Sorry.
Absolutely. And in terms of the brands as well, so if you look at the brands, it operates under 6 different brands. That is your ITC Hotel, Mementos, Welcome Hotel, Story, Fortune, as well as Welcome Heritage. Now, in terms of how these are divided, in the luxury segment, we have ITC Hotels and Mementos, where around 16 hotels and 16 hotels for ITC Hotels and around 4,700 odd keys. For Mementos, they have 2 hotels and 181 odd keys. And in terms of the segmental mix, right now ITC Hotels is 11%. And Mementos is roughly 1%. Welcome Hotels, on the other hand, is around 19% of the total portfolio. So that's the biggest chunk where it comes to all of these 6 brands. In terms of Story, there are 7 hotels and 191 keys. So that's 5% of the total portfolio. Fortune is mid to upscale segment restaurant hotel, where around 56 hotels operate under this brand, and that makes up to 39% of the total portfolio. And lastly, Welcome Heritage, which is their heritage resorts, is roughly 24% of the total hotels, and roughly 35 hotels come under this particular category. In terms of the overall brand-wise inventory mix, if we see, there you go. This is the overall mix. ITC Hotel and Mementos is roughly 37%. Welcome Hotels and Story is roughly 24%. Fortune is 31%. And Welcome Heritage is roughly 8%. In terms of the growth target as well, management is focusing right now on Welcome Hotel, Story, as well as Fortune. So these will be the 3 brands where management contracts will take place, and these are the pockets where the growth will actually come from. So this is everything that you need to know about the company per se, and then of course the parameters that we take up for judging the company in terms of ratings.
Absolutely. Let's look at those. In fact, so we've kind of broken this down into parameters starting from income statement, balance sheet, cash flow, and in the income statement we'll also look at some operational metrics which Mahima has pulled out. Cash flow, return ratios. We'll thereafter look at shareholding, street cred, valuation, and street coverage. So that's how we'll break this up. Mahima, why don't we go with income statement?
Absolutely. So in terms of income statement, well, great set of numbers here. In terms of revenue, we see a 3-year CAGR of almost 39% for the counter. In terms of EBITDA also, the 3-year CAGR has been a whooping 157%. Plus, in terms of net profits as well, the company has managed to grow pretty well from FY24, where it stood at around 400 odd crores. It's gone to almost 698 crores in FY25. So great set of numbers there. Margins have slightly improved from 33 to 34%. But as we mentioned earlier as well, the management has said that they will move to management contracts, which means that margins will definitely go higher going ahead. So the blended margins will definitely improve. But the question here is really that to what extent will they improve, and that's something that we'll be asking the analyst as well. In terms of operational metrics also, they have been on an increasing trend and improving trend. The average revenue rate, average room rate, which was around 12,000 in FY24 has gone to 12,500 in FY25. The RevPAR, which was around 8,200 in FY24, has gone to around 9,100 in FY25. Occupancy has gone from 69% to 73%, which has not been the case for hotels this particular year. This has only been seen in ITC hotels. Otherwise, if you see IHCL, EIH, Lemon Trees, everywhere the occupancy has remained in that 68 to 70% range, but ITC has seen occupancy rate of 73% in FY25. In terms of the RevPAR that comes from premium segment, that is almost 30% of the total RevPAR. In terms of operational efficiencies also, the company has improved quite significantly. The gross food cost has been reduced to 24% from 27%, energy cost to 5% from 7%, payroll cost has come down to 21% from 28%, and other operating costs has also come down to 28% from 30%. In terms of the segmental mix where revenue is concerned, room contributes around 52 odd percent, food and beverages contributes around 40 odd percent, and the other categories around 8 odd percent. And they've also signed 54 hotels in terms of last 2 years, and also signed 30 odd hotels for management contracts in the past 2 years. So that's and that is one of the reasons as to why we've seen a significant amount of uptick in the financials of the company. So that's where
EBITDA especially. You look at that EBITDA number, it's very impressive. And Mahima, it's my understanding is it's two factors, and correct me if I'm wrong. One is the fact that your occupancy has gone up.
Correct.
So your fixed cost base remains the same.
Correct.
The number of people you employ in a hotel remains the same.
Correct.
But because your occupancy has gone up, the number of people residing there has gone up, that flow through to the bottom line
Correct.
is immediate. And that makes a big impact in terms of growth on the EBITDA number. So that's one. And the second thing is these reductions in costs. Give me perspective. So these reductions in costs are a percentage of top line.
Correct. As a percentage of top line, and that has been reduced. So the reduction that I'm talking about has happened in the past 4 odd years. So as a percentage of top line, and so as you were mentioning earlier as well, it's not just how these occupancy ratios have improved, but it's also the operational efficiency that has aided the EBITDA as well as the bottom line.
Sure. Okay. So that's on the top line. Very impressive numbers for sure. No contention there. Let's talk about the balance sheet. Now, no concerns here. They've got around 1,600 crores of cash. They've got a decent amount of equity size. Their borrowing is nearly zero, and there's no concern with regard to debt, because look at the amount of cash sitting on the balance sheet. It's 1,600 odd crore. That's part of the demerger. 1,500 crore was given over to an ITC Hotels. There's very little capex that's planned in, or rather compared to the quantum of cash it's generating, and therefore there's no concern with regard to this one. Let's talk about cash flow, Mahima, very quickly.
Right. So cash flows, again, a healthy set of numbers. It's improved from 670 odd crores to 803 crores in FY25. That is from operations. Even the ratio of cash flow from operations to PAT has improved. In terms of the net cash flows, they are also strong enough here. So I mean, overall cash flow position stays strong. Plus, the ITC as a parent company has also decided to invest some amount every year in ITC Hotels. So I don't think cash is a problem for ITC Hotels for now.
Perfect. I'd in fact want to know what they do with that extra cash that keeps coming in. That's what I'm curious about. Let's talk about return ratios though, because that's the other piece which is the key. You want your return ratios to be good, but we are not seeing double-digit ROE. Even ROC is just about double-digit. That's because of the pivot from owned hotels to managed hotels. That entire pivot is yet to happen. You'd want to see how much this ROCE can go up by. Of course, it's an upward trend. It will likely go up as well, continue to go up, but at the moment it's falling short of expectations. So we've given this a thumbs down. Shareholding, Mahima.
Right. So shareholding, since the company is just listed, we just have the information with regards to March quarter, where promoters is roughly almost 40% of the total equity, FI is around 25%, DI 21%, and public shareholding 13%. But the overhang here is BAT, because BAT has sold stake in ITC but not ITC Hotels. Analysts are expecting that might not happen for the next 2 to 3 odd quarters, but BAT still holds almost 15% in ITC Hotels. So that is one overhang where shareholding pattern comes into play.
That's a large overhang. Yes. That's a large risk as well. So something to keep in mind. Let's talk about street cred. Now, I did mention that this one will likely be a neutral because of the fact that while the performance since listing has been quite strong, what we're seeing is that what ITC's implied value per share was basis tax disclosures that they had to make was far higher than the current stock price, which is roughly at around 270 odd was the number which ITC was penciling in, and 188 was the list price, after which the stock in fact went down by another 10 odd %. So, and thereafter has rebounded. So So that's the nature of the way in which the stock has moved, and hence the neutral with regard to street cred. But Mahima, valuations, that's the most complex part of this.
Absolutely. So, when I was seeing the valuations as compared to how peers are concerned, well, all of them are trading at very high PE levels, right? In terms of the MCAP to EBITDA level also, and the PE levels also, even going forward in FY26, FY27, for ITC hotels, it goes to around 49 times in 26 to 40 times in FY27. As compared to that, IHCL trades at around 56 times right now, which might go to around 51 times and 43 times. So, I mean, both the top two players in this industry, both of them are very expensive. As compared to that, EIH is slightly less expensive, trading in that 30 to 35 X odd range. And Lemon Tree is interesting here because of their addition of keys that they're going extremely high. That's one of the reasons as to why their PE is expected to come down to almost 29 times in FY27. So overall, all hotels definitely very expensive, and ITC is also not looking very cheap. So we've given a neutral rating here because as compared to peers also, it's trading in the same range.
Let's talk about how analysts are viewing this one. So street coverage, you have just about 4 analysts tracking this one with an 8% upside, so nothing material. We've given this a neutral and close this off. Let's quickly look at all of the KYC metrics that we have analyzed. The income statement, balance sheet, cash flow, thumbs up on all 3. Return ratios, definitely asking for more right here. 100%. What you want to see is shareholding pattern is a neutral because there's some bit of overhang from BAT. Street cred is a neutral because of what we just talked about. Valuations are a neutral because largely in line with the sector leader, which is IHCL, and if you're getting an IHCL at the same price, hey, why wouldn't you consider it? And street coverage is also a neutral. So it stacks up as a 5 out of 8 on our KYC ratings. But let's bring on board Mr. Prashant Biani, who's the Vice President of Institutional Equity Research and Sector Lead for Agri Inputs, Sugar and Hotels at Elara Securities. Now, welcome on board, Prashant. Prashant, I want to first start off with trying to understand this model of owned versus managed. What should the margin expectations broadly be for ownership versus managed hotels? So just give us that context and thereafter give us the kicker from here. What's the expectation like in terms of revenue accretion from today for the next 5 years on ITC hotels, and how much of that will come from managed?
Sure. So first thing on owned versus managed, while margins for managed hotels is good, it can range to the extent of 80% because on the management fee part, you don't have any major cost. At max, you will incur around 10 to 20% under few for advertisements and other purposes. But other than that, you have management fee business operates at around 80% EBITDA margin. But on the owned hotels, if you see, mostly the luxury hoteliers tend to earn margins of anywhere between 33 to 37%. But the key difference between the two is that the EBITDA from owned hotels is chunky, whereas the EBITDA from management fee business would be small in absolute terms vis-a-vis owned hotels EBITDA. So therein lies the difference between the two. It is not that one business model is better than the other. I think in India, the right model will be a mix of owned as well as managed. Because for every one hotel that gives you EBITDA, you can compensate that with maybe 7 to 10 managed hotels. So I think the right way forward would be a mix of both. And then answering to your second question, I think over the next 3 to 4 years, the ITC hotels revenue growth we are expecting is between 15% CAGR. And part of it will be driven by the hotel business, and some of it will also be driven by the sale of luxury residential apartments that they will start off from this year in their latest property in ITC Ratnadipa, which is in Sri Lanka.
Prashant, hi, Mahima also joining in. Just want to understand that because they have said that management contracts will go up to almost 65% of the total portfolio by FY30, what do you think the blended margins will go to? Because right now, owned hotels is roughly 35 to 36% of margins, but in terms of management contracts, that goes up to 70% in terms of margins. So then, where do you think blended margins will stand at?
Yeah, so we expect margin expansion of around 300 to 400 bips over the next 4 years. Certainly, part of it will be driven by growth in management fee. And then we will also see EBITDA accretion from the sale of luxury residential apartments, which is also a high margin business. So both of them will contribute to the margin accretion for ITC hotels.
Just do the rough math, Prashant, on an Excel file. 15% growth for 4 years takes me to a top line of around 6,300 odd crore. Around a 37% margin on that will roughly mean 2,500 crore of EBITDA. Am I right in kind of laying these numbers out?
So till FY28 or by FY28, we are expecting top line of around 5,300 to 5,400 crore for ITC hotels, and EBITDA of somewhere between 2,000 to 2,100 crores. That would imply a margin of around 38% for the company.
Prashant, just want to understand, right now the company is sitting on a cash of roughly 1,600 odd crores right now. The company has also said that they will invest roughly 300 crores every year in terms of capex, that is around 8 to 10% of their total revenue. Plus, ITC is also expected to infuse around 1,500 crore post that demerger, which has still not happened. Just want to understand as to how this entire cash flow will be put to use.
I think that 1,500 crore from ITC has already been infused. So they have a net cash of around 1,500 to 1,600 crore already. And going forward also, I think the cash generation is likely to be quite good. So that is a concern from our side also. While cash on an isolated basis is good to have, but it also drags your return ratio. And if you look at their own hotel pipeline, right now they have a pipeline of around 400 to 500 keys in the owned portfolio, which they will start over the next 2 to 3 years. So I think as an analyst, I would like to see more properties on the owned side. If they opt for a greenfield expansion, then certainly I think on the luxury side, it will take at least 5 years to come up with something. So deployment of cash is something that Street will also be looking out for from the management.
Very interesting, Prashant, that you're looking at this from an owned angle when everyone's looking at this more from a managed hotels angle. Let me ask you, what's driving occupancy for ITC? Because Mahima was suggesting earlier in the show that the occupancy rates have gone up in a more significant fashion versus peers. So what's driving that in your opinion?
So the first driver for occupancy is the commencement of ITC Ratnadeepa, which they started in April itself. So they started with 250 keys and now they have opened it full-fledged 352 keys. So occupancy ramp up at that hotel will be the key driver. Other than that, for the new hotels that they have opened since 2020, I think occupancy in those hotels have also not yet reached the optimum levels. So then that is the second driver, that occupancy ramp up at recently owned hotels. That would, and the third driver is that typically most of the hotels go for renovation after a period of every few years. So that generally leads to some of the room closures on a recurring basis. So once those renovations are complete, then that will also drive occupancy for the owned portfolio. So these are the main factors, and then certainly you have tailwinds in terms of hotel industry doing quite good. So these are the factors which is driving occupancy for ITC hotels.
Prashant, regarding the batch stake sale, because that holds almost 15% of ITC hotels, how much of an overhang do you think will that have on the stock, and till what time will that overhang continue? Do you think that BAT will come out and sell their stake in next 2 to 3 quarters, or there's still time?
That I think only BAT will be able to answer, but it will certainly be a overhang on the stock because I think 15% in a business which is not related to them, they would certainly would like to exit from the company. But timing, I think, is best would be best decided by them. But 15% is a large stake, and I think it may create an overhang for some time on the stock.
Prashant, if I were just to extrapolate the numbers, it's trading at around 20 times free cash flow FY28, or rather operating cash flow FY28, because we don't know how much capex they'll put up. Is this looking expensive for you? How should you view it with a high level of certainty? This doesn't look too bad, right?
So we still, I think there is still some upside on ITC hotels, but I think we would rather than looking at from a cash flow valuation, I would rather look for more cash deployment. But I think we have a target price of somewhere around 230 on the stock. We have valued it on SOTP, valuing hotel business separately, and also the bifurcation of residential real estate business. So I think there is still some upside on the stock, but it may be subject to revising upwards, provided they provide us more clarity on the owned portfolio pipeline if they plan to come up with something.
Okay, thank you so much, Prashant, for joining us. That gives us great amounts of clarity with regard to how ITC will likely play out. And viewers, in fact, that's all the time we have as well. So from Mahima, myself, everyone who puts the show together, thanks so much for watching. Of course, ITC Hotels, do you like it or not? Something that we leave with you, but completely out of time on this one.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term? Buy, sell or hold?
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock.
Well, a rare confluence of structural tailwinds make India a great long-term story. This, in a very simple nutshell, is how I would classify or call one of the key reports that has come out of the stable of Bank of America. And as we sit in the venue of their India Investor Conference, it's an absolute delight to speak to Amish Shah. As he outlines, how does he think India stands in the investing pecking order from his perspective, and what has the conference been all about as well? Amish, great having you. Thank you so much for talking to us. And thank you for having us here.
Thank you for coming down, Neeraj.
No, the pleasure is entirely mine. Amish, so tell us, we'll come to the note as well, but I just want to get the rumblings of the conference. I hear from your team and from others that this has been an unprecedented attendance, both from the corporates as well as the investing community. Tell us a bit about the conference. What was the theme showcased or the principal messaging, and what is it that you've told both investors and corporates?
Sure. So Neeraj, meaning as you know, we restarted our India conference, for the last 3 years. It's only kept on becoming bigger. This year, we are hosting 107 corporates. We have about 450 investors. There are 21 plenary sessions, and there are already 1,500 conversations that have happened between investors and corporates. But we are not stopping. So our conference comes to an end today. But we are continuing for the next 2 days through this week with 6 field trips. So these are investors who want to see the real India.
Okay.
So they want to go and see a manufacturing facility. So there's a manufacturing tour. Or you want to go and talk to the dealers, distributors on a consumption tour. I'm myself hosting a policy tour where we will have all the key bureaucrats or the policy makers, speak about what are they thinking about, how they want to drive the policy making going forward. So there are 6 different themes across different sectors, and then we will be continuing with those trips as well. Coming to the theme of the conference.
So sorry, just before we get there. So it's interesting, Amish, that all of this is happening, and this unprecedented India interest, if I can use that term loosely, is happening at a point of time when Amish is telling people that the Nifty's done its course and we don't see much upside. So there is wide India interest despite the fact that the markets may not have near-term gains.
Absolutely, because everybody wants to keep India on its radar.
Okay.
Back in the time, like let's say if I rewind 5 years back, India's weight in MSCI emerging markets was only about 8.5%. Now it's close to 20%. So it's no longer a market that, even as an emerging market fund manager, obviously as an India dedicated fund manager, you want to know what's happening in India. But even as an emerging market fund manager, 20% is a pretty large weight. We are just a shade below China now. China is about 24%, right? So it is a market of relevance. You may not want to invest immediately, but you want to keep it on your radar. You also want to meet these companies, do your homework, find out what is a price at which you will ideally buy these companies, and if these prices were to come, then you have to be ready to jump onto it, because Indian markets, as we know, is a structural growth opportunity. It won't give you that opportunity for long, so you have to be prepared for it. So absolutely, from an interest perspective, therefore, despite full valuations, and we'll speak about that, definitely a lot of interest right now.
Okay, now the theme of the conference. What is it that you are telling your set of investors who are coming? I heard 450 the number, so that's a very large number. What is it that you're telling investors about? Why is it, or what is it that within India they should see? What's the central theme of the conference?
So the central theme is about accelerating growth, and we have named that because we think that we are now all know that over the last 3-4 quarters growth did come down, and there are a variety of factors to that. The most commonly being spoken about is that there was over tightening of fiscal, there was an over tightening of monetary policy, and as a result that led to some growth come off, and then there was credit growth contracting as well. So a confluence of all of this led to corporate earnings growth coming off as well. But everyone expects the growth to now accelerate because the monetary policy has completely turned its course. We are now talking about lesser regulations, more liquidity, lower rates, and so on and so forth. In fact, there's a possibility for even a fiscal stimulus now, because RBI has given dividends which are slightly higher than what the government had budgeted. Crude prices are lower. As a result, government has hiked the excise duties on the petrol and diesel at the pump. That gives additional sources of revenues to the government. So all of this put together, there is therefore a question on whether the government now has a room to go and spend that money and do a small fiscal stimulus on the back of it. So all of these factors put together on the back of the low base of growth clearly means that the growth will accelerate. In what form, how structural, that is all up for debate, but there is definitely a growth acceleration, and therefore the central theme is accelerating growth.
Great. Can I actually just go a bit minutiae for a moment, and then we'll come to how investors are receiving this, what are the conversations like? At the end of Q4, an overarching view is that we might do about 10-12%, what have you, the number, right? And I remember a conversation that we had at our studios when you had come down, when you were saying that the pricing power is not quite there with the Indian corporate right now. So the possibilities of the numbers coming down might also stay. Now my question to you is, what is your stance right now, particularly in light of the fact that, in my view, we have a favorable base effect for Q1 and Q2, and that optically might bump up the growth number, even though in absolute numbers, the EPS may be X or Y or Z. So how do you think about growth, earnings growth, Nifty 50 or whatever benchmark you may want to choose for FY26 now?
So, Neeraj, meaning as I said, that for the sequentially there will be an acceleration of growth.
Right.
So, to put numbers to this, if I look at Nifty, the earnings growth that it has delivered in fiscal 25 is 5.5%. Now, obviously, you can slice dice it, because if you want to look at optimistically, you will say that let's look at X financials, X energy. Even if you do X financials, X energy, which is generally the sectors that has dragged growth, Nifty earnings growth has been 7% in FY25, and this is nominal earnings growth, whereas the nominal GDP itself has grown at around 10%, right? So corporate earnings for the largest set of Indian companies is lower than the nominal GDP growth, and that is a low base that you speak about. On that low base, in FY26, we are arguing for a 9% earnings growth, which is again a shade lower than nominal GDP growth, or maybe at best equal to nominal GDP growth. There is no large acceleration to it. Now, when we come to the concerns on why we are not so optimistic on markets from a near-term perspective, I would say that markets, as we know, is all about what is already priced in. So when we began this calendar year, for FY26, consensus expectation was 22% earnings growth, because they thought that on a low base, the growth can be quite sharp. We were arguing for 9. We are still at 9. Consensus is down from 22 to 13. So, and then 13 will further, in our view, keep coming down to 9. So in a way, tying up the two things that we've spoken so far, is there an acceleration of growth? Yes, because 5.5 will go to 9. But, is that good enough from a market's perspective? Not really, because 9 is weaker than 13 that markets are already pricing in.
Okay. So which is why the upsides are capped. Yes. Can the capping of the upsides change if indeed we see this fiscal stimulus? I believe a monetary policy easing of anywhere between 50 to 100, whatever the debated number might be, is already baked in?
So the short answer is that 9 is after budgeting for that fiscal stimulus.
Okay.
Because while I spoke about the positives of the fiscal math, the concern that we have is that personal income taxes, despite 1 trillion rupees of tax breaks that government has budgeted for, the personal income tax growth budgeted for F26 is 14%, which we think is quite optimistic. We think that in reality that number will end up at about 11. So you will have a slight disappointment in your personal income tax collection, which to some extent will get filled up with the excise duty collections on petrol and diesel, plus the extra RBI and possibly even the PSU dividends. So at the margin, we think that the budget will get balanced, but there is not too much scope to do a large stimulus as of now.
Okay. So, I'll get to the minutiae, and then I'll want a sense from you about what happens to India in the light of what's happening across the world as well, right? Because I'm sure you have a view there. But since we are on the topic of India, where is it that within this conversation of this 9% earnings growth that you are penciling in, would the outliers be, or the beneficiaries be, or the ones which the investors would want to go for be? That list versus where is it that you are anti-consensus, wherein the street might be constructive, but you believe that those themes may not necessarily give adequate returns, let's say over the next 12 months?
So let me start with the anti-consensus one first. First of all, I would say that, would like to believe that our views on market itself is anti-consensus. Generally, there is a lot of optimism on India right now, and we are optimistic as well, but not at these valuations, right? And then I would say it's the capex theme. So capex is something that we were, for a very long period of time, were very bullish. We wrote that entire theme from 2020 to 2020 up until August of 24. But August of 24, we completely changed our mind. So from being completely bullish, we went completely bearish. So I covered 14 stocks within the capex space, and we downgraded 13 out of 14 from buys to straight sells.
Okay.
Right now,
what changed that?
Yeah. So what changed that is that if you look at the mix of capex, it was predominantly driven by government-led infrastructure. Right? And if you look at the government budgets over the last few years, let's say between FY21 to FY24, central government capex grew at the CAGR rate of 31%. Right? So which basically means that in 3 years they doubled the capex allocations. And this is already on a high base because capex allocations has been going up since FY15. So to quote some numbers, let's say if you make a pie chart of government expenditure in India, you will realize that about 72% of government expenditure is fixed expenses. So, irrespective of the political party, you cannot really change that number because it's fixed expense. The remaining 28 is really a choice on whether you want to do populism with that money or do you want to use that towards infrastructure build out, right? Over the last 10 years, what we have seen is that the share of government expenditure towards subsidies, which is populism, came down from 18.4% to 8.6%.
Okay.
Right? Whereas the number for capex went up from 9 to 30%. Right? And these ratios are expanding in an expanding pie because government expenditure obviously is growing in line with the nominal GDP growth of 10-11% each year as well, right? So in an expanding pie, 9 going to 30 is a massive shift, right? And as a result of that, that's the time when we were bullish because we saw that quarter after quarter the government was just accelerating its investments in favor of infrastructure, and that made us bullish. But back in June, July, August last year, we think that the government has now started to, rightfully so, balance consumption-led demand with capex-led investment. Because clearly the consumer economy, we know that a rural ecosystem was quite weak. They had to push that growth up. Urban, everybody had started to discuss that urban growth is now leveling off. So there was a need for a consumption stimulus. Maybe subsidies were cut too far. There was less money in the pockets of people to go and spend, and as they tried to therefore allocate more money in the pockets of people in terms of tax breaks or subsidies as we call it, clearly the run rate of growth towards capex has therefore slowed. Now, once this growth has slowed, let's please understand that this is a deep cyclical sector. So to just give you some perspective here, typically a capex cycle in India has gone on, it goes on for 8 to 10 years. And over a 10-year period, what we have seen is that the entire P&L of an industrial sector company becomes a multiplication factor. So because when the orders are accelerating or the growth in new capex is accelerating, you get pricing power, so your margins go up. You also can improve your working capital because you can go to your client and say that, I need to be paid faster because I have other jobs to complete. And the client also wants to complete it faster because he can see a momentum in the economy. So you want to get the project, like if I'm building an airport, for example, I want the airport to be finished fast so that I can have footfalls coming in immediately, right? So it's in everybody's interest to accelerate the pace of that. So you're talking about more orders, faster execution, better margins, better working capital. And as a result, we have seen that ROEs of these companies from a down cycle to an up cycle in a 10-year period triples. And because your ROEs triple, obviously you have to expand valuation multiples as well. Right? So therefore you get double whammy in these stocks that your earnings growth is accelerating and your valuation multiples are also expanding, and that's why these sectors become multi-baggers, which is the wave that we wanted to ride or we ideally did ride between 20 to 2024. But at the conversely, when this pivots, on the down cycle is the same story, that if the orders slow, then it will bring along with it margin pressures, it will bring along with it working capital pressures,
and therefore valuation derating.
And therefore valuation derating. Right?
So you are in that cycle now, you think?
So I would say we are not in a down cycle, but we are not in an up cycle. So we are now going to be firmly in a mid cycle. So let me put it this way, that we think that over the last 3 years, government, private and PSU capex all combined was growing at 20% on an annual basis. We think that will now slow down to 10.5. So 20 down to 10.5, I would not call it as a down cycle, because down cycle numbers go down to 5% growth. So we are not in the 5% camp, but we are not in the 20 camp. We are somewhere in between, and 10.5 is broadly the nominal GDP growth of India. So I would say if you were to calculate a ratio of capex divided by GDP, it will be like a flat line.
Got it.
And from a company perspective, it will be weaker than what you already expect in growth. Until the time the stocks don't budget for it, I think there is a need to be cautious.
Okay, so just so that the viewers understand as well, I'm not asking you to name names, but I'm saying that the companies in that capex cycle, which could be MNC names like ABB, Siemens, etc., or L&Ts of the world, all of that might be in a mid-cycle thing. My question to you is, presumably, could there be outliers to this? Like, for example, the government may do larger defense capex because, now there is proof of concept because of the sad conflict, if you will, right? So could there be outliers to this in the capex theme per se?
Absolutely, yes. And the better way to cut it is to say that, we divide capex into 4 parts.
Okay.
So central government-led capex, state government-led capex, PSU-led capex, and private sector-led capex, right? Now, each one of them have their own dynamics. So we think that the state government capex is going to shrink the most.
Okay.
So any sector which is linked to, or companies that are linked to catering to the state capex, and this is primarily water, irrigation, power distribution, metro rail, and state highways. So these are the top 5 categories where the state government spends its money. So if you are a company catering to that side of the capex, you are going to be the most hit.
Okay.
Right. If you are catering to the central government capex, and central government spends most of its money on highways, railways, and defense.
Okay.
So if you are a company catering to that, you are moderately impacted because the growth is coming down, but not coming down as sharply as it is coming down for the state governments. If you are a company catering to PSUs, you have relatively negligible impact because PSUs have their own balance sheets. They don't have to rely on government budgets for them to make their capex decisions. So they will continue to spend what they were already spending. So there are no breaks to their overall capex. So you're actually quite well positioned. And within private, it's actually further bifurcation, because private is a combination of real estate capex, industrial capex, so new steel, cement, etc. plants, BOT projects like toll roads, BOT airports, etc. And it's all the new age industries like semiconductors, data centers, biofuels, green hydrogen, which is the new kind of things where private is spending money. So depending on where you are, touching the private capex, the growth rates are different.
Okay.
So to sum it up, I would say that the worst is the ones exposed to state capex. The best is actually the ones exposed to PSU capex, and then center and private is somewhere in between.
Okay. So just to rewind the 2 questions, the PSU capex beneficiaries, you reckon there the upcycle might still be there, so the valuation multiples might still stay high if they are high already?
That's right. So relatively clearly you can say one versus the other, but wearing my strategy hat on, I would say that the whole sector will underperform in comparison to something else.
Got it. One last question there. I heard you say power distribution as well, but I thought transmission and distribution is actually in a very sweet spot. Evacuation issues, lot of transmission needs to set up even now, and therefore that is in a sweet spot. You don't agree?
So transmission yes, distribution not. Transmission is predominantly the job of private or PSU companies, which is, as I said, the capex which is doing well and is not going to get impacted. Power distribution is a domain of state governments.
Okay.
Primarily, there are literally some licenses that you can count on your fingers where distribution is done by the private sector, but by and large power distribution is a state government domain and which will get impacted.
So cables, transformers, etc., all of which are in the transmission space might still continue to do okay because they'll get orders.
Correct.
Okay, perfect. Now, where your strategy at is and I'll have a final question on the report because the 9 structural drivers for India is great, right? But just one more thing. So now, where in your strategy hat, we've discussed capex, you are anti-consensus there. Where is it that you are constructive?
So we are constructive on anything which is a rate-sensitive sector because, as we discussed, is there a need to stimulate growth in India? Yes. Can you stimulate growth through fiscal measures? Tough. Because as we discussed, government budgeted tax revenues, etc., may be a tad bit disappointing, and that disappointment will get covered up with RBI, etc., excess dividends. So fiscal, I think, the government will just be able to balance its budget the way they have estimated. But we think that there is a lot of room to stimulate through monetary measures. There are plenty of tools available, in terms of more rate cards, more liquidity, fewer regulations, etc. And the government will want to use it, and in this case, RBI will want to use it. So we do think that monetary stimulus is the way to go. And as a result, any sector that benefits on the back of accommodative or a loose monetary policy is therefore what we like, and that includes rate-sensitive sectors like financials, real estate, REITs, autos, internet. So this is something that we like. And given that I'm generally cautious on markets or not that upbeat on markets right now, we are therefore also positioned in defensive sectors because if the market corrects, these are sectors that will not fall as much. So that includes things like telecom, hospitals, domestic pharma companies. Those are more defensive oriented sectors, which is where we will be overweight as well.
Not staples, not consumer staples. Okay, not consumer staples, which is interesting.
I mean, obviously, we might have one or two ideas on a bottom-up basis on stocks that we like. But if I were to generalize the staples as a sector, we still think that the growth is going to be weaker or muted growth. For the valuations that it still trades as a sector, 45 times, we are not yet excited.
Got it. My final question, Amish, and that ties in with two-part question rolled into one. It ties in with the report that you guys have written about 9 structural growth drivers and how longer-term India is great, right? So some reference of that and tying that in with what is it that changes your view? Is it a time correction? Does it, if the Nifty doesn't do anything for 6 months, broader markets kind of stay stable, does that therefore bake in the valuation discount that India should get, and therefore do you turn constructive? Is it better earnings growth which surprises you, which seems to be the obvious answer, but is that or is there something else?
So Neeraj, let me put it like this, right? If I were to purely put this in the form of arithmetic, so markets, as we know, is EPS multiplied by valuation multiple, right? And and therefore it's also about the time frame of your investment. So let's say if I were to set a price target for December of 25, which is the end of this year, I would say that, okay, what is likely to be the December 26 EPS of Nifty 1 year forward, because markets will be willing to pay 1 year forward. So what will be the December 26 EPS multiplied by the valuation multiple I'm okay to give, right? That sets my price target for December of 25. But now if I were to say that I want to set a price target for December of 26, then I'm saying that, okay, what will be the EPS of December 27 and multiplied by the P multiple, So this therefore, first of all, becomes a question of your time horizon of investment, right? The longer you want to stay put in the market, obviously, given the fact that India is a structural growth market, so earnings will keep on compounding. And if earnings keeps compounding, markets will also keep compounding. So once we have established that, the markets will keep compounding, but my entry point decides that despite that compounding, how much return will I make?
Agreed.
Right? So given the valuations that we already are, if you, let's assume that if you're an investor who wants to stay invested for 18 months, you should be expecting 8% CAGR returns, purely on the back of that math. If you are an investor who's invested for the next 7 months, you should be expecting 1% return, right? Because that is how the math works. So basically the way we have formed our views is that for December of 25, our Nifty target is 25,000, right? And in August, August of last year, so August of 24, we went bearish on markets because markets were at 26,500.
Right.
So they were already higher than my fair price, and they were higher 16 months in advance because we are in August 24 and I expect it to be at 25 by the end of December 25. Right. So because we were already higher, we went bearish. And that is the time when we had that conversation in February. But over a period of time, from August of 24, the markets came down to 22,000.
Which is when you turned constructive.
So because the markets came to 22,000, we said, this is now a 14% upside to our price target. So we turned bullish. But in 2 months' time, the markets have come back to 25,000, and which is why we are again now seeing no returns. So on Nifty, I would say that I'm not bearish, but I'm saying that it is full price.
Got it.
Right? So the markets have to therefore consolidate. You are unlikely to make too much returns. You might probably make better returns by being in fixed income markets right now, is the way to think about it. Now to your final question, assuming that the markets actually go the way I expect, and let's say by December the markets are still at 25,000, then obviously I would say that, okay, now I'm looking at December 26 EPS, and 1 year forward I will find more returns. Right, so that's a way to think about it. So structural compounding will stay. Depending on your time horizon, you have to adjust your returns therefore.
Got it. I believe I've exhausted my time. Else, I would have loved to talk about the structural 9 growth drivers as well. But there's a fabulous report, Amish, and maybe at some point of time in the next couple of months, you get the chance. We should talk about that in detail.
Absolutely.
Yeah, but thanks for having us at your conference, and all the best for the remainder of the conference.
Thank you, Neeraj.
And viewers, thanks for tuning into this broadcast.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind?
Hello and welcome to Profit Buzzers. This is Heeral Dadia. Let's quickly take a look at how markets are doing at this hour. Overall, an interesting day of trade. You're seeing, almost a 200 points gain coming in on the Sensex, Nifty 50 as well. Nearly at the day's highest levels, gains of 0.2% coming in there. What's interesting is it's inching towards the 24,600 mark. In fact, it did hit 24,612 in intraday trade. Let's pull up Bank Nifty as well and the PSU Bank Index, and then we look at the sectoral picture. Bank Nifty has also inched higher, but still little away from the day's highest levels, and the PSU banking space is clearly seeing gains of 0.4%. If you look at the sectoral heat map, interesting moves there. Media continues the upward trend as well. Apart from that, Nifty IT is seeing a good move in today's session. Infra is on the positive side as well. What's losing is real estate. In fact, yesterday that sector was trading in the positive. Today seeing some bit of profit booking. Consumer durables is down in trade as well. And you have FMCG and the private bank index, which are pretty much on the borderline. Let's look at the Nifty 50 contributors very quickly, and then you look at the broader markets as well. If you see in terms of what's contributing, HDFC Bank, the top gainer today. In fact, Alex had highlighted this one on the back of the HBD IPO. So a sentimental move coming in on that one. Bharti Airtel, you have a brokerage note which is positive on Bharti Airtel, contributing today. Zomato and Reliance Industries. What's losing is ICICI Bank, Axis Bank, TCS and LNT. Let's look at mid-cap and the small-cap index, because yesterday's session, again, there was some bit of outperformance from the broader markets, and that continues. 0.5% up move in terms of mid-cap 150, as well as if you look at small-cap 250 as well, 0.4% higher. So broader markets are clearly outperforming the benchmark indices in trade. I'm not going to really look at the individual stocks, because few names that we need to highlight over here. Spark and Sun Pharma. What's happening? A couple of trials that have probably not worked, and 18% downtick coming in on a Spark. What's interesting is Sun Pharma not reacting that negatively, just seeing marginal cuts of 0.6%. In fact, let me get in my colleague as well, Varsha, to decode this for us as to what has happened and why this kind of a stark reaction on a Spark. Varsha, over to you.
Thank you so much for that. So yes, we are seeing, as you rightly said, the setback is more for Spark than Sun Pharma. Let's see first what has happened. So the experimental drug, the Sun Pharma's experimental drug trial has failed their phase 2 drug trials. Now this is a drug which did not meet the main goals for the company. The drug was being tested in 2 mid-stage clinical trials, that is phase 2 trial, and this was conducted to treat cirrhosis and eczema. Now this drug was an oral drug, and Sun Pharma had licensed this drug to treat both the diseases. Now why the impact you are seeing is bigger on Spark than on Sun Pharma? Because one thing is, the Spark is the R&D arm of Sun Pharma, and this drug was developed by Spark, which was a $1 billion plus opportunity that investors and that people were expecting from this company. So losing this opportunity questions company's primary purpose of research and development. Future prospects of Spark was directly tied to the success of this product, and Spark factored in revenue from this drug in FY30, which is kind of at a low risk now. But the other trigger is, this is not the first time that Spark has failed when it comes to this drug trials. A trial for the Parkinson drug also failed in April 2024. So this drug was actually the biggest opportunity for the company, which now they have lost. And why impact on Sun Pharma is less severe than Spark? Because this only impact the specialty portfolio of the company, and Sun Pharma, being a very big company, doesn't impact their other operations or other generic business for the company. The potential revenue from this drug was actually not accounted in company's financials, because this was expected to come in FY30. But this is a very big setback for Spark, because of the $1 billion opportunity that company has lost now.
Right, $1 billion opportunity that is lost. Varsha, stay with us before we come to you for a PI Industries. Let me also get in Gaurang Shah. Gaurang, good afternoon and welcome to the show, and a pleasure to speak to you as always at NDTV Profit.
Thank you.
How are you looking at this drug trial failure for a Spark versus Sun Pharma? Do you think it's an opportunity lost for a Sun Pharma for a Spark, I beg your pardon, completely? Or this is just a knee-jerk reaction that you're seeing currently and it will pick up and it does become a good bet then?
Thank you so much, Hiral, for having me on the show. Good afternoon to you and to all the viewers of NDTV Profit. Like your colleague Varsha was just mentioning, this is not the first time. There has been instances in the history where not only with Sun Pharma or Spark, but with other pharmaceutical companies, trials have not turned out to be as fruitful as it would have thought of. Speaking specifically about Sun Pharma, let me give a disclosure. Our fundamental research team has a hold recommendation on Sun Pharma. Failing a particular drug trial does not mean that that's the end of the road. They can go back to their work tables, put in more efforts, and make another effort to get success. That only future can tell us as far as this particular drug is concerned. So, as a prudent disclosure, Hiral, we have our fundamental team has a hold recommendation. A Spark, my team don't have any coverage. Doesn't cover
so
Spark.
we'll let that go then. If there's, we'll let that go if no view on that one so far. But Gaurang, stay with us. PI Industries is also up in trade, and that's a positive news coming in there because a key customer in Japan has gone ahead and raised its forecast with regards to the second half of the financial year that they follow, which gets over in October 2025. Stock is at the day's highest levels with gains of 5%. Varsha, a quick one in terms of the forecast that has been upped and how does it benefit a PI Industries?
Thank you for that. So, operating forecast has been raised by 34% and they've revised their consolidated earnings forecast for second cumulative quarter. Now, why this is important for PI Industries? Because QMAI is actually a big customer for PI Industries. PI Industries supplies a herbicide called pyrosulfane to Kumai AI, and it contributes almost 35 to 38% to PI's total revenue. Now why this forecast has been revised? Because net sale is expected to exceed forecast due to advanced shipments to overseas market. Positive impact has also been seen in agriculture, chemicals and agriculture related business. And operating income, if you see, has increased significantly due to higher sales, but net income remains almost unchanged due to large foreign exchange losses caused by appreciation of yen. So because of 35 to 38% revenue tied up to your customer, and customer raising the forecast will directly benefit to PI Industries.
Thank you, Varsha, for that quick one. Gaurang, any coverage with regards to PI Industries and a view?
So the fundamental team has a coverage on PI Industries on the buy side from a long-term point of view, and our sense is that specialty agrochemicals, complex chemicals sector should do well here.
Right, so this is going to be a sector that probably could do well as Gaurang is mentioning. But moving on, you have a Man Industries that is in focus in today's day of trade as well. The stock is seeing cuts of around 2%, and this comes in after the plan to raise almost around 300 odd crores, if I'm not mistaken. And this is via a preferential issue. The fundraise is mainly to support expansion plans is what we were picking up. Let me also get in Nikhil Mansukhani, Managing Director at Man Industries, to talk to us more, and Anushi will be joining us on this conversation as well, as she tracks the sector pretty closely. Nikhil, good afternoon and welcome to the show, and a pleasure to speak to you as always. My first question coming to you is, firstly, the 300 crore fundraise. What is the main purpose and how are you going to divide that between the expansion in Saudi Arabia and Jammu, as well as your other working capital needs and deleveraging?
So the total amount is around 300 crores. The major usage is for capex. Around 50 to 60% is for capex and GCP, and approximately 40% is for the working capital. Majority of these funds are going to go for Saudi. I think more than 70% or 80% of the capex we are going to be using it for our Saudi expansion, as majority of our costs for Jammu has already been spent in this year. So that's how we are dividing it currently.
Hi, this is Anushka joining in, Mr. Mansukhani. My question to you is about the Saudi Arabia plans. Now, just want to understand the overall expansion plan over here. What's the kind of update? What's the progress going on? When is it expected to be commercialized?
So we have ordered all the equipments, opened the LCs for all the equipment. So equipment delivery is in the next couple of months. We already started, we've already ordered the PEB structures, the civil work, everything is going on site. So we should be, we are targeting operationals by October, November, and then we will need a couple of months for the approvals for API and everything. And in the time being, till the time the API approvals and everything come, we should be doing some water work locally. So we are looking at somewhere around December, January to start the trials and everything for the first pipe from Saudi.
Okay, so is that all the fundraise that we are looking at, or would there be expectation of higher fundraise in the upcoming quarters as well? Firstly, want to get more outlook on that as well.
No, I think this would be the fundraise which is required. I don't think we want to do anything more than this in the next couple of years. We hope so. So as of now, we are done with our capex, and outlook for the raising is we are very sorted right now.
Also, just want to get an overall picture in terms of where the Jammu Greenfield capex is, and along with that, the Saudi Arabia capex, which is already going on. Once these capacities are on stream, what is the kind of revenue potential that you see? If I'm not mistaken, from Saudi Arabia, you're seeing about a 2,000 crore of a potential. So, just want to get an understanding, when will these incremental revenues come on stream for the company?
So the incremental revenue will start coming in from FY27. FY27, we should be getting around 2,000 crores more revenue from FY27. But the peak revenue we will be hitting in 28, 29, and 30, which we are expecting a 70 to 80% efficiency from both the mills, from the Saudi as well as the SS. So we should be looking at an overall group, India plus Saudi, around 8,000 to 9,000 crores of top line.
Okay, so 8,000 to 9,000 crore is the top line that we are looking at. Other than that, also, if you are looking at export side of the business, you know, you're increasing your focus here. If you look at the order book also, about 80 to 90% of it is from the export side of the picture. Want to understand what's the current contribution, and going forward in FY27-28, what is this contribution expected to scale up to?
So basically, we are an export-based unit. We focus more on exports. The margins are slightly better, and plus there's a lot of business worldwide which is coming up, and we are seeing a lot of traction. Large projects coming up around the world. So I think this year also we should be 80% exports or somewhere around there. And for the next 3 years, our outlook and our planning is also to keep it up to 80-85%. Maybe the India portion will go up a little bit, fluctuate in the next couple of years. But for the time being, what we are seeing and the global markets we are seeing and our bid books, we are quite confident that we will be between 75 to 80% exports for the next 3 years as well.
75 to 80% is the mix that we are looking at. So considering that FY25 you've clocked in about 10% of margins, with this higher exports coming in, more ramp up in terms of the Saudi Arabia and Jammu plant as well, which are more margin accretive for you as well, what's the kind of improvement that we'll look in terms of where the margins are headed?
So FY28-29, we are looking at between 13 to 15% EBITDA margins.
13 to 14%.
That's what we are working towards. So, and we are confident that we will get there.
Can you break it up in terms of the domestic? How is that different from the domestic and the export side?
The EBITDA portions, you mean, or
the EBITDA question? Yeah.
I think the domestic, because we are doing almost 80% exports, so I think the domestic would be between 9 to 10%, and the exports are between 15 to 16%. So blended would come anywhere between 13 to 14%. And once we ramp it up in FY28 and 29, we are expecting to be above that.
Okay, that's fair enough. And considering the order book also, now you're seeing about a 2,500 crore of an order book. Outlook for FY26, considering what's the kind of inflows that you're looking at, and what is the execution going to be for these current order book which is already in place?
Yeah, so we should be FY26 a guidance of between 25 to 30% growth. And this is from the existing facility without Saudi and without the SS. I think the FY27 is the kick-in year where we would be doing almost a 30 to 40% growth, because both the mills will be operational. And like we said, the EBITDA margins will also start moving up because they are more value-added product and more premium. And Saudi is commanding a much higher premium than India right now.
Nikhil, taking the order book and everything into consideration, what is the bid pipeline looking like, and the current executional order book that you're sitting on, which will be executed probably in 26, and how much in 27?
So currently, like we said, 2,500 crores. The bid book is approximately around 13,000 crores. Out of the bid book, we are L1 in a couple of projects. So hopefully we should be getting them soon. Compared to normally, what happens is in our business, suppose we've got 4,000, 5,000 crores of order book, which is for long lead projects. And the shorter projects, which we don't declare all the time, is because the water, we keep getting new businesses for water, ERW and locally. So we should be, like we said, 25 to 30% growth this year from India, India factory. And looking at a long-term horizon, I think, like we said, that we would be growing around 25 to 35% next 3 to 4 years.
Okay. One quick question I have is, initially as well, in July 2024, Nikhil, the company had indicated 100% revenue growth over the next 2 years and triple the profitability in the same time frame, which is clearly telling us that the confidence is something which is sustained. Would you stick to that, or do you think it is further enhanced and you could outperform that number as well?
It's better to be conservative and then outperform. So I wouldn't like to add to that further. I think there is enough pressure in the system, and we are pushing to get to the numbers. And the numbers we committed for FY25, we outdid them. And I think that's where we would like to be. We would like to give a realistic number and then push it forward with more support from the team and us, and outdo the numbers so that, we can, people start believing that the numbers are true and correct, and we can push them forward. So I think still the numbers of 3 times the profit, let's get there. I think we should be more than capable to get there and outdo that. So we stick to that.
Okay, so that's the outlook that we are looking forward. Just for a quick update on the green hydrogen pipeline that you had, you received an approval from EU as well. Just want to understand what's the kind of opportunity from there? What's the sort of growth that you're looking from that aspect?
So the hydrogen, like we said, India is it's still coming up. I think a lot of players, Adani, Vedanta, L&T, all of them are working on it right now. I think probably L&T and Adani are quite advanced, and we're looking at the next 2-3 years. There would be certain new line pipes coming, and we would be very keen to work on those. Other than that, we are seeing a lot of traction in Europe. So from Eastern, Western, all over Europe, there are a lot of lines coming up. And I think that's where we are looking at, and we are already bidding for some projects. And we are hopeful that we should at least start getting some business from the hydrogen sector this year and the coming years.
Right, so that's going to be interesting to watch out for. Thank you, Nikhil, so much for joining us on the show and sharing the views. So that's the management of Pan Industries. Stays with a conservative guidance of doubling revenues and tripling profits in that same time frame that was given in July 2024. Gaurang, any quick comment in terms of Man Industries, the fundraise, the capex plans, and the guidance and outlook? Any coverage?
Well, the coverage is not there, but we like the sector. And of course, as the management was speaking about the top line and bottom line increment in the next couple of years, I think it's ambitious but achievable at the same time. Companies in the infrastructure stroke construction that we have coverage. We have coverage on HG Infra, NBCC, NCC, PNC Infra. That's where our fundamental team has coverage.
The view, Gaurang, but another one that's, it's actually raining block deals of late. 2 block deals in Ola Electric and Yes Bank were concluded after hours yesterday. Today, there are 4 such ones that you need to watch out for. My colleague Mahima joins in with some key highlights on them.
Right, so it's certainly a day of block deals today. To start with, both block deals for Indegene as well as ABFRL have been upsized. The expectation for Indegene was roughly 10.2% of equity is changing hands, but around 12.2% has changed equity in terms of trading. ABFRL was supposed to be around 6% of equity changing hands, but that has been upsized to around 8.8%. Tata Tech, however, has remained at 2.1% in terms of block deal, and Alchem has around 1.4% equity changing its hands. Now, in terms of the approximate value for these block deal, that that is roughly around 3,500 odd crores. For Indegene, Carlyle Group is set to exit the company. Carlyle owns share through its affiliate, that is CA Dawn Investments. In terms of the floor price, that was set at 580, and the discount was roughly 6.4% to its yesterday's closing. Tata Tech, on the other hand, the floor price was between 744 to 767. The approximate value of the block deal is roughly 635 odd crores, number of shares 8.5 lakhs, and around 0 to 0.03% of discount from its yesterday's closing price. In terms of Alchem, well, the promoter Jayanti Sinha was expected to sell around 1.4% of its total equity, and currently she holds around 2.46% of the equity. Promoter holding currently stands at around 55.13%, which will come down to around 53.71%. In terms of the details with regards to this block deal, the floor price was around 4850 and a discount of around 2.9%. ABFRL is a big one there because the stock is really seeing the pressure in trade today. Flipkart is set to exit its 6% stake in ABFRL. The floor price is set at 79.5, which is a discount of whooping 7.6% from its yesterday's closing. But of course, this deal has also been upsized to around 8.8%. So we'll have to see, wait and watch and see as to who the sellers are in ABFRL apart from Flipkart. So these are the four stocks definitely focus on the back of block deals.
Well, thanks for that, Mahima. Gaurang, very good afternoon. It's Puneet this side. I just wanted to ask also first a specific view on Tata Tech as well. Because stock hasn't done well post listing. Roughly about 500 rupees was the IPO price, went to 1300. It also came back to almost 600 rupees, and now over the last month we've seen some bullish momentum on that stock. Any specific view that you have on Tata Tech as well as anything on the others, if you have any coverage on Indegene, ABFRL as well as Alchem?
Hi Puneet, good afternoon to you as well. So the research team has a accumulate rating on ABFRL. On Tata Technologies, to be more specific, we covered the stock during the IPO not very long ago. I think the floor was 585 or something like that, if I'm not mistaken, if my memory serves me right. In the IPO note for Tata Tech, my team had given a subscriber recommendation from a long-term point of view. I think the stock made a high of 1400 and then a downward move. Currently, as we speak, I think it is just managing to establish itself after this news flow of block stroke bulk deals that is happening. Well, the view on the IT sector is very positive of my research team. And if I have to just make that IPO note as a base, then if somebody's invested in Tata Tech from a long-term point of view, I think can definitely hold on. One important thing that I've noticed in the earnings, last quarter, that is the fourth quarter, last financial earnings, was a shade better than what they delivered earlier.
So Tata Tech, interesting one to watch out for. In fact, the other stock we should be looking out is a Garden Reach. Strong moves there. They've signed an MOU with Norway's Kongsberg, if I pronounce it correctly, to build a vessel for India's Arctic and Antarctic missions. How does this benefit? Anushi is still here with us to tell us more. Anushi, how big a deal is this for a Garden Reach?
Right, so Garden Reach has signed an MOU with Norway's Kongsberg, as you were mentioning about it, and this is to build first ever polar research vessel for India. Now, this is an important collaboration that we are looking at, considering that this vessel will be indigenously made in India only, and it will support India's scientific missions, that's in Arctic and Antarctic regions. This pertains to research for climate research, oceanography and polar projects as well. And the vessel that we are seeing is going to be built in its yard in Kolkata under the Make in India initiative that we are seeing. But it is interesting how Garden Reach has performed so far. If you just look at the 1 month performance, the stock is up over 80% in trade today. In fact, it recently just had a big order win of 25,000 crore as well. It had emerged as an L1, that's the lowest bidder for next 5 next generation corvettes for Indian Navy. This was an order which was expected for the company, as highlighted in its conference call as well. If you look at the order book also, that stands roughly at 22,600 crore. This is as of the March figure that we are looking at. According to a brokerage note also, they are seeing that this order book shall be 5x in the next to the coming period as well. So this is an interesting update that we are watching for Garden Reach. The stock has seen strong up moves in the last 1 month or so.
Okay, Anushi, stay with us. We're talking about a shipbuilding company. Let's talk about another company which is very related. I mean, we're talking about Adani Ports as well, right? Adani Airports, and they are looking to place bids, and this is with regards to the ground services, the ground handling services. What is the key news over there, and how big is it expected to be?
So Hiral, if you are looking at what the reports are suggesting, that Adani is evaluating bids for 2 airports, and this is Mumbai and Ahmedabad, with which they are planning, or rather they are mulling to enter in the airport ground services, and this is especially after Celebi's exit that we are looking at this. So Adani will be the 3rd ground handler at these facilities if it wins this bids. If we are looking at, do note that Indian regulations do require that 3 ground handlers should be there for major airports with capacities of more than 1 million annual passengers. That's the traffic that we are looking at. Again, if you are looking at why Adani might consider this foray is in line with the strategy of branching into allied services in sectors of businesses wherein Adani is already a part of. So it's in this existing businesses it looks to venture into similar areas. Do note that Adani Airport Holdings currently operates 8 airports. So this includes the upcoming Navi Mumbai one as well. The company especially wants to fill this gap post the Turkish operator Celebi's exit, which was halted after Turkey voiced its support for Pakistan. Celebi, if you look at, they had operated 9 airports in India, which included the likes of gateway facilities in New Delhi along with commercial hub of Mumbai. So that's the update that we are seeing for Adani Group as well.
Well, thanks for that, Ranushi. Gaurang, let me come to you first on Garden Reach. We've seen a very strong up move from this particular stock, backed by news flow as well as good results. How do you view Garden Reach as well as the other shipbuilding stocks? Do you have a pick right now in this space?
Puneet, so our research team has a coverage on Cochin Shipyard. Along with that, couple of other defense-related names. And as a theme, our sense is that, if you decide to invest in a defense-related theme, then have a 3-year, 5-year kind of time horizon, because it takes time to execute the order book because of the complexities and the high technology. Now, imagine Garden Reach building a vessel which goes into the Antarctica and the Arctic. That means it has to face severe weather, surface which is actually hard ice to break into and reach to the destination. So, it's not easy to build these kind of sea vessels, marine vessels, I beg your pardon. We like Cochin Shipyard, and of course, likewise, we have positive coverage on overall defense sector as well.
Got that, Gaurang. But Gaurang, stay with us. We'll be back in a very short break. Stay tuned to Profit Buzzers for more.
That's huge. That is a biggie. It's out there.
गोल्ड प्लस क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
markets trade in the green, though in a narrow range. Nifty nears the 24,600 mark. Sensex hovers around 80,950. All sectoral indices except Nifty Real Estate trade in gain in Nifty. IT leads the winners.
Several stocks buzz on the back of a block deal. Indegene, ABFRL, Alchem all trade with cuts. Aditya Birla Fashion loses the most, down 10% so far.
Starlink India will have to pay 1.6 crore rupees in non-refundable entry fee for India foray. Elon Musk's satellite company will also pay over 1.2 crore rupees in performance and financial guarantees. That's an NDTV Profit exclusive.
In another NDTV Profit exclusive, sources tell us that banks are willing to give loans to Vodafone Idea again, but only if the government relents on AGR dues. Remember, yesterday we reported that the government is considering possible solutions for Vodafone Idea's financial troubles.
Welcome back. You're watching Profit Buzzers on NDTV Profit. Now, growth will accelerate in the coming time, believes Amisha of BofA Securities. He lays out multiple reasons behind it. Let's quickly listen in.
Everyone expects the growth to now accelerate because the monetary policy has completely turned its course. We are now talking about lesser regulations, more liquidity, lower rates, and so on and so forth. In fact, there's a possibility for even a fiscal stimulus now because RBI has given dividends which are slightly higher than what the government had budgeted. Crude prices are lower. As a result, government has hiked the excise duties on the petrol and diesel at the pump. That gives additional sources of revenues to the government. So all of this put together, there is therefore a question on whether the government now has a room to go and spend that money and do a small fiscal stimulus on the back of it. So all of these factors put together on the back of the low base of growth clearly means that the growth will accelerate.
Well, that was BofA's view, but Macquarie has come out with a note on the 6-star buys. Let's get in Varsha to get us through the list. Varsha.
Yeah, thank you for that. So yes, Macquarie has released India Super 6. The report is a way of highlighting that what they believe is the most attractive investment opportunities in the Indian stock market. They've organized these ideas into 3 distinct categories. First one, Macquarie 6 stars. Now this list represents their long-term foundational investment ideas. Now while these stocks have been absolute gains, especially Mahindra and Mahindra and HDFC Bank, but this list as a whole has actually performed slightly less than the broader index market since its last update. Now this was mainly due to the underperformance of TCS. Macquarie has decided to keep all the companies on the list without any changes. The second list is 6 hitters. Now this list is for short to medium term investment opportunities, and these are stocks where Macquarie sees specific catalysts for short term momentum. They have removed Ultratech Cement and NTPC of the list, and they've added L&T due to order flows, and LIC was added due to valuations. List has seen 14% gains since inclusion, led by stronger gains in BHE and a bounce back in Reliance Industries. Macquarie's third list is 6 rising stars, which is a path to 2x returns. Now they believe that they have the potential to double the value over a longer period of time, and this list has been the best performer, achieving an average 24% gain since the last update, with Delivery and Aditya Birla Capital leading the way. Macquarie has not made any changes to the list in the current report.
Well, thank you for that, Varsha. We also have Brijesh Ale, who's joining in, the head technical and derivatives retail research at IDBI Cap, and we also have Gaurang with us. Brijesh, let me come to you first on a particular stock in the rising stars list from Macquarie, which is Delivery. Stock has recovered post its Q4 earnings. What do the charts suggest going forward in terms of momentum?
I think there would be a stock-specific view, and I think the stocks like trend is something which is quite positive on charts. So in the near term, this can go back to 6,000 plus level. So it would be more of a stock-specific. I think that's an opportunity what they are speaking of. The view would be positive.
Okay. Gaurang, from the 6 stocks that we are talking about, path to 2 times returns, Delivery, Aditya Birla Capital, Uno Minda, IRCTC, Lemon Tree Hotels, Devyani International, what would your top pick be and a recommendation from there?
So, Hiral, auto ancillary is something that excites us. Auto sector overall excites us, and so does auto ancillary. So, Uno Minda is one stock on which our fundamental team has a buy coverage.
Okay, so Uno Minda is a positive one coming in there. But moving on, you have HDB Financial Services. They've received the go-ahead from SEBI for its initial public offering. In fact, they filed its draft in October last year to raise up to 12,500 odd crores through its IPO. 10,000 crores is what goes to HDFC Bank. 2,500 crores is what you're looking at as a fresh one. Harsh joins us. Harsh, seems like HDFC Bank is absolutely happy to get that 10,000 crores, contributing to some smart moves in terms of Nifty 50.
Well, yes. So yes, for sure. It's positive sentimentally because there's some amount of value unlocking. But let's try and really dissect this. Let's first talk about why the fuss. NBFC, HDB Financial is an NBFC promoted by HDFC Bank and the HDFC Group. The HDFC Bank approximately holds a 94% stake in the company. Now let's talk about the IPO details. 12,500 crores in terms of size, 10,000 crore is the offer for sale, 2,500 crore is the fresh issue. The offer for sale pretty much entirely going to an HDFC Bank, and price bands are of course yet to be disclosed, but we'll talk numbers in just a minute. What the company does, it was incorporated in 2007. It's a retail focused NBFC, has around sub 1,800 odd branches and a presence in 31 states in the country. Let's talk about the business itself. It lends, and of course, understandably, 71% of the loans are secured though. So that's something you want to really mark out. The other piece is it does all these ancillary services for HDFC Bank and otherwise. So those are all the services that it does and provides to its customers. Let's also talk a little bit about the financial metrics and how those stack up. But before that, how the lending mix is. Enterprise loans is around 40%, asset finance is around 37%, and 23% consumer finance, which likely is the unsecured bit in the business. Let's talk about financial metrics, and this is FY22 versus FY25. Look at the way in which loans have grown, around 20 odd %. The net worth also has gone up by around 18.5 odd %. The NAV has gone up from 121 to around 199, which is an impressive increase of around 18 odd %. And the return on assets is between the 1.5 to 2 odd % number. It's gone up to 3. It's come back off because of certain hits with regard to credit costs which have come through in FY25. Let's talk about ROE as well. Again, 11 to 20%, again come off to around 14.5 odd %. Your NPA ratios have started to inch up, especially in H2 FY25, and your net NPA ratios also reflecting that. So they came off. Net NPA was at 0.6% at the end of H1 FY25. Let's talk about financial metrics in terms of income statement. Your revenue has gone up around 13 odd %. Your NII is up around 14 odd % on a CAGR basis, 3-year CAGR basis. Look at that impairment. It's largely steady because impairments have gone up in this year, which is FY25, and impairments was on a high base in FY22 as well. Profitability, therefore, on a YOY basis in FY25 has taken a knock. It's in fact down 10 odd % on a YOY basis, but a 29% CAGR growth seen on a 3-year basis. Let's last off very quickly talk about what it means for HDFC Bank shareholders. There's some amount of value unlocking, of course, which is at play, but HDFC Bank will receive 10,000 crore, which is approximately 0.7% of the market cap of HDFC Bank. So not substantial in terms of moving the needle. There's going to be a reservation of 10% for HDFC Bank shareholders as well. So that's something that you can look out for if you are an HDFC Bank shareholder. Pricing again is going to hold the key. HDFC Group has churned out several businesses, 2 of them which have done quite well on exchanges. HDFC Life, which has doubled since its listing in 2017, and HDFC AMC, which has gone up 4x since its listing in 2018. HDFC Bank itself has been a multi-bagger of sorts, has done really well on exchanges. These are some of the other approvals that came through yesterday. Dorf Kettle, Spec Chem, they're going to do debt repayment. You can literally take a screenshot of this and it will give you the whole picture as to how and which companies are really looking at IPOs, which sector they are in, as well as why they're coming out with their respective IPOs. Last off, I want to talk a little bit about the IPOs that have happened since 2024. There have been 113 IPOs since 1st of January 2024. The listing day gains have come in 85 out of the 113. 25 of them have seen a listing loss. They listed absolutely flat, were just 3 of them. Now let's talk about gains since the listing day. 64 out of 113 are sitting on gains since the listing day as well. And over 10% losses since listing day is 33. Nearly 30% of those IPOs are actually sitting at a 10% or more loss since that listing day. So you want to be careful as well.
Well, thanks for that, Harsh, giving us both views on HDB as well as the other IPOs. Gaurang, let me come to you specifically for HDB. Do you see that as one of the prospective IPOs, and would you be applying if you're an HDFC shareholder as well?
Puneet, we know everything else but the valuation. And without the valuation missing, it is very difficult to take a call, my friend. But yes, the pedigree is good. The history of wealth creation in terms of new listing, as your colleague was mentioning, HDFC Life, HDFC FC. We have positive coverage on HDFC Bank from our fundamental team, Puneet. That's the disclosure. But we'll wait for the valuation to get announced. And then possibly our team will take a call to come out with a subscribed note for the IPO or not. But that totally depends upon the valuation.
That, Gaurang, fair enough. British, on the charts, just HDFC Bank, what do you make of it? Do you think that it's a good time to enter the stock?
Yeah, I think there has been a very strong consolidation, and the level of this 1900 and 1950s can be watched as a very good accumulation. So I believe there can be a good amount of breakouts can be seen. It's too early, but then structure is positive. So somewhere I believe we can go back to 2000, 2050 level on the charts. So we are having a buy view, and we do like to take the in the money call option also. So we are positive on the HDFC Bank.
Sure. Gaurang, sorry, let me come back to you. You mentioned you'll wait for the valuations. Currently, HDFC Bank at 2.6 times, as Harsh is mentioning it. What valuations for HDB will you be comfortable at?
My view does not matter, right? I mean, I would like the management and the financial advisors to leave as much as possible on the table for investors. I am absolutely nobody to comment in terms of listing gains. But I think, let me give given the kind of diversified work verticals that they have, business verticals, one of them I believe is also a little bit of housing finance. And if interest rates have to go down going forward, day after we have a credit policy, 25 basis point is the expectation. One of the first beneficiaries of the rate cuts amongst the NBFCs is housing finance companies, HFCs. So I hope that there is a decent valuation and there is a lot that is left on the table for long-term investors.
Absolutely, that's what the hope is. Let's see what comes out of it. But as Harsh is here with us again, Jefferies has put out an interesting list of the new faces of Indian banks. Harsh is here to take us through the entire list and what those faces look like. Harsh, over to you.
Well, there's just so much happening in banking, right? And yeah, it's a very interesting note for sure that Jefferies has put out. And Warren's mentioned, because there have just been so many changes with regard to senior management within the banking space. That doesn't happen too often in a single year in 2024. Let me start off. It was a year where there was huge attrition across banks. We'll first start off with some illustrations. Mr. KVS Manian moved to Federal Bank from Kotak Mahindra Bank, where he was for a very long time. All of these saw either retirements or shifts. So those are some big names on the boards of some large banks and financial institutions, including the likes of a Prashant Tripathi, who have now stepped down or moved elsewhere. Additionally, there has been now in the pipeline changes within the 361 leadership as well as in the IndusInd leadership, both of which are still awaited, likely to come through at least the IndusInd leadership by 30th of June. The smaller banks and financials are also exploring new talent at the top. There's also been plenty of moves with regard to ownership. Let's talk about some of that. Foreign partners owners, there's an SMBC acquiring a Yes Bank. There's also SMBC acquiring 5% of 361. Reports of Emirates NBD acquiring IDBI Bank, and that's a chunky sale that's going to come likely. Alliance quitting partnership with Bajaj and partnering with Jio Financial. There's also these changes in ownership will also likely lead to a change in leadership, and that's what really Jefferies is coming to. So let's try and break down what all of this could or what we could look forward to with all of this in the pipeline. One, you have investment in retail, digital and tech platforms which will get accelerated. Second one, you're going to see strengthening of business teams, a churn within leadership of various banks. You saw something like a Poonawalla as well, where HDFC Bank leadership has started to take over in a big fashion. You're seeing larger ESOP pools, higher attrition at some of the larger banks, and it's positive from an FDI flow perspective. So you'll have plenty of flow coming through as some of these large institutions take up large stakes in some of our financial institutions as well. So you could likely also see a re-rating as a result of all of this playing out.
Right. Thank you so much, Harsh, for getting us all these details, because this is an absolutely interesting note. Gaurang, anything that catches your eyes which could be good investment bets on the back of the leadership changes that could be coming in, because there could be some change in strategy as well then?
Well, so he'll again, I'll refrain to make any kind of comment since we don't have clarity in terms of specific names. But if you're referring to the banking and finance, and as I mentioned about rate cuts coming through, then I think we should give equal weightage now to private sector banks, public sector banks. If I have to name a few, State Bank of India, Indian Bank, from my research team, private sector banks, we are positive. We already gave a disclosure of HDFC Bank. Other than that, I think Axis Bank, ICICI Bank, small banks, Hiral, in form of IDFC First Bank, Federal Bank. This is something that really interests, and our guess is at our fundamental team that the demand for credit is going to go up consistently, and we are going to see a decent amount of improvement in terms of net and gross NP improvement.
With regards to overall banking as a pack. But moving on, we're looking at the auto pack pretty closely today. One stock that was in trouble in the last couple of trading sessions was Olectra Green. But before we go to Olectra Green, where Puneet is miking up for the same, another rate cut probably could be on the horizon. Goldman Sachs, Shantanu Sengupta believes that RBI may aim at a repo rate of 5.5% now. Let's quickly listen in as he explains the reason why.
We think 25 basis points, not very different from consensus in the Friday meeting release when it comes out. We think there's one more cut after this one, which takes the repo rate to 550. We think it'll be back-to-back cuts in the June and the August meetings. The reason why we don't think the RBI cuts beyond 550 and goes to 5.25 or 5% is because if you look at inflation numbers in India on a forward-looking basis, as you head into either the August or the October meeting, when you're thinking about cutting deeper than 550, the 1 quarter, 2 quarter ahead inflation number will look like 4 to 4.5%, which is the Q4 of this fiscal year, and the Q1 of fiscal year 27 will be in the region of 4 to 4.5% inflation. So as the central bank sees inflation rising largely because of base effects into the first half of the next year, we think that they will stay away from cutting deeper.
Right, so that's with regards to a 5.5% repo rate. That could be the aim. But moving on to the auto pack, you have Class 8 truck orders that have trickled in as well. What's interesting is the downtick in terms of a year-on-year basis is still stark, but a marginal improvement that has happened on a month-on-month basis. So from April to May, there is some bit of positivity, though the orders are below the 7-year May average of 18,319 orders. Now, whether this is the start to the trend of improvement or not, pretty early to say, because it's just 1 month of month-on-month improvement that you're seeing. But what would this mean is a downtick on a Bharat Forge, which is down 1.5%. RK Forging is also taking a beating to the tune of around 2% as we speak. Brijesh, both these stocks, what are charts indicating? Further weakness or an opportunity to buy?
So Bharat Forge we were liking, but I think today specifically there has been some sell-off, some distribution has been happening. So I think slightly negative bias. Bharat Forge can slip back to 1200 level on an immediate basis. That's a trading bet. So I think it's finding the resistance. So I won't take the fresh buys in the Bharat Forge. So cautious and some more downside.
Gaurang, any quick view in terms of Class 8 truck orders and impact?
Well, I think more than the Class 8 truck orders, Dhiral, now Bharat Forge is in discussion because of the foray into defense. Great amount of investment into artillery support to our armed forces. Our research team has a fundamental coverage on Bharat Forge from a long-term point of view. But yes, I think Class 8 truck orders to the US may get affected or impacted in the future here because of the expected tariffs coming through and slowdown in the US market. So that will only time will tell about that.
So that's with regards to Bharat Forge. You know, it's becoming more of a defense play, as Gaurang is mentioning. But staying with the Autopac, Electra Green is the next stock that we have been focusing on as well today. No major downticks, but 0.4% lower. The latest was where the Telangana government had gone ahead and cut the bus orders from only 10 from the previous 50. Now, what's ailing this electric bus maker is the question, because Maharashtra government had gone ahead and cut the entire order, or now they've gone and reinstated it as well. Puneet joins us with all the details as to what is the reason why state governments are really looking at Electra Green in terms of discontinuing the orders, and where is the major hurdle lying? Puneet, over to you.
Well, thank you so much for that. So Electra Green, definitely a lot of promises that the company has made, but the guidance and the execution hasn't kept up with it. Let's start with what you rightly mentioned on Telangana first. The company was awarded roughly around 50 buses on 6th March of 2023 to be delivered by May. That hasn't happened yet. Now the government has gone ahead and cut the order from 50 to just 10. Deliveries were expected to start by July of 2024, but that did not happen, and the numbers were just around 10 that were delivered in this particular time frame. The company has not yet updated how many buses it had delivered, but the government has come out in Telangana and said that 10 buses are delivered, and they're cancelling the further order of 40 buses. When you look at what happened in Maharashtra as well, the company had gotten an order of roughly about 5,150 buses which were cancelled. The Transport Ministry has come out and said that we are reinstating the order now with a new execution timeline. Now what's mentioned is in terms of a new delivery schedule, they've said that in 2025 there will be roughly 620 buses that are expected to be delivered by Electra Green Tech to Maharashtra government itself. This will be subsequently increased to 2,100 in 2026, and the rest incremental almost of 1,500 to 2,000 buses in 2027. So it's a very steep timeline as well for the company, and we'll tell you why. Because the key aspect is in terms of what's happened in the quarterly performance as well over the last few ones. So if you look at the four quarters of FY25 specifically, in Q1 the company had an FY25 guidance of 1,500 to 2,000 buses specifically to be delivered in the full year of FY25, and they mentioned that they will be looking to deliver more than at least 2,000, which is the upper range of the guidance. That was reduced to 1,500 and subsequently to 1,200 buses for FY25. And finally, the company could only deliver 972 buses in FY25 versus an original guidance at the upper end of 2,000 buses. So a 50% drop in terms of actual deliveries. When you look at the next one aspect, which is of course the number of buses where the company had sold, we mentioned about FY25, but this is not a one-off phenomena. In the last 2 years as well, the company had promised in FY24 delivering over 1,200 buses, but could only deliver 541 and subsequently delivered only 580 buses versus a guidance in FY23 of 1,000. So this is not a one-off that the company has actually missed the guidance in this particular time frame. But let's look at what actually went wrong with the company in terms of availability. Now, the company has huge orders, but not actually enough capacity, because the current annual capacity only stands at roughly about 1,200 units per annum versus a guidance that the company has of an order book of 10,224 buses. They will actually take 8 to 9 years to complete the current order book, and that is also subsequent if they don't get any orders for that time frame as well. So it's a very steep ask by the company in terms of increasing capacity as well as delivering these buses as well. The key other component for all electric vehicle buses is actually the battery, which is the main, because there's no engine in an electric vehicle bus, and that has been a key constraint for the company, and maybe some issues spurring up with BYD because of non-payments as well. Now, the company in its conference call has not clarified whether these supply constraints have been resolved yet. They're just claiming it that it's an industry issue and might take some time to resolve. But Olectra largely procures these batteries with BYD. They've said that they have an agreement till 2030 for the same. But looking at the number of deliveries, this definitely seems to be an issue as well. The key aspect is in FY26, they've guided for 2,500 buses, but the current capacity is only 1,200. So it's going to be something that has to be watched out for how that will happen. Finally, in terms of what are the key questions that you need to ask as an investor to the company, as well as see if they are actually able to outperform and maintain the guidance. How will the company meet its FY26 guidance of 2,500 buses? Subsequently, the company has said that they'll increase capacity, but no real timeline, and they've missed that as well in FY25 when the company had guided for over 2,500 buses capacity. The second question, does the company have the capacity to meet it? We spoke about this, but the company also claiming to increase capacity by 5,000 in Q4 of FY25 seems to be a very steep target from the current 1,200 buses that they have. Finally, in terms of what's been the stock performance versus valuation, as well as analyst recommendations specifically, stock is down 31% in the past year because it has not been able to deliver its promises. And the other key aspect is that it has no analyst coverage. So taking just the trailing PE multiple, which is FY25 numbers, the stock has a multiple of 74 times price to earnings for FY25, which is steep to say the least. It's almost 3 times that of valuation or something like an Ashok Leyland. So definitely a lot of promises, but hollow guidance as well as performance is definitely a disappointment for Olectra Greentech.
Absolutely. Thank you for breaking this down for us in absolute crystal clear language as well, Puneet, because it means a lot in terms of what it actually has in store. But one quick sector that I want to track right now is the railway stocks. Overall, if you see in terms of all the railway names as well, a smart up move that's coming in terms of trade today. Let's just pull up all these counters from a Urcon to a Titagar to Jupiter Wagons. All of them are seeing a smart up move in terms of today's session. Titagar, BEML, Railtel, there you go. Gaurang, very quickly, any trigger that you're picking up as to why the railway stocks are up in trade, and if any topic?
So, Viral, the sector looks quite promising on fallback of what the changes in policies have been there. Upgradation of modernization of railway station, tracks, high-speed trains, investing into dedicated freight corridors, etc., etc. So, the sector looks promising. Unfortunately, our team does not have any specific coverage.
Okay. Brijesh, very quickly, anything which tops the chart in terms of a buy call? 30 seconds.
Yeah, I do agree. These stocks like Titagar Wagon and RITES are having a very strong breakout, and I think this breakout will sustain. So the further extension of this move by another 15-20% can be seen. So we are having a positive bias. So Titagar and RITES can be on the watch list.
2 stocks that could be on the watch list from a railway perspective as well. But completely out of time. Thank you, Gaurang. Thank you, Brijesh. And a thank you from the team that put the show together, Puneet and myself. In fact, lots more lined up on the other side. Please stay tuned to NDTV Profit.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
The markets move fast,
and so should your portfolio. Expert insights, real-time stock picks.
do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Hello and welcome to NDTV Profit. You're watching Top Trades with me and Varsha joining you as well. Varsha, let's talk about markets. How are they faring in trade currently?
Yeah, so definitely in green energy, the Nifty 50 if you see is up almost 0.27%. But let's see who are the contributors, rather who are the gainers when it comes to benchmark index. You have Eternal, you have Bharti Airtel, IndusInd Bank, Hindalco and Tata Consumer, which are in green today, while Trent, Bajaj Finserv, Axis Bank and L&T are some of the losers. Even ICICI Bank, some of the losers when it comes to Nifty 50. But let's see what sectorial heat map is saying us. Barring realty, everything is green actually. If you see realty is down almost 0.84%. And but except that everything is green. Nifty Auto is up 0.21%. You have Nifty Media which is up 0.54%, 56%. I think Saregama is one of the reasons why media is up. Even FMCG is up 0.08%. Nifty Bank if you see is up 0.07%. But let's see what broader markets are doing. Are they mirroring benchmark index? So if you see Nifty Mid Cap 150 is up almost 0.49%. Yes, they are mirroring benchmark index. Well, let's see who are the gainers when it comes to broader markets, where Nifty Mid Cap 150 you have RVNL. In fact, all the railway stocks are buzzing in trade today. You have RVNL, you have PI Industries which is up almost 4%. Now this is on the back of Kumai, which is the customer of PI Industries, have raised their profit estimates. You have PB Fintech, you have Thermax also gaining when it comes to Nifty Mid Cap 150. On the loser side though, you have ABFRL. Now this is under pressure on the back of block deals. Even this is followed by Alchem Labs, which is under pressure because of the block deal. Phoenix Meal, Fact and Suzlon are some of the losers when it comes to Nifty Mid Cap 150. Let's see what Small Cap 250 is doing. It's up almost up 0.5%. And on the gainer side, you have Ircon, you have Railtail, you have Alcargo Logistics and Swan Energy gaining on the Small Cap 250. But on the loser side though, you have Spark. Now this is because of one of the drugs where the company has stopped more development. It failed in phase 2 clinical trials. We'll be speaking more on that. Even India Cements, Avanti Feeds and Home First are some of the losers when it comes to Small Cap 250. But let me, on that note, let me invite Sneha Poddar, who is Vice President Research at Wealth Management of MOFSL. Well, Sneha, welcome to the show. Great to have you. Just wanted to have your view on markets. How are you seeing it?
Very good afternoon. So with regards to market, what we're witnessing is a consolidation. We have witnessed good, up move in the last 2 months. So we've almost recovered the YTD losses that we were witnessing earlier. So this consolidation was expected. Moreover, there's a lack of trigger currently, which is keeping the market a little sideways and leading to some sort of profit booking. See, basically on the domestic front, things have improved. On the macro front, the numbers which are coming out are very robust. Q4 numbers were ahead of the estimates and better than expectation. Your rate cut cycle has started, and again another rate cut is expected this Friday too. So probably that could provide further momentum. On the global front, there are certain uncertainties with regards to tariff war, with regards to the geopolitical tensions, and with the mixed set of economic data points getting released from US. So keeping all these factors in mind, the market is likely to consolidate in the near term till a fresh set of trigger is given to the market.
Right. Thank you for that view, Sneha. Well, Spark is in focus. Now, the stock is down almost 19%. Now, why? This is on the back of its experimental drug fails clinical phase 2 trials. Now, this drug was being tested in 2 mid-stage clinical trials to treat cirrhosis and eczema. Now, Sun Pharma had licensed this product to treat these 2 diseases. Now, why there's more impact on Spark and not on Sun Pharma is because Spark is the R&D arm of Sun Pharma, and for Spark this was a $1 billion plus opportunity. Now, losing this kind of opportunity questions Spark's primary purpose. Spark factored in revenue from this product in FY30. Now, this is not the first time why Spark has been seen major setback, because in April 2024 the trial for their Parkinson drug also failed. So not the first time where we are seeing this failure, but this was a billion plus opportunity, plus this was a triggering point. Investors had a huge expectation from this drug for Spark, and this is one of the reasons why Spark is under pressure. But let me go to Sneha. Sneha, your view on Spark, because $1 billion plus opportunity has been lost and the stock is under pressure. What would you advise to investors?
Okay, we do not have the coverage on the stock, but how I view the stock is that since this was a very important drug for them, and definitely the failure of it is a big setback. But then this is a kind of cycle these sort of companies keep on facing. So in the near term, obviously there will be a huge setback on this account, but then eventually the company will again come back and they would again restart the trials and all, and probably they might get success in the future. So these kind of they're very concept driven kind of stocks, which has to be looked from a very long term perspective. Short you cannot view these stocks from a trading perspective or short term perspective. You have to have a vision of 3 to 5 years for such kind of companies.
Okay, so that's the view that we're looking for both Spark and Sun Pharma. But let's shift focus to the Adani Group set of companies. Now, what is happening here is, this is a report which has indicated that Adani is mulling entering in airport ground services, and this is especially after Celebi's exit that we are looking at this kind of an update. So the update is that it's evaluating for two bids for 2 airports, that's Mumbai as well as Ahmedabad. So with this, Adani will be the 3rd ground handler at these facilities if it does win the bid. Now, do note that Indian regulations require at least 3 ground handlers for airports, for major airports with more than 1 million passenger traffic. So this foray again is in line with company strategy of entering into allied services of the businesses which are already in place. Again, do note that Adani Airport Holdings currently operates 8 airports, which includes the likes of the upcoming Navi Mumbai one as well. So what had happened, if you just take the Celebi's exit also into account, Celebi's operations were halted. This is after Turkey had voiced its support for Pakistan, and Celebi operated 9 airports in India, which included the likes of gateway facilities in New Delhi along with commercial hub of Mumbai as well. So Sneha, let me come to you on this update that we are seeing. We just want to get your overall sense on Adani Enterprises first of all, and if there are any other Adani group of set of companies also that you favor.
Okay, so see, Adani Enterprises will definitely benefit from the the expansion that they are looking at in the airport segment. Overall, the travel industry is doing very well for last few years, and still the tailwinds are not over. So, with the more and more airports coming under coverage, obviously this will expand the scope for the company. From that angle, obviously the company stands to benefit. We also we have coverage on Adani ports, wherein we are quite optimistic. The company has expanded beautifully on on both the sides of the so both on the western and the eastern fronts they have expanded, and even internationally they are building their presence. The kind of rapid expansion that we are witnessing both domestically and globally, that would keep the overall volume growth intact for the company. And the if you look at the numbers consistently, the company has been able to deliver the numbers quarter after quarter, so that makes us quite optimistic. And with the kind of the Make in India vision that the government has for the country, so obviously this will provide a lot of impetus to the overall logistics space. So in that, Adani with its leading position would benefit.
Right. Thank you so much, Sneha, for that view. But viewers, disclaimer: do mention. I have to mention that the NDTV Profit is a subsidiary of Adani Group. Well, it's raining block deals of late. 2 block deals in Ola Electric and Yes Bank were concluded after hours. Today there are 4 block deals which are in focus. Mahima tells us more.
Right, so definitely it's a day of block deals today. To start with, there are 4 counters, as you rightly mentioned, that are in focus on the back of block deals, and the expectation versus actual as to what the block deal has actually, how the block deal has actually taken place. In Indegene, the expectation was roughly 10.2% of equity changing hands, but around 12% of equity has changed hands. For ABFRL, the expectation was around 6%, but the block deal actually has exchanged around 8.8% of the total equity. Tata Tech 2.1%, and Alchem Laboratories around 1.4% of the total equity has exchanged hands. Now approximately 3,480 crore is the total value of these 4 block deals. In terms of details for each of these block deals, Indegene, well, Carlyle Group is expected to exit the company for around 1,420 odd crores, which is around 10.2% of the total equity, and Carlyle owns the share through affiliate CA Dawn Investments. In terms of the floor price set, that is around 580 per share, which is at a 6.4% discount from its yesterday's closing. Moving on to the next counter. We have Tata Tech in focus. Well, for Tata Tech, the total amount is around 635 odd crores. Floor price was set anywhere between 744 to 767, discount of around 3 odd percent, 0 to 3 odd percent to its yesterday's closing price, and around 8.5 lakh equity shares are expected to exchange hands, and that has already taken place. So around 2.1% of the total equity has exchanged hands. This is of course another clean trade in focus. The next one, let's pull up that. We have Alchem Laboratories, where promoter Jayanti Sinha has sold around 1.42% equity sale via block deal. She currently holds around 2.46%. The total promoting holding right now stands at around 55.13, and post this stake sale, promoter holding will come down to around 53.71. In terms of Aditya Birla Fashion, Flipkart was expected to sell around 6% of the total equity. The total amount roughly is 600 odd crores for Flipkart. Floor price set at 79.5, which is a 7.6% discount to its yesterday's closing, and number of shares involved will be roughly 7.3 crore. But lastly, ABFRL has around 8.8% equity that has exchanged hands. So we'll have to see that apart from Flipkart, who else has actually sold in Aditya Birla Fashion. So these are definitely the 4 stocks in focus on the back of block deals.
Right. Thank you so much, Mahima, for all the details. Well, Sneha, all the stocks are under pressure, but for, of course, reasons. Now, just wanted to have your view, especially on Indegene, ABFRL and Tata Tech.
Okay. See, so we do not have view on Tata Tech and Indegene, but But with regards to ABFRL, this block deal probably can be looked at as a buying opportunity at lower levels, and the reason being that the Q4 numbers were quite good, and post the demerger, the recent demerger that we witnessed in the stock, the overall balance sheet has improved. So the debt concerns which were earlier there, that has eased out a lot, and now the company can focus on improving the profitability in their overall fashion portfolio. So from a long term perspective, we see this as a stepping stone for the company to start improving its overall financials, which it has been struggling for quite some time. So from the valuation perspective also, the valuation seems quite reasonable. So my suggestion would be one can look at this levels as a opportunity to enter the stock from a long term perspective.
Okay, so overall a positive view that we are looking for ABFRL for a long-term picture, but the stock currently down about 10% in trade on the block deal. But let's move on to an NDTV Profit exclusive. Now, sources tell your channel that banks are willing to look at Vodafone Idea proposal. To talk to us more about this, Vishwanath Nair joins us with more details.
Right. So there is a talk amongst all the bankers that they will be willing to look at a Vodafone Idea loan proposal if the government relents on the AGR dues. So essentially, the government has to either give a complete waiver of the dues on the adjusted gross revenue, or they have to give more time to Vodafone to repay that, a moratorium of sorts. Only then will banks be interested, at least the major public sector banks, be interested in extending loans to Vodafone. What sources are telling NDTV Profit is that as far as the private sector banking community goes, they've in fact said that they are not interested in participating in this loan proposal at all, despite where the company stands. But the public sector banking universe, which includes banks as well as large public sector NBFCs, they'd be willing to look at a proposal and extend further credit to Vodafone Idea. According to the bankers, the financial position for Vodafone has greatly improved. However, the AGR dues continue to remain a drag until that matter is resolved, till the government gives some clarity on what it intends to do. They will not look at the loan proposal. Just for context here, Vodafone owes more than 83,000 crore in AGR dues to the government, of which the company has already sought a 45,000 crore waiver on dues that is still pending with the government. So far, the government has not given any indication what it intends to do. However, yesterday we had an NDTV Profit exclusive which pointed out the fact that the government is looking at maybe 2 or 3 options to support Vodafone, which may include a moratorium on these AGR payments.
Thank you for that, Vishy. Now, what we are seeing for Vodafone Idea, as Vishy pointed out, is that AGR dues has remained a concern. Sneha, coming to you, there's been a lot of debate about what's the update on Vodafone Idea. I want to understand your outlook on the stock.
So see, this support is actually required by the company because the debt burden is too heavy, and basically the company has to embark on the huge capex in order to keep up with its peers with regards to the big network gap which is there between them. So to reduce this network gap, the company has to incur significant capex, and for this they require this support, either the AGR relief or probably the support from the banks. But even though the support is extended to them, the key thing for the stock will be the company has to regain the subscribers. It is continuously losing subscribers month after month, and this is the key criteria for the company. So till the time they don't really win the subscribers back, it will be very difficult for the company to actually turn around the profitability. So from the at least near to medium term perspective, our view stands negative on the stock. In fact, we have a sell rating on it, and we have a target price of 6.5 on it.
Okay, so negative outlook is what we are seeing for Vodafone Idea. Thanks for that, Sneha. But let's shift attention to the defense side of the business. Now, guarded reach is particularly in focus. What we are looking at is about 6.5% of gains currently. And this is after the company has signed an MOU with Norway's Kongsberg to build a vessel for India's Arctic and Antarctic missions. Puneet joins us with more details.
Well, thank you for that. So definitely it's a very big order coming in for Make in India specifically. It's the first ever polar research vessel that we built within India for India. And this will be done by Garden Reach. It will be indigenously developed as mentioned by this company. Specifically, it will be supporting India's scientific missions as well as, Arctic in Antarctic and Arctic regions. And that is expected to be India's first, as mentioned, polar vehicle. Largely, it's for climate research as well as for oceanography as well as polar logistics. And that's one of the key updates. It's going to be built from its yard in Kolkata. So the stock reacting positively on the back of this news flow.
Thank you for that, Puneet. Sneha, coming to you on Garden Reach, now this stock is on a tear. While we are seeing just the last 1 month return, 80% up itself, even in the last 1 year or so, it's more than doubled as well. There has been a couple of updates also. Firstly, the strong FY25 performance. They recently won an award for more than 22,000 crore as well. This is for 5 next generation corvettes. Just want to understand your overall outlook from here onwards. What is the expectation that an investor should have for this counter?
So see, Garden Reach stands to benefit from the overall, the strong orders which are likely to get announced by the government. Overall, the focus on the defense sector continues to be strong. So especially post the Operation Sindoor and given the rising tensions again between Ukraine and Russia. So the importance of having the indigenous defense system built in India is people are recognizing that, and so a lot of orders are being announced, and in fact, a lot are in pipeline. So keeping that in mind, and keeping that the company is making various efforts to expand its portfolio to tie up with various foreign players to enhance the overall efficiency and build new indigenous models. So from that perspective, this is a very important news, and given the history of Garden Reach, the kind of portfolio that they've already built, and the kind of success story that they have, and the order book stands quite robust. So the overall the profitability outlook is quite good for the company, and one can actually look at this counter from a long-term perspective.
Right. Thank you so much for that view, Sneha. Well, moving on, Servotech Renewables is in focus after receiving a new order from Northeast Frontier Railway. Puneet, who is still with us, will give us more details.
Well, it's a small order, but the stock's reacting very positively, Varsha. It's roughly a 7 megawatt order for grid connectivity solar roof projects. It's a total consideration of about 33 crores for the said order. Now, this has been awarded by the Rangia division of the Northeastern Frontier Railway Systems, and that is for a 5-year contract, and it includes the annual maintenance as well. As mentioned, small order, but stock reacting very positively.
Thank you so much, Puneet, for all the details. Well, Sneha, what is your view on Servotech? Because clearly the company has almost 300 to 350 crores of order as of now, and the stock is buzzing on this, small order win. So, you tracking this counter?
No, we do not track this counter.
Well, no issues. But Sneha, thank you so much, for joining this conversation. Pleasure to have you.
Thank you.
Well, moving on, with the global uncertainties mounting on, India has emerged as a highlight. We spoke to Manish Dangi, founder at Macro Mosaic Investing and Research, if Indian market valuations are actually fair. Listen into what he had to say.
The best case scenario for us is that that valuation isn't a problem. Wouldn't you like to have a situation in which, it's enticing? And it's been so long since COVID that you had this, especially after 2021-22, that you haven't had actually a setup in which you could actually shout out to your friends and colleagues that, look, valuations are cheap and you should buy it. And which is why I said that, it's boring because, it's just about there. In Hindi you call gunguna. So, valuation's not a problem. It's not cheap. It's not very expensive, of course. And therefore, run-of-the-course stuff out there in absence of macro market would simply chug along and deliver you 3-4% over bonds. It's not cheap, so therefore you can't expect sort of a phenomenal profits, from markets anytime soon.
Well, let's talk about another NDTV Profit exclusive. Now, sources tell us that India has some pretty big ask from Starlink ahead of granting a SATCOM license. Aishwarya is breaking that story now.
Well, we're going to hear more of Starlink as it gets closer to being granted a license by the government. What we're picking up from our sources is that Starlink's India arm, Starlink Satellite Communications Private Limited, is set to pay a non-refundable entry fee of about 1.60 crore rupees. Apart from that, they are also set to pay about 1.20 crore in financial as well as performance bank guarantees. Now, the fees include a unified license, which includes GMPCS, VSAT, as well as ISPA for the whole area or pan-India business. The government, apart from this, has also baked in some clauses which are preemptive in nature and do act as a legal armor to ditch some of the loopholes that the legal document may have. Now, Starlink and related parties are also required to clear dues of not only itself, but also its associated parties, its affiliated companies, as well as sister concerns. In this clause, what they've included is that if at all they have any association with telecom operators that were struck down by the Supreme Court order, 2012 Supreme Court order related to the 2G scam, that is just preemptive in nature, even that will be taken into consideration. And if at all that is linked to Starlink, all their dues must also be cleared, is what they've mentioned. Now, Starlink did receive, if you remember, the LOI early in May. Now, the global licensing head, what we're learning from our sources, Parnil, is also in India for a week to meet the DOT officials as we speak. And it could be just a matter of days before they are granted the license by the government. Starlink is yet to be given the unified license by the DOT, and the license is expected somewhere around in mid-June, what we've been reporting in the past as well. Once the license is granted to Starlink, it will take about 6 to 7 months for them to build the gateways or earth stations, which will be to the tune of about 27 to 30 across 3 identified sites, which Starlink has already done. Now, remember, Starlink is required to unequivocally and unconditionally accept the terms of the offer of the LOI, and then they can proceed with setting up their business and infrastructure in India.
Well, thank you for that, Aishwarya. But that's all the time that we had on this edition of Top Trades from Varsha and me, Anushri.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
The markets move fast,
and so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term? Buy, sell or hold?
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I
or
hold
buy
CDSL for the long term? Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio.
Hello and welcome. You're watching India Market Close here on NDTV Profit. I'm Harsh Saita. Let's quickly look at how the Nifty is doing today. We're around 0.25% odd higher, maybe 1/3% higher. 24,600 is something we've reached, but we're fairly range bound in today's day of trade. Let's look at it intraday as well, and and that'll kind of show us the levels. Just about a 75 point odd range, or rather just a 95 point range, beg your pardon. That the Nifty has played in today's trade. We're sitting at the day's high, so that's something which is looking interesting. So things are looking good actually as we go into this last hour and a half of trade. Let's pull up the contributors, and what we'll see is some of the heavyweights are chipping in today, and that's why you're seeing that kind of move. Eternal is doing well. Bharti is doing well outside of those two heavyweights, HDFC and Reliance. What's not doing well is some of the other private sector banks. TCS within the IT pocket and L&T, which is the cap goods major. Let's look at the entire heat map of the Nifty 50, see the direction there. Of course, advances outstripping the declines in terms of number, but you're seeing good traction in an Eternal, expectedly so, given the points contribution there. 3% higher on an Eternal. A Bharti Airtel also perked up 2% in trade. And you also have some IT names thereafter, something like a Tech Mahindra and an Infosys doing fairly well for themselves in trade today. What's not doing well? A Bajaj Finserv, Trent, Shriram, some of the names languishing, but nothing major, frankly. No large losers that we're seeing in trade today. Let's look at the advanced decline overall on the NSE, and that ratio too is looking good today, especially, versus yesterday. So we're seeing a bit of traction in that sense. Let's look at how broader markets are therefore performing. Choppy morning, but thereafter we've seen a good recovery both on the Nifty mid cap as well as on the Nifty small cap indices. So seeing a good bounce back of sorts, both of those outperforming the Nifty 50 index. Let's look at sectors as well. Can we bring the entire sectoral heat map? And what we're seeing there is most sectors trading in the green. Realty is the only notable one sitting in the red, around 1% lower, but it's had a good run. Look at metals really shining in trade. The defense index is up 0.6% odd. I want to look at the intraday on that one, but before we go to that, I want to also point out that the Nifty PSU banking index is up around 0.25%. We'll talk about a couple of these because you've seen sharp rallies in both of those indices, the Nifty PSU bank as well as defense. Those are the ones where we've seen good traction in the last week or so. So we'll zoom into those. Now let's look at the intraday on the Nifty India defense. And I'm also curious to know how the Nifty PSU bank has done through the day of trade today, off the day's highs, but certainly a good recovery on the Nifty PSU bank that we're seeing. Neeraj, some names that are buzzing in trade, perhaps?
Yeah, actually, let's leave it to the market to tell us what's buzzing and what's not, Harsh. And if I can, let's pull up on the wall the gainers before we get to Jai Bala. Let's pull up on the wall the BSE 500 winners and losers, and let's try and see what is moving and what's not. Can we just show the list of stocks first, please? So You can see the gains out there. Ercon up about 11.78%. There is strength in Swan Energy and RVNL. They tend at times to move as a pack. Some gains for Graphite India, RITES, Aster DM, PI Industries because of the guidance by one of the key customers being increased. It's a very different set of stocks which has done well. And it's evident so because while metals and defense are up, not necessarily a very large presence today in the top gainers list. What's gone down today? Massive downticks in Aditya Birla Fashion, Spark, India Cements, Zydus Wellness, Phoenix Mills, and the 2 or 3 names on which there were deals, right? So AB Fashion is certainly one amongst those on which there was a large block deal, and that stock has corrected not a bit but quite a bit in trade today. So that is something that you certainly want to keep an eye out for. Beyond that, the block deals that happened in the session today, I mean, we were expecting Indegene, Tata Technologies and Alchem as the last few stocks to show individually before we go to Jai Bala. Indegene had a large block, about 1420 crores, and you should pull up Indegene. We should pull up Tata Technologies. So Indegene is down. Tata Tech, clean out trade. That stock is doing reasonably well. And Alchem Labs should come up, 825 crore block. That stock too is down about 2.43%. Jai Bala, founder and chief market technician at Cash the Chaos, joins us right now on the show. Jai, so good talking to you. It's been a while, but thank you so much for taking the time out and being with us today.
Thank you, Neeraj. It's good to be here.
Yeah, Jai, what's the thesis? We kind of seem to be stuck in a very narrow range now. It kind of seems to be, at least in the mind, stuck between 44,500 or rather 24,500 to 24,800 of sorts.
Yeah, it's a good thing, Neeraj. The market took off vertically from the April lows, and it went to about 25,100, and then the pullback from there has been in a stair-step fashion. Now, I turned bullish on the markets in the second week of April, and my medium-term objective for the Nifty is 29,000. So I still maintain that. So this range, which seems to be a stuck range, that's a good thing because this works with the idea of a bullish consolidation for the markets. So the fact that markets aren't moving much on the lower side or on the higher side after a vertical up move signals that this is a bullish consolidation.
Okay, bullish consolidation. So what is it that we do at this point with the Nifty, Jay? And talk to us a bit about the Nifty Bank as well in terms of levels that you're looking out for.
Yeah, I'm looking at the Nifty to pull back somewhere close to 23,825. When you spoke a fortnight back, that was my idea. But there was a possibility that the market could see even shallower correction and take off about 25,116. So that hasn't happened. So the supports for the Nifty at about 24,300, 23,825, and 23,040. I don't think the market could drop to 23,040. That support level just is a fact that if the markets were to drop even as low as 2340, it wouldn't disrupt the bullish thesis that I have for the next 6 to 12 months, where I'm having an objective of 29,000 for the Nifty. So I'm anticipating a shallow pullback. When it comes to the banking index, it's a bit more laggard. It's a little more struggle for the banking index. The objective for it is about 58,000 to 59,000. But the short-term pullback could bring the banking index to somewhere close to 53,400 to 52,900. The supports for the banking index are 53,480, 52,669, and 52,063. And the resistance about 58,500 to 59,000.
Jay, what's your picks? What are your picks in this market?
Yeah, as I pointed out a fortnight ago, I said the real estate sector could perk up. That's been happening. Stocks like Omax, Shobha Developers, and a few other stocks within the real estate space have been perking for the last 2-3 sessions. Right now, my pick is again from the real estate space. Puravankara. It's broken out of a bottoming pattern when it crossed 268 today. I placed a stop at about 239. I'm expecting this recovery from the bottom to take the stock to somewhere close to 389. So bullish on Puravankara. The next stock is SRF. SRF is possibly on a long-term breakout. 3099 is a very important level. So as long as the stock can stay about 2819, it's bullish, and possibly taking the stock to 3,500 in the short to medium term. And in the long term, this stock has potential because this had a consolidation in a sideways pattern for the last 2 years, and it broke out above the sideways consolidation. So the stock is bullish in the short term, medium term, and the long term. So the medium term objective could be something like 6,000 to 10,000, but that's a 24 months time frame.
Okay. And Jay, what's the sense like with regard to an Eternal? When I'm looking at the last 1 week chart of Eternal, the stock is up 10%. Further upsides, can one expect that?
No, I don't like the price setup. When it was trading as Zomato back in December, I mentioned that 300 was an important resistance for it. And the stock has come down from there to about sub 200 to 198 odds. And the bounce from there has been choppy, and it doesn't look like a start of a new trend. I could be wrong, but if it were to drop below 222, I think that will signal the first leg of the correction was from 300 to 198. And this is possibly start of a second leg of correction that takes the stock to somewhere close to 160s. So watch 222 as a very important support. But it's not yet a short. So I want support levels to get taken out. Until that, do nothing in the stock.
What do you do with railways at this point? You've got a bucket of railway stocks doing very well, Jay, and RVNL, RITES, and IRCON, all of those really flying in trade. What's the sense like on those?
Yeah, so most of the railway stocks have got a very interesting pattern. March lows and the April lows have coincided. And so this has potential to take the market back to all-time highs. I was expecting the correction in railway stocks to last a little bit more longer, but it did correct deeply, but but I was bullish on the long term. I saw the long-term correction would have, in my books, would have taken a couple of more months. But it seems to be bottoming quicker. Rail Vikas Nigam is actually an interesting stock. It's got an inverse head and shoulders pattern. Whereas IRCON and the other name that's got a double bottom pattern. So all three are signaling upside potential. I like RVNL better than the other two names. Very slight difference, but most of them have upsides to work with. RVNL, I would place a trailing stop at about 369 and hold on to the bullish view.
Okay. Jay Bala, lovely talking to you as always. Keep on coming, and thank you so much for speaking to us today.
Thank you. Good to be here.
All right, that's the technical view. Now, a management wherein what we're trying to do now, viewers, over the course of the next few days is try and get in companies wherein we may not have had a chance to talk to them during their earnings, because it's just a lot of companies, but either the con call or their numbers or their guidance has something interesting in them. And I can tell you that the management of Mold Tech Packaging, when they did the con call, have given some very interesting thoughts around what could happen to business going ahead, particularly with the new vertical of sorts that they are now working on, which is pharmaceuticals. So Mr. Janu Mahanti Lakshmana Rao, Chairman and Managing Director of Mold Tech Group, joins us right now on the show to talk about all of that and more. Mr. Rao, good having you. Thank you so much for taking the time out. This is Neeraj here. Good afternoon. How would you characterize what's happened in FY25, and how does that take you ahead in FY26, Mr. Rao?
Yeah, 25 is a stabilizing year where all our newly created assets, almost 400 crores we invested in the last 3 years, which was equivalent to 30 years of our investment in the past. So these 3 years are a huge investment platform we built up for Aditya Birla Group and a foray into pharmaceuticals. I'm very glad to say that the year ended, though at 8 to 9% volume growth, it paved the way for future faster growth. We are already witnessing that in the Q1, and I'm confident that the going years will be in mid double digits, somewhere around 12 to 15% volume growth for sure, with improved EBITDA margins.
So, Mr. Rao, also, of course, tell us, okay, we'll come to the numbers in a bit, Mr. Rao, 12%, 15% volume growth. We'll keep that at the back of our mind. But first, what will drive this? Because the existing categories, which is paints, etc., there is not so much of a demand buoyancy that we see per se, at least as the way we think. Is it the newly established or newly launched pharma division which will drive this overall growth? And tell us a bit more about what is it that you're doing in pharmaceuticals.
Okay. Yeah, the growth platform comes from mainly pharmaceutical to start with, but also ABG volumes that have been created, I mean, capacities that have been created last year are getting better utilized in the current year. And pharma is a very heartening positive for us, that we started just a year ago as broke even in the fourth quarter itself with a decent profitability, reaching around 6.5 crores of revenue for the quarter against nothing a year ago. So closing the full year at about 11 crores, half of it, more than half of it coming in the Q4. That's a good sign because this will now multiply 4 times at least in the coming year, because all these pharma orders are also sticky orders. And we hope to cross 30 to 35, in the bracket of 30 to 35 crores turnover in pharma from 10 to 11 crores last year. That's just a beginning. And even 30, 35 crores is no big deal, because it's hardly less than 1% of the overall demand in the country for both exports and for Indian market put together. It is not even 0.5%. The overall market is somewhere around 6 to 7,000 crores per annum, the packaging alone. So in that, even achieving 30, 35 crores is minuscule, but it's a good start because generally companies take a couple of years to accept a new packaging vendor because of the stability tests, because of the quality concerns and online trials and whatnot in the pharma industry. But I'm glad to say Moltech could cross the barrier within 3 quarters and delivered positive results in the fourth quarter. And more heartening is more than 20 companies have approved our facilities. They're made of world-class facilities at our Sultanpur, Hyderabad plant. And those plant operations produce not only the standard bottles and caps, but also variety of products, canisters, effervescent tubes and caps. And now we are developed holders, and we are developing various new products for the pharma industry. What is more heartening for us is, apart from just getting the bottles and caps business, we are able to drive new product development, which is a very time-consuming thing in pharma packaging in the country, whereas Moltech could cut the delivery periods from 4 months to almost 1.5, 2 months, and thus becoming, a useful vendor for pharma companies going forward.
Okay, sir, this is Harsh also joining in. I want to unpack this a little bit more. One, there's going to be pharma, which is likely going to drive growth. But again, as you correctly said, it's going to be a very small component of your top line. So where is that growth going to really come from, and what's the kind of number you're targeting maybe next year as well as maybe over the next 3 years? Take us through that journey, and what does that do to margins? Because capacities are now built, as you correctly said. What does this do to top line and margins? Give us that perspective.
See, the overall asset turnover ratio is not even 1 as of today. It has to go up to 1.3, 1.4 level on the average, because in fails, we achieve even 1.7. But in food and FMCG and pharma, it will be in the range of around 1.2. So easily it is reachable up to 1.4, 1.5 as the overall company average, which is currently hovering around not even 1. So crossing 1.2 this year and probably hitting 1.4 next year, that's 26, 27 is the target. But however, there will be new capacities will be added again, because pharma, as I said, hardly contribute even at 35 crores, 4 to 5% of our top line. But that can still have a potential to grow to 15, 20% of our top line in the next coming 3 years, because the area is very wide. And as we enter and have the credentials, the numbers what we can add in that field is phenomenal compared to paint and loops, where we have our position for last several years, more than 3 decades. So in the pharma, we see the numbers shooting up year by year. I can't predict at this stage, but I will be really disappointed if we are less than 100, 120 crores after 3 years in coming from pharma. And the growth area coming is also from thin wall and food and FMCG, where last year we had a tepid growth of less than 10%. This year, we managed to cross 14.7% overall growth in terms of volumes year on year. So that is a good number, and we foresee that it may cross even 20% next year, because basically our Panipat plant, which is in north, will be starting manufacturing these food and FMCG products starting from June. In fact, Hindustan Lever's detergent pack production started there already 2 months ago, though it is not a food, it is a FMCG product. Food products will start from June, middle of June or end of June, and that will contribute handsomely, or whatever it contributes will be an addition to the food and FMCG. So we are looking around anywhere close to 15 to 20% growth in food and FMCG. Paint industry is also growing good because the APG numbers are ramping up, and thanks to Asian Paints adopting more and more IML brands, we also stand a chance to grow with them. And overall picture in all these three segments look good. Lubricant is always a stagnant line for us. Hardly we find plus or minus 3% growth in that segment. The remaining all segments are showing at least around 10 to 15% growth, which can pull up the company's numbers in the coming years.
What does that do to margins, sir, if I were just to follow that on with margin outlook?
Yeah, you might have already noticed that we crossed our benchmark 40.2, I think somewhere around 40.2 per kg EBITDA we crossed after several quarters, after maybe 7-8 quarters, dropping EBITDA from 37, 38. Today we are at 40.2, and I see that coming close to 42 in the current financial year if the growth plans go as per our targets.
No, but okay, so that Mr. Rao, that would be the gross margins or per kg EBITDA. When I look at your reported EBITDA, which investors will be able to look at, right? For example, in March 22 or FY22, you did about 19% operating profit margins. March 25 or the year gone by, you've done about 18% operating profit margins. So what do the operating profit margins behave like in the next couple of years?
Yeah, profit margin dipped from 19.5 level to 18.5 in the last 2 years.
Yes.
And now in this particular quarter, that is Q4, we hit again 19.3. If you look at quarter in 11. And if you look at in future, EBITDA margins of pharma are in the range of 25 to 30%, depending upon the product mix. And food and FMCG always are around 24, 25. So these numbers growing faster than the pale segment, hopefully this should now come close to 20% in the 1 or 2 years time.
Okay, so you are saying that in 1-2 years, while you grow volumes in 13 to 15% range, that will be accompanied by margins maybe touching the 20% mark.
Yes.
Okay. And if the volume growth is 13 to 15%, console with all the businesses coming in and various kind of pricing that you may have, what does it translate into overall revenue growth, sir? You think you can do 20% CAGR revenue growth, reported sales growth, or could it be higher?
No, the revenue growth would continue to be in the region of 12 to 15%, CAGR. Probably 15% is possible. I'm not counting on the raw material price fluctuation, keeping the volumes as the base always. So volume-based growth will be in the region of 12 to 15% for next 2-3 years. And at least double that should reflect at the bottom line.
Double that. So you're saying 15% revenue growth, maybe 30% PAT growth.
Yeah, 25 to 30% PAT.
25 to 30% PAT. So people believe that you might actually nudge profits of about 80 to 85 crores in FY26 and maybe 110 odd crores in FY27. Are these realistic estimates, sir?
Yeah, they're good estimates, optimistic, I would say. Not very easy to achieve, but we are aiming that.
You are aiming for that.
What I said, 25-30% growth is what we certainly see is a realistic one.
Okay, just one more follow-up from my end, Mr. Rao, and that is on cash flows. Your cash flows have looked very solid. Is it because companies are paying on time and because you are supplying to the organized industry? And does that remain that way? Your cash flows, will they match your profitability, if you will?
Yeah, our cash flows are always good because touchwood, all our clients are top class clients in any industry you touch. You name Castrol, Mobil, Shell, Exxon in lubricants, Asian Paints, ABG, Kansai, Narolac, Berger Paints in paint industry. You look at food and FMCG, we have...
Is it the same in pharma?
Yeah, even in pharma, we have MSN, Marksons. There the payment periods are a little longer. As you all know, pharma pays 90 days plus. So there it might pull up our working cap requirements a bit. But being a small contributor as of now, that wouldn't impact our working capital. And will not impact our cash flows. We continue to have decent cash flows going forward.
So explain this to us, Mr. Rao. You've got this large capex which has come on stream. You have very, very strong demand which you've spoken about. Why just 12 to 15% growth in terms of volume?
See, I wish to do 15 to 20%, but I would like to be, realistic and talk to the markets what is definitely is possible, and hope to do better.
Sure. So the guidance, sir, therefore is more conservative, is what you say, and so
let's say realistic.
Sure. Okay. We'll stick with that. And sir, just tell us about what the future capex plan looks like. How quickly does this capacity get maxed out, and when does the next round of capex come on stream? Just give us that perspective.
It's ongoing, in fact. I wish to control, but already we have committed more than 60-70 crores in this year also, as of today. Because pharma, we are again enhancing our capacity, adding 7-8 machines in the current year, taking it from 1,500 tons to 2,500 tons by end of this year. And already we procured a land adjacent to our unit, very adjacent, 2 plots away. For 2.5 acres of land, we have been just sanctioned, spending about 11-12 crores for the further pharma growth, because the space is required for future. And that land has been acquired recently, and the payments are yet to be made. A sanction letter has been received from the Telangana Industrial Corporation. And so investments would happen, but not to the tune of 140 crores you have seen in the last 3 financial years per annum. It may come down to 70 to 80 crores this year, mainly for pharma, because we need to expand and create capacities as we add clients. Today, we have at least 20 approvals. Only 5-6 of them are giving the orders, and remaining people are in trials and trial lots, stability tests. And another 20 more new pharma companies are visiting us in the next 3 months, 10 to 15 companies, of which at least 80% of them will approve because of our world-class facilities and standards, and our ability to make molds and maintain the molds. For example, I was telling in the con call also, everybody is using a 15 gram, 200 ml bottle. Somebody needs a 17 gram or a 13 gram. And for our competitors to make those cores or change parts takes a couple of months. We are ready in a couple of weeks. So that is where we will be able to submit the samples faster and get the pharma company also move forward with their end clients. So that strength is what I see is going to help Maltech to grow in pharma. So further investment of at least 40 to 50 crores I envisage in this year on pharma, and the rest is balancing equipment for our regular pails and food. Food is another area, because in Panipat we are starting in a small way. In a 20,000 square feet area, we are setting up 6 machines, but that will be definitely inadequate, and we'll be needing another 6 machines at least by the season, that is March next year. So food and FMCG would also require around 25-30 crores of investment. So I think we have budgeted 70-80, but we might cross marginally even that budget.
Okay. Thank you so much, sir, for coming and speaking with us. New vectors of growth is what looks interesting, and that's likely what stood out for both of us as part of this conversation.
The thing also, Harsh, is that one, that they are growing at a good rate with a new vertical, but the cash flows are looking very strong. Usually companies tend to get stretched on the cash flow front. Here, that is not the case.
Yeah, in fact, when I was just looking at the PAT to cash flow ratios, it's looking very healthy in that sense. So yes, for sure. So that number looking good. But what we'll do, we'll slip into a very short break. But before that, let's quickly go across, because we were present at the sidelines of the Marcellus India Wealth Survey 2025 event. My colleague Pallavi caught up with the founder and CIO of Marcellus Investments, Saurabh Mukherjee, about HNIs and their struggle with low savings and high debt despite ambitious financial goals. Listen to what he had to say, and we'll see you on the other side of this break.
So what we are finding, Pallavi, is that we have a country where nearly half the HNIs aged between 30 and 45 are saving less than 20% of their income. So generally we're finding it in the HNI community, quantum of savings is subpar, but specifically this 30 to 45 age group, savings are less than 20% of annual income. Second thing we are finding is most HNIs have a proliferation of financial goals, and by and large, they're not saving enough for the goals. Our estimate is their deficiency in saving is between 40 to 50% of what they should ideally be saving, right? And the third thing is asset allocation. Indians even today have too much real estate, too much small cap, very little global equities, and diversified portfolios are hard to find even in the HNI community, right? So that's the three big findings. That's subpar quantum of savings, poor asset allocation, and too many goals, modest means.
Another interesting finding was how almost a tenth of those surveyed are struggling with debt. Tell us a little bit more about that.
So look, I think the RBI had flagged this last year in the Financial Stability Review published in December. The RBI had said that too many households have taken on debt. I had expected, since we were surveying HNIs, right, people earning 2 to 3 times the typical income taxpayer's earning, I'd expected the level of financial stress to be less in the HNI community. But as luck would have it, or as things stand, the proportion of HNIs who have too much debt is 10%, same as the RBI number, which suggests to me that high debt is increasingly a phenomenon seen at all strata of Indian society.
Right. Another interesting finding was how almost about 40% of those surveyed aspire for entrepreneurship.
Yeah.
Tell us a little bit more about such trends as well.
Stunned by that, right? So it was not surprising to see that 3/4 of Indians want to save for their children's marriage, education. वो तो understandable है. But you're right. The fact that 40% of HNIs want to save for starting a business was a bit of a stunner. I think this is a result of the unicorn culture that's built up over the last 5 years, right? The number of companies being opened in India today is nearly 5-6x that of what was happening 10 years ago. So we have become an entrepreneurial nation, and clearly all of that josh has seeped into HNI's veins, and the result is, 4 out of 10 families, 2 out of 5 HNI families are saying they want to set aside money and start a business of their own.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term? Buy, sell or hold?
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Welcome back. You're watching India Market Close, and it's turning out to be not a half bad afternoon. I mean, look at the recovery that you've seen from the low point of the day, especially in the broader indices. I'm going to start with the advanced decline ratio, just to get you a sense of where we are an hour before we close trade for the day. And you're not bad. You're almost at the high point. Advanced decline also looking quite robust. What's driving the markets right now? IT stocks have made quite a bit of recovery, sharp recovery over there, but you have platform companies that are doing really well. Platform companies, and I would say real stocks. So let's look at an Eternal, look at a Swiggy, specific stocks that I'm talking about. Both of them doing very, very well. I mean, Swiggy on a complete tear, 8% up on a Swiggy. I don't think you've seen these kind of moves in quite a while. Look at an Ircon, look at a RailTel, RVNL, right? It's all about the railways this afternoon and through the day. You've seen a sharp jump up over there. What's also catching my eye is a Garden Reach. Now, if you had watched NDTV Profit this morning, you would have seen our technical analyst to talk about his buy calls on a Garden Reach. We pointed out big order there, and what they're doing is very, very interesting. They're going to go out and going to make a vessel for exploring the North Pole, the Indian contingent in the North Pole. So new kind of an order over there, which has seen Garden Reach doing very well. Techno Electric is the other one, big order from the railways to man their data center. These are some of the stocks that are buzzing at this point. But on this leg of the show, let's welcome in Avinash Gorakshakar, Director Research Profit Mart, and Kush Bora, founder kushbora.com. Welcome to both of you, and great to speak with you. Kush, let's start with what are the levels that you're seeing this afternoon? And closing strategies that you'd recommend?
Sure. Hi, Tamanna. First, a very good afternoon to everyone. I think Nifty is consolidating. We'll take that as a healthy sign as far as levels go. 24,400, 24,500 support zone acting up. Heartening to see that the PCR is close to 0.74. Put option activity also shifted to 24,500. But there's a straddle at play at 24,600 with a premium of about 150. So that also ties in rather nicely with the support zone of 24,450 and a resistance of about 24,750 thereabouts. But I think a lot of action, as we've been seeing over the last week or so, has shifted to stocks rather than the index itself. So while Nifty does its own thing, continues to consolidate, I think the focus should shift a lot on stocks. And as far as the 24,400, 24,500 support zone goes, as long as that is intact, I think the bias in the market for Nifty will continue to remain positive. Just a quick word on Bank Nifty. Technically, this is much better placed. 54,800 is the support. 56, as we perhaps all know now, is the resistance and the major one at that. But I think up until Friday, once the RBI policy, meeting outcome is announced, post that you might get you might get a directional move on Bank Nifty. Bias here also remains positive. But even this one seems to be consolidating and waiting for the trigger to be out of the way. So both the indices, bias remains positive, are holding on to support zones, but not a big move. So perhaps avoid or a wait and watch, or if you have a position, continue to hold with trailing stop losses in place.
What would be your picks this afternoon, Kush?
Going with both the long calls, Tamanna. The first one is GMDC. Yesterday, also during the closing show, we did have a brief mention about this one. On the whole, the setup looks very interesting. Has had a good recovery. Just a couple of sessions ago, it's seen a golden crossover as well. So from a near-term perspective, 380, 395 are your targets. 356 is where you place that stop loss. The other one is from the pharma pick. That is Glenmark Pharma. Here too, we've seen good moves over the last 4 to 5 sessions. Golden crossover underway. Mild resistance of 1540 might play out the 200-day moving average, but with the kind of volumes that it saw yesterday and did well in the relative market, I think this is well placed from a near to medium term perspective as well. So 1545, 1575 targets, 1485 is where you place the stop loss. So GMDC and Glenmark Pharma on the long side.
Okay. Some big losers of the day that we should look at, and a lot of them, to be honest, are because of block deals coming in. So we need to keep that into mind. ABFRL is one of them. Indegene, of course, the other, and these are to be expected to have that kind of a pressure. But I want to get Avinash Gorakshakar in, and your view on ABFRL fundamentally right now. Is this a stock that you'd look at?
Yeah, I think Tamanna, the longer term we continue to be structurally positive on ABFRL, but I think considering the kind of OFS and the kind of near-term kind of activity in the market, it could happen that maybe the stock could underperform in the short term. But looking at the next 12 months, our sense is that both the top line as well as profitability could be significantly better. And I think the tailwinds in the retail market are also quite encouraging. So I think they have a very large domestic bouquet of products. They have a good geographical reach. So my sense is that you need to give in some more time for this business to actually gain traction and show better operational numbers. So I think from a 12 to 15 month kind of time frame, definitely it looks to be a good buy. Clearly from a longer term angle.
Okay, so that's the story with ABFRL. I wonder if you have a view, Kush, on an ABFRL or an Indegene or any of these block deals today, even Motilal Oswal. I just want to pull up the Motilal Oswal stock. 0.6% of equity changed hands today. Stock, of course, has been zooming ever since, about 2% up right now. Any of these that you're tracking on the charts and a view there, Kush?
So Motilal Oswal looks very interesting. It's had a good run, but the last few sessions it's held up above the 200-day moving average. Today, of course, because of the deal, the volumes are spiking. But overall, if you see the medium-term trend is very much intact. We've seen traction in some of these capital market plays. This one also has participated, although not in a very big way. But the medium-term trend for sure remains intact. So with the stop loss around the 790 mark, on the way up, you're looking at 855 and about 880 as the next levels of resistance. So among the three that you mentioned, the only one that seems to be rather nicely placed from a near to a medium term perspective is Motilal Oswal.
If I'm looking at the gainers, I just want to pull up 2 or 3 stocks which are having some consistent runs and not normally coming in the scheme of things. So Quick Heal, which is the top gainer, I think market wide today, 18.96% higher, 19% higher now. But look at the last 5 days, and I think it's had a couple of fairly decent days in the last 5. So one of them is Quick Heal. If you can pull up the 5-day chart, some very solid moves there. Yeah. So one bump up and then today. So that is one. The other one is Reliance Infra, 374. It's broken out in some fashion, 9% today, but over the last 5 days or the last 10 days, Reliance Infra 2 has had, if I'm not wrong, some decent days right there again. A bump up one of the days and then some perk up there too. A clutch of those names might come in, but Kush, any thoughts? Quick Heal, Reliance Infra, not your usual names, though must be trader friendly, Reliance Infra for sure, but is there a further trade that you can do here?
I think in both the names, Neeraj. In fact, just to highlight, Reliance Infra has had a good run, as even you've pointed out, for the last about 4 weeks. And all of them with good volumes, but the last 2 weeks in particular have seen a rather interesting bump up in volume, almost the double of the last 20 weeks average. So a very good bump up on this. Nothing suggesting that the momentum is abating. I mean, if you look at it from a smaller time frame perspective, then of course they will look overheated. But with the kind of run up that they've seen over the last month and a half, I think this is a good up move. If you have a position, continue to hold. If not, with a target of 400 and higher, Reliance Infra can still be considered. In fact, a lot of traction in some of these infra plays is starting to catch up. The stop loss on Reliance Infra, by the way, would be 355. Quick Heal, almost diametrically opposite, where it didn't do much for 8 to about 10 weeks. Had been consolidating. You could see volume bump ups here or there, but today it's a good clean breakup. And despite the kind of run up that it's seen over the last 3 sessions, including today, I think there is a very favorable risk reward ratio to be had, where a good support zone near the 300 310 mark comes in. But on the upside, you've got levels of 410 and then about 470 thereabouts. So risk reward ratio is fairly favorable, and this seems to be the start of the next up move. So both of them, for slightly different reasons, do seem like a good trade from current levels also.
Avinash, very quickly, curious to know your view with regard to a Quick Heal. Kush seems quite positive. Avinash, your view on Quick Heal?
Question was for me.
Yes, please. Yes, please. Yes, please.
See, I think clearly, Harsh, if you look at the financial performance of Quick Heal, in the past few years, the company has not actually delivered to the extent what investors had expected. So my sense is that unless and until there is some genuine traction on the business side and typically some new product development, I would be a little wary on the price increase. A 20% jump in a single session, unless there is some large corporate announcement or some M&A kind of development, I think which only one is clear about it. One could take a conscious call here. Otherwise, in the last 2 to 3 years, there's hardly any money which has been made on this counter. So my sense is I would prefer to wait, for some more clarity. But yes, within the product category space, it's a large kind of category, a large opportunity for the company to, gather, solid top line growth. But I think we need to see much more stronger, quarterly numbers at least for a couple of quarters. So at these levels, maybe I would prefer to, wait. I wouldn't hurry, in a rush. But yes, I think definitely longer term prospects are good, but the near term valuations seem to be fair to expensive.
A quick fundamental take with regard to a quick heel. Let's also look at the stock of the day now. Sun Pharma Advanced Research Company, or SPARC as it's called, is in focus after a couple of trials for its psoriasis drug failed. And we have Varsha here with more details. Stock, of course, down 19%. Varsha.
Thank you for that. The main question is why this is a bigger setback for SPARC and not Sun Pharma. So what has happened is the Sun Pharma's experimental drug failed in clinical phase 2 trial, and this did not meet company's main goal, that is 75% of improvement. Now drug was being tested in 2 mid-stage clinical trials, and the trials were conducted to treat cirrhosis and eczema. Now why we are seeing a big impact on SPARC, because this is an R&D firm of Sun Pharma, and this drug was developed by SPARC, and the opportunity for this drug for SPARC was almost over $1 billion. So losing $1 billion of opportunity questions SPARC's primary business, that is research. And investors and analysts were actually betting on this company for this one main drug. The future prospects for SPARC was directly tied to the success of this product, and this was expected to come in by FY30. Now the other setback is that this is not the first time that SPARC has faced major R&D setback. In April 2024, the trial for Parkinson drug also failed. So basically, because of that failure, investors were having an opportunity for this drug if that was to be positive. Now why not much impact we are seeing on Sun Pharma? One is because this failure impacts company's specialty portfolio, not the overall operation, and the potential revenue from this product was not accounted in the company's financials. And of course, Sun Pharma has the generic portfolio also, which will do well, and other specialty products which are in pipeline, which will actually do well for the company. But for the SPARC, because you are a research company and your multiple drug has failed in the phase 2 trials, is one of the setbacks why we are seeing the stock is down almost 20% in trade today.
It's maybe in hindsight, it's smart that the research wing has been hived off. So Sun Pharma has relatively been insulated by this. But SPARC, I just want to pull up the 52-week or the 1-year chart for SPARC, because this is not the first hit that SPARC has had, and in the last 3 months has been okay, but the 12-month chart is showing pain, 9-month chart is also showing pain. Today, another huge hit coming in. Avinash, any redeeming factor for a SPARC today? And if someone is in the stock, what do they do?
No, I think, Tamanna, this business is a very high margin but a very high risk business, and whenever any drug fails, then I think it takes a lot of time for the market to actually absorb this. Primarily because this business is what we have seen in the last few years has not got the kind of scalability typically any manufacturing or pharmaceutical business has seen. So this is a very high gestation business. If the product succeeds, then I think the multiple benefits do come in. But if it fails, then whatever investment the company has made, it has got to go to the drawing board and again start from scratch. So my sense is that this is unlikely to generate a big alpha in the very near term, because we have seen successive drug attempts, new products, by SPARC, but unfortunately it's not got translated into the numbers. the company still does not make any decent kind of cash flows. And, in terms of the effort which they put in, the revenue kind of implication is not that significant, which the market would like. So I would say that, it's more of a trading counter. I wouldn't like to put my money on a stock where visibility of earnings is very volatile. And to that extent, it's better to bet on Sun Pharma, which is the parent company, and where I think they have a kind of a very large product base, a very strong balance sheet. So to that extent, if one were to take a call on Spark, I think it's better to buy a small position in Sun Pharma, which I think can give a better risk reward and a much better kind of capital protection kind of strategy.
Okay, thanks for that, gentlemen. By the way, just before we go to Manish Singh, just want to mark Moltech Packaging, because I think the street seems to have heard the conversation, a bit of a bump up in that stock after that interview that they did. 670, 661 now. It was way lower actually. This chart seems to a bit indifferent. But anyways, be that as it may, let's go across to Manish Singh, CFA and CR at Crossbridge Capital. Remember, European markets have opened higher despite the metal tariffs as well. Manish, great having you. Thank you so much for taking the time out.
Thank you.
India is besieged with conferences. We're covering many conferences this week and last, and there seems to be a fairly large appetite for the Indian markets. How do you see risk appetite, appetite for risk assets, and within that landscape for Indian equities?
See, I think we first have to look at the macro picture, how it is shaping up. And if you see President Trump's post last night on Truth Social, it's an acknowledgement and probably an admission that his tariff strategy is not going to succeed, at least not against China. Now, that is definitely a big positive, because that has been an overhang on risk and on equities in general, and not just US, I think emerging market as a whole. However, if we talk about the Indian equity outlook or India macro outlook, then that is also bilateral between the US and India. If you see some of the strong statements that have come out, and also if you see Secretary Howard Lutnick, he is in Delhi, I believe. And if I see the panel on which he spoke, and he mentions about the changes that he wants to see from India in terms of India should be buying more from the US, and President Trump and the US, though they don't seem to be very happy that India has pursued this policy of moving away from the dollar by being part of BRICS grouping. So there is a lot of, I would say, bilateral issues that needs to be resolved if you're looking in terms of what is the outlook for Indian equities going forward. But anything that takes the global risk away, and that has been with respect to the tariff, has to be good news for everyone, including the Indian equities.
Okay, hi Manish, Tamanna here. Great to speak with you. Yeah, fabulous to speak with you. Just trying to get a sense of what is the extent of impact we can expect from all of these trade announcements. For example, European markets don't seem to be responding too aggressively to anything that Trump has said. June 4th, today is when the steel tariffs have to come into place. Is this now being discounted as something which will be eventually reversed?
I think it should be discounted, because let's look at one by one. If you see the inflation number that came out in Eurozone day before yesterday, it's now at 1.9%. So it's below the ECB's target of 2%. You're seeing the GDP number in the US, at least for Q2. If you look at the Atlanta Fed's projection from the GDP Now model, that's way up at 4.6% for Q2 GDP growth in the US. On the tariff front between US and China, we are seeing a resolution to the point that the excess tariff on China is not going to work, and therefore you're going to see the Chinese investments or the Chinese consumption also rise. Let me give you a number. If you look at Chinese exports to the US as a percentage of Chinese GDP, that's 3%. If you look at the S&P 500 earnings exposure to China, that's 7%. So the US equities or the US businesses definitely want more of China consumers and to be selling more to China. And that is going to be in their interest. And therefore, they're going to lobby against the tariff. And you saw that. The whole climb down started when you had the CEOs from Walmart and some other retailers go and speak to President Trump and basically read it out to him that the shelves are going to be empty if this tariff continues and the trade stands to zero. So that has not gone away. That's the reality. Having said that, I don't think you are going to see any big deal between US and China when this 90-day pause ends, because there is no big deal to be done, in the sense that both sides are going to be competing to further their own interests. And you have seen that China is on record, or I mean, at least there was an article in the Financial Times which talked about that China continues to remove US and European companies from its supply chain. And US is doing the same thing by saying, oh, there's certain companies that can't export chips and various other. This was after the Geneva deal that they had agreed on. Both sides have been taking measures to make themselves better. That's geopolitics for you. So you're not going to see any big, broad-based deal which people always look at and nothing comes out of it. Businesses are going to trade based on what they see as advantageous, and the countries are going to compete based on what is advantageous to them. And that is not a bad thing for global equities, because the huge effect that comes from the policy side may not be as big as it is made out. And that was proven when you saw the S&P correct in April and now go back to almost 6,000.
Manish, this is Harsh also joining in. Rationalize this for us.
Hi, Harsh.
Hi. Rates, at least globally, are going to be higher for longer. Can India, and maybe this is more of a domestic question, can the Indian Central Bank continue to cut and cut substantially? Because that will be the very big news this week, likely, at least here in India.
So I would say that I would slightly disagree with you. I do not think the rates will be will stay higher for longer.
Okay.
Sure. As I said, ECB, if you look at the ECB, I think they have cut rates, they will cut rates more. To me, the big macro agenda, or big thing on macro agenda, is going to be disinflation. And why do I say that? If you go back to the pre-COVID days, entire world was struggling from disinflation and the rates were low. And then you had COVID, which just disrupted the supply chain. What has happened between COVID and now? There's been more technology, more productivity, and things have just gotten better on the supply side. If you take that and then add that to the demand, at least on the Western side, Western economy, Japan, Korea, anywhere, the demographic problem that they face in terms of lower consumptions, that is not going to be helping demand in a big way. So if the supply has increased and gotten better, technology has gotten better, productivity is getting better and continues to be every day, what happens to basically supply meeting the demand very, very quickly? There will not be inflation. So my point has been right from the beginning. I've written about it. I've said about it many times. To me, disinflation is what we will be talking about. So this whole thing about inflation is going to be higher. It is all driven by tariff. And yes, if you increase tariff by 40%, you will have price level increase by 40%. But that will be just one-off increase, and then it tails off from there. I don't see even that happening. So for me, the big case is disinflation, and therefore I'm bullish on global growth and global equities, because that will allow the central banks to cut rates. Don't be surprised if you see Federal Reserve cutting more than twice or thrice this year. I know they have said that they're sitting on the sideline watching all these things, but they're just waiting for President Trump to give a signal that he's done with his tariff game, and that allows them. And look at the data, the core PC, the super core PC is almost negative, and the core PC is below 2. So what are they waiting for? So in my opinion, the Fed is looking in the wrong direction, and they will realize that, and they will start cutting rates. And that will allow other central banks to cut rates in India as well.
Point taken. Manish, last quick one. Do you expect the outcome, or rather, let me keep this more open-ended. What's the outcome you expect from everything that's happening with regard to US tariffs and Trump?
I say that, like I said, I don't think there will be any grand deal to be struck, because this is something which will carry on for long term on very specific elements, and which is where the steel tariff and other thing comes in. I think President Trump will have his way, because that is on national security grounds. The real trade war is between the US and Europe, not between US and China, because China and US are very equally matched, and they both can hurt each other, and they both know that. And the appetite to take pain on China's side is much higher than America, and that makes America's position very weak. But it's not the same with Europe. So your real trade war will continue with Europe, because in Europe, all the countries are not the same, and you have to get 28 countries together to speak in one language, which is never easy. And if you look at the trade imbalance in terms of goods that Europe has with US to almost $150 billion, which is exactly what Trump always talks about, is extremely high. And the other thing I'll point out is that trade imbalance is not because the Europeans are more productive. That is not the point, because if you look at the paper that Mario Draghi has written, Mario Draghi's paper clearly said that the tariffs or the non-tariff barrier in within the EU is extremely high, and that is holding productivity. So the trade surplus gains that Europe has over the US is because Europe buys much less from US because of the non-tariff barrier that EU and Europe imposes on US, and that's what US wants to bring down. So to me, the real trade war will continue to happen between Europe and the US. And between US and China, it is more evenly balanced. They will compete. They will compete as they are competing. Both sides have massive advantages. And to me, that will just continue, and businesses are going to trade as they used to in the past.
Okay, thank you so much, Manish, for joining us this afternoon, giving us that global perspective on this Wednesday afternoon. Thanks so much, and have a great day. Pleasure talking. Interesting thoughts, Neeraj, especially with regard to the world view. But let's start talking stock specific, frankly. PI Industries is abuzz after a key customer raised its forecast for profits. Varsha is standing by with more details on this one. 4% higher, Varsha.
Yeah, so the key customer, that is Qumi AI, has raised its profit forecast, have raised operating profit forecast by 34%. Now, why this is positive for PI Industries? Because PI Industries supplies pyrosulfane, which is a herbicide, to this customer, and which contributes 35 to 38% to PI's overall revenue. Now, just on the forecast update, so net sales has been revised to which has led to 8.7% increase. Operating income has been revised, which is a significant 34% increase, and net profit has been revised, which gives almost 6.9% increase. Now, why Kumai has raised this forecast? Because expected net sales will exceed forecast due to advanced shipments to overseas market, and they are expecting increase in the operating income because of the higher sales, but net income will remain almost unchanged because of large foreign exchange losses, which is caused by appreciation of yen. So because your customer is raising its guidance, which will ultimately benefit PI Industries, so this customer contributes almost 35 to 38% to the overall top line of company.
Okay, so that's with regard to a PI, clearly moving the needle where the stock price performance is concerned today. Thank you so much, Varsha, for that. Avinash, PI looking interesting to you?
Yeah, I think, Harsh, looking at the kind of growth outlook which has been estimated by one of their large customers, I think definitely today the stock is in the limelight. But I think even otherwise, the company has a very attractive product mix of agrochemicals and custom synthesis. They have a very large order book, which I think can easily, give them good visibility for the next 12 to 18 months. So I think despite the fact that the stock is, quite fair to expensive, I think it operates in a very niche space, and hopefully this year, agrochemicals is one sector where I think there's going to be a very strong revival. Last year was not a very good year for most of the agrochemical companies. So I think to sum it up, I think definitely we could expect a strong traction in FY26 and 27. So I think it could be a good buy on dips. Even at the current levels, if one were to take a 12 to 18 month call, one could definitely buy the stock in a SIP strategy, which could actually give a good risk reward.
A couple of options. Avinash, clearly positive. Kush, your view?
Well, Harsh, slightly divided here. The reason being that while the stock has made a very good recovery from the lows of 3,000, what's happened is then, and this is not just for PI, this is actually for a lot of stocks in the sector, including the likes of Sharda, Cropchem, Rallis. If you see, I mean, it was somewhere close, last year, somewhere in late October, early November, where a lot of these stocks started consolidating, and the names that I mentioned, Sharda, Rallis, PI. Some of these are now coming up at those supply zones. So while yes, the recent turn has been positive, the medium-term outlook is positive. I think they could see some sort of a pause going forward. So, for example, PI in particular, has a resistance near the 4,000, 4,050 mark. So maybe you could see some sideways movement, some profit taking, some offloading around these levels. But I think once in the clear of these levels, I think higher levels of about 43.50 are also on the card. So that's the kind of medium-term trend, uptrend that some of these stocks are witnessing. It's just that for maybe a week or so, or maybe a little longer, there could be some supply pressure that might come in. So if you want to create fresh positions, you might want to wait for these resistance levels to be taken out. But if you have an existing position, no worries at all. Just with a trailing stop loss, continue to hold on to them. That level for PI Industries comes close to 3,800.
talk about a couple of platform entities in the same breath, Kush, because look at the moves that a Swiggy is making, 9% higher now. Zomato is obviously the top gainer for a while on the Nifty 50 index. What are your views with regard to a couple of these?
So Swiggy, from a risk-reward standpoint, has made a very good turn. Not really perturbed about the kind of 9% uptick that it's seeing today. There is still a lot of upside to be had. It's had a good, it's had a good and steady upswing. Today is a breakout day, so this momentum also could well continue. I would continue to hold on to this one for about 380 and 410 kind of levels on the upside. Stop loss for this one 345. Eternal, I've maintained that there is a range of about 200 on the downside, about 240, 250-ish on the upside. That is not yet broken. So for me, once it clears 250, also the 200-day moving average lies at 248. Once it clears that, I think the uptrend could begin. It's seen consolidation for the last 5.5, 6 months, almost all of this calendar year. So once you see the supply pressure getting over above the 250 mark, I think the next leg of up move for Eternal will start, and it could be rather soon.
Now, okay, so thanks for that view, Kush. I'm going to quickly also flag off a note by Morgan Stanley, which has come through, and this is on the back of the India Investment Forum 2025, and what they write, and I'm going to quote them: the company is trying to create differentiation in a market with otherwise similar offerings so that the customer can interact with it across different use cases. This is Swiggy I'm talking about. So that's one. The second one is the total addressable market of quick commerce in India has expanded. They are expecting AOVs, which is the average order value, to expand something in the mid-teens or the high teens in FY26. That could really drive margins as well. So that's going to be the focus for the company. Now, talking about margins, the company has reiterated its guidance of contribution margin break-even in the QC business in the next 3 to 5 quarters. Likely some of that commentary driving the stock price today. Avinash, bullish with regard to a Swiggy, especially given the discount that it trades at to a Zomato, and Morgan Stanley highlighted that in their note yesterday as well, that the discount is fairly large. In fact, if I recall, 51% was that number in absolute terms, at least on the basis of price to sales.
No, I think, Harsh, from a 2 to 3 year kind of perspective, I would say that the food app space, where Swiggy operates, is definitely looking very attractive because lifestyle habits are changing, and I think the market opportunity and the runway for growth is significantly large. So I think maybe in the near term we may not see profitability coming very soon, and the cash flows may not be coming. But if you take a near 2 to 3 year call, then I think it definitely is a good portfolio candidate for somebody who wants to make a decent alpha over the next, say, 2 to 3 years. Because in most of these companies, even as of now, they're burning cash. And I think the only positive is that in the food app space, only 2 large players exist. That is Zomato and Swiggy. So I think competition is limited. But clearly, I think this is a space where a lot of runway for growth is available. So I think, longer term investors can definitely look at it, considering that there's a big discount to Zomato. And Swiggy is definitely gradually upgrading its product bouquet, improving its technology focus. So I think all that will get reflected in numbers over the longer term.
Okay, so Swiggy in focus, looking delicious today, that stock price, but another one which has been in focus, and we're doing a bull versus bear segment on it, is Garden Reach. I mean, the kind of moves the Garden Reach shipbuilders is putting in place is really seen to be believed. The stock has hit its 52-week high. Harsh points out that the stock has nearly doubled. Harsh, you were mentioning after the 1st of May.
Yeah, since the 1st of May, if we pull out the 1-month chart, it's nearly doubled, at least that was my reading of it. But let's go across. Anushi is standing by with the bull versus bear.
Right, so I'll start off the first point as to why Garden Reach has been buzzing so much recently. Now, in today's focus point for the business has been its recent MOU, the new MOU that it has signed with Norway's Kongsberg, and this is to build a polar research vessel, which is a first for India as well. Now, what does this mean for India? This construction of the vessel will take place indigenously in India, and it will support India's scientific missions in the Arctic and the Antarctic regions. Again, this would pertain to climate research along with oceanography on polar logistics as well. So they'll be building this building this vessel in their Kolkata yard. So that is an interesting one. And again, in the under Make in India initiative is what we are seeing. So this MOU is an important development that we are seeing for Garden Reach in trade today. However, if we look at the bear case scenario, it likely is more of a bull case. We are seeing that the stock has been up over 71% in this 1 month. In fact, if we take the 1 year in picture, it's seen about a 164% of an upside. But going forward, what could be the outlook? It's important to keep a track of. Now they have a couple of project delivery timelines in focus. It would be crucial for them to meet these obligations which are there in terms of the vessels, the next generation corvettes, the P75, what is happening with that. So we have to keep a focus in that regard, which brings us to our second point, which is there. If you are talking about Garden Reach, of course, the focal point would be the order pipeline that the company has. If we talk about the present order book, that stands roughly at about 23,800 crore or so. But it's the order pipeline which is interesting, especially for the next 2 years. They're seeing about a 1 lakh crore of a pipeline in just these 2 years, which is 5x of almost where its current order book stands at. So that is a very strong point for the business, not just for Garden Reach, but the other shipbuilding companies like Cochin Shipyard and Mascot Dock as well. Even if you look at the recent update which had taken place, now they had been declared as an L1, that's the lowest bidder for 5 next generation corvettes, and this is to the size of 25,000 crore that we'd seen. Total size was of 40,000 crore, of which Garden Reach had the biggest pie of the order. So so management continues to remain and investors continue to remain focused on the kind of order pipeline opportunity that the shipbuilding industry has going forward for the next 2 to 3 years. Do note that there was a maritime fund also which was set up, which was exceeding the size of 25,000 crore as well. But a couple of delays in terms of where these large ticket orders could be could derail some of these estimates in terms of where the EPS is, and that could raise concerns about the outlook, especially if we consider FY27 as a year wherein it has been pointed out what these order pipeline could be going forward, whether that is the peak that we are looking at, because FY25-26 the outlook has been constructive in terms of these large ticket orders that are in place, but it's the outlook beyond FY27 that we have to see what's the outlook going forward. So that brings to our final point, which is there for Garden Reach, which is now if we see how the company has done, it has been reporting strong set of numbers, not just in FY25, but in 24 to 23 as well. So overall, we did see a strong set of numbers in FY24. In fact, if we see the future outlook, they are seeing a 20 to 25% of a CAGR growth for the next 2 to 3 years as well, even in terms of where the capex plans are headed towards. Now, what has happened that they had just recently, in 2024, they had enhanced the capacity from building 20 to 24 ships. Now they are expecting that this 24 ships capacity to further increase towards 28, and this is by end of 2025 that we are looking at. In fact, the most of the construction which also takes place is in their Kolkata facility, Kolkata yard. So they are looking to expand beyond that also, and greenfield expansion is not off the table. So that is something that we should keep an eye out for, because that would improve the production capabilities for the business as well. But it's the valuations which remains as a concern, because most of these companies have seen significant sort of returns in this last 1 year. As we've just talked about the stock price return, if you look at the current P, that stands at 71 times. This is the current multiple that we are looking at versus an average 3-year multiple of 28 times. But again, do keep the growth potential also in picture. We are looking at almost 5 times the order book size. It's the execution which would be an important metric to keep a track of for these estimates and these valuations to sustain for the business. So that's the overall bull and the bear case scenario for Garden Reach.
Very detailed piece there. I think the biggest bear case is the valuations more than anything else, and the fact that it is a lumpy business. Avinash Gorakshakar, how do you look at the defense pack and a Garden Reach at this point with no stopping it, frankly?
No, I think, Tamanna, we look at 3 parameters when you look at companies, obviously whom you partner with, what is the business, and finally what's the valuation. So I think in case of Garden Reach, the first 2 parameters are perfect, but the third one, as your colleague mentioned, valuations are extremely expensive. And I think, as you rightly mentioned, this is a lumpy business. The project execution is also very critical. I think what we have seen, what has happened to Mazgaon Dock, very poor numbers in the Q4. And I think markets have now been driven, especially for most of the defense stocks, purely on sentiment after the Indo-Pakistan, border action. So my sense is that it's better to wait for a slight mild correction before you enter at these levels. Valuations are extremely high. And I think to justify these high valuations, you need to have a very robust earnings growth engine, which if it doesn't happen, then I think the fall could equally be fast because, looking at just the order book and the kind of, MOU which has been signed, these are events which are definitely positive, but which are yet to contribute to the earnings kind of, curve. So my sense is I think it's better to wait. Existing holders can hold on, but fresh buying at these levels is definitely not advisable.
I wonder if some of the newer listings will see some fresh buying because they've seen buying in the market bourses for sure. So Skoda is one thing, but and that is of course up today. The debut is promising. But look at, for example, Belrise. It's up about 5.13% today, 96 rupees currently. So move. It's a recent listing. Then AG's Wopac is up another 5% today, 268. Remember on the listing day, it started off at about 217, 218. The last, post that, I think it's only gone one way, and that is higher, 268 and counting. Schloss is lower, but the others are higher. In the recent listings, Avinash Gorakshekar, is there something that stands out for you? Something that you will be willing to commit money at this stage as well? At these valuations, whatever the valuations may be?
No, I think Neeraj, within the listing, I think Belrise seems to be quite attractive because it operates in a very large product category in the auto component space. And it's been one of the tier 1 component suppliers to a lot of OEM names. And I think, once we get a better sense of FY26, because the stock has just got listed, we'll be looking at their quarterly number, their conference call commentaries. And I think the management bandwidth is extremely strong. So maybe around 95, 96, it's not very exorbitant as compared to its IPO price. So I think, it would give a decent risk reward for investors who can take a slightly medium to long term call. As far as the other stock, Aegis Vopak is concerned, is also an interesting opportunity. You rightly mentioned that on the day of the listing, it got a very tepid listing. But I think here also, I think the business is very unique, a very scalable model. So here also around 250 or 260, if one would get an entry, definitely the medium term to long term prospects appear to be quite encouraging and solid.
Okay, all right. So there's some of the new listings which are in focus, but it's also the block deals which are in focus. It's been raining block deals. 2 blocks in Ola Electric and Yes Bank were concluded yesterday after market hours. Today there are 4 which have taken place. Mahima tells us more.
Right, so definitely it's a day of block deals today. To start with, there are 4 counters, as you rightly mentioned, that are in focus on the back of block deals, and the expectation versus actual as to what the block deal has actually, how the block deal has actually taken place. Indegene, the expectation was roughly 10.2% of equity changing hands, but around 12% of equity has changed hands. For ABFRL, the expectation was around 6%, but the block deal actually has exchanged around 8.8% of the total equity. Tata Tech 2.1% and Alchem Laboratories around 1.4% of the total equity has exchanged hands. Now approximately 3,480 crore is the total value of these 4 block deals. In terms of details for each of these block deals, Indegene, Carlyle Group is expected to exit the company for around 1420 odd crores, which is around 10.2% of the total equity, and Carlyle owns the share through affiliate CA Dawn Investments. In terms of the floor price set, that is around 580 per share, which is at a 6.4% discount from its yesterday's closing. Moving on to the next counter. We have Tata Tech in focus. For Tata Tech, the total amount is around 635 odd crores. Floor price was set anywhere between 744 to 767, discount of around 3 odd percent, 0 to 3 odd percent to its yesterday's closing price, and around 8.5 lakh equity shares are expected to exchange hands, and that has already taken place. So around 2.1% of the total equity has exchanged hands. This is of course another clean trade in focus. The next one Let's pull up that. We have Alchem Laboratories, where promoter Jayanti Sinha has sold around 1.42% equity sale via block deal. She currently holds around 2.46%. The total promoting holding right now stands at around 55.13, and post this stake sale, promoter holding will come down to around 53.71. In terms of Aditya Birla Fashion, Flipkart was expected to sell around 6% of the total equity. The total amount roughly is 600 odd crores for Flipkart. Floor price set at 79.5, which is a 7.6% discount to its yesterday's closing, and number of shares involved will be roughly 7.3 crore. Lastly, ABFRL has around 8.8% equity that has exchanged hands. So we'll have to see that apart from Flipkart, who else has actually sold in Aditya Birla Fashion. So these are definitely the 4 stocks in focus on the back of block deals.
Okay, thank you so much, first off, Mahima, for that very detailed link. Avinash, let me come to you with regard to this one, and let me also couple something like an ethos. Primary issuance, 410 crore, stock up and away in trade. So that's the other one in focus. I want to try and ask you a couple of questions on this. One is with regard to all of the stocks which we've just spoken about, ABFRL, Indegene, Alchem, Tata Tech. Any of these on your radar? Because we've seen quite a bit of a stock cut in the stock price that we've seen today versus yesterday. Are these opportunities to therefore buy? That's my first part. Second, does this mean that this flood of exit which is happening, whether it's PE, whether it's VC, whether it's promoters, does it ring any alarm bells at all at this point?
No, I think, Harsh, the second part to your question, I would like to answer first.
Sure.
I think I don't think it's going to create any alarm bells, because most of these promoters are also finally wanting to encash their equity holding. So it's a process which the market obviously has accepted. Typically, what happens is that during these kind of offers, the stock corrects, and there is an opportunity to buy the stock. But I think one has to see the longer term growth trajectory of these companies. So I think, if you look at companies like Indegene or maybe ABFRL, we are quite positive on these companies and structurally positive over the next, say, 1 to 2 years. So I think, somebody who has not probably purchased or had missed the opportunity of buying during the public issue and wants to, add to their portfolio, this could be a good time when the stock is under pressure. But the long-term fundamentals of these businesses are right. So I think ABFRL and Indegene, we believe that these are very strong kind of companies which have got very strong, business domains. And most importantly, the markets have always recognized, wherever the business is scalable and where the management bandwidth is extremely strong, I think these kind of short-term price movements are very temporary. So if you take a slightly longer term view, I think these could be good opportunities to accumulate, but only for those investors who can give a slightly medium to long-term view, for their portfolios.
Okay. And now time for the closing strategy. Kush Bora. We've discussed a flood of stocks. I don't know if any of those stand out for you, but if a view on that. And then, of course, your closing strategy, Kush, most importantly.
So I think the one that we discussed in terms of the Motilal Oswal, as I said, is doing well, has been doing well before that as well. So I think that is the one that you could well focus on. None really from the names that were just mentioned, Alchem, Tata Tech, they don't really stand out. And the way typically I like to see them is what were the stocks doing before the deal was announced. So you could at least take the deal and the price movement with that pinch of salt. But not many of these had a very encouraging price movement about a week or 15 days prior to today as well. So while I will have these on my radar, nothing yet on buying radar except for maybe a Motilal Oswal. Now, as far as the BTSC trade goes, it's on Uno Minda. The stocks had a very good run. 200-day moving average conquered sometime back, holding comfortably above it. Golden crossover, about to be hit on the way up. The next level of resistances are fairly high. Weekly setup also very encouraging. So it's got a few things going for it. From that perspective, I think from a BTSC trade perspective, or even from a positional standpoint, with targets of 1080 to 1110 with a stop loss around the 1020 mark, Uno Minda is a stock that can be considered on the long side.
Okay, so those are some names for you, but let's take a view as well. BofA cautious that Indian valuations are stretched amid risks of a global slowing of growth. At the BofA conference, we caught up with Amish Shah, who's Head India Research, BofA Securities, about the growth that he is penciling in. Listen in.
It ties in with the report that you guys have written about 9 structural growth drivers and how longer term India is great, right? So some reference of that and tying that in with what is it that changes your view? Is it a time correction? Does it, if the Nifty doesn't do anything for 6 months, broader markets kind of stay stable, does that therefore bake in the valuation discount that India should get, and therefore do you turn constructive? Is it better earnings growth which surprises you, which seems to be the obvious answer, but is that or is there something else?
So Neeraj, let me put it like this, right? If I were to purely put this in the form of arithmetic, so markets, as we know, is EPS multiplied by valuation multiple, right? And and therefore it's also about the time frame of your investment. So let's say if I were to set a price target for December of 25, which is the end of this year, I would say that, okay, what is likely to be the December 26 EPS of Nifty 1 year forward, because markets will be willing to pay 1 year forward. So what will be the December 26 EPS multiplied by the valuation multiple I'm okay to give, right? That sets my price target for December of 25. But now if I were to say that I want to set a price target for December of 26, then I'm saying that, okay, what will be the EPS of December 27 and multiplied by the P multiple, So this therefore, first of all, becomes a question of your time horizon of investment, right? The longer you want to stay put in the market, obviously, given the fact that India is a structural growth market, so earnings will keep on compounding. And if earnings keeps compounding, markets will also keep compounding. So once we have established that, the markets will keep compounding, but my entry point decides that despite that compounding, how much returns will I make?
Agreed.
Right? So given the valuations that we already are, if you, let's assume that if you're an investor who wants to stay invested for 18 months, you should be expecting 8% CAGR returns, purely on the back of that math. If you are an investor who's invested for the next 7 months, you should be expecting 1% return, right? Because that is how the math works. So basically the way we have formed our views is that for December of 25, our Nifty target is 25,000.
Okay, so that's the BofA view coming in for you. But Street watches what will be RBI's next move. That's going to be the big move this week. Subhana Sheikh caught up with Alka Anbarasu of Moody's ratings on and Karthik Srinivasan as well of ICRA to understand the implications of rate cuts on the banking space and more. Listen in.
On back of perhaps inflation also coming down, we do see that RBI has room to cut rates, and we do expect interest rates to gradually decline in India. Having said that, actually externally, we also see many regulators in Asia Pacific have started reducing domestic interest rates, while globally there are still some uncertainties. But for India, we do see that there will be some room for rate cuts in this year.
But in terms of NIMs, clearly there's going to be pressure on NIMs for banks, because as per our estimates, over half of the bank's portfolio is linked to external benchmarks where the repricing would be faster. MCLRs do not get repriced so fast, but at least on half of your book, the repricing could be faster. Deposit rates are still at elevated levels, notwithstanding that we have seen some large banks cut savings rates or definitely cut on the term deposit rates over the last month and a half. But small saving rates are still high, so it's going to be difficult for banks to cut rates very aggressively unless they really take a call that they want to protect their margins. So we do expect some compression in NIMs over a period of year, maybe 10-15 basis points for the whole year. But a falling interest rate also provides a lot of opportunity for banks to build up on their treasury gains during the current year. So if I was to just extend your question, NIMs, treasury profits are one aspect. Look at the final bottom line, which is the profitability. There will be some marginal impact, but the overall profitability numbers should still remain fairly robust for the banking sector. Above 1% is our estimates for now.
All right, we are 4 minutes away from market close. Let's get in the top stock movers and just try and see if we can get some final thoughts from our experts. So Kush Bora, I'm trying to think of stocks which have kind of had some serious moves in the last few minutes of trade. Anupam Rasayan, Praxis Home Retail, MTAR Tech. Good volumes, good price action on almost all of these. Any of these that stand out for you?
So a couple of from the couple of names that you've mentioned, I think Anupam Rasayan's fairly overheated. So it's not a bad idea to start taking money off the table and perhaps consider a re-entry at slightly lower levels of about 970, 975 thereabouts. So that's the view on Anupam Rasayan. But MTAR Tech, this one seems to be making a comeback after a good consolidation of 9 to 10 odd sessions. As you said, volumes are also on the on the rise in this one. In the coming days, 1750, 1825 thereabouts. Could be the next levels to watch for. 1620 is a good stop loss to place for a fresh entry. So MTAR Tech stands out. Anupam Rasayan is a profit booking candidate.
Okay, a few movers this afternoon and what you should do with them. I'm just wondering, Coach, if you're finding any of these rail numbers interesting, whether it's in IRCON or RailTel or RVNL. I mean, that's really the story of this afternoon. Is there anything that you would snack into right now?
So the one stock that I like in this space is TexRail. It's had a good move, comes after a bit of a consolidation, still some distance away from a resistance of 185. So that's the one that viewers can still consider on the long side support zone. The resistance of 165 will now act as support. So 185 on the upside, about 193 being the second target. RVNL, IRCON, some of them are starting to hit resistance levels. That said, the medium-term structure for them is, still very much intact. But from a near-term perspective, I think, they're starting to hit resistance zones. So some profit booking or some consolidation could well be seen in the next couple of days.
Okay, so likely that to play out. So thank you so much, both of you gentlemen, for coming and speaking with us. We're around a minute to close now, and let's start seeing as to what are the final rates that are shaping up on the index today. A third of a percent higher on the Nifty 50 index. We have lost some ground from the high for sure. So around 30 odd points shaved from the top. Let's look at it intraday as well. The Nifty Bank also largely flat, just about a minor positive bias seen there. So we did see a bit of an inch up, but that inch up was completely sold into, at least on the Nifty 50 index. So around a quarter of a percent, 24,600 odd is where we are settling in at close. Let's look at the heat map on the index as well, and some really standing out. One is an Eternal, of course, 3% higher. Along with it, there's also Swiggy, not on the Nifty 50, of course, but that one has shot up by nearly 10% in trade today. So Eternal, Swiggy, that's one pocket which has really done well for themselves. What's not done well, you're seeing some pressure on an Eicher Motors and a Trent as well as a Bajaj Finserv. So we've closed for the day. And of course, as those rates settle, we'll quickly take you through how it's all working. The breadth on the Nifty 50 is positive. So that's one positive piece. Let's also look at sectors which have done well. And of course, the top contributors were the heavyweights, at least on the Nifty 50 index. We're looking at the Nifty India Defense Index, which is again up 1% in trade, and it's the top sectoral gainer. Some ground lost to the Nifty Metal, which has cooled off just a wee bit at close. Nifty Realty is the only and the top sectoral loser in trade today. The Nifty IT Index around a third of a percent, largely in line with that Nifty 50 index. But what we've seen is that banks haven't contributed significantly in trade today, except for the large cap HDFC Bank, where you have the HDB Financial IPO, which got cleared by SEBI, and there was some zing on that stock today, which aided the index. Let's look at the advanced decline as well on the NSE. And the advanced decline, of course, a very narrow band in the sense that the advance is just about beating the declines by 1200 to around 950, and therefore very, very narrow in that sense. There's some bit of choppiness at the start of trade, and that will likely reflect on the Nifty mid-cap and small-cap indices as well. Let's pull those up, 0.8%, closing at the day's high, the Nifty mid-cap index. Clear show of resilience and strength within the broader markets that we're seeing. 0.5% higher on the Nifty small cap. We didn't see that uptick right towards the end on the small cap like we saw on the mid cap, but nonetheless, we've closed well higher of what the Nifty 50 has done in trade today on the Nifty small cap as well. Let's look at the BSE 500 top gainers, top losers, and some railway stocks showing some real zing in trade. 14% high on an IRCON, and RVNL also featuring there, a RITES featuring there as well. So those are 3 stocks out of 8 within the railways basket, which has done well. Spark was down 20%. We spoke about that. AB Fashion had a block where Flipkart sold 6%. So that was down around 10% odd. Then you have the Chola twins, which were down 3 to 4% odd. So those are some names where there was pressure. Alchem also under pressure due to blocks. Let's see what to watch out for tomorrow. That's of course the big one. You have the US service PMI, which we will look out for. And thereafter, we'll also have some domestic cues, I'm sure, with regard to dividend announcements, which we will track. But out of time on this edition of India Market Close from, okay, I'm going to
do that, Harsh.
Sure.
Before you do that, let's talk about the big thing that happened last night, right? And after 17 long years, Royal Challengers Bangalore lifted the IPL trophy and brought it home. The team returned to their fans with the trophy. My colleague T.N. Veera Raghav joins us and will share how the fans are going to welcome the team.
Match may not have this kind of fever. It's absolute RCB madness out here. Full crowd out here. All the darlings, all the Souths, every damn thing that's on. ಈ ಸಾಲ ಕಪ್ ನಮ್ದಾಯ್ತು ಮುಂದಿನ ಸಾಲು ಪಂಜಾಬ್ಗೆ ಏನು ಮೆಸೇಜ್ ವಾಟ್ ಮೆಸೇಜ್ ಫಾರ್ ಪಂಜಾಬ್
Preeti Zinta.
Preeti Zinta is a message for Punjab. Preeti Zinta, what message to Preeti Zinta?
We love you. Preeti Zinta ನೋಡಕ್ಕೆ ಹೆಂಗೆ ಇರ್ಬೋದು ಕಪ್ ಮಾತ್ರ ನಮ್ಗೇನೆ. ಪ್ರೀತಿ ಜಿಂತ ನೋಡಕ್ಕೆ ಹೆಂಗೆ ಇರ್ಬೋದು ಕಪ್ ಮಾತ್ರ ನಮ್ಗೇನೆ.
So the chant is, this year the cup is ours. Next year too the cup will be ours. Let's see what happens. There's a message to Preeti Zinta and to Punjab as well. But it's absolute electric atmosphere here.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock.
Market Express, your power-packed 50 stories from the world of markets, national buzz, global updates, entertainment beats, and sports action. I'm your host, Himakshi Bahugna. So let's dive right straight into the show. Viewers, markets end on a positive note. More than 30 Nifty 50 stocks end the day in red. Nifty closed near 24,600 mark. Sea of green on the D Street. All sectoral indices except Nifty Realty end in green. Nifty Defence and Metal end as top sectoral gainers. The rupee closed 32 paise weaker at 85.91 against US dollar. This is the lowest closing level since May 22nd. Sun Pharma's R&D arm is under scrutiny after its experimental drug SCD-044 fails in 2 mid-stage trials for psoriasis and eczema. Now, the company confirms that the drug did not meet its primary goals, leading to its discontinuation. Spark faces uncertainty as the failure jeopardizes a potential $1 billion opportunity. Investors reacted sharply, with Spark shares plunging nearly 20%. Despite the setback, Sun Pharma states its overall operations remain insulated as the revenue from SCD-044 was not factored into the financial projections. PI Industries was up over 4% in trade after one of its biggest customers, Kumiai, raised its forecast for profits. Now, the company supply key herbicide to Kumiai and rates its forecast for financial year ending October FY25 by 34%. Now, the herbicide contributes 35 to 38% to the company's total revenue. Carlyle Group is set to exit Indegene through a block deal worth 1,420 crore rupees. The private equity firm holds its stake via affiliate CA Dawn Investments, which plans to sell 2.44 crore shares at a floor price of 580 rupees per share, reflecting a 6.4% discount to the previous closing price. Now, the transaction will also significantly reduce Carley's presence in the healthcare technology firm, which has seen strong market activity since the listing in May 2024. TPG is set to offload 2.1% stake in Tata Tech through a 635 crore rupees block deal. Now, the private equity firm plans to sell 8.5 lakh shares at a floor price of 744 to 767 rupees per share, reflecting a 0 to 3% discount to the previous closing price. Now, the move comes as part of TPG's broader strategy to reduce its holding in the company, which has seen mixed performance in the recent months. Alkem Laboratories promoter Jayanti Sinha is set to offload 1.42% stake in the company via 825 crore block deal. Sinha currently holds 2.46% of total equity, and post-transaction total promoter holding will reduce from 55.13% to 53.71%. Now, the deal involves 17 lakh shares at a floor price of 4,850 per share, reflecting a 2.9% discount. Man Industries approves a 300 crore rupee fundraise via equity and warrants to investors targeting expansion in Saudi Arabia and Jammu. The funds will also boost working capital and strengthen the balance sheet of the company. With a 2,500 crore rupee order book, the company expects 20% top-line growth in FY26. Garden Reach has signed an MOU with Norway's Kongsberg to build a vessel for India's Arctic and Antarctic missions for climate studies, ocean research, and polar operations. The company will also construct the PRV in its Kolkata yard, aligning with the Make in India initiative. The company also won a major Indian Navy contract as the top bidder for 5 advanced Covetus. Now, this strengthens GRSE's substantial order book. Aditya Birla Fashion and Retail shares dropped 10% as 6.23% equity worth 617 crore rupees has changed hands in a block deal. Flipkart is reportedly offloading its entire 6% stake in ABFRL, with Goldman Sachs facilitating the transaction. Now, market sentiment remains cautious as investors react to the large equity transfer. Macquarie has unveiled its 6-star buys, highlighting stocks with strong potential. The list also includes Mahindra & Mahindra, HDFC Bank, Bharti Airtel, Trent, TCS and Power Finance Corporation, with targets ranging from 16% to 62% upside. Additionally, 6 hitter stocks such as Bharat Electronics, Reliance Industries, GAIL, Shriram Finance, Larsen & Toubro and LIC have been added to their picks. Shares of railway firms including Ircon International, Rail Vikas Nigam, Railtel and RITES jumped up to 12% on Wednesday, driven by strong trading volumes on the NSE. Orders for Class 8 trucks, the heaviest commercial vehicles, have slowed significantly, falling 47% year-on-year in May to 12,000 units. Now, this marks the lowest May order total since 2020 and remains below the 7-year May average of 18,319. Now, a 40% month-on-month recovery was also seen due to tariff pause, offering some relief. However, overall net orders for 2025 are still down 32% year-on-year, signaling continued weakness in the demand. Electra Greentech's bus sales guidance for FY25 raises concerns as actual deliveries fall short of projections. In Q1 of FY25, the company aimed for 1,500 to 2,000 buses but delivered only 972 units. FY24 saw 541 buses sold against a 1,200 target, while FY23 saw 580 units versus 1,000 projected. The stock is also down 31% in the past year, trading at 74 times of FY25 P ratio with no analyst coverage, fueling doubts over its hollow guidance. Tata Motors President Shailesh Chandra says that the company expects to grow market share and volumes in the short term, with a long-term goal of reaching a steady 50% market share. Addressing concerns over China's rare earth magnet export curbs, Chandra assures that there is no immediate impact on Tata Motors' production. Meanwhile, Siam and ACMA are also in discussions with the government to ensure continued supply from China. Morgan Stanley maintains equal weight rating on Tata Motors with a target price of 715 rupees and a projected 1.4% upside. The company recently launched Harrier EV on its Active Plus platform. Analysts believe that Tata needs a breakthrough in the passenger vehicle segment, with the upcoming Harrier EV and Sierra launches seen as key drivers. Moltech Packaging reports a muted Q4 with revenue up 14.5% year-on-year to 203 crore rupees, but EBITDA growth is at 7.8%, leading to a slight margin dip to 19% from 20%. Net profit also declined 9.5% year-on-year to 16.3 crore rupees, impacted by higher depreciation and finance cost. Despite the near-term challenges, the pharma division sees aggressive expansion with revenue jumping to 6.7 crore rupees in Q4 on quarter-on-quarter basis and guidance set for 30 crore rupees in FY26 and 50 crore rupees in FY27. The company is also ramping up the capacity to 3,000 TPA by March 2026, with 5 new injection molding machines arriving by June. Skoda Tubes hits 5% upper circuit after a flat debut on the Indian stock market, listing at 140 per share, matching its price issue. Now, the stock also initially declined to an intraday low of 136, but soon saw strong buying momentum. It also surged 4.96% from its listing price, hitting the 5% upper circuit. Investors responded positively, driving the stock to a strong close despite early fluctuations. HDB Financial Services, a subsidiary of the HDFC Bank, has received SEBI approval for its 12,500 crore IPO. The offering includes a 10,000 crore offer for sale by HDFC Bank, which also holds 94.3% stake, and 2,500 crore rupees fresh issue. Now, the IPO also aims to strengthen the Tier 1 capital and meet the future capital requirements. Price bands are yet to be announced, and the listing is expected to comply with RBI's mandate for large NBFCs. SEBI has approved IPOs with funds primarily allocated for debt repayment and capacity expansion. Since January 1st of 2024, 113 IPOs have debuted with 85 listings at a gain 25 at loss, and 3 at base price. Post-listing, 64 IPOs gained while 33 dropped over 10%. Market momentum also remains strong as new listings continue. Yes Bank's board has approved a 7,500 crore rupees equity raise and an 8,500 crore debt fundraise for FY26. SMBC will also appoint 2 directors and SBI will appoint 1, with their rights contingent on maintaining a minimum stake of 10% and 5% respectively. The move actually aims to strengthen the bank's financial position and support future growth. The government is taking decisive steps to prevent a telecom duopoly, considering options like a temporary suspension of the AGR dues. Discussions are active at the Department of Telecommunications, with Vodafone, 49% government-owned, recently receiving a different treatment than Airtel. Vodafone Idea may also secure fresh loans as banks show willingness to consider its proposal, but only with clarity on its 83,400 crore rupees AGR dues. Major public sector lenders are in favor, though some remain reluctant due to the telecom's financial strain. The company's improved position offers hope, but AGR resolution remains critical. Top executives at Nestle India and HUL saw salary increases below 5% in FY25, down from prior years as per annual reports. Now, this reflects weaker FMCG performance due to soft urban demand and slowing growth. Analysts also say that restrained raises align with sector-wide consumption and margin pressures. Starlink India must pay a 1.6 crore rupee as non-refundable entry fee and over 1.2 crore rupees in guarantees, with legal clauses tied to 2G scam verdict requiring dues clearance. Sources tell NDTV Profit that the company received a letter of intent in May and expects a license by mid-June. Post-approval, Starlink will build multiple gateways across 3 sites within months. Now, the company is actively engaging with the Department of Telecommunications to ensure compliance and swift rollout. This move actually aligns with India's push to expand digital infrastructure in undeserved regions. Adani Airport secures $750 million from global banks to refinance debt and upgrade 6 airports, including Ahmedabad and Lucknow. The operator serves 94 million passengers annually and aims to triple capacity to 300 million by 2040. The new Navi Mumbai International Airport is also nearing completion, boosting Mumbai's aviation infrastructure. Amish Shah, head of India Research at BofA Securities, expects growth to accelerate in the near future, supported by RBI's approach of less regulation and increased liquidity. Goldman Sachs predicts that the RBI will lower the repo rate to 5.5% in the current rate cycle, citing moderating inflation and supportive macroeconomic conditions. Inflation is also expected to remain between 4 to 4.5% in the first half of FY26. As the International Space Station nears retirement, the race to build its successor intensifies. VAST Space, led by CEO Max Worth, is betting on Haven 1, a commercial space station set to launch in 2026. Now, the project aims to reduce cost and enhance safety, marking a shift towards privately operated space habitats. Haven 1 will integrate with SpaceX Crew Dragon, offering 4 two-week missions over 3 years. No relief for Gensol as NCLAT has sent the case back to Ahmedabad NCLT. The company had made a request for a relief from the NCLT on directions of freezing their accounts. Now, this is due to the governance issue flagged by the company. India has raised objections to the Asian Development Bank's, that is the ADB, for $800 million financial package for Pakistan, citing concerns over potential misuse due to Pakistan's rising defense spending and declining tax to GDP ratio. The package, also approved on June 3rd of 2025, includes a $300 million policy-based loan and a $500 million guarantee to enhance Pakistan's fiscal sustainability. India argues that Pakistan's economic fragility and history of terror financing pose risks to ADB's funds. Despite India's objections, the ADB proceeded with the package to support Pakistan's reforms in the tax policy and public financial management. Roshni Nadar Malhotra, chairperson of HCL Tech, tops the Hurun India Next Generation Women's Leaders List 2025 for her influential leadership. She is recognized for driving HCL Tech's AI innovations and empowering young talent, particularly women in tech. Now, the list highlights her as India's richest woman and a global top 10 billionaire. Her contributions include advancing AI force and fostering gender diversity in the industry. Work Hard aims to achieve 5,000 crore rupees in revenue within 3 years, driven by new antibiotic launches and global expansion. Work Hard is focusing on antibiotic Xenic and strengthening its US and European markets. Chairperson Habil said that the company aims to regain 5,000 crore revenue in 3 years. A massive gold heist has shaken Karnataka's Vijaypura district, where 59 kg of pledged gold was stolen from a Canara Bank branch. The robbers disabled the alarm system and used a fake key to access a specific locker containing the gold. In a bizarre twist, they allegedly left behind a black magic doll, possibly to mislead the investigators. Authorities have formed 8 teams to probe the case as concerns rise over security lapses at the bank. The monsoon session of Parliament is set from July 21st to August 12th, says Union Minister Kiren Rijiju. The Cabinet Committee, led by Rajnath Singh, recommended these dates. Opposition demands a special session on Operation Sindoor, but Kiren Rijiju confirms that all issues, including this, will be discussed during the monsoon session. Automakers Volkswagen has said that 20,000 employees will leave the company voluntarily by the end of this decade. The German automaker is restructuring the operation structure. Company's brand management has struck a deal to cut German production capacity by 7 lakh units. Piyush Goyal addresses the India-France CEO Forum in Paris, emphasizing cooperation in technology and startups. He highlights mutual commitment to stronger trade ties and announces a fast-track mechanism for resolving trade issues. Goyal also meets WTO and Saudi officials to boost global partnerships. Is the friendship between Trump and Musk on rocky ground? Elon Musk calls Trump's Big Beautiful Bill a disgusting abomination, which will explode the federal budget deficits. Says shame on those who voted for it. A mass shooting in Toronto's Lawrence Heights neighborhood on Tuesday night left 1 person dead and 5 others injured. Gunfire erupted around 8:30 p.m., prompting a swift response from the police. Authorities are also actively investigating the incident to determine the circumstances and those responsible. Mayor Olivia acknowledged the tragedy, assuring residents that law enforcement is prioritizing the case. Israel conducted airstrikes on Syrian regime weapon sites in the south, escalating regional tensions. Now, the strikes followed 2 projectiles reportedly fired into Israeli territory, which Israel blames on Syria. Syrian officials deny posing any threat, adding on the ongoing geopolitical uncertainty. The incident also underscores the fragile security dynamics in the region as both sides respond to rising hostilities. Lee Jae-myung has won South Korea's presidency, marking a major political shift in the country. His rival Kim Moon-soo conceded defeat after a closely watched election. Now, the vote comes after former President Yoon Suk-yeol was impeached over martial law orders. The election outcome is expected to shape South Korea's political landscape in the coming years. Mongolia's prime minister has resigned following intense public outrage over his son's lavish lifestyle. Extravagant displays, including designer bags and helicopter rides, sparked criticism amid widespread poverty in the country. His resignation comes as citizens demand greater accountability from the leadership. In his farewell statement, he expressed gratitude, saying that it was an honor to serve my country. Iran has rejected the US nuclear deal proposal, arguing that it disregards Tehran's interests and uranium enrichment rights. Supreme Leader Khamenei reaffirmed that Iran's commitment to continuing enrichment despite international pressure. The US has urged Iran to accept the deal, warning of grave consequences if negotiations fail. President Trump emphasized that no uranium enrichment would be permitted under any future agreement. Indian Premier League crowns a new champion last night. Royal Challengers Bengaluru win their maiden IPL title, defeating Punjab Kings in Ahmedabad by 6 runs. The biggest star, Virat Kohli, who has been the franchise, for the past 18 years, was seen in tears, overwhelmed by the moment. This victory is especially significant as the team was led by Rajat Patidar, a first-time captain. Krunal Pandya, known as the man for big matches, earns the Man of the Match award for his brilliant bowling performance. Conceding just 17 runs and taking 2 wickets in 4 overs, fans from all over the country were celebrating the team's victory. Well, with that, viewers, it's a wrap on Market Express, but stay tuned to NDTV Profit with me on the other side with Profit 360. Stay tuned.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term? Buy, sell or hold?
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term? Buy, sell or hold?
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in?
Nifty Sensex snapped 3-day decline. All sectoral indices barring Nifty Realty close higher. Oil and gas and metal gain emerge as the top performing index for the day. Sources tell NDTV Profit exclusively that banks are now willing to offer the struggling Vodafone a lifeline and are willing to look at Vodafone Idea proposal provided they see more clarity on the telecom's AGR dues. The Indian government is opening the gates to the satellite communication sector, but with some strict conditions. The letter of intent issued to Starlink Satellite Communications Private Limited outlines a comprehensive set of obligations, including non-refundable entry fee of 1.6 crore rupees. Sources tell NDTV Profit that SEBI board may take up key proposals in the June 18 meet. Agenda includes demerger of clearing corporations from stock exchanges and simpler FPI rules likely for Indian government bond investors. A failed drug trial and a lost $1 billion opportunity. Shares of Spark, the R&D division of Sun Pharma, fall 20% after unsatisfactory trial of a drug meant to treat cirrhosis and eczema. HDB Financial Services, Vikram Solar and 4 other companies received the go-ahead from the Securities and Exchange Board of India for the initial public offerings. Piyush Goyal addresses the India-France CEO Forum in Paris, emphasizing cooperation in technology and startups. Also met WTO and Saudi officials to boost global partnerships. Hello and welcome. This is Profit 360 on NDTV Profit and I'm your host Himakshi Bahuguna. Along the next half an hour, we'll bring you the latest on the markets as well as national and international news. So viewers, a buoyant end to the trading session as Indian markets snapped their 3-day losing streak, with the Sensex climbing 220 points and the Nifty reclaiming the 24,600 levels. This was led by strong buying in the heavyweights like the Eternal and Geofinance. Sectorally, if I look at oil and gas and metal indices emerged as top performers. My colleague Harsh is joining us with a detailed market wrap of the day.
Well, the Nifty traded in a very, very narrow band. Let me start off with that. We consolidated through the day. We were just about inching higher and we've given up all of those gains that we made. So if you look at the intraday chart, we were roughly around the 24,650 mark at the day's high, thereafter giving up nearly 30 to 40 points of gains very, very quickly. So that strength not really consolidating itself or not really building on itself. That's what we saw today. In terms of names, the heavyweights did chip in and contribute today. You had an HDFC Bank, a Reliance do well, and those were two stocks which contributed. Outside of that, and Eternal did very well for itself. Stock was perked up nearly 4%. That entire basket, in fact, Swiggy also did very well for itself, and the stock was up 9% on the back of Morgan Stanley note and their commentary at the Morgan Stanley India conference. So those were a couple of stocks and spaces which were buzzing. Outside of that, let's talk sectors first off. The defense sector was did really well, with Garden Reach one of the top gainers, 6% higher, but the Nifty India Defense Index continued to show resilience, 1% higher. In trade was the top sectoral gainer as well. In terms of the solo loser, it was the Nifty Realty Index, which was down around 0.5% thereabouts. You also saw some gains clocked in by something like an IT index, largely in line with the way Nifty moved. You also had the metals index do decently well in trade, so around 0.6, 0.7% higher on the Nifty metal index as well. So something to keep in mind are some of those sectors. I want to also talk about railway stocks, because those were some stocks which showed very good traction today, and Ircon and RVNL, those were stocks which were some of the top performers on the BSE 500 list. In terms of the mid-cap and small-cap, it's very interesting, the broader markets. The mid-cap index outperformed the small-cap index. The small-cap index outperformed the Nifty 50 index. So we saw outperformance from the broader markets, but the mid-caps did much better. So that's how the day played out. Remarkable resilience by the Nifty mid-cap index that we saw pretty much through the day, and it closed at the day's high. So that was the other highlight of the day.
Thank you so much, Harsh, for that market roundup. Viewers, now Morgan Stanley's Jonathan Garner highlights India as a standout in Asia, driven by strong domestic growth, particularly in financials, consumer and industrial sectors. He also emphasizes that a preference for financial stocks across Asia, including Japan and China, while warning of risk to Asian export firms due to trade and tariff tensions.
financials, consumer, discretionary, and industrials in India, which are, the majority of market cap. We also are emphasizing financials in other core geographies in Asia, including Japan and to some extent in China. And what you have to be careful about, obviously, are Asian export companies that get caught up in the trade and tariff issues, and where actually currency strength tends to sort of diminish their margins. And so that's not such an attractive feature for like export-dominated markets, including, for example, Taiwan. So India, with its very strong domestic growth dynamic, is our top overweight in the region.
HDB Financial Services has received the go-ahead from the SEBI for its initial public offerings. They also filed its draft in October last year to raise up to 12,500 crore rupees through an IPO. My colleague Harsh is joining us with more details there.
It's positive sentimentally because there's some amount of value unlocking, but let's try and really dissect this. Let's first talk about why the fuss. NBFC, HDB Financial is an NBFC promoted by HDFC Bank and the HDFC Group. The HDFC Bank approximately holds a 94% stake in the company. Now let's talk about the IPO details. 12,500 crores in terms of size, 10,000 crore is the offer for sale, 2,500 crore is the fresh issue. The offer for sale pretty much entirely going to an HDFC Bank, and price bands are of course yet to be disclosed, but we'll talk numbers in just a minute. What the company does, it was incorporated in 2007. It's a retail focused NBFC, has around sub 1,800 odd branches and a presence in 31 states in the country. Let's talk about the business itself. It lends, and of course, understandably, 71% of the loans are secured though, so that's something you want to really mark out. The other piece is it does all these ancillary services for HDFC Bank and otherwise. So those are all the services that it does. And
thank you so much, Harsh, for that. Now, viewers, in what appears to be a needed breather for the beleaguered telecom giant Vodafone Idea, sources have told us that big public sector lenders are ready to infuse money in Vodafone, provided the government waives off the company's heavy AGR dues. Let's go over to my colleague Vishwanath Nair to get more information about the conditions applied by the big lenders.
There is a talk amongst all the bankers that they will be willing to look at a Vodafone Idea loan proposal if the government relents on the AGR dues. So essentially, the government has to either give a complete waiver of the dues on the adjusted gross revenue, or they have to give more time to Vodafone to repay that, a moratorium of sorts. Only then will banks be interested, at least the major public sector banks be interested in extending loans to Vodafone. What sources are telling NDTV Profit is that as far as the private sector banking community goes, they've in fact said that they are not interested in participating in this loan proposal at all, despite where the company stands. But the public sector banking universe, which includes banks as well as large public sector NBFCs, they'd be willing to look at a proposal and extend further credit to Vodafone Idea. According to the bankers, the financial position for Vodafone has greatly improved. However, the AGR dues continue to remain a drag until that matter is resolved, till the government gives some clarity on what it intends to do. They will not look at the loan proposal. Just for context here, Vodafone owes more than 83,000 crore in AGR dues to the government, of which the company has already sought a 45,000 crore waiver on dues that is still pending with the government. So far, the government has not given any indication what it intends to do. However, yesterday we had an NDTV Profit exclusive, which pointed at the fact that the government is looking at maybe 2 or 3 options to support Vodafone, which may include a moratorium on these AGR payments.
Thanks, Bishi. We also spoke to Piyush Pandey, a telecom analyst from Centrum Broking, on Vodafone's current situation. In his opinion, it could be difficult for banks to lend money further to the telecom operator, as he reckons the company is already highly leveraged. Let's listen into that snippet.
So we expect that Vodafone can get some sort of relief, and relief can be in the form of like say moratorium. The government can extend the payment timelines by around say another couple of years, or maybe that see I have also a feeling that somewhere down the line there can also be option of converting some of the debt to equity. And as far as the bank part is concerned, I think it will be slightly difficult for banks to extend further loans, given that Vodafone remains highly leveraged.
But how has the journey been for Vodafone Idea? Right from Supreme Court's AGR dues ruling in October 2019 to the present day, June 4th of 2025, where banks are ready to lend, but with some extremely important conditions. On October 2019, the Supreme Court actually ruled that the telecom operators must include non-core revenues in the AGR calculations. This triggered massive dues for Vodafone Idea, deepening its financial distress. Then in March, between February 2023 to March 2025, the government stepped in twice. First in February 2023, converting 6,133 crore rupees of interest dues into equity. And again in March 2025, converting the 36,950 crore rupees, making the center the largest shareholder with a 49% stake. Then in May 2025, despite government backing, financial challenges persisted. Vodafone Idea sought a third bailout, requesting in the AGR waiver of around 45,000 crore rupees. Then on 19th May, the Supreme Court rejected waiver pleas from Vodafone Idea, Airtel and Tata Teleservices, keeping AGR dues intact for the telecom players. Then, on 31st May, in response, Vodafone Idea approved a 20,000 crore rupees fundraise on May 31, hoping for government support. Then on June 4th, banks indicated readiness to extend loans to Vodafone Idea, provided that there is clarity on AGR dues. This brings fresh hopes for the telecom operator as it seeks financial stability. Now, viewers, Elon Musk Starlink is poised to enter the market, but not without meeting stringent conditions set by the Indian government. According to sources, Starlink will also pay a non-refundable entry fee of 1.6 crore rupees. They will also provide performance and financial guarantees totaling over 1.2 crore rupees. Aishwarya is joining us with more details on this.
Well, we're going to hear more of Starlink as it gets closer to being granted a license by the government. What we're picking up from our sources is that Starlink's India arm, Starlink Satellite Communications Private Limited, is set to pay a non-refundable entry fee of about 1.60 crore rupees. Apart from that, they are also set to pay about 1.20 crore in financial as well as performance bank guarantees. Now, the fees include a unified license, which includes GMPCS, VSAT, as well as ISPA for the whole area or pan-India business. The government, apart from this, has also baked in some clauses which are preemptive in nature and do act as a legal armor to ditch some of the loopholes that the legal document may have. Now, Starlink and related parties are also required to clear dues of not only itself, but also its associated parties, its affiliated companies, as well as sister concerns. In this clause, what they've included is that if at all they have any association with telecom operators that were struck down by the Supreme Court order, 2012 Supreme Court order related to the 2G scam, that is just preemptive in nature, even that will be taken into consideration. And if at all that is linked to Starlink, all their dues must also be cleared, is what they've mentioned. Now, Starlink did receive, if you remember, the LOI early in May. Now, the global licensing head, what we're learning from our sources, Parnil, is also in India for a week to meet the DOT officials as we speak. And it could be just a matter of days before they are granted the license by the government. Starlink is yet to be given the unified license by the DOT, and the license is expected somewhere around in mid-June, what we've been reporting in the past as well. Once the license is granted to Starlink, it will take about 6 to 7 months for them to build the gateways or earth stations, which will be to the tune of about 27 to 30 across 3 identified sites, which Starlink has already done. Now, remember, Starlink is required to unequivocally and unconditionally accept the terms of the offer of the LOI, and then they can proceed with setting up their business and infrastructure in India.
Right. Thank you so much, Aishwarya, for that. Now, in a strong diplomatic move, India has flagged serious concerns over the Asian Development Bank's continued financing to Pakistan. According to the government sources, viewers, New Delhi has raised alarm bells over the potential misuse of ADB resources in light of Pakistan's rising defense expenditure, which starkly contrasts with its deteriorating domestic resource mobilization. India has also expressed worries over fungible financing tools such as policy-based loans which though intended for structural reforms could be indirectly diverted to fund Pakistan's defense activities. Now these concerns is amplified by the fact that Pakistan's revenues are in decline, yet its military spending continues to rise. Also note that despite repeated financial interventions, Pakistan has now approached the IMF for a record 24th bailout. India also questioned the quality of program design, execution and monitoring, emphasizing that without accountability, reforms will not deliver deliver the intended results. Finally, India has warned that Pakistan's economic fragility, high debt to GDP ratio and persistently low credit ratings pose a direct risk to the ADB's own financial health and sustainability. It has also called for greater vigilance by the bank to protect its long-term interests. And Adani Ports has also raised $750 million US dollars through external commercial borrowings from international banks. The financing was led by first Abu Dhabi Bank, Barclays and then Standard Chartered, and the company will use $400 million US dollars to refinance the existing debt. The rest will go towards the capital expenditure across 6 airports in Ahmedabad, Lucknow, Bengaluru, Jaipur, Guwahati and Thiruvananthapuram. They will also expand non-aeronautical businesses such as retail and services. In FY 24-25, Adani Airports handle 94 million passengers. It plans to expand the capacity to 300 million passengers annually by 2040. The Navi Mumbai International Airport is also expected to become operational soon, starting with 20 million passengers, eventually scaling to 90 million. Now, Adani Airports currently manages 8 airports and holds 74% stake in both Mumbai International Airport and Navi Mumbai International Airport. Now viewers, on to an NDTV Profit exclusive. The market watchdog SEBI may take up a bunch of key proposals on June 18th. This includes subjects like easing FPI rules for Indian bond investors, mutual funds being allowed to raise equity fund exposure to REITs and a lot more. Let's go across to my colleague Charu, who has all the details there.
The market regulator, Securities and Exchange Board of India, is going to be having its next board meeting on June 18. Now, this was an NDTV Profit exclusive. There are several key proposals that are up for discussion. For example, demerger of clearing corporations from their parent stock exchanges. Now, this is a proposal that has been in the talks since November last year. However, the stakeholders which will be affected by this proposal believe that the ownership structure should not be changed so much, and some sort of partial ownership or partial stake of the parent exchange should exist in the clearing corporation. So some sort of a tweak can also be expected, but it is a discussion that was supposed to take place in the last board meeting as well. So it's highly likely that something on this could come out. Apart from this, there could be discussions on treating REITs and InvITs as equity for index inclusion, and mutual funds may be allowed to raise equity fund exposure to REITs and InvITs. Apart from that, AIFs could be discussed to offer co-investments under separate schemes, and there are some other key very important areas. For example, NSE IPO, settlement under the NSEL scam for commodity brokers. Apart from that, settlement scheme for brokers who were associated with algo trading platforms. These are also some things which could be discussed. And lastly, SEBI has also been talking about optimum regulation. Now, this is something that does not explicitly require a board meeting to go by, as told by the chairperson also in the last interview. However, there could be some changes and discussions around that as well, and about the code of conflict of interest.
Right. Thank you so much, Charu, for that. Now, a failed drug trial and a lost billion-dollar opportunity. Shares of Spark, the R&D division of Sun Pharma, fell 20% after unsatisfactory results from trials for a drug meant to treat psoriasis and eczema. It also announced the discontinuation of specific SCD-044 drug with no further plans for clinical trials. To tell us more about the impact on Spark and Sun Pharma, my colleague Varsha is joining us.
We are seeing, as you rightly said, the setback is more for Spark than Sun Pharma. Let's see first what has happened. So the experimental drug, the Sun Pharma's experimental drug trial has failed their phase 2 drug trials. Now this is a drug which did not meet the main goals for the company. A drug was being tested in 2 mid-stage clinical trials, that is phase 2 trial, and this was conducted to treat cirrhosis and eczema. Now this drug was an oral drug, and Sun Pharma had licensed this drug to treat both the diseases. Now why the impact you are seeing is bigger on Spark than on Sun Pharma? Because one thing is, the Spark is a R&D arm of Sun Pharma, and this drug was developed by Spark, which was a $1 billion plus opportunity that investors and that people were expecting from this company. So losing this opportunity questions, company's primary purpose of research and development. Future prospects of Spark was directly tied to the success of this product, and Spark factored in revenue from this drug in FY30, which is kind of at a low risk now. But the other trigger is, this is not the first time that Spark has failed when it comes to this drug trials. A trial for the Parkinson drug also failed in April 2024. So this drug was actually the biggest opportunity for the company, which now they have lost. And why impact on Sun Pharma is less severe than Spark? Because this only impact the specialty portfolio of the company, and Sun Pharma, being a very big company, doesn't impact their other operations or other generic business for the company. The potential revenue from this drug was actually not accounted in company's financials, because this was expected to come in FY30. But this is a very big setback for Spark, because of the $1 billion opportunity that company has lost now.
Right, thank you so much, Varsha. Now, Piyush Goyal addressed the India-France CEO Forum in Paris, emphasizing cooperation in technology and startups. NDTV's Pariti Bhanot joins in from Paris.
The Union Minister for Commerce and Industries, Piyush Goyal, has wrapped up his 3-day visit to Paris, France. This was an important visit because Piyush Goyal held multiple bilaterals, engagements, as well as public discussions. One of the key things from this visit is the WTO informal ministerial level meeting, which took place as of Tuesday. Now, during this meeting, Piyush Goyal reiterated India's stance when it came to agriculture, when it came to small fisheries, but also when it came to tariffs. Another important aspect of this visit had been his interactions with his European counterparts as well as his French counterparts. Now, a top focus during these interactions has been talking about the EU-India Free Trade Agreement, which was also another priority of the minister during his visit to Paris, France. Other than this, he's also interacted with several top global CEOs from companies such as L'Oreal, Renault, EDF, to name a few. And the focus of these interactions was to see where future investments in India can lead to.
Union Minister Kiren Rijiju told that monsoon session of Parliament will be held from July 21st to August 12th. Now, this follows opposition's demand for a special session to discuss Operation Sindoor. To tell us more, we have NDTV's Aishwarya Jain joining in.
Yesterday, it was Trinamool Congress MP Derek O'Brien who stated that government is responsible to Parliament and Parliament is responsible to people. And it is a matter of 140 crore Indians that demands answers from the representatives of lakhs and lakhs of people in the Parliament as to what has happened after Operation Sindoor. And also, it was 16 political parties, including the Aam Aadmi Party, separately writing to Prime Minister Narendra Modi for a demand of special session of Parliament. And in that particular letter, it was specifically written to the Prime Minister that why it was United States who and President who ensured that those statements that he made, that he mediated between India and Pakistan, while the stance remains very clear between India and Pakistan, that was a mutual understanding to stoppage of any exchange of fire on land, sea and water. But certainly the opposition wants these answers. It is government who is very clear that they are ready to have any sort of discussion, but with a due process that is involved. BSE will be convened, all party meeting will be called, and if any demands of the opposition parties would be that government will agree to, then definitely they are open for any sort of discussion. And Operation Sindoor is something that they are going to discuss in the upcoming session of Parliament, that is the monsoon session. The dates have already been declared by the Parliamentary Affairs Minister Kiran Rijiju, and of course now it has become very clear that government is not thinking upon any sort of special session of Parliament that is being demanded by the opposition parties, while on the other side, of course, the government is mulling upon to bring the impeachment motion against Justice Verma. That's also one of the key issues that will have in focus on the upcoming session.
Yes, viewers, the dream has finally come true for the countless fans of Royal Challengers Bengaluru. After years of heartbreaks, close finishes and endless memes, RCB lifted their maiden Indian Premier League trophy in 2025. For a franchise that has carried the weight of high expectations year after year, this victory means far more than just a cricketing triumph, but an emotional release, a celebration of loyalty and long years of trust. The team that has now arrived in Bengaluru received a hero's welcome as they returned to the Garden City. Enthusiastic fans lined the streets cheering loudly and hoping to catch a glimpse of the star-studded squad. Led by Rajat Patidar, the RCB contingent was welcomed at the airport by Karnataka Deputy Chief Minister D.K. Shivkumar. Well, that's all the time we had on this edition of Profit 360. Viewers, stay tuned to NDTV Profit for more news and updates.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers. Hello and welcome. You're watching KYC. I'm Harsh Saita. With me is my Varsha Jani, and you wouldn't have guessed which stock we're going to talk about today, because it's a sector where the leader, which is Indian Hotels, has done 7.5x since April of 2021. So in the last 4 years, if you would have invested in an Indian Hotels well after COVID, Mahima,
Yes.
it's a 7.5 bagger for you, which surely moves the needle for most of us. So that's why this one becomes interesting. It's the most recent listing within the hotel space after the Leela, obviously. Yeah. But ITC Hotels is the one that we're going to be talking about today. What I want to know about ITC, I want to first understand whether it's a good play within the hospitality space. There are plenty of options. I want to understand whether this one is the good one, because the potential is large. The re-rating has been significant. So is this a good time to really enter in the hospitality space. Second one, they're doing a huge pivot. They are moving from the current ownership model towards management contracts. What's the margin upside here is what I want to understand. The third one is free cash flow. What's the kind of growth expectation which one can expect on the free cash flow front going forward? Largely because all of the free cash flow that will come onto the balance sheet will likely be utilized somewhere, because it's going to be capex light in terms of the model that they are adopting. Sustenance of the low capex goal. So hopefully no large capex plans by the company. What do they do with the excess cash therefore? So it's more of the free cash flow that I'm going to talk about. What's the applicability of that? What's the outlook like? How quickly can they grow? I also want to know the basic, right? What's the margin play between an owned hotel and a managed hotel? This is something I have been consistently talking to you as well as trying to understand. But we're not getting a clear answer, and hopefully we'll get an absolutely clear answer, because that pivot from owned to managed is going to be large, and that's why I want to know what the margin profile is like. How likely is demand to exceed supply? We're reading lots of analyst notes which are talking about demand outstripping supply in a large fashion. Now ITC is well placed to ride that wave, but how likely is that to even happen? Because valuations have built in some bit of positivity, but you want to understand the likelihood of that playing out. So all of that and more is what we'll talk about. Let me first start off with what the company does, and we'll start right from the very basic. It's a 50-year-old hotel chain. It was started by ITC Limited, of course, from the cash flow coming in from the cigarettes business in 1975. It now owns and manages 140 hotels. The first hotel was started in Chennai. It's demerged from ITC Limited in Jan of 2025. The ascribed value, Mahima, was around 270 rupees. So currently trading at a discount. So that's the other thing that's very interesting. And it's the number 2 listed hotelier in the country, brand wise as well as size wise, and that's saying something, because India's penetration in terms of hotels is very, very low. So this could well be that play. Let's talk about the models in the hotel industry and what's really led to this large turnaround, right? It's been a significant turnaround, and IHCL has been at the forefront of that. ITC, of course, has ridden the wave because of the fact that a large part of the valuation was captured inside ITC Limited and has now come outside ITC Limited. But firstly is the brand name, is the own hotels business, where the hotel is actually owned by the company. Like for example, an ITC Hotels owns the hotel itself. So it's a capex heavy business. Brand name is owned by the hotel, capex done by the company. So if ITC were to do the capex itself, it's a heavy capex business. The management, marketing as well as operations completely managed by the hotel chain. Let's talk about management contracts now. Owners retain property rights. So there are now two parties. One is the owner, one is the hotel manager and the brand. So the owners retain the hotel rights, the property rights, but the management company, which is ITC Hotels in this case, handles the day-to-day operations. Profits are shared, capex put up by the owner. There's no capex put up by the management company mostly, which is ITC Hotels, and brands are provided by the management company, which is it's branded under the ITC Hotels umbrella. Okay. Anything you want to add here?
Right, absolutely. And as you rightly mentioned, it has a current portfolio of around 140 odd hotels.
Yes.
And the keys right now are 13,000 odd keys,
yes.
Of which, as per Jeffrey's report, 45 are owned at present and 55 are managed. But this 55 as a percentage will increase. And the margins that you were talking about, we were discussing as to how the owned margins are around 45 odd percent, 35 to 36 odd percent, but the managed margins go up to almost 70 odd percent. So we'll have to see if management contracts go up, how blended margins will go up.
Correct.
In terms of the brands, in terms of before we go on onto the brands, we have the target that the management has already given with respect to how they will expand their entire hotel category. They are planning to expand up to 200 hotels. So the total hotels that they will be adding in the next 5 years is roughly 60 odd hotels, 18,000 keys, of which the change in the mix of owned versus managed will go from 45, the owned will come down to 35 and managed will go up to 65%. In terms of...
Mahima, I just want to come in for 1 second here.
Yeah.
Let's look at that graphic one more time and let's flip back to the earlier graphic in current footprint. And this is what really stands out for me.
Yeah.
You look at the number of keys owned, around 5,800 currently in the owned space. In the managed space, it's 7,200. If I flip this forward, what we are seeing is that the ownership share is up only about 10% from now till calendar year 30. But look at the managed number. It's gone up by 4,500. This is where a large part of the re-rating is going to play out. So while it's only a 10% flip, but it's a very, very large, significant size increase that's going to come from here. Sorry.
Absolutely. And in terms of the brands as well, so if you look at the brands, it operates under 6 different brands. That is your ITC Hotel, Mementos, Welcome Hotel, Story, Fortune, as well as Welcome Heritage. Now, in terms of how these are divided, in the luxury segment, we have ITC Hotels and Mementos, where around 16 hotels and 16 hotels for ITC Hotels and around 4,700 odd keys. For Mementos, they have 2 hotels and 181 odd keys. And in terms of the segmental mix, right now ITC Hotels is 11%. And Mementos is roughly 1%. Welcome Hotels, on the other hand, is around 19% of the total portfolio. So that's the biggest chunk where it comes to all of these 6 brands. In terms of Story, there are 7 hotels and 191 keys. So that's 5% of the total portfolio. Fortune is mid to upscale segment restaurant hotel, where around 56 hotels operate under this brand, and that makes up to 39% of the total portfolio. And lastly, Welcome Heritage, which is their heritage resorts, is roughly 24% of the total hotels, and roughly 35 hotels come under this particular category. In terms of the overall brand-wise inventory mix, if we see, there you go. This is the overall mix. ITC Hotel and Mementos is roughly 37%. Welcome Hotels and Story is roughly 24 odd %. Fortune is 31%, and Welcome Heritage is roughly 8%. In terms of the growth target as well, management is focusing right now on Welcome Hotel, Story, as well as Fortune. So these will be the 3 brands where management contracts will take place, and these are the pockets where the growth will actually come from. So this is everything that you need to know about the company per se, and then of course the parameters that we take up for judging the company in terms of ratings.
Absolutely. Let's look at those. In fact, so we've kind of broken this down into parameters starting from income statement, balance sheet, cash flow, and in the income statement we'll also look at some operational metrics which Mahima has pulled out. Cash flow, return ratios. We'll thereafter look at shareholding, street cred, valuation, and street coverage. So that's how we'll break this up. Mahima, why don't we go with income statement?
Absolutely. So in terms of income statement, well, great set of numbers here. In terms of revenue, we see a 3-year CAGR of almost 39% for the counter. In terms of EBITDA also, the 3-year CAGR has been a whooping 157%. Plus, in terms of net profits as well, the company has managed to grow pretty well from FY24, where it stood at around 400 odd crores. It's gone to almost 698 crores in FY25. So great set of numbers there. Margins have slightly improved from 33 to 34%. But as we mentioned earlier as well, the management has said that they will move to management contracts, which means that margins will definitely go higher going ahead. So the blended margins will definitely improve. But the question here is really that to what extent will they improve, and that's something that we'll be asking the analyst as well. In terms of operational metrics also, they have been on an increasing trend and improving trend. The average revenue rate, the average room rate, which was around 12,000 in FY24, has gone to 12,500 in FY25. The RevPAR, which was around 8,200 in FY24, has gone to around 9,100 in FY25. Occupancy has gone from 69% to 73%, which has not been the case for hotels this particular year. This has only been seen in ITC Hotels. Otherwise, if you see IHCL, EIH, Lemon Trees, everywhere the occupancy has remained in that 68 to 70% range, but ITC has seen occupancy rate of 73% in FY25. In terms of the RevPAR that comes from premium segment, that is almost 30% of the total RevPAR. In terms of operational efficiencies also, the company has improved quite significantly. The gross food cost has been reduced to 24% from 27%, energy cost to 5% from 7%, payroll cost has come down to 21% from 28%, and other operating costs has also come down to 28% from 30%. In terms of the segmental mix where revenue is concerned, room contributes around 52 odd percent, food and beverages contributes around 40 odd percent, and the other categories around 8 odd percent. And they've also signed 54 hotels in terms of last 2 years, and also signed 30 odd hotels for management contracts in the past 2 years. So that's the and that is one of the reasons as to why we've seen a significant amount of uptick in the financials of the company. So that's where
EBITDA especially. You look at that EBITDA number, it's very impressive. And Mahima, it's my understanding is it's two factors, and correct me if I'm wrong. One is the fact that your occupancy has gone up.
Correct.
So your fixed cost base remains the same.
Correct.
The number of people you employ in a hotel remains the same.
Correct.
But because your occupancy has gone up, the number of people residing there has gone up, that flow through to the bottom line
Correct.
is immediate. And that makes a big impact in terms of growth on the EBITDA number. So that's one. And the second thing is these reductions in costs. Give me perspective. So these reductions in costs are a percentage of top line.
Correct. As a percentage of top line, and that has been reduced. So the reduction that I'm talking about has happened in the past 4 odd years. So as a percentage of top line, and so as you were mentioning earlier as well, it's not just how these occupancy ratios have improved, but it's also the operational efficiency that has aided the EBITDA as well as the bottom line.
Sure. Okay. So that's on the top line. Very impressive numbers for sure. No contention there. Let's talk about the balance sheet. Now, no concerns here. They've got around 1,600 crores of cash. They've got a decent amount of equity size. Their borrowing is nearly zero, and there's no concern with regard to debt, because look at the amount of cash sitting on the balance sheet. It's 1,600 odd crore. That's part of the demerger. 1,500 crore was given over to an ITC Hotels. There's very little capex that's planned in, or rather compared to the quantum of cash it's generating, and therefore there's no concern with regard to this one. Let's talk about cash flow, Mahima, very quickly.
Right. So cash flows, again, a healthy set of numbers. It's improved from 670 odd crores to 803 crores in FY25. That is from operations. Even the ratio of cash flow from operations to PAT has improved. In terms of the net cash flows, they are also strong enough here. So I mean, overall cash flow position stays strong. Plus, the ITC as a parent company has also decided to invest some amount every year in ITC Hotels. So I don't think cash is a problem for ITC Hotels for now.
Perfect. I'd in fact want to know what they do with that extra cash that keeps coming in. That's what I'm curious about. Let's talk about return ratios though, because that's the other piece which is the key. You want your return ratios to be good, but we are not seeing double-digit ROE. Even ROC is just about double-digit. That's because of the pivot from owned hotels to managed hotels. That entire pivot is yet to happen. You'd want to see how much this ROCE can go up by. Of course, it's an upward trend. It will likely go up as well, continue to go up, but at the moment it's falling short of expectations. So we've given this a thumbs down. Shareholding, Mahima.
Right. So shareholding, since the company is just listed, we just have the information with regards to March quarter, where promoters is roughly almost 40% of the total equity, FI is around 25%, DI 21%, and public shareholding 13%. But the overhang here is BAT, because BAT has sold stake in ITC but not ITC Hotels. Analysts are expecting that might not happen for the next 2 to 3 odd quarters, but BAT still holds almost 15% in ITC Hotels. So that is one overhang where shareholding pattern comes into play.
That's a large overhang. Yes. That's a large risk as well. So something to keep in mind. Let's talk about street cred. Now, I did mention that this one will likely be a neutral because of the fact that while the performance since listing has been quite strong, what we're seeing is that what ITC's implied value per share was basis tax disclosures that they had to make was far higher than the current stock price, which is roughly at around 270 odd was the number which ITC was penciling in, and 188 was the list price, after which the stock in fact went down by another 10 odd %. So and thereafter has rebounded. So that's the nature of the way in which the stock has moved, and hence the neutral with regard to street cred. But Mahima, valuations, that's the most complex part of this.
Absolutely. So, when I was seeing the valuations as compared to how peers are concerned, well, all of them are trading at very high PE levels, right? In terms of the MCAP to EBITDA level also, and the PE levels also, even going forward in FY26, FY27, for ITC hotels, it goes to around 49 times in 26 to 40 times in FY27. As compared to that, IHCL trades at around 56 times right now, which might go to around 51 times and 43 times. So, I mean, both the top two players in this industry, both of them are very expensive. As compared to that, EIH is slightly less expensive, trading in that 30 to 35x odd range. And Lemon Tree is interesting here because of their addition of keys that they're going extremely high. That's one of the reasons as to why their PE expected to come down to almost 29 times in FY27. So overall, all hotels definitely very expensive, and ITC is also not looking very cheap. So we've given a neutral rating here because as compared to peers also, it's trading in the same range.
Let's talk about how analysts are viewing this one. So street coverage, you have just about 4 analysts tracking this one with an 8% upside, so nothing material. We've given this a neutral and close this off. Let's quickly look at all of the KYC metrics that we have analyzed. The income statement, balance sheet, cash flow, thumbs up on all 3. Return ratios, definitely asking for more right here. 100%. What you want to see is shareholding pattern is a neutral because there's some bit of overhang from BAT. Street cred is a neutral because of what we just talked about. Valuations are a neutral because largely in line with the sector leader, which is IHCL, and if you're getting an IHCL at the same price, hey, why wouldn't you consider it? And street coverage is also a neutral. So it stacks up as a 5 out of 8 on our KYC ratings. But let's bring on board Mr. Prashant Biani, who's the Vice President of Institutional Equity Research at and Sector Lead for Agri Inputs, Sugar and Hotels at Elara Securities. Now, welcome on board, Prashant. Prashant, I want to first start off with trying to understand this model of owned versus managed. What should the margin expectations broadly be for ownership versus managed hotels? So just give us that context and thereafter give us the kicker from here. What's the expectation like in terms of revenue accretion from today for the next 5 years on ITC hotels, and how much of that will come from managed?
Sure. So first thing on owned versus managed, while margins for managed hotels is good, it can range to the extent of 80% because on the management fee part, you don't have any major cost. At max, you will incur around 10 to 20% under few for advertisements and other purposes. But other than that, you have management fee business operates at around 80% EBITDA margin. But on the owned hotels, if you see, mostly the luxury hoteliers tend to earn margins of anywhere between 33 to 37%. But the key difference between the two is that EBITDA from owned hotels is chunky, whereas the EBITDA from management fee business would be small in absolute terms vis-a-vis owned hotels EBITDA. So therein lies the difference between the two. It is not that one business model is better than the other. I think in India, the right model will be a mix of owned as well as managed. Because for every one hotel that gives you EBITDA, you can compensate that with maybe 7 to 10 hotels, 10 managed hotels. So I think the right way forward would be a mix of both. And then answering to your second question, I think over the next 3 to 4 years, the ITC hotels revenue growth we are expecting is between 15% CAGR. And part of it will be driven by the hotel business, and some of it will also be driven by the sale of luxury residential apartments that they will start off from this year in their latest property in ITC Ratnadipa, which is in Sri Lanka.
Prashant, hi, Mahima also joining in. Just want to understand that because they have said that management contracts will go up to almost 65% of the total portfolio by FY30, what do you think the blended margins will go to? Because right now, owned hotels is roughly 35 to 36% of margins, but in terms of management contracts, that goes up to 70% in terms of margins. So then, where do you think blended margins will stand at?
Yeah, so we expect margin expansion of around 300 to 400 bips over the next 4 years. Certainly, part of it will be driven by growth in management fee. And then we will also see EBITDA accretion from the sale of luxury residential apartments, which is also a high margin business. So both of them will contribute to the margin accretion for ITC hotels.
Just do the rough math, Prashant, on an Excel file. 15% growth for 4 years takes me to a top line of around 6,300 odd crore. Around a 37% margin on that will roughly mean 2,500 crore of EBITDA. Am I right in kind of laying these numbers out?
So till FY28 or by FY28, we are expecting top line of around 5,300 to 5,400 crore for ITC hotels, and EBITDA of somewhere between 2,000 to 2,100 crores. That would imply margin of around 38% for the company.
Prashant, just want to understand, right now the company is sitting on a cash of roughly 1,600 crores right now. The company has also said that they will invest roughly 300 crores every year in terms of capex, that is around 8 to 10% of their total revenue. Plus, ITC is also expected to infuse around 1,500 crore post that demerger, which has still not happened. Just want to understand as to how this entire cash flow will be put to use.
I think that 1,500 crore from ITC has already been infused. So they have a net cash of around 1,500 to 1,600 crore already, and going forward also I think the cash generation is likely to be quite good. So that is a concern from our side also. While cash on an isolated basis is good to have, but it also drags your return ratio. And if you look at their own hotel pipeline, right now they have a pipeline of around 400 to 500 keys in the owned portfolio, which they will start over the next 2 to 3 years. So I think as an analyst, I would like to see more properties on the owned side. If they opt for a greenfield expansion, then certainly I think on the luxury side, it will take at least 5 years to come up with something. So deployment of cash is something that Street will also be looking out for from the management.
Very interesting, Prashant, that you're looking at this from an owned angle when everyone's looking at this more from a managed hotels angle. Let me ask you, what's driving occupancy for ITC? Because Mahima was suggesting earlier in the show that the occupancy rates have gone up in a more significant fashion versus peers. So what's driving that in your opinion?
So the first driver for occupancy is the commencement of ITC Ratnadipma, which they started in April itself. So they started with 250 keys and now they have opened it full-fledged 352 keys. So occupancy ramp up at that hotel will be the key driver. Other than that, for the new hotels that they have opened since 2020, I think occupancy in those hotels have also not yet reached the optimum levels. So then that is the second driver, that occupancy ramp up at recently owned hotels. That would, and the third driver is that typically most of the hotels go for renovation after a period of every few years. So that generally leads to some of the room closures on a recurring basis. So once those renovations are complete, then that will also drive occupancy for the owned portfolio. So these are the main factors, and then certainly you have tailwinds in terms of hotel industry doing quite good. So these are the factors which is driving occupancy for ITC hotels.
Prashant, regarding the batch stake sale, because that holds almost 15% of ITC hotels, how much of an overhang do you think will that have on the stock, and till what time will that overhang continue? Do you think that BAT will come out and sell their stake in next 2 to 3 quarters, or there's still time?
That I think only BAT will be able to answer, but it will certainly be a overhang on the stock because I think 15% in a business which is not related to them, they would certainly would like to exit from the company. But timing, I think, is best would be best decided by them. But 15% is a large stake, and I think it may create an overhang for some time on the stock.
Shant, if I were just to extrapolate the numbers, it's trading at around 20 times free cash flow FY28, or rather operating cash flow FY28, because we don't know how much capex they'll put up. Is this looking expensive for you? How should you view it with a high level of certainty? This doesn't look too bad, right?
So we still, I think there is still some upside on ITC hotels, but I think we would rather than looking at from a cash flow valuation, I would rather look for more cash deployment. But I think we have a target price of somewhere around 230 on the stock. We have valued it on SOTP, valuing hotel business separately, and also the bifurcation of residential real estate business. So I think there is still some upside on the stock, but it may be subject to revising upwards, provided they provide us more clarity on the owned portfolio pipeline if they plan to come up with something.
Okay, thank you so much, Prashant, for joining us. That gives us great amounts of clarity with regard to how ITC will likely play out. And viewers, in fact, that's all the time we have as well. So from Mahima, myself, everyone who puts the show together, thanks so much for watching. Of course, ITC Hotels, do you like it or not? Something that we leave with you, but completely out of time on this one.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Hi,
Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. This show gets you insight on everything personal finance related, and that means that sometimes we have to talk about uncomfortable subjects as well. And the subject that I've chosen today is something that will hit close to home for a lot of people because the numbers of divorces are going up in India. We'll talk about, most importantly, what the rules on alimony are. We'll talk about prenuptial agreements, which has been a concept that is mostly associated with the West, but increasingly young couples are contemplating it at the very least. To talk about everything associated with divorce and settlement and everything that you need to know, I'm joined this evening by Aditi Mahoney, who is a family lawyer. Thanks so much, Aditi, for taking the time. It's not the easiest subject to speak about, but anecdotal evidence suggests that there are more cases now than there were even a decade or two back. Is that something that bears out in the numbers?
Hi, thanks so much for having me. Yeah, absolutely. I think you're very, very right about that. What's happened is post-COVID, there's been a huge shift in how family operates really in India. And I think this could be attributed to, husband and wife spending long hours in confined spaces. You see a lot of new marriages where couples are, barely married for a couple of months, maybe within a year, who are now deciding to split. So that's pretty prevalent at the moment, and we're still dealing with the backlog of that even today.
And do the cases usually take long to find a solution? And is it a solution that is often found outside of the court? I'm talking about out-of-court settlements, or is it more often that you're seeing that it drags on in court?
So it's interesting because what happens is usually when the couples are younger, they kind of want to move on at the earliest. So you'll see a lot of out-of-court settlements happen in their case. Many times, though, if you're not able to arrive at that monetary sum, you will see matters then getting litigated. Now, we all know that litigation in India is a prolonged process. One has to understand that the entire framework of even family courts came into effect in 1970s, 1980s. We have about 7 courts to deal with the entire jurisdiction of Mumbai up to a little bit beyond Andheri. And that becomes a little tedious because the burden on the courts is absolutely astronomical and they aren't able to deal with the number of matters there are today.
So therefore, it's understandable that cases tend to go on. I take the point of young couples wanting to move on, and incidentally, this is also a very key demographic shift from what you saw maybe even 20, 30 years back, where in most cases now, both parts of the couple or both individuals are working, and so therefore the concept of alimony becomes a little more complicated, and that's the reason really part of the reason why we're talking about that on our show today, because it relates to money. How does alimony get decided, Aditi?
Yeah, so you're absolutely right. When it comes to alimony, one has to take into account several factors, all right? Now, understand the court is very clear that alimony is not a dole simply to be handed out. The spouse who requires alimony has to be able to substantiate his or her claims in terms of why they require that amount and what that amount is. So when I say substantiate, it basically means that you have to prove your claims. Now, for marriage, as you may be aware, that we're governed by personal laws unless the marriage is registered under the Special Marriage Act. As per these laws, usually maintenance is only reserved for the woman, with the exception of the Hindu Marriage Act, which extends that privilege even to the man. To be able to substantiate your claim for maintenance, you need to provide bills, you need to provide, any kind of proof of standard of living. It could be photographs, it could be pictures of vacations, medical bills, and so on and so forth to corroborate your claim.
Okay. So, and when you're talking about documents, is there anything that is codified in terms of a list of documents, or is it anything that you will find substantial to prove your case?
So what happened in 2019, we had a very, very significant and very landmark judgment that came about. It was the Rajneesh versus Neha judgment. So let me just paint a quick picture prior to 2019. What would happen is, in the event, or let's say a woman agitates a claim for maintenance, she would go to court and she would file an application for interim maintenance to start with. To be able to prove that she requires interim maintenance and to showcase that the husband has a particular lifestyle or a particular income, she would have to ask for documents from the husband to be able to corroborate her claim, in addition to substantiating it with her own evidence. So in 2019, with this judgment that came about, this entire step was eliminated. What the court said was, husband and wife both have to produce and file a very comprehensive affidavit of assets and liabilities. That is going to list down basic details and even beyond in terms of what assets you own, what properties you own, what was your income a year prior to marriage, what is your income a year prior to filing for divorce, what is your current income. So it's very, very detailed. It's the husband and the wife, both of them, who now have to furnish this affidavit in court. This has made it a little bit easier, because earlier we would really have to file that application for production, then argue it. The husband or wife would not come to court with clean hands. Documents would be withheld. So this has sort of eliminated that to a large extent.
Okay. The judgment that you're speaking about, Rajneesh versus Neha in the Supreme Court in 2020, it seems like a landmark judgment. Is this something that you refer to or the court refers to often when it's deciding on alimony?
100%. And what the Supreme Court has actually gone a step beyond and has given us a format in terms of what that affidavit of assets and liabilities is going to look like. So it has details to the extent of what phone you have, what watch you wear, as specific as that, to be able to ascertain that standard of living.
Now, when it comes to the actual numbers, assuming that an individual, and here in this case, as you pointed out, based on the act that you have used or under which you are married, both parties have a claim, the husband and the wife. So how does that number get determined, Aditi?
Okay, so to correct you there, it's only under the Hindu Marriage Act that the husband and wife both have a claim. Everywhere else, it's only reserved for the woman. Now, to decide how that number is going to be calculated, unfortunately, there's no formula. A few years ago, I think in 2017, there was a judgment that came about which said about 20 to 25% of your spouse's income is what you would be entitled to, subject that you are able to prove that you require alimony. Now, how it is calculated primarily is based on the standard of living of the parties post-marriage. If the spouse has any independent income of her own, that will be calculated. If there are any children, what their expenses are, that would be calculated. And then a sum would be arrived at. We also need to keep in mind that the way India views maintenance is that it is a necessity. It is not a luxury. So it is something that is given for your basic needs and essentials, and a little bit over and above that, just to ensure that you're not living a life of less than the dignity that you had previously. So that's the intent. It's not going to be like the West, where you get this huge chunk of alimony or maintenance, as one would think.
I'm wondering about that. So a few things come to mind. What is the periodicity of the payment? Is this paid in perpetuity? Is there a finite amount of money that gets paid out? And also, is this adjusted for inflation, or is it a fixed amount that gets decided?
Okay, so there are two components to maintenance. You have what is known as an interim maintenance, that's during the pendency of your case, and then you have a final maintenance, which is your permanent alimony or maintenance, as it is viewed. Now, the interim maintenance will hold until your case is finally decided and disposed of. At the time of final hearing, you could be awarded maintenance in two ways. It could either be a lump sum or it could be a monthly payment. Now, unfortunately, inflation is not taken into account. In the event of changed circumstances, or you require more money, or let's say tomorrow the husband loses his job, both parties will have to go to court to agitate a claim under changed circumstances and say that, look, I either need more maintenance or I can't pay the maintenance that was previously awarded, and we need to revisit this entire structure.
Okay, and it's an important point that you make, because there are instances where, for legitimate reasons, a payment cannot be made. But is that taken into account by court? And in the event that a payment is wrongfully not made, what is the legal recourse that a party has?
Okay, so let me start with what happens if you withhold payments. Okay, the option available to, let's say, the wife in this case is to file what is known as a darkhast. A darkhast is sort of like an execution or recovery proceedings where she will go and say that the husband is in arrears of, let's say, 20 lakhs, 25 lakhs because he's been withholding payment for the last 3 months, 5 months, and so on. The husband, however, can fire back, or he can initiate, be the first one to initiate proceedings saying that, look, at the time when this order was passed, I was in a position to be able to give her 3 lakhs or 5 lakhs, whatever that amount was, as maintenance. However, I have now retired, or my position has changed, or I've lost my job, which is why I can no longer pay this kind of money, and we need to revisit this entire arrangement. Understand that that case also will have to be proved. Simply going and making a statement like this in court is not going to suffice. You will have to prove as the husband in terms of what has changed in your circumstances, why you can't pay anymore. And the wife will also then come back with her claim saying that, this may or may not be true because he does have savings and so on. And what her financial position is, if she has children, what are the ages of the children and so on.
Okay, important points that are being made. Now, all of this comes to pass when there is obviously the reaching of a point where there is no common ground. And so therefore, understandably, parties have to split. But are more people contemplating prenuptial agreements, which, in case you're unfamiliar, viewer, has to do with an agreement between two parties before a marriage contract is gotten into? Is this, first of all, legally binding, Aditi?
So no, unfortunately, it is not. While you do have people who are opting for prenups, it is with the understanding that this is not enforceable. However, there's another way to look at prenups as well. It becomes beneficial for Indians who are now residing abroad and are married to either foreigners or married abroad. And given that, in most places in the West, you have a communal split in properties, a prenup would then help to kind of protect your interests in India in the event that you are initiating your divorce proceedings abroad.
Understood. Okay, now, since we've established that this prenuptial agreement is not legally binding, what I'm given to understand also is that it's an understanding between the two partners where they say if at some point we have to split, this is the way that we envision the split taking place. But having said that, in your considered opinion, what is the best outcome to seek? Because ultimately this is happening because there is no meeting of the minds, and you would want to have as clean a separation as possible. So what are the few things to bear in mind if, for example, an individual is in this kind of a situation?
Right. So I think at the get-go, I don't think prenup is the way to do it, because I think what happens is it's viewed as restricting your rights. Let's say today, as a husband might have 10 crore rupees, right? And the prenup has been drawn on out basis the 10 crore rupees, where the wife after a few years will get so much if the marriage lasts for so long and so on and so forth, depending on how you've executed that agreement. But let's say tomorrow the husband has 100 crores. The wife may feel curtailed to an extent that, I don't think I only deserve 1 or 2 crores as was previously agreed, and I deserve more. So I think the ideal way to really go about it is having clarity of thought in terms of how, in the course of marriage, you're going to manage your finances. How, if your wife is a homemaker, you do something to ensure that even she feels secure, even she feels protected. Maybe you'll both have a common bank account where you transfer certain amount of monies per month, and you maintain a lifestyle which is fair and something that you can sustain, even if you have to part ways tomorrow respectfully.
Last question, and this is in the event that one of the two parties is not playing fair, Aditi, and this often happens. How should somebody proceed in this kind of a situation? Because as you've pointed out, court cases can last years.
Absolutely. When people are not playing fair, though, unfortunately, what the intent is for the husband to deprive the wife of as much as he probably can, and for the wife to get as much of a settlement as possible. So the basis of that entire conversation is actually unfair to begin with. Unfortunately, then what happens is we need to obviously deploy tactics in terms of how the man would then protect his income and how the woman would then show that she is exceedingly dependent on him. That would involve, keeping evidence of their lifestyle in the course of marriage, what their electricity bills were, how often they ordered food online. So you will really have to go to the very basics as a woman to be able to prove that, I require this sum, which is equivalent to the standard of living I enjoy. Similarly, the man will have to show that, look, she's earning, she's capable of taking care of herself, she's educated, she has been involved in her work, in her business, and so on. And he will have to protect himself in some manner, which would also then maybe involve setting up a trust, protecting his assets, and so on.
Last question, and this has to do with a very critical aspect of marriages, which is children. And you've alluded to this at some point over the course of the conversation, but there is a question of custody. How is that determined, and how can a woman in this case protect her rights? Often, as I'm given to understand, please correct me if I'm wrong, the custody preference is to the mother.
So that's not entirely true.
Okay.
Custody goes to, while deciding the issue of custody, it's only the welfare of the child that's important. And that's what courts look at. Now, they will try to analyze who the welfare of the child rests with. Is it with the mother or is it with the father? Obviously, given that, when children are up to 3, 5, 6 years of age, the mother is preferred because of their emotional needs and, other needs in general. But for whatever reason, if the father is able to prove that the mother is unfit or she is incapable of taking care of the child and the welfare really rests with him, the courts may consider awarding the custody of the child to the father.
And okay, the very last question. In your opinion, is this best decided between the parties themselves rather than letting it go to the court?
100%, right? Because when you go to court, you're actually airing dirty laundry in public. You have to make allegations against your spouse saying why he or she is an unfit parent. You'll bring up instances which may not necessarily be entirely true, which are obviously concocted, which also adds to a lot of emotional strain. You see children getting tutored because one parent will now start, showing that they are the more fit parent and start putting the other parent down. So the child is also then caught in this conundrum and is very, very emotionally scarred during this entire process. And when children are a little older, they can be called to court to be interviewed by the judge itself in deciding how the custody is going to work and who they prefer living with.
All right, thanks so much, Aditi, for joining in for that very important conversation. Now, we've spoken about the splitting up of two individuals on account of divorce. And in certain situations, what that results in is having a single parent. And this is not obviously the only situation that can arise. You could have the demise of one partner, as a result of which you have a single parent. And we decided on this program to talk about how you should manage your finances if you are a single parent. And joining me to talk about that is Kiran Telang, financial planner. Kiran, what in your opinion are the first few things to bear in mind? We just spoke about alimony when it comes to a divorce, but what are the things that you need to bear in mind as a single parent?
Well, I would say, Alex, it's an unfortunate situation of single parenting, whether it is due to demise of a parent or due to divorce. In such situations, finances become very important. So when we look at finances in case of a single parent, I mean, whether it be due to divorce or demise of the partner, there are three aspects that you need to take care of. One is whether there is enough income available to take care of the current expenses. Second, is there enough income to provide for the future expenses, which are essentially your goals? So either there should be income available or there should be assets which are sizable enough to take care of the future goals. So that could typically be, the education, higher education for children or for the own retirement of the spouse. These are two critical aspects. The third aspect also what needs to be kept in mind is how will you protect any loss of income. So, a loss of income can arise from the single parent being, incapacitated, or if there is a demise which happens while the children are still young. Then how do you handle such situations? So these are three aspects which need to be kept in mind. Now, when we talk of divorce specifically, you said you have discussed alimony already. So alimony could be one of the sources of income, or it could be the source of providing for future goals. So if it's a lump sum alimony, it could be invested in such a manner that it becomes available for any future goals like the children's higher education. If the alimony is coming on a monthly basis, that could probably, support the ongoing current expenses. But there are pros and cons to each of these situations. So there could be situations where there is a monthly alimony coming in, or, interim or an annual kind of a thing. What if the other spouse decides not to pay? So then you are stranded, if you're depending on that kind of income coming in through alimony, it might create a problem in meeting the ends. Also, the other aspect that we forget here is, whether the single parent is himself or herself earning. So there are certain situations where the income by the single parent is good enough to support any future goals. So in such situations, you are in a much better position financially to take care of things. But if there is no income for the single parent, it becomes a very difficult situation.
Yeah, and of course, this is a very conditional case-by-case thing, and it depends from a situation to situation, because a lot of times people leave behind money, both in the form of investments, and here I'm talking about a demise, or there is life insurance that provides a bit of a safety net, which is why term insurance is so important to have. But let's talk about a scenario where there is a person who's earning and who has access to a little bit of money, but not a lot, and needs to ensure that they're taking care of both their requirements as well as their child's requirements. So in the order of priority, in your opinion, in the way that you would plan their finances, what is the order that you would decide?
You're talking in case of demise, I believe?
Yes.
Demise of one partner?
Yes.
Yeah. So in such a situation, I think first of all, you need to look at all the sources of income that are available. So like you mentioned, there could be insurance monies that would be available if the partner who has passed away had insurance in his or her own name. It could be either insurance that they've taken personally, or there could be insurance available through the employer. There could also be other assets which become available in such situations. For example, there would be provident fund money that can come in. A lot of corporates provide for superannuation funds also. So in case of demise of the employee, those funds become available as well. So first of all, we need to kind of arrive at, what are the assets that could be available, and make a list and claim all those assets. So a lot of times there are things which are missed out. So it is always better to keep a list of, assets that you have or investments that are available, so that in case such a situation ever arises, the surviving partner is at least able to claim whatever is required. So once that is claimed, then you need to figure out how much will that support, whatever asset size you have received, will that be enough to keep up for the future goals? If not, then either you have to increase the income in some manner, or then you have to, revisit your goals and see if there can be any modification, or there could be certain other assets which could be monetized. A lot of times people have, a second property which is lying idle, or it is rented out. So thinking of whether it can be better to monetize that property and, use it in a better manner. So kind of juggling your overall investment portfolio to optimize it to suit your future goals. I think that would be the priority that I would take.
In this case, would you say more than investments being made for the future, insurance becomes absolutely important, both health as well as life?
See, health insurance is always a priority, whether it's a single parent or, it's a normal family with the couple being around. So health insurance obviously is the top priority in any case. So health insurance, I'm presuming, would be there. If not, it has to be taken. Especially, in case of demise of a single parent, there might be, and if that parent was a single earner, there might be employer insurance which might no longer be available. So that situation, then health insurance becomes critical. In a similar case, life insurance also for the surviving partner becomes important. Here, I would also like to point out that when the surviving parent is taking a life insurance policy, normally the children are made the nominee. But in situations where the other parent is not alive, the question comes as to who will be the guardian. So, those are things that need a little thought as to who will be the best guardian in situation where the second parent also is not there.
Important considerations to have. Final question and a quick answer to this. Are there any things that you would say are a no-no in terms of a money decisions?
I would say look at liquidity factor. A lot of times people choose options which are pretty illiquid because those are probably the easiest and probably the traditional ones which anybody would suggest. So there'll be a lot of suggestions coming in from friends and family and well-wishers. But think of liquidity as a very important factor in your journey going forward as a single parent. Do not block large chunks of money from places where you cannot withdraw it as in when you need it.
All right. Kiran, on that note, thank you so much for joining us. It's a pleasure speaking with you.
Thanks, Alex.
All right. That brings us to the end of this edition of Your Money Matters. Thanks so much for joining in. Do stay tuned. Lots more coming up on NDTV Profit.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Well, a rare confluence of structural tailwinds make India a great long-term story. This, in a very simple nutshell, is how I would classify or call one of the key reports that has come out of the stable of Bank of America. And as we sit in the venue of their India Investor Conference, it's an absolute delight to speak to Amish Shah. As he outlines, how does he think India stands in the investing pecking order from his perspective, and what has the conference been all about as well? Amish, great having you. Thank you so much for talking to us. And thank you for having us here.
Thank you for coming down, Neeraj.
No, the pleasure is entirely mine. Amish, so tell us, we'll come to the note as well, but I just want to get the rumblings of the conference. I hear from your team and from others that this has been an unprecedented attendance, both from the corporates as well as the investing community. Tell us a bit about the conference. What was the theme showcased or the principal messaging, and what is it that you've told both investors and corporates?
Sure. So Neeraj, meaning as you know, we restarted our India conference, for the last 3 years. It's only kept on becoming bigger. This year, we are hosting 107 corporates. We have about 450 investors. There are 21 plenary sessions, and there are already 1,500 conversations that have happened between investors and corporates. But we are not stopping. So our conference comes to an end today. But we are continuing for the next 2 days through this week with 6 field trips. So these are investors who want to see the real India.
Okay.
So they want to go and see a manufacturing facility. So there's a manufacturing tour. Or you want to go and talk to the dealers, distributors on a consumption tour. I'm myself hosting a policy tour where we will have all the key bureaucrats or the policymakers, speak about what are they thinking about, how they want to drive the policy making going forward. So there are 6 different themes across different sectors, and then we will be continuing with those trips as well. Coming to the theme of the conference.
No, sorry, just before we get there. So it's interesting, Amish, that all of this is happening, and this unprecedented India interest, if I can use that term loosely, is happening at a point of time when Amish is telling people that the Nifty's done its course and we don't see much upside. So there is wide India interest despite the fact that the markets may not have near-term gains.
Absolutely, because everybody wants to keep India on its radar.
Okay.
Back in the time, like let's say if I rewind 5 years back, India's weight in MSCI emerging markets was only about 8.5%. Now it's close to 20%. So it's no longer a market that, even as an emerging market fund manager, obviously as an India dedicated fund manager, you want to know what's happening in India. But even as an emerging market fund manager, 20% is a pretty large weight. We are just a shade below China now. China is about 24%, right? So it is a market of relevance. You may not want to invest immediately, but you want to keep it on your radar. You also want to meet these companies, do your homework, find out what is the price at which you will ideally buy these companies, and if these prices were to come, then you have to be ready to jump onto it, because Indian markets, as we know, is a structural growth opportunity. It won't give you that opportunity for long, so you have to be prepared for it. So absolutely, from an interest perspective, therefore, despite full valuations, and we'll speak about that, definitely a lot of interest right now.
Okay, now the theme of the conference. What is it that you are telling your set of investors who are coming? I heard 450 the number, so that's a very large number. What is it that you're telling investors about? Why is it, or what is it that within India they should see? What's the central theme of the conference?
So the central theme is about accelerating growth, and we have named that because we think that we are now all know that over the last 3-4 quarters growth did come down, and there are a variety of factors to that. The most commonly being spoken about is that there was over tightening of fiscal, there was an over tightening of monetary policy, and as a result that led to some growth come off, and then there was credit growth contracting as well. So a confluence of all of this led to corporate earnings growth coming off as well. But everyone expects the growth to now accelerate because the monetary policy has completely turned its course. We are now talking about lesser regulations, more liquidity, lower rates, and so on and so forth. In fact, there's a possibility for even a fiscal stimulus now, because RBI has given dividends which are slightly higher than what the government had budgeted. Crude prices are lower. As a result, government has hiked the excise duties on the petrol and diesel at the pump. that gives additional sources of revenues to the government. So all of this put together, there is therefore a question on whether the government now has a room to go and spend that money and do a small fiscal stimulus on the back of it. So all of these factors put together on the back of the low base of growth clearly means that the growth will accelerate. In what form, how structural, that is all up for debate, but there is definitely a growth acceleration, and therefore the central theme is accelerating growth.
Great. Can I actually just go a bit minutiae for a moment, and then we'll come to how investors are receiving this, what are the conversations like? At the end of Q4, an overarching view is that we might do about 10-12%, what have you, the number, right? And I remember a conversation that we had at our studios when you had come down, when you were saying that the pricing power is not quite there with the Indian corporate right now. So the possibilities of the numbers coming down might also stay. Now my question to you is, what is your stance right now, particularly in light of the fact that, in my view, we have a favorable base effect for Q1 and Q2, and that optically might bump up the growth number, even though in absolute numbers, the EPS may be X or Y or Z. So how do you think about growth, earnings growth, Nifty 50 or whatever benchmark you may want to choose for FY26 now?
So, Neeraj, as I said, that for the sequentially there will be an acceleration of growth.
Right.
So, to put numbers to this, if I look at Nifty, the earnings growth that it has delivered in fiscal 25 is 5.5%. Now, obviously, you can slice dice it, because if you want to look at optimistically, you will say that let's look at X financials, X energy. Even if you do X financials, X energy, which is generally the sectors that has dragged growth, Nifty earnings growth has been 7% in FY25, and this is nominal earnings growth, whereas the nominal GDP itself has grown at around 10%, right? So corporate earnings for the largest set of Indian companies is lower than the nominal GDP growth, and that is a low base that you speak about. On that low base, in FY26, we are arguing for a 9% earnings growth, which is again a shade lower than nominal GDP growth, or maybe at best equal to nominal GDP growth. There is no large acceleration to it. Now, when we come to the concerns on why we are not so optimistic on markets from a near-term perspective, I would say that markets, as we know, is all about what is already priced in. So when we began this calendar year, for FY26, consensus expectation was 22% earnings growth, because they thought that on a low base, the growth can be quite sharp. We were arguing for 9. We are still at 9. Consensus is down from 22 to 13. So, and then 13 will further, in our view, keep coming down to 9. So in a way, tying up the two things that we've spoken so far, is there an acceleration of growth? Yes, because 5.5 will go to 9. But, is that good enough from a market's perspective? Not really, because 9 is weaker than 13 that markets are already pricing in.
Okay. So, which is why the upsides are capped. Yes. Can these the capping of the upsides change if indeed we see this fiscal stimulus? I believe a monetary policy easing of anywhere between 50 to 100, whatever the debated number might be, is already baked in?
So the short answer is that 9 is after budgeting for that fiscal stimulus.
Okay.
Because while I spoke about the positives of the fiscal math, the concern that we have is that personal income taxes, despite 1 trillion rupees of tax breaks that government is budgeted for, the personal income tax growth budgeted for F26 is 14%, which we think is quite optimistic. We think that in reality that number will end up at about 11. So you will have a slight disappointment in your personal income tax collection, which to some extent will get filled up with the excise duty collections on petrol and diesel, plus the extra RBI and possibly even the PSU dividends. So at the margin, we think that the budget will get balanced, but there is not too much scope to do a large stimulus as of now.
Okay. So, I'll get to the minutiae, and then I'll want a sense from you about what happens to India in the light of what's happening across the world as well, right? Because I'm sure you have a view there. But since we are on the topic of India, where is it that within this conversation of this 9% earnings growth that you are penciling in, would the outliers be or the beneficiaries be, or the ones which the investors would want to go for be? That list, versus where is it that you are anti-consensus, wherein the street might be constructive, but you believe that those themes may not necessarily give adequate returns, let's say over the next 12 months?
So let me start with the anti-consensus one first. First of all, I would say that, I would like to believe that our views on market itself is anti-consensus. Generally, there is a lot of optimism on India right now, and we are optimistic as well, but not at these valuations, right? And then I would say it's the capex theme. So capex is something that we were, for a very long period of time, were very bullish. We wrote that entire theme from 2020 to 2020 up until August of 24. But August of 24, we completely changed our mind. So from being completely bullish, we went completely bearish. So I covered 14 stocks within the capex space, and we downgraded 13 out of 14 from buys to straight sells.
Okay.
Right now,
what changed that?
Yeah. So what changed that is that if you look at the mix of capex, it was predominantly driven by government-led infrastructure. Right? And if you look at the government budgets over the last few years, let's say between FY21 to FY24, central government capex grew at the CAGR rate of 31%. Right? So which basically means that in 3 years they doubled the capex allocations. And this is already on a high base because capex allocations has been going up since FY15. So to quote some numbers, let's say if you make a pie chart of government expenditure in India, you would realize that about 72% of government expenditure is fixed expenses. So, irrespective of the political party, you cannot really change that number because it's fixed expense. The remaining 28 is really a choice on whether you want to do populism with that money or do you want to use that towards infrastructure build out, right? Over the last 10 years, what we have seen is that the share of government expenditure towards subsidies, which is populism, came down from 18.4% to 8.6%.
Okay.
Right? Whereas the number for capex went up from 9 to 30%. Right? And these ratios are expanding in an expanding pie because government expenditure obviously is growing in line with the nominal GDP growth of 10-11% each year as well, right? So in an expanding pie, 9 going to 30 is a massive shift, right? And as a result of that, that's the time when we were bullish because we saw that quarter after quarter the government was just accelerating its investments in favor of infrastructure, and that made us bullish. But back in June, July, August last year, we think that the government has now started to, rightfully so, balance consumption-led demand with capex-led investment. Because clearly the consumer economy, we know that a rural ecosystem was quite weak. They had to push that growth up. Urban, everybody had started to discuss that urban growth is now leveling off. So there was a need for a consumption stimulus. Maybe subsidies were cut too far. There was less money in the pockets of people to go and spend. And as they tried to therefore allocate more money in the pockets of people in terms of tax breaks or subsidies as we call it, clearly the run rate of growth towards capex has therefore slowed. Now, once this growth has slowed, let's please understand that this is a deep cyclical sector. So to just give you some perspective here, typically a capex cycle in India has gone on, it goes on for 8 to 10 years. And over a 10-year period, what we have seen is that the entire P&L of an industrial sector company becomes a multiplication factor. So because when the orders are accelerating or the growth in new capex is accelerating, you get pricing power, so your margins go up. You also can improve your working capital because you can go to your client and say that I need to be paid faster because I have other jobs to complete, and the client also wants to complete it faster because he can see a momentum in the economy. So you want to get the project, like if I'm building an airport, for example, I want the airport to be finished fast so that I can have footfalls coming in immediately, right? So it's in everybody's interest to accelerate the pace of that. So you're talking about more orders, faster execution, better margins, better working capital, and as a result we have seen that ROEs of these companies from a down cycle to an up cycle in a 10-year period triples. And because your ROEs triple, obviously you have to expand valuation multiples as well, right? So therefore you get double whammy in these stocks, that your earnings growth is is accelerating, and your valuation multiples are also expanding, and that's why these sectors become multi-baggers. Which is the wave that we wanted to ride, or we ideally did ride between 20 to 2024. But at the conversely, when this pivots, on the down cycle is the same story, that if the orders slow, then it will bring along with it margin pressures, it will bring along with it working capital pressures,
and therefore valuation derating.
And therefore valuation derating. Right?
So you are in that cycle now, you think?
So I would say we are not in a down cycle, but we are not in an up cycle. So we are now going to be firmly in a mid cycle. So let me put it this way, that we think that over the last 3 years, government, private, and PSU capex all combined was growing at 20% on an annual basis. We think that will now slow down to 10.5. So 20 down to 10.5, I would not call it as a down cycle, because down cycle numbers go down to 5% growth. So we are not in the 5% camp, but we are not in the 20 camp. We are somewhere in between, and 10.5 is broadly the nominal GDP growth of India. So I would say if you were to calculate a ratio of capex divided by GDP, it will be like a flat line.
Got it.
And from a company perspective, it will be weaker than what you already expect in growth. Until the time the stocks don't budget for it, I think there is a need to be cautious.
Okay, so so just so that the viewers understand as well, I'm not asking you to name names, but I'm saying that the companies in that capex cycle, which could be MNC names like ABB, Siemens, etc., or L&Ts of the world, all of that might be in a mid-cycle thing. My question to you is, presumably, could there be outliers to this? Like, for example, the government may do larger defense capex because, now there is proof of concept because of the sad conflict, if you will, right? So could there be outliers to this in the capex theme per se?
Absolutely, yes. And the better way to cut it is to say that, we divide capex into 4 parts.
Okay.
So central government-led capex, state government-led capex, PSU-led capex, and private sector-led capex, right? Now, each one of them have their own dynamics. So we think that the state government capex is going to shrink the most.
Okay.
So any sector which is linked to, or companies that are linked to catering to the state capex, and this is primarily water, irrigation, power distribution, metro rail, and state highways. So these are the top 5 categories where the state government spends its money. So if you are a company catering to that side of the capex, you are going to be the most hit.
Okay.
Right. If you are catering to the central government capex, and central government spends most of its money on highways, railways, and defense.
Okay.
So if you are a company catering to that, you are moderately impacted, because the growth is coming down, but not coming down as sharply as it is coming down for the state governments. If you are a company catering to PSUs, you have relatively negligible impact, because PSUs have their own balance sheets. They don't have to rely on government budgets for them to make their capex decisions. So they will continue to spend what they were already spending. So there are no breaks to their overall capex. So you're actually quite well positioned. And within private, it's actually further bifurcation, because private is a combination of real estate capex, industrial capex, so new steel, cement, etc. plants, BOT projects like toll roads, BOT airports, etc. And it's all the new age industries like semiconductors, data centers, biofuels, green hydrogen, which is the new kind of things where private is spending money. So depending on where you are, touching the private capex, the growth rates are different.
Okay.
So to sum it up, I would say that the worst is the ones exposed to state capex. The best is actually the ones exposed to PSU capex, and then center and private is somewhere in between.
Okay. So just to rewind the 2 questions, the PSU capex beneficiaries, you reckon there the upcycle might still be there, so the valuation multiples might still stay high if they are high already?
That's right. So relatively clearly you can say one versus the other, but wearing my strategy hat on, I would say that the whole sector will underperform in comparison to something else.
Got it. One last question there. I heard you say power distribution as well, but I thought transmission and distribution is actually in a very sweet spot. Evacuation issues, lot of transmission is to set up even now, and therefore that is in a sweet spot. You don't agree?
So transmission, yes. Distribution, not. Transmission is predominantly the job of private or PSU companies, which is, as I said, the capex which is doing well and is not going to get impacted. Power distribution is a domain of state governments. Primarily, there are literally some licenses that you can count on your fingers where distribution is done by the private sector, but by and large, power distribution is a state government domain and which will get impacted.
So cables, transformers, etc., all of which are in the transmission space might still continue to do okay because they'll get orders.
Correct.
Okay, perfect. Now, where your strategy at is and I'll have a final question on the report because the 9 structural drivers for India is great, right? But just one more thing. So now, where in your strategy had, we've discussed capex, you are anti-consensus there. Where is it that you are constructive?
So we are constructive on anything which is a rate-sensitive sector, because as we discussed, is there a need to stimulate growth in India? Yes. Can you stimulate growth through fiscal measures? Tough. Because as we discussed, government budgeted tax revenues, etc., may be a tad bit disappointing, and that disappointment will get covered up with RBI, etc., excess dividends. So fiscal, I think, the government will just be able to balance its budget the way they have estimated. But we think that there is a lot of room to stimulate through monetary measures. There are plenty of tools available, in terms of more rate cards, more liquidity, fewer regulations, etc. And the government will want to use it, and in this case RBI will want to use it. So we do think that monetary stimulus is the way to go, and as a result, any sector that benefits on the back of accommodative or a loose monetary policy is therefore what we like, and that includes rate sensitive sectors like financials, real estate, REITs, autos, internet. So this is something that we like. And given that I'm generally cautious on markets or not that upbeat on markets right now, we are therefore also positioned in defensive sectors, because if the market corrects, these are sectors that will not fall as much. So that includes things like telecom, hospitals, domestic pharma companies. Those are more defensive oriented sectors, which is where we will be overweight as well.
Not staples, not consumer staples. Okay, not consumer staples, which is interesting.
I mean, obviously, we might have one or two ideas on a bottom-up basis on stocks that we like. But if I were to generalize the staples as a sector, we still think that the growth is going to be weaker or muted growth. For the valuations that it still trades as a sector, 45 times, we are not yet excited.
Got it. My final question, Amish, and that ties in with two-part question rolled into one. It ties in with the report that you guys have written about 9 structural growth drivers and how longer-term India is great, right? So some reference of that, and tying that in with what is it that changes your view? Is it a time correction? Does it, if the Nifty doesn't do anything for 6 months, broader markets kind of stay stable, does that therefore bake in the valuation discount that India should get, and therefore do you turn constructive? Is it better earnings growth which surprises you, which seems to be the obvious answer, but is that or is there something else?
So Neeraj, let me put it like this, right? If I were to purely put this in the form of arithmetic, so markets, as we know, is EPS multiplied by valuation multiple, right? And and therefore it's also about the time frame of your investment. So let's say if I were to set a price target for December of 25, which is the end of this year, I would say that, okay, what is likely to be the December 26 EPS of Nifty 1 year forward, because markets will be willing to pay 1 year forward. So what will be the December 26 EPS multiplied by the valuation multiple I'm okay to give, right? That sets my price target for December of 25. But now if I were to say that I want to set a price target for December of 26, then I'm saying that, okay, what will be the EPS of December 27 and multiplied by the P multiple, So this therefore, first of all, becomes a question of your time horizon of investment, right? The longer you want to stay put in the market, obviously, given the fact that India is a structural growth market, so earnings will keep on compounding, and if earnings keeps compounding, markets will also keep compounding. So once we have established that the markets will keep compounding, but my entry point decides that despite that compounding, how much return will I make?
Agreed.
Right? So given the valuations that we already are, if you let's assume that if you're an investor who wants to stay invested for 18 months, you should be expecting 8% CAGR returns, purely on the back of that math. If you are an investor who's invested for the next 7 months, you should be expecting 1% return, right? Because that is how the math works. So basically the way we have formed our views is that for December of 25, our Nifty target is 25,000, right? And in August, August of last year, so August of 24, we went bearish on markets because markets were at 26,500.
Right.
So they were already higher than my fair price, and they were higher 16 months in advance because we are in August 24 and I expect it to be at 25 by the end of December 25. Right. So because we were already higher, we went bearish. And that is the time when we had that conversation in February. But over a period of time from August of 24, the markets came down to 22,000.
Which is when you turned constructive.
So because the markets came to 22,000, we said, this is now a 14% upside to our price target. So we turned bullish. But in 2 months' time, the markets have come back to 25,000, and which is why we are again now seeing no returns. So on Nifty, I would say that I'm not bearish, but I'm saying that it is full price.
Got it.
Right? So the markets have to therefore consolidate. You are unlikely to make too much returns. You might probably make better returns by being in fixed income markets right now, is the way to think about it. Now to your final question, assuming that the markets actually go the way I expect, and let's say by December the markets are still at 25,000, then obviously I would say that, okay, now I'm looking at December 26 EPS, and 1 year forward, I will find more returns. Right, so that's a way to think about it. So structural compounding will stay. Depending on your time horizon, you have to adjust your returns therefore.
Got it. I believe I've exhausted my time. Else, I would have loved to talk about the structural 9 growth drivers as well. But there's a fabulous report, Amish, and maybe at some point of time in the next couple of months, you get the chance. We should talk about that in detail.
Absolutely.
Yeah, but thanks for having us at your conference, and all the best for the remainder of the conference.
Thank you, Neeraj.
And viewers, thanks for tuning into this broadcast.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Good evening, you're watching The Big Question. I'm Sanjana. At a time when your next meal is just a click away, you would think that restaurants are flourishing. But look closer and you see a different story simmering. One where restaurants find themselves in a catch-22 situation in this gig economy. To be or not to be on these apps. Small restaurants are struggling to sustain their margins as they are burdened with high commission rates, mounting ad expenses and pressure to offer deep discounts. Opt out of these and you vanish from the customer's radars. Let's take the example of Scoopful, a Bengaluru-based ice cream store which complained of slowing margins due to high costs. Now, the company owner claims to have paid over 15,000 rupees to Zomato out of a total sale of 17,000 rupees, leaving him with just 1,500 rupees of profit. Now, it's not just one store. The situation has gotten so bad for small restaurants that costs are outweighing the benefits, and many have now decided to leave the platform altogether, highlighting tensions in India's gig economy. Now, how Zomato and Swiggy decides that these fees remain clouded in mystery. There's no real transparency on how these are calculated, how commissions are paid out, how the hike should happen, why they should happen. So NDTV actually spoke to industry sources, and NDTV Profit went on ground, and we found out that Swiggy and Zomato charge 10 to 28% commission from these restaurants. Now, these commission charges change as per average order value and number of orders. This is not all. A restaurant's brand identity can also affect these commissions, and many times larger chains or more popular brands end up paying a lower commission than smaller restaurants. So with this, the big question that we're asking this evening is Zomato's growth starving small restaurants and gig workers? So quickly, let me welcome my panelists that are joining me this evening. I have Nirupama Soundarajan, co-founder and CEO of Policy Consensus Center. Thomas Fenn, co-founder Mahabali and secretary NRAI. Saurabh Gupta, author and tech entrepreneur, co-founder Frogo. Thank you so much for joining me this evening. I'm going to come to you first, Thomas. We're seeing small restaurants like we just spoke about, a Scoopful in Bengaluru, losing nearly 90% of its sales because of what's happening with regards to Zomato, right? We're looking at that payout not really being fair to these small restaurants. Where do restaurants go? And how are these costs forcing small businesses into a catch-22 of staying on platforms or then losing visibility?
Today, there's not really a choice. 95% of most cloud kitchens, when I mean cloud kitchens, I mean restaurants that do delivery for people. If you do dine-in, at least you have some sort of baseline to maybe, buffet loss of revenues, that is, via the delivery channel. Unfortunately, we've reached a point where there are only two players. So choice to a customer is only two players, such as Zomato and Swiggy. Choice to a restaurant is only two players. And choice to a gig worker is also actually realistically only two players. What this leads to is two poor outcomes. One, there's nowhere else to go, which means that you have two players who are also able to set the terms of the trade regardless of how asymmetrically it affects all the stakeholders involved. Usually customers don't pay the price for this. At least they don't directly pay the price for this because they are kept out of the loop as the third wheel. But eventually all of these costs do add up. It means a higher price for a customer. It will mean higher operating costs for a restaurant to be on the platform. And eventually it will mean shrinking margins for the restaurant to effectively sustain on the platform.
Okay, so thanks so much for breaking that down. Saurabh, I'm going to go over some numbers now, right? We're looking at 58% Zomato's market share, driving customer reach, but high commissions, that's up to 28%, squeezing small restaurants' margins. So how can platforms continue to justify these rates when small businesses are struggling to even break even?
I think, first we need to understand what goes behind the scene, or say how these models are built.
Okay.
Right. So Zomato and Swiggy, if I put in a first in a one-liner, these platforms are selling the convenience to the customers.
Okay.
Right. The amount of time and effort it will take for us as a customer to go all the way down to the offline a dine-in and have the food there. They bring in the convenience there. Now, coming to your point about the small restaurants, that where do they make the profit? I think, or say where do they conserve their margins? It's so they have to. And by the way, they are the price they are listing on the menu is not the same amount of input price that goes into building that product, right? So in order to generate more demand, they need to have a strategy about the pricing and how do they list up in their Zomato and Swiggy listings. And if there are alternate sources of generating the lead where they can conserve the margins, by all means. So a couple of numbers, if I talk about the stats over the last 5 or 6 years, the cloud kitchen model has flared up to 16.5 year-on-year growth in the last 5 to 6 years, and is expected to become the $4 billion market in next 7 years. Right. So it all giving an indication that the small restaurants, if they can conserve their margin from the dine-in and generate the lead with this food aggregator platform, by all means, they would have a segue into paths to profitability in their business models.
Okay, but the thing is, I also think that, and maybe Thomas can weigh in on this. I also think that we're looking at downgrades recently with Zomato and Swiggy because a lot of people now are preferring to dine in. They're preferring to actually go to restaurants and dine in over delivery. So I'm not entirely sure what you're saying actually holds too much weight. But before I go back to Thomas, Nirupama, I'd like you to jump in here. We're seeing opaque commission structures clearly leaning towards larger chains over small restaurants. What policies could level the playing field and protect small businesses in India's gig economy? And at the same time, if you could also, for our viewers and for me, explain the kind of pressure that this puts on the gig economy.
So I think first thing is gig economy is one thing, and what we're talking about is a separate thing here. What we're talking about is a platform based, it's almost like an e-commerce kind of setup. Gig economy is what these platforms actually, gig workers are what these platforms hire. But the problem that you are talking about has to do with the smaller restaurants who are onboarded onto these platforms and what is happening there. So if we take that issue first, if you look at it in terms of policy, look, there are two things, right? There is what policy can do and there is what contracts are. So the first question, of course, and I would love to hear from, Thomas as well on this, is at the time of onboarding, I'm sure there was a contractual agreement that was there between the platform as well as far as the restaurants also concerned. So whether there is any kind of deviation from that contract, is it in line with the contract is the first bit. If there is opaqueness in the contract itself and therefore in charges that are being levied, I think regulation comes in there. Regulation, if you look at e-commerce regulations, they have already specified that charges have to be spelled out very clearly, whether it is for the quintessential seller, who can be a restaurant in this case, or whether it is for the consumer. And if they are not doing that, then they are in some cases in breach of regulations.
Okay. Thomas, would you like to add to that?
Sure. So I think the question was enforceable contracts, basically. Like, are there enforceable contracts? See, when restaurants on board with Zomato, Swiggy, they sign what is called merchant terms of trade.
Okay.
Right? Like this is an online digitally signed document, which lays out in basic terms what your commission rate is going to be, what are the sharing of liabilities between the two parties. But they're not time bound in any sense. So there's actually nothing stopping or no protections to a restaurant to kind of hold on to this. There's no consistency in the terms of trade. So there is nothing stopping a Zomato or Swiggy maybe 3 months down the line saying that your commission rate, let's say my commission rate was 10%. It says there is nothing stopping them from saying, look, your commission rate from this day forth is 15%. And you have 1 week to accept or reject this contract. If you reject this contract, you will be delisted from the platform. And if you accept, well, the rate is going to go up. The commission rate is just one aspect of, like a wide set of terms and conditions which are skewed towards the platform. They can change it. So it doesn't even operate the way a rent agreement would. So what a restaurant, just like any other business, a restaurant operator wants predictability. And predictabilities are usually bound by contracts. So honestly, even though there might be some sort of structure to it, it is not really legally enforceable beyond a point because you're signing on to something that one party can change with just like a very small piece of information.
Absolutely. Saurabh, because, and I'd like to just bring that in here and adding and reiterating what Thomas is saying, because we saw a quote from Safroma. I think it was the restaurant in Noida that actually, first initially put this post, and it went viral, and that's how we all got to know about this issue, about many restaurants now pulling out of Zomato. And if I can read from the quote, it said that in the beginning, Zomato executives gave us a lot of hope, and that onboarding will increase my sales order. And once I got in, the expenses kept increasing because we are a new restaurant. They even took control of ads and discounts provided where I had no say. So really, I'm trying to understand, because where does it end? Because you may have a term of trade that is signed, but if it's going to be that dynamic and that flexible, how are you allowing a small establishment to grow if you're going to be eating into all of their profits?
Absolutely. I'll connect back to the point that Thomas made.
Sure.
That it all starts with an agreement. Okay. And in the agreement at a high level, it will, there will be commission, there will be charges, and there will be levers with which the restaurants can up their sale, right? So the levers are clearly listed, that what are the demand generation channels, what are the levers, whether it is ad clicks, whether it is video ads, whatever it is, and restaurant signs up for it. Right. So the only case which you brought in picture right now, that restaurants was not aware that the ad clicks for which they were paying on Zomato and Swiggy were not actually clicking for them. It was not generating any leads. Now that depends on a lot of factors. That depends on, it may be the catalog, it may be the choice of the, the recipes which they're selling on these platforms. That is a different thing. Now, when these expenses are charged back to the restaurants, of course, they will take a hit, or say it will hit them badly, because this was something which was not earlier anticipated in their margins, right? So when it comes to the feedback, these observations from the smaller restaurants, it is very well taken. But the point being that it was totally oblivious from their accounting or say consideration, I do not agree. All I agree is the point that the engine was running to generate the lead for them, but something didn't click well. Now that needs to be figured out, at what didn't click for them to generate the demand on that particular day or hour, whatever the case may be.
Okay, but now Saurabh, if I ask you then as a follow-up, given the tension between platform growth and, say small restaurant sustainability, what changes do you think that potentially Zomato or Swiggy or any of these platforms could implement to ensure fairer treatment then for smaller restaurants? Because let's remember, this is not an isolated incident, and this is not the first time that this has actually been brought about. And I was actually having a conversation, and a very sharp and pointed one, with Thomas before we got on this call, and he said that, from this, none of the players seem to benefit, not even the customer anymore.
Absolutely. So in my viewpoint, Sanjana, there'll be two things which I would suggest or recommend.
Okay.
If I would be, one is the customer awareness. Right now, customer is totally opaque to how these engines are running. Right. I see a lot of posts coming. Read a lot of blogs where customers say that Zomato is driving the price engine. Zomato is driving the discount. Zomato is, or say these players are actually, the gig workers, and they are paying or not paying. All of these myths and, facts come out open in the blog. So somewhere I think these platforms have to open up that what goes behind serving one food from a restaurant all the way till home, and all this chain, all these small points in this entire process chain is not entirely owned by these people, right? They have gig workers, they pay salary to them. There's entire battery of operation analysts, operation managers who are working in the background. So there's a cost associated to it. They cannot, if the restaurant is selling for 100 rupees something, they cannot give it back to 100 rupees to the customer. Someone has to bear that cost. This is point number one, that the awareness to the customer has to come out in more explicable way. Second is, I agree that fairness, there has to be an ethical and governance layer where they need to abide by certain rules and regulations, that either it can be with an open reporting or with the margin structure with the smaller restaurants or the large chains, that up to a certain extent they cannot go beyond it. Like they cannot be charging, if the total, say, they cannot hit the margin badly all the way up to 80%. As the case which you mentioned, that 15,000 out of 17,000 income that they are paying to Zomato, there has to be a regulation that how much percentage of the total income made by the smaller restaurants can go to Zomato's kitty. So these are the two things, but yeah, continue.
Okay, so Nirupama, then attesting to what Saurabh is saying, do we have a current framework that says that this level of transparent reporting needs to be done? Or if you could explain to our viewers, how that entire process works right from the time that you order your food. Is that tip or that fee actually going to the delivery partner? All of these things. Does the current framework or the policy allow for it right now for platforms to come out honestly and authentically and report about all of these things? What is your sense of it?
The policy doesn't actually look at that. So look at it in terms of two parts of the supply chain as we are. So there is one, as a consumer, I am ordering from the platform. So do I see what the breakup of the charges are? Yes, to some extent, I see what the breakup of the charges are. I see what the fees are. I see there is a tip that I can add. I see that there is if there is a convenience fee, or if there is a platform fee, or if there's a delivery cost, or if there's a packaging cost. I see all of that. But what I don't see as a consumer is how much of that is actually going towards Zomato, and how much of it is actually, or Swiggy, or the platform per se, and how much of it is actually charges put on by the restaurant itself. So, for example, that would help in terms of consumer education. The second is what happens, from the restaurant to the platform. And I think the big problem is there. Thomas said something very interesting. He spoke of predictability. And I think that's where the problem is. See, contract enforceability is one thing. And you can certainly enforce a contract, but a contract that changes without giving the other person a choice and randomly does not actually ensure any kind of predictability for businesses. And I think that's the issue. Coming to caps on, on commissions, I think that's a very doable model and something that your regulation can look at. So if you look at the insurance sector, and I just want to draw a parallel there. So, insurance sectors also work based on an agent model where you have insurance brokers who go and they sell. There is a cap in terms of how much commission you can actually pay for the broker. So, you have similar examples in other sectors. You can use those as guiding principles to look at it here. The fact of the matter is, the easiest solution is a commission should be a percentage of what the sale is, right? It's a straightforward thing. If I make X amount of money, you take a small percentage of that, which should be fixed for a certain period. Until you move to the next slab of sales, you don't so you have a tiered structure, which kind of equates to your sales volume, makes sense. But I think the problem here is not just the commission alone. It is things like advertising costs. It's like, what you're clicking on, what you're not. Now, the fact is we can go on a he said, she said. The platform can say, what, all of this is there. The restaurants can say, no, they're not there. But the fact is, if more and more restaurants feel that this is not being dealt with adequately, then either the platform has to take on the responsibility of it, educating their the restaurants at the time of onboarding, particularly the smaller ones, or their communication in terms of what they're charging has to be much better. I mean, if they're not doing that, then obviously they're failing somewhere on the governance side. Even if all what they're saying is correct and they think they're being very transparent, and even assuming they have everything down, but if the communication of transparency hasn't gone through, then I would question whether that's really called transparent.
So Thomas, then is that level of transparency being maintained? Would you say that there is a certain onboarding process that is followed where the restaurant is completely aware of the levers that we were talking about, the possible changes or how flexible this contract can be, and also about at what point things could potentially change? Are all parties aware of this?
Okay, so I think we should broadly also segregate an average restaurant into two broad groups. Okay. One is an aware restaurateur, and another is one who's not so aware.
Okay.
Which, I mean, some people are tech savvy, some people are not. Some people will get the intricacies of how a phone works, some people will not. Now, there is a clear mismatch of incentives. Look, Zomato and Swiggy are also large companies. They also distribute incentive responsibilities to what we call points of contact, who are the boots on the ground who actually interact with the restaurant partners, to activate these restaurants on or educate them about what the benefits are coming on the platform are. Many a times, it is the case that that points of contacts or POCs also push on products to you that you don't really need, because their incentives are actually lined with increasing the revenue for the company. So they will promise you the moon, deliver a tree, and there's not too much accountability coming from it, right? You also have to go into it with some sort of belief that the system works. The second thing is the burden of like reconciling accounts in terms of what I as a restaurant am supposed to be getting after deduction of all these costs is a nightmare. It is absolutely a nightmare. And I'm a fairly organized, like in the restaurant world, I'm a fairly organized player. So there are accounts teams that actually help me do this. But to a small restaurateur, I can understand how infuriatingly complicated just simply understanding how much money am I supposed to be getting back from the platform is after deduction of all of these fees. So what eventually happens is that there are these scrupulous small amounts that start creeping into your actual payout that you might not have been aware of. It's the burden of proof or the burden of questioning it is on you as a restaurant partner to tell them, hey, look, my numbers don't seem to be matching. And if you have to do this on a like the payout schedule for a platform is anywhere, it's a T+1. So it's either in 1 day or in 3 days or in 7 days, depending on how you choose to kind of take your payout back. So imagine having to do this exercise every day, every 3 days, and every week. Like, as you can see, I don't have much hair, despite of having a team to run it. But it becomes incredibly complicated. And I think it's complex also by design, so that little things start falling through the cracks. And when you report them, sure, they will probably say, oh, this has been a mistake, or this has been, like bad on our part. This is not supposed to be here or not supposed to. So I'm not saying that they challenge it to the point, but the burden of proof should not be ideally on us to the extent that it is right now.
Okay, so then Saurabh, if you had to give some advice, since you've been on the other side, what would you advise to restaurant partners? What would you advise to those working in the gig economy? How do they stay aware? You spoke about consumer awareness, but what about the other side?
I think my only advice to the restaurants will be figure out the working equation with the food aggregator platforms. Okay, because if I give a counter view of that, in case these restaurants are not on the food aggregator platform, then what options do they have? What choices? They cannot have a seating capacity of maybe 1,000 orders a day, right? They would have a limited capacity. They have to invest in the infrastructure. They have to invest in many things in the manpower. If they wish to go completely offline, if they switch off their online aggregator or say online delivery platforms. The second thing is that once, as Thomas mentioned, that they have to be super clear on what they're getting into with the food aggregator platforms. These agreements are there. Okay, the numbers are there. They have to be crystal clear of what numbers are, and when they go and invest into ad clicks or some other campaigns which are planned by food aggregator platforms, Zomato and Swiggy, they have to be aware whether this is hitting their margin or whether there is a chance of getting an intrinsic futuristic value with the investment they are making today. A lot of restaurants that we know and a lot of merchants in this space, they invest maybe 2 days a week or say 2 days a month, but they know that once they hit the customers right, these customers, the lifetime value of these customers will tend to grow on these platforms in future, right? So, and every time they don't have to invest the same thing. So crack that working equation, that how you need to run the business on food aggregator platform. And the example of such, changing consumer behavior is right in front of us. I mean, a lot of merchants, and the reason, even this segment is taking a hit because of sudden rise of the quick commerce platforms as well. That's another level of convenience which has been added to the consumer behavior. So all I can say is the best person who is reaping all the benefits day in, day out are the customers who out of nowhere, without much of awareness, they're still utilizing these platforms like Zomato, Swiggy, Zepto, Instamart, Blinkit, and getting their demands fulfilled all the way from the large merchants to the smaller merchants. So figure out that working equation. I think there is a path to profitability, even though surviving with this aggregator channel.
Thomas, can restaurants survive off platform while competing in a delivery driven market?
I think so. I think it can survive because we have been eating food. People have been going out to eat. Zomato, Swiggy did not invent food delivery by any measure. We have been delivering food to people's homes for a very long time. And I think it will continue to with or without the platform as they exist today. Saurabh raised two interesting points. One, it is a very valid question. And I think it is something that we also should ask ourselves inwards. That, look, the fact that we don't have a choice to deal with someone rather than to just deal with two platforms doesn't really make it fair. So I think we have to maybe zoom out a little bit and not be comfortable with the fact that, well, you really don't have a choice but to be on Zomato, Swiggy. So what are you going to do? No change has ever stemmed from accepting the status quo. Number two, he spoke about the lifetime value of the customers. Today, we have no idea who these customers are because Zomato and Swiggy also blocks us away from those customers. So the only interaction point, and this is also by design, this of customer defensiveness, is that tomorrow if I want to leave the platform and I want to maybe market to customers who have ordered from me in the past, I have no means of doing that because Zomato Swiggy does not share that information with me. Secondly, if I want to tell the customer to also order from me directly because the experience could be better, either from a value proposition or from a pricing perspective, there are clear terms on the agreement that says that we will penalize you to something as an amount as high if you advertise your own direct delivery while on a Zomato or a Swiggy order. So make no mistake over here. There is some pretty devious behavior that platforms are also doing to protect their turf. I don't think that all of them are in the interest of, driving innovation. It is only in the interest of protecting their turf. And I think it also stifles competition, right? Like it also stifles competition from a perspective of, can there be a third part, platform that comes in? And I think the time is right for maybe a third alternative to kind of
putting that on national television and out into the universe. I'm afraid we're completely out of time, but thank you so much, Thomas, Nirupama and Saurabh, for this extremely insightful and razor-sharp discussion on Zomato and, of course, several other platforms, or like we're talking about the two platforms, whether they're starving small restaurants, businesses and the gig economy. More on the other side of this short break, but thank you so much for watching The Big Question.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest
ಬರಬೇಕು ಅಂತ ಅವ್ರದ್ದು ರಿಕ್ವೆಸ್ಟ್ ಇತ್ತು. ವಿ ಡಿ ನಾಟ್ ಅಲೋ, ನಂಬರ್ 1. ತಿರ್ಗಾ ವಿಧಾನಸೌಧದಿಂದ ಬರಬೇಕು ಅಂತಿತ್ತು, ಅಲ್ಲೂ ಮಾಡಲಿಲ್ಲ. ನಾವು ಪರಿಸ್ಥಿತಿ ನೋಡ್ಬಿಟ್ಟು ನಾವ್ಯಾರು ಭಾಷಣ ಕೂಡ ಮಾಡಕ್ ಹೋಗ್ಲಿಲ್ಲ, ಅವ್ರಿಗೆ ಅಭಿನಂದನೆ ಸಲ್ಲಿಸಕ್ ಹೋಗ್ಲಿಲ್ಲ. ಅವ್ರಿಗೆ ರಾಜ್ಯದ ಪರವಾಗಿ ಗೌರವ ಕೊಡಬೇಕು, ಕೊಟ್ಟು ಇಲ್ಲೂ ಅಷ್ಟೇ ನಾನು ಅವ್ರಿಗೆ ಡೈರೆಕ್ಷನ್ಸ್ ಕೊಟ್ಟೆ. ನಮ್ಮ KCA ಸೆಕ್ರೆಟರಿಗೆ ಪ್ರೆಸಿಡೆಂಟ್ಗೆ ಎಲ್ಲ ರಿಕ್ವೆಸ್ಟ್ ಮಾಡಿಕೊಂಡೆ, ವಿತಿನ್ 10-15 ಮಿನಿಟ್ಸ್ ವಿ ಶುಡ್ ಕ್ಲೋಸ್ ದಿ ಫಂಕ್ಷನ್ ಅಂತೇಳಿ. ಅದಕ್ಕೆ ನಾನೇ ಬಂದು ಇಲ್ಲಿ ಇದ್ಕೊಂಡು ಇಲ್ಲಿ ಯಾರು ಏನು ಮಾತಾಡದೆ ಒಂದು ರೌಂಡ್ ಮಾತ್ರ ಮಾಡಿ ಸೆಕ್ಯೂರಿಟಿಗೋಸ್ಕರ ಅವ್ರಿಗೆ ಬಂದಂಥವ್ರಿಗೆ ಅಭಿನಂದನೆ ಸಲ್ಲಿಸಲಿಕ್ಕೋಸ್ಕರ ಮಾಡಿ ಆದಷ್ಟು ಜಲ್ದಿ ನಾವು ಮುಗಿಸಿದ್ವಿ.
All right, as we said, of course, questions are being raised and politics on this has already started. BJP has hit out at the government for this hurried program. B.Y. Vijendra, who is the BJP president of Karnataka, is speaking at this moment. Listen.
ನಿನ್ನೆ RCB ಫೈನಲ್ಸ್ ಗೆದ್ದಾಗ ನಡಿ ದೇಶದಲ್ಲಿ ಸಂಭ್ರಮಾಚರಣೆ ಆಯಿತು. ರಾಜ್ಯದಲ್ಲೂ ಕೂಡ ಲಕ್ಷೋಪಲಕ್ಷ ಸಂಖ್ಯೆಯಲ್ಲಿ ಸಂಭ್ರಮವನ್ನು ಆಚರಣೆ ಮಾಡಿದ್ದಾರೆ. ಆದರೆ ದುರಂತ ಅಂತ ಹೇಳಿದ್ರೆ ಇಂಥ ವಿಜಯೋತ್ಸವ ಆಚರಣೆ ಮಾಡತಕ್ಕಂಥ ಸಂದರ್ಭದಲ್ಲಿ ರಾಜ್ಯ ಸರ್ಕಾರ ಸ್ವಲ್ಪ ವಿವೇಚನೆಯಿಂದ ನಡ್ಕೊಳ್ಬೇಕಾಗಿತ್ತು. ರಾಜ್ಯ ಸರ್ಕಾರ ಇದು ಏಕಾಏಕಿ ಇವತ್ತನೇ ಯಾವುದೇ ಒಂದು ಪೂರ್ವ ತಯಾರಿ ಇಲ್ಲದೇನೆ ಇವತ್ತು ಸಂಭ್ರಮಾಚರಣೆ ಆಯೋಜನೆ ಮಾಡಬೇಕಾಗಿತ್ತ ಅಂತೇಳಿ ಒಂದು ಕ್ಷಣ ಯೋಚನೆ ಮಾಡಬೇಕಾಗಿತ್ತು. ಬಹಳ ಅನ್ಯಾಯ ಅಂತ ಹೇಳಿದ್ರೆ ಇವತ್ತು ವಿಧಾನಸೌಧದ ಮುಂದೆ ಸಂಭ್ರಮಾಚರಣೆ ನಿಮಗೆ ಗೊತ್ತಿರೋ ಪೊಲೀಸರು ಅನುಮತಿನೂ ಕೂಡ ಕೊಟ್ಟಿರಲಿಲ್ಲ. ಪೊಲೀಸರು ಯಾವುದೇ ಕಾರಣಕ್ಕೂ ವಿಧಾನಸೌಧದ ಮುಂದೆ ಸಂಭ್ರಮಾಚರಣೆ ಬೇಡ, ನಾವು ಕ್ರೌಡ್ ಅನ್ನ ಕಂಟ್ರೋಲ್ ಮಾಡೋದಕ್ಕೆ ಸಾಧ್ಯ ಆಗೋದಿಲ್ಲ ಅಂತೇಳಿ ಪೊಲೀಸ್ ಹಿರಿಯ ಅಧಿಕಾರಿಗಳು ಹೇಳಿದ್ರು ಸಹ ಮಾನ್ಯ ಮುಖ್ಯಮಂತ್ರಿಗಳು ಹಿರಿಯ ಪೊಲೀಸ್ ಅಧಿಕಾರಿಗಳಿಗೆ ಒತ್ತಾಯ ಮಾಡಿ ಆಗಲೇಬೇಕು ಅಂತೇಳಿ ಆದೇಶ ಮಾಡಿದ್ಮೇಲೆ ಒತ್ತಾಯ ಮಾಡಿದ್ಮೇಲೆ ವಿಧಾನಸೌಧದ ಮುಂದೆ ಇವತ್ತು ಸಂಭ್ರಮಾಚರಣೆ ಕಾರ್ಯಕ್ರಮ.
जो दो चूक लग रही है, क्योंकि आप तो हर एक फंक्शन में रहे
रखा गया, बिल्कुल अचानक प्रोग्राम नेक्स्ट डे ये प्रोग्राम हो गया. 1-2 दिन के गैप पे नहीं था, नेक्स्ट डे प्रोग्राम हो गया. और उन्होंने भी उम्मीद नहीं की होगी तो ये होगा कि स्टेडियम में जैसे पिछली बार हुआ था वानखेड़े में कि लोग स्टेडियम में बैठ गए तो उसके बाद कार्यक्रम हो गया. तो सोचा कि स्टेडियम के अंदर लोग बैठ के 30-35-40 हजार लोग अरे देखेंगे, लेकिन लाखों लोग उमड़ पड़ेंगे इसकी संभावना नहीं थी. तो ये जो है एक बहुत बड़ी बात है और एक सबक भी है सबके लिए.
बिल्कुल शुक्ला सर, एक और चीज कही गई है कि बाहर अनाउंसमेंट कर दिया गया फर्स्ट कम फर्स्ट सर्व की तरह से. जैसे रेलवे स्टेशन पे आपने अक्सर सुना है कि 1 नंबर की गाड़ी 4 नंबर पे आएगी. ये एक बहुत बड़ी वजह है जो हमें बताया जा रहा है.
राजीव शुक्ला जी हमारे साथ थे.
Of course, one of the prominent faces as far as the cricketing world is concerned,
of the BCCI.
and likely to take over as the president of the BCCI as well. But Veera Raghav and my colleague Haripriya both are with us at this moment. Just let me first quickly go across to Haripriya. She's at the hospital where some of these people. All right, we have lost that line with Haripriya, but Veera is with us. Veera, already the BJP is raising questions. Of course, there will be questions raised, but the fact at this moment remains that the focus is on the number of people, those who have been injured, and the situation which is on the ground at this moment.
Well, at the moment, it all seems under control because they've started fireworks, and I think those who had to leave had left from that place. We'll give you an update on that, but I think obviously questions will have to be raised. I heard DK Shivkumar there. I heard BY Vijayendra there speaking. Leave the politics aside for the moment. The question really is that the kind of frenzy, was it expected? A. B, if it was, even if it wasn't expected, as DK Shivkumar pointed out, it was perhaps extremely wise to have not had that open chariot celebration, because that could have resulted in enormous chaos. But really the point, Ankit, and I can tell you from about 4 o'clock, I was sure that there was something, and I had indicated as well that this was not a very conducive atmosphere, because the kind of crowds that had gathered there was no traffic diversion. Cars were still plying through that way. It just started swelling, and then people started.
That line with Veera, will go across back to him. Haripriya is also with us. Haripriya, you are at one of the hospitals. What's happening there? What is the latest?
I'm here at the Boring Hospital in Bangalore, and about 14 to 15 people have been admitted here of serious injuries. Of what we know, about 7 people are confirmed dead. We had the Home Minister of Karnataka, G. Parmeshwara, and the Chief Minister, Siddaramaiah, come to the hospital here. The situation is pretty intense, and the political involvement has gotten intense. So far, both of the ministers have not spoken, and they have just rushed inside to take a stake of the situation here. There's also B. Vijayendra, who's the son of Yediyurappa, former Chief Minister Yediyurappa of the BJP, who's here, and who's also trying to take stake of the situation, and then also questioning the ruling party's measures to stop this from happening. We see ambulances coming in. Just saw two of them come in, so it's only increasing. What is confirmed is about 14 to 15 people are here right now, and 7 of them are announced dead.
It's a big question, Osama. While 11 people have died outside waiting to catch a glimpse of the fans, should at this moment this entire routine of felicitation and the celebrations inside would have taken place? Because I'm not too sure if the fans, if the players would know, but these days with phones and social media, it takes seconds before you have access to that kind of information. Should this have gone as business as usual? That is something that needs to be addressed, needs to be questioned.
It is heartbreaking contrast, as you rightly mentioned, Ankit. Thousands of people, they are cheering inside the stadium, celebrating this title, while 11 people have lost their lives. Many people have been injured. Many more families, they have been devastated, and this is really, really sad. These fans.
All right.
We have Mr. Arun Dhumal joining us on the phone line. Sir, this is not what we were expecting. We were expecting a happy celebration for the first time winners, and what we are witnessing right now, it is absolutely chaotic. People have lost their lives. The big question is, while we know that people have lost their lives outside the stadium, the felicitation is still going on.
Indeed, very sad and tragic. The moment I got to know, in fact, we had no knowledge of any such victory parade or celebration happening in Bangalore, because the event got finished last night only, and whatever celebration was to take place, it happened there. I don't know who organized it. Then the moment we got to know of it, we spoke to the management and told them, and in fact, they were not aware of what has happened outside, and they assured us that they are immediately calling it off.
Can I ask you this, because it possibly would have been expected that the city which has won, the team which has won, would want to go back to their home stadium and celebrate. But the fact remains that, like Osama was saying, while at a time it is known that so many fans have lost their life, mismanagement is being questioned. Should they have continued with this kind of an event at this moment, with the players speaking and the song and dance happening inside?
No, definitely not. And like I told you, because the moment I spoke to their officials, they didn't know of what has happened outside the stadium. They were not aware. So when they got to know of it, it assured me that they are going to wind it off immediately.
Sir, have you been able to speak to officials in Bengaluru, in Karnataka as well, with what has happened? Because, precious lives of cricket fans have been lost.
No, definitely. It is very sad and tragic. And first of all, I would like to convey my heartfelt condolences to all the families who've lost their loved ones. And as soon as I got to know of it, I spoke to RCB officials and they assured me that they are winding off the event.
Do you think, sir, this was put in place in hurry and that's the reason why they could not anticipate the number of people who came in, and that's the result at this moment, a tragic turn of events?
We are not even aware whether somebody had planned this event or these fans came on their own thinking that, they'll be coming with the cup there. So this would be looked into once we get to know of how it was planned, who organized it, and how come such a huge fan crowd came to the stadium.
Is there a protocol, sir, that is put in place? Because this is not the first time that IPL is happening. Of course, it's been 18 years. And after the victory, is there a protocol? Does the body of IPL need to be informed by the authorities if there is some celebration planned, the victorious team?
See, for BCCI, IPL ended last night. How it has to carry it forward is by the respective franchise. This has never happened in the past. So this is, I would say, the lessons learned, and whatever we need to take care in the future, we'll definitely take a note of it and see to it. But when you have all the bigwigs of the state government being there, I'm sure all the protocols would have been there.
Mr. Dhumal, do you feel that there was a sense of hurry from the government in order to get some political mileage out of this event?
Not want to comment on that. This is not my job to comment on whatever the political parties or governments wish to do. But it is indeed very sad, and I would like to convey my heartfelt condolences to all the families.
Would this trigger some, policies in the future, sir, as far as IPL is concerned?
I'm sure whatever is required to be done from our side, we'll take a note of it. And whatever is required to be done by the state governments in case of any such event, they would also take a note of it so that precious lives are not lost like this.
Thank you, Mr. Dhumal, for speaking to us. In fact, at this moment, the IPL chairman speaking to NDTV, very clearly saying that they had absolutely no idea about this event being put together. He also said that importantly, and let me reiterate what he said that he spoke to the RCB franchise, management. They had no idea about the tragedy that has struck outside in the Chinnaswamy Stadium, and they also assured him that they are going to wind up the event very, very soon, because no matter how big a fan of cricket or RCB you are, ladies and gentlemen, you would not want to be celebrating at the time when 11 families at this moment, many of them would not even know till very late in the night that their loved ones are not coming back home. This is absolutely tragic and unfortunate.
Absolutely. And Mr. Dhumal, also, there mentioned that the players, they were not aware of what has transpired outside, and the moment they got to know about it, that the event had been called off, and that is something that the
we'll have to confirm whether that is happening or not, because just a short while back, Veer Raghav was telling us firecrackers were on, the entire event was going on as usual.
Deepak Bopanna is also there with us. He's joining us at this moment.
All right, Deepak, if you can hear us, just go ahead.
See, 2 of them are between 20 to 24. One more will be like 28, 30, and one more is all are between 20 to 30 range.
Okay. And what was their condition when they were brought here, ma'am?
Nothing, no pulse, no BP. Anyhow, we have done our ACLS protocol, we have done all resuscitative measure, but we could not revive them.
As far as the injured are concerned, how many people were brought injured? Are they still being treated? What's their condition?
In that, they are all stable. One is being admitted here just for a minor injury like brachial plexus injury. Otherwise, everybody is stable now. Some were even treated in OPD basis and sent home. Others, they had a suturing, 1 or 2 sutures on the head. That's all.
So among the injured, there's no possibility that someone could lose their lives in terms of the number going up. So they're all fine.
40 remaining.
Unfortunate news.
Like 12 people are all stable.
Okay.
Only 4 were brought dead.
Okay. Okay. And as of now, are you hearing anything from the officials? Have they asked you to prepare in any manner? Are there more injured who likely could be brought into the hospital?
If they are coming also, we are prepared for it. No need to worry.
Thank you for speaking to NDTV. Well, that was the doctor here. Madam, if you could also tell me your name, madam.
I am Dr. Humera. I am the medical administrator of VSH.
Oh, well, that was Dr. Humera from the Vaidehi hospital confirming here that 4 people were indeed brought dead. When they came here, there was no pulse is what I'm being told. Let me speak to a few people here. You all came to the stadium. Could you tell us how the situation was? Was it bad? Everyone tells that, preparations probably could have been done better. Were you all near the Chinnaswamy Stadium or close by? Could you all confirm how the situation was?
बहुत ज़्यादा भीड़ था, बहुत ज़्यादा भीड़ था, रश था, सब तरफ आदमी चढ़ रहे थे एक दूसरे के ऊपर। तो पुलिस ने फिर भी काफ़ी अच्छा काम किया, पर संभाला, फिर भी भीड़ कंट्रोल नहीं हो पा रहे थे।
आप किधर थे जब ये स्टैम्पीड हुआ? आपने देखा कुछ?
इतना तो कुछ देखा नहीं, बस एम्बुलेंस आ रहे थे तो रास्ता क्लियर कर रहे थे।
एम्बुलेंस को अंदर जाना था, वो लोग उधर गेट के आगे से हट नहीं रहे थे।
किधर?
जो
चिन्नस्वामी के पास या
स्टेडियम का गेट था ना, उधर से लोग हट नहीं रहे थे, तो मतलब लोगों को हटाने के लिए पुलिस ने थोड़ा कुछ लाठीचार्ज को स्टार्ट किया शायद। मैंने जब तक देखा वहाँ तक तो लाठीचार्ज स्टार्ट करने से वो लोग थोड़े भाग गए उधर उधर, तो भाग दौड़ में शायद कुछ हुआ है, किसको लगा किसको नहीं लगा। हम लोग थोड़े दूर खड़े थे उससे, मतलब
पुलिस ने अपना अच्छा काम किया था, लेकिन पुलिस बात को सुन रही नहीं थे, बस वही दिक्कत था।
And many of them, of course, have gathered here because they realize that tragedy has unfolded. As we speak, you can see hundreds still walking because right now the metro lines have closed. We should also note that people are trying to walk back home. Tell me, in terms of arrangements, are you satisfied with the arrangements that have been made? Because right now 11 deaths have been reported because of the stampede. The metro lines have closed because of overcrowding. You're having to walk back. Tell me how was the situation wherever you were? Where were you firstly?
To be honest, we got down near Vidhan Saudha. We tried to get in there. There was a lot of traffic. We couldn't do anything there. So we walked towards the stadium. We had our passes, but to be honest, because of the crowd, we couldn't get in. So we had to walk back.
Where you were, did you feel anywhere unsafe? Was the crowd behaving unruly at that point? Was there enough police to manage the situation?
To be honest, we couldn't even get into the stadium because the crowd was so much. Police were around, but I'm pretty sure even they couldn't handle it. There were a lot of people. Pretty sure they tried their best, but nobody could handle it. There were a lot of people.
The crowd, it is too much now today.
Now, yes, it was time for celebrations, but right now 11 people have lost their lives is what we're picking up. Of course, as RCB fans, this is not something that we would have wanted.
Yeah, that is not sure about, we are not sure as of now.
Yeah.
Anyway, we tried there, but we couldn't go, even though we had passes.
I'm sure we couldn't do much.
Absolutely, because the management should have been better in terms of crowds. I hope you all get back safe. Young kids like this, where were you when you were in the crowd? Were you safe there, or was there a lot of pushing and pulling? You felt safe?
Yes.
Well, he says he felt safe. You were near Vidhan Saudha or near the stadium?
No, I was near stadium.
You were near the stadium. Around what time were you there?
Around 4 o'clock.
Okay, around 4 o'clock the situation was pretty much better. Tell us, where were you? Because right now we are hearing of multiple locations where stampedes were happening. Many people have lost their lives. Were you safe where you were?
Yeah, we were safe. Yeah.
Where were you the last couple of hours?
I think we were at the VIP gate from where the bus entered.
Okay, and everything was okay there because we heard that there was a little bit of a stampede sort of a situation.
The situation was really tight. Actually, everyone was pushing around. After seeing the crowd, I thought we should just come out because breathing space wasn't there. Even at an open space, we couldn't breathe there actually. So it wasn't a fair thing.
Do you feel arrangements in any manner could have been better than what you saw?
I think so. They tried their best. The number of people that gather around was out of control actually. And then if the space is this much and the number of people is this much, I don't think so. The suffocation was too much for everyone.
Yeah, in fact, it's probably the largest crowd that I've also seen in Bengaluru. They're saying right now at least 11 people have lost their lives. This is not how we probably wanted to celebrate.
Yes,
it was a day for a celebration for the people of the city. Now it's turning into a tragic situation. Tell me right now, as you all try to walk back because there's no transport, I believe that you were trying to take the metro as well. How are you trying to get back now?
We are still walking. We are not getting any cabs, not autos, nothing. Even the buses are full.
Yeah, and where do you all live?
Banchankri, second stage.
So quite a long distance for you all to go. Thank you for speaking to us. A lot of issues now. No transport. Buses are full. Metros are closed, in fact, because they're overcrowded. There's also a situation where at the hospital people are lining up. Not sure if the families are aware right now because not very clear if identity cards were found on the people who were brought in as well. The doctor who spoke earlier to NDTV, of course, confirmed that all of them who were brought here, whatever efforts that the doctors put in, they were not able to revive them. It was a very difficult situation for the doctors. One good news coming out of the hospital is that those who were brought in injured, they are out of danger. The doctors, the medical teams here are doing everything that they can to provide the best treatment is what I'm picking up. There are at least 7 people who've been brought there to the Bowring Hospital. That's a little distance from where I'm standing, and crowds continue to come in. You can see right now without public transport being available, no private transport as well available because of the sheer number of people that turned up. People now forced to walk, and many of them live 10 kilometers away, 5 kilometers away. The only option is to walk now. Many questions could come up right now. Many of them I spoke to, they said that the police tried their best. The crowds were really overwhelming. Yes, it was. It's probably in the last about 4 decades that I've been in the city, I've never seen a crowd like this. And if this sort of a crowd was coming in, there had to be massive preparations. That's where the police themselves had expressed some apprehensions about even allowing for an open bus parade this morning. While there were plans to do it, they suggested against it. Even then, an open bus was brought to Vidhan Sauda, not sure why. And one more question that could come up is whether this felicitation ceremony at Vidhan Sauda, the Grand Steps, was really required, because it made 2 different locations where the event was taking place. Crowds were gathering at these 2 locations, and then there was overcrowding as well. Now the police, of course, trying to disperse the crowds to who are gathered at the hospital. So definitely a lot to look at politically as well. Things are developing with the BJP now blaming the state government for this situation.
Deaths happened outside the stadium while celebrations continued inside. There were felicitation that was going on. The big question that everyone is asking, are these photo ops more important than fans' lives?
Absolutely. We are slipping into a very short break, ladies and gentlemen. We are coming back with our continuous coverage on what is happening in Bengaluru.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit. The markets move fast.
And so should your portfolio. Expert
Well, a rare confluence of structural tailwinds make India a great long-term story. This, in a very simple nutshell, is how I would classify or call one of the key reports that has come out of the stable of Bank of America. And as we sit in the venue of their India Investor Conference, it's an absolute delight to speak to Amish Shah. As he outlines, how does he think India stands in the investing pecking order from his perspective, and what has the conference been all about as well? Amish, great having you. Thank you so much for talking to us. And thank you for having us here.
Thank you for coming down, Neeraj.
No, the pleasure is entirely mine. Amish, so tell us, we'll come to the note as well, but I just want to get the rumblings of the conference. I hear from your team and from others that this has been an unprecedented attendance, both from the corporates as well as the investing community. Tell us a bit about the conference. What was the theme showcased or the principal messaging, and what is it that you've told both investors and corporates?
Sure. So Neeraj, meaning as you know, we restarted our India conference, for the last 3 years. It's only kept on becoming bigger. This year, we are hosting 107 corporates. We have about 450 investors. There are 21 plenary sessions, and there are already 1,500 conversations that have happened between investors and corporates. But we are not stopping. As our conference comes to an end today, but we are continuing for the next 2 days through this week with 6 field trips. So these are investors who want to see the real India.
Okay.
So they want to go and see a manufacturing facility. So there's a manufacturing tour. Or you want to go and talk to the dealers, distributors on a consumption tour. I'm myself hosting a policy tour where we will have all the key bureaucrats or the policy makers, speak about what are they thinking about, how they want to drive the policy making going forward. So there are 6 different themes across different sectors, and then we will be continuing with those trips as well. Coming to the theme of the conference.
So sorry, just before we get there. So it's interesting, Amish, that all of this is happening, and this unprecedented India interest, if I can use that term loosely, is happening at a point of time when Amish is telling people that the Nifty's done its course and we don't see much upside. So there is wide India interest despite the fact that the markets may not have near-term gains.
Absolutely, because everybody wants to keep India on its radar.
Okay.
Back in the time, like let's say if I rewind 5 years back, India's weight in MSCI emerging markets was only about 8.5%. Now it's close to 20%. So it's no longer a market that, even as an emerging market fund manager, obviously as an India dedicated fund manager, you want to know what's happening in India. But even as an emerging market fund manager, 20% is a pretty large weight. We are just a shade below China now. China is about 24%, right? So it is a market of relevance. You may not want to invest immediately, but you want to keep it on your radar. You also want to meet these companies, do your homework, find out what is a price at which you will ideally buy these companies, and if these prices were to come, then you have to be ready to jump onto it, because Indian markets, as we know, is a structural growth opportunity. It won't give you that opportunity for long, so you have to be prepared for it. So absolutely, from an interest perspective, therefore, despite full valuations, and we'll speak about that, definitely a lot of interest right now.
Okay, now the theme of the conference. What is it that you are telling your set of investors who are coming? I heard 450 the number, so that's a very large number. What is it that you're telling investors about? Why is it, or what is it that within India they should see? What's the central theme of the conference?
So the central theme is about accelerating growth, and we have named that because we think that we are now all know that over the last 3-4 quarters growth did come down, and there are a variety of factors to that. The most commonly being spoken about is that there was over tightening of fiscal, there was an over tightening of monetary policy, and as a result that led to some growth come off, and then there was credit growth contracting as well. So a confluence of all of this led to corporate earnings growth coming off as well, but everyone expects the growth to now accelerate because the monetary policy has completely turned its course. We are now talking about lesser regulations, more liquidity, lower rates, and so on and so forth. In fact, there's a possibility for even a fiscal stimulus now, because RBI has given dividends which are slightly higher than what the government had budgeted. Crude prices are lower. As a result, government has hiked the excise duties on the petrol and diesel at the pump. That gives additional sources of revenues to the government. So all of this put together, there is therefore a question on whether the government now has a room to go and spend that money and do a small fiscal stimulus on the back of it.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India.
Hello and welcome. You're watching Ask Profit on NDTV Profit and I'm your host Himakshi Bahuguna.
And I'm your host Malika Mishra, and along the next 1 hour viewers, we will be taking up all your stock related queries. So do not forget to call us on the numbers flashing on your screen. You can also write to us on WhatsApp, but we do urge you to pick up your phones and call us straight away on the numbers available to you. And on that note, I'd like to introduce you the guest of this evening. Mahesh M. Ojha joins in on the fundamentals, and our technical expert will be joining us shortly. But till then, hi Mahesh M. Ojha, thank you so much for joining us this evening. Let's get straight to our first query. Venkat has written to us from Tirupati. He is asking whether this is the right time to enter BSE. Mahesh, I have noticed a lot of investors are kind of curious if this is the right time to enter BSE, especially before NSE maybe comes to the picture, and BSE has been trading in a attractive zone for some time now. Do you suggest investors to take fresh positions in this particular company?
Good evening. I think BSE is overvalued in comparison of NSE also, if you are comparing with world exchanges also. So BSE looks little bit expensive. So I think on new investment, investors should wait. If any stock cool down, then they should try to buy new fresh. But if you are holding, then you can hold because it's also running day by day, so profit will be increased. So from new buy view, I think investors should wait for some cool down in the stocks.
Okay, thank you so much for that. Now we have another WhatsApp query written to us from New Delhi. Chandan holds 2,500 shares of Capacite Infra at 337 rupees. He's looking for a 2 months view on the counter. Currently it's trading at 332, fallen from the rates at which he had bought at. Looking at the charts, Mahesh, if you could just tell us about the technical aspect of it, because I can see that after witnessing a high around 21st of April, the stock is moving in its downward trend now. So what's your sense on the counter?
I think he sort of stop loss nearby 314, 316 zone. A little bit consolidation could be here. I think the stock could touch 348, 368 if any upside will come. So lower stop loss 314 keep, and upper side range could be 348, 360. On upper side range, your investors should try to exit on the same.
Right, and next up we have Arun, who's written to us from Kerala. He currently holds 1,400 shares of GAIL at 190 rupees a piece, and is asking for a short-term query on this one, like a short-term view on this one for the next 2 to 3 months. Now, GAIL was about 1.25% down in trade today. Mahesh, speaking of the fundamentals of this, of course, would you be able to give us a target price for the next 2 to 3 months, depending on how fundamentally the company has performed?
Counter like GAIL is very slow moving counter. So I think on a 2 to 3 month, if you're looking from a 2 to 3 month, then technical will be supporting much more than the fundamentals. I think in lower, if you are holding, then you can keep stop loss nearby 182. On upper side, range 198,208 level could be watch out for a 2 to 3 month at least. About 208, we can see 220 level. So currently, GAIL is on the mid verge. So I think 182 could be a stop loss. Up in upper side 198 first level, and above that 208 level could be touched.
Okay, thank you so much for that view. With that, we have a query, again WhatsApp query. So Arijit holds 15,130 shares of ITC at 397 rupees. And he is sitting on a profit of over 3 lakhs rupees there. So he hasn't mentioned the time horizon. So firstly, I'd like to take the fundamental view on it. Our technical guest will be joining us shortly. So Mahesh, if you could just help us with the fundamental view on ITC.
See, counter like ITC is much more beneficial if you are holding from a longer term perspective. I'm not saying about 1 to 2 to 3 months, but if you are holding more than 12 or more than 1 year, so I think investors should wait some more time. And if your investor is taking a position in ITC, I think their horizon is more than 1 year. So from 1 year perspective, I think 500 level could be touched easily. Above 500 level closing, we can see up to 540 range. So from my perspective, still hold from a longer term perspective.
Okay, and with that, let's welcome Sarvendra Srivastav, who is joining us as a technical guest for the show. Welcome to the show, Sarvendra.
Very good evening.
Good evening.
To the panel. Yeah.
Yes.
Tell me.
Sarvendra, actually, we were discussing about ITC because, there's this query by Arijit. He holds 15,130 shares of ITC. He bought it at 397. Currently, he is sitting on a profit of over 3 lakh rupees there. So what's your suggestion? What are the charts suggesting, Sarvendra?
So I'm afraid the kind of gap down that I see over the last week, I think I would say that the stock has broken the medium term and long term supports also. So my sense is that this is a sell on bounce, and I don't see it closing. The momentum is now shifted on the downside, and I don't see any upside momentum building in unless it crosses 430. So 430, 435, that's a big trigger. That should be the trigger if at all it has to go up. But I think it would be a tough ask. I think this gap should not get filled. Until that's not the case, I think all bounces here should be sold into. He should book some profits and take some money home because he's already come into this trend very late. Buying at 393, I would presume that he came very late to the party. The stock is already a stock which was around 150, 160. If he's entering at 390, I think at the fag end of the trend he came. So better that he books profit on a bounce.
Understood. Thank you so much for that, Mr. Sarvendra. And we have another WhatsApp query. Ramachandra has written to us from Guntur, and he currently holds 8,000 shares of Ramki Infrastructure at 491 rupees a piece. And I'm not sure whether he wanted a long-term or a short-term view, but let's take a 3-month outlook on this one. Our investor is sitting on a profit as close to 1 lakh rupees currently via this investment. And Sarvendra, just taking this question to you first, Ramki Infrastructure is currently trading around 503 odd levels, and it has climbed pretty much, like about say 11 to 12 rupees odd per share from the point at which our investor bought them at. And from the next 3-month perspective, would you suggest our investor to continue holding his positions, or should he book profits depending on how the stock has been fluctuating?
Absolutely. What is his price? If I can just get that, at what price did he buy?
491 rupees a piece.
Okay. See, I think I would congratulate him on the fact that he came. He had that patience and let the stock correct, and something which has corrected from 1,000 to 500. You've already redressed 50%. So a lot of what do you call the correction? When we say a medium to long term correction, I think 50-60% is what you would expect in a long term trend, that a retracement may not come. So in this case, whenever you're expecting a retracement, I think 40-50% on a fib retracement is a good place for supports, and I think the stock has done that. So he's taken a good trade. Now 1 to 3 months, this being a slightly illiquid stock, I think 1 to 3 months, I would say that since he's got it at a good price, I think he should have a slightly higher horizon around 3 to 6 months. If he holds, I think he could get a very decent pullback, and you could get targets in the region of 630, 650 also. But in that case, I'll tell him, since he's already in profit, and it's criminal to make a loss in a profit stock, if he can trail his stop loss to his cost, so that at least he gives the time. He gives the time that he gives some time to the trade to mature, and in the meantime, he can take the stop around his cost or slightly lower, and minimize his risk. Then he might make a very good profit going forward.
Okay, thank you so much, Sarvendra, for that. With that, we are joined by a caller from Tamil Nadu. Hi, Naveen. Good evening.
Hey, hello, good evening.
Yes, how can I help you today on the show?
So I want to, I'm looking for like a momentum investing into solar industries.
Okay.
Roughly maybe like 50 to 100 shares.
Yeah.
I can see the share is going up.
Yes.
Like 1% every day.
Yeah.
Last 20-25 sessions, it has gone 25%
Yes.
up.
Absolutely, yes.
And given the geopolitical scenarios, I don't think so. The scenarios are going to change. Can I invest like for a short term with a like strict stop loss, and then like what should I expect as a target?
Okay, so you are a
If there is
short-term
any.
investor.
I have long-term portfolio also, but this is something I'm looking from a like momentum play
Okay,
point of view.
okay, understood. So Sarvendra, rightly said, firstly, solar industries posted some great Q4 numbers. And if we talk about the order book also, it stands at 17,000 crore rupees, which is pretty strong. So, and the significant part is that since May 20th, the stock is moving, and how? From 13,489 to current levels at 16,809. For someone who wants to invest in this company, so are these the correct levels to enter, or the stock has reached its elevated levels? What suggestion do you have?
In the short term, he's missed the bus. It's very clear. He's missed the bus. Something which is run up from 9,000 to 16, 17,000, 8, 9,000 to almost double, I would say. So the short-term bus, he's already missed. So it's a no in the short term. I think the risk rewards don't justify a short-term trade here. Even a slightly longer-term trade also, I think we are very, very overbought on monthlies and weeklies. So I would tell him that possibly he's missed the bus here, and he should wait, have some patience, and possibly if there's a correction coming in, then possibly reassess and call us back again. And at that point in time, we'll be able to help. We will be able to help, but now, as of now, strict no in this time frame. We should not trade this.
All right, thank you so much for that, Sarvendra. And now we are being joined by Rahul from Chandigarh. Hi, Rahul. Good evening.
Hello, ma'am. Good evening.
What's your question today?
Ma'am, I want to inquire about Anant Raj.
Okay.
And I'm looking for a 3 to 6 month outlook.
Okay.
And want an advice if these are the current levels to invest in the stock.
Okay. And Rahul, why are you interested in Anant Raj in the very first place?
Ma'am, they have a good business share across different verticals, power and distribution. And they recently got a big order as well, and they are also trying to enter into semiconductor space, which is a good business going forward in India.
Okay, interesting. Mahesh, taking this question to you, Rahul from Chandigarh is interested to know about Anant Raj. What's your perspective on Anant Raj, and do you think, although it is diversified and maybe the financial metrics support the strong fundamentals that Rahul is hinting towards, but from your analysis, do you think it's a good realty play?
Firstly, I want to tell this is not the 3 to 6 month story. It's a story of 1 to 2 year and 3 year story. So it's a data center story, it's a land bank story, and many more in the place. So I think if anyone want to buy, they can buy on these levels. They should start in a staggered way, in accumulation in a staggered way. That is the beneficial strategy to buy any stock if you are buying from a longer term horizon. So staggered way buying is a good opportunity. From here, I think 520 to 550 range could become their accumulation can be done. But if you are buying Anant Raj, I think it's a 2 to 3 year story. On the 2 to 3 years downline the time, you will get much good return in this space in particular sector on a particular stocks. From my view, you can start accumulation in Anant Raj from a 2 to 3 year horizon, I think it's a good stock to buy from a 2 to 3 year horizon, and absolutely, I think you will make good money in Anantraj.
Okay, okay, all right. Then Sarvendra, my question to you is that if Mahesh's advice and analysis says that Anantraj perhaps is a long-term bet, a long-term story of 1 or 2 years, then do you think the fact that the stock price of this company has been consolidating since January of 2025 is a blessing in disguise for anyone who wants to enter?
See, again, coming to his time frame, just like the previous callers, the moment you give me a time frame, it becomes easy for me. For a 3-6 month horizon, as just rightly said by the other speaker, the risk rewards are not that great. Why? Because it was a 370 rupee stock like 7 weeks back. It was I think a 370 rupee stock, and right now it's close to 570, 600. In fact, we had a weekly high around that 595 mark, so almost 600. So momentum play is already over, and he said he wanted to play momentum. So momentum play is already over. Yes, you'll have to have some patience. I don't see the stock immediately breaking out from that 595, 600 area. So there might be a small cool off, little bit of cool off where you might get it close to 480, 500 again. That should be the area that you should be looking at. So just have some patience, and then if at all it starts running up from here, then you can next week onwards you can again call and check. But right now I think the bounce is over, and a small little correction is possible. So you'll get better prices.
Okay, okay. Thank you so much for that. We are joined by a caller from Bengaluru. Hi, Sonia. Good evening.
Hi, good evening.
Yes, please go ahead with your query.
So I am holding GRSC. I am holding 58 shares of GRSC, and my buy price was 1745.
Yeah.
I want to know a long-term view on this stock, and can I still accumulate it, or it has reached an overvalued state now?
Yeah. Because firstly, congratulations for spotting such brilliant levels there, Sonia. And you are sitting on a significant profit there. But for how long are you planning to hold, if at all?
For next 2 to 3 years.
2 to 3 years. All right, all right. So Mahesh, without wasting much time, talking about the fundamentals of Garden Reach Shipbuilders and Engineers, because she bought it at 1745. Currently, it's trading at 3356. And if we talk about today itself, the stock was up in trade, and if we look at the charts as well, it's up, moving in an upward direction. So what suggestion do you have for Sonia and other people, other investors who have invested in this counter? Should they be invested in this counter for another 2 to 3 years?
Firstly, I would tell you the fundamental of stocks looks slightly expensive. So I think some partial profit booking advisable on these level. But story is not over here. If you're a horizon in 2 to 3 year or more than 3 year, I think still if any downside, people can accumulate the stocks for a longer term horizon, because it's a valuation, it's a different thing, but outlook is a different thing. So from many sector outlook, many more thing which we can see in upcoming time that could be beneficial for stocks. But yes, as you bought in nearby 7,700 level and you are getting 3,400 level nearby. So I think 50% profit booking is advisable. If any downside nearby 2,800, 2,900, then they think to re-enter again. So I think some partial profit booking here is advisable. But yes, if your horizon is 2 to 3 years, I think we are optimistic for some good upside from a 2 to 3 year horizon. But yes, partial profit booking is advisable on these levels.
So partial profit booking is advisable, is what Mahesh is suggesting. And Sarvendra, do you also hold the same view? What are the charts suggesting?
See, it's a non-stop run-up for the last 8 years, from 80 odd levels to wherever we are right now, around 3,400 levels. So it's a fantastic return. It's a fantastic return in the last 8 years. It's grossly overbought when you look at monthly, quarterly charts. The stock's overbought. So thought here again, I would again agree with this is my regular strategy. If something's very grossly overbought and you've already made around 2x, 3x on that, so it's always good to book half your profits. If you book half the profits, then your price for the equity that you hold then is zero. So then you can hold it with great deal of peace, and you don't need to worry if you have a long-term view on that stock. Then you need not worry since you've already recovered your price. So that in that sense, I think she should book half. She can just be rest assured and not bother about, since she's also wanting to hold in the long term. If there's a God-given correction somewhere down the line, then she might use that money that she's kind of booked out here, and at lower levels she should start looking at that stock. So for me, that level will be around 2200, so slightly lower than Mahesh, but yeah, around 2300 you can start looking at the stock again. But in the meantime, you can book out half your profits. That makes your holding absolutely free.
Okay, all right. Thank you so much for that. And now we're being joined by Pradeep from Bengaluru. Hi, Pradeep. Good evening.
Good evening, ma'am. First of all, I would like to congratulate you on your brilliant show, because this is the only channel, I think, which gives at the same time both the technical and the fundamental findings of the experts.
Thank you. Thank you so much.
Now I am having, madam, 200 shares of IEX.
Okay.
Before that, I just want to tell you that I have been investing in stocks for the last 2 or 3 years. I'm a senior citizen, and I have a vision of another 2 to 3 years.
Okay.
So I have purchased this 200 shares of IEX at an average price of 171 rupees. Now, since my purchase about 3 years back, it has remained below my purchase price. But for the last 2 or 3 months, I have been seeing an upward movement in the price, and it is now more than my purchase price. So I'm a bit confused. So I wanted to know whether I should hold it for the long term or book profits.
Okay. Firstly, thank you so much, Mr. Pradeep, for giving us that compliment. It really makes our day and means a lot to us. And going to your query, Pradeep from Bengaluru, gentleman, holds 200 shares of IEX, Indian Energy Exchange, at 171 rupees a piece. And the stock has definitely climbed up to 202 odd levels. And this run-up has been witnessed in the stock price, especially in the last couple of months from March of 2025, if I'm not wrong. Mahesh, speaking of Indian Energy Exchange, Pradeep, being a senior citizen, has a horizon of 2 to 3 years in mind with regards to this particular investment. And the couple of metrics that I noticed that have really caught my attention is the fact that it has a healthy ROCE at 53.6% as compared to its peers, really signaling a good utilization of its capital. What's your perspective on this fundamentally, and would it be a good idea for Pradeep to continue holding this for the next couple of years?
I think stock is a good, and I have also checked from closely these stocks from in last week. So from current today, I think a closing of about 202 is technically good. Sarvendra will give you a good idea about this. From my perspective, stock can be hold if your horizon is a more than 1 year. 260 plus level could be a ideal target, should be keep in mind, and stop loss could be nearby 184 range. So profit still there is some profit should be kept in the pocket. But yes, from technical perspective, I think it's a good idea to hold from medium term also.
Okay. And Sarvendra, I'm really inquisitive to know what your technical analysis says here. And you were asking for a time frame. We have a time frame of 2 to 3 years, very strictly for IEX. And the kind of run up this stock has seen just in the past couple of months, do you think that is sustainable?
Very much. But I think looking at his profile, I think being a senior citizen, I think this is a slightly high beta stock. And it's a new age stock. So energy trading is a niche segment. Not everybody understands. Not everybody does. So in that sense, since he has picked up this, what you call unique stock in his portfolio, I think it's slightly high beta, not probably for his risk profile, but maybe he knows his risk profile better than me. We are talking for the first time. So I think the stock has consolidated well, and the setups look bullish. I would also tend to agree that 265, 270 would be initial targets for this move. And if you are able to cross those numbers and decisively break past those levels, I think in that case, you would have higher targets also in store, and all-time highs at around, I think they were around 310. So that those might also get challenged. So I think since he has this time horizon, I think he should stay in that trade. But as I always say, that since if you've done that hard work and you've had it for so long, then don't again get into a losing position. So in that case, I would tell him to possibly have a stop around his cost or slightly higher, so that at least he recovers his holding price. So some amount of cost of carry plus your cost price should be your stop loss, and hold for 3 to 6 months.
Okay, thank you so much for that. We are joined by Sethu on the phone line from Bengaluru. Hi Sethu, good evening.
Good evening to you. Thanks again for all the good job that you are all doing.
Thank you so much,
And
Sethu.
you're welcome. I would like to know about the Tata Motors. I hold 400 shares at the rate of 720 rupees. I want to know the short-term view on that.
Okay, and when did you purchase these shares?
I purchased about 2 days back,
Okay, okay. And for how long are you planning to hold it?
maybe a month.
Okay, just a month's outlook on it. All right. Sarvendra, again coming to you. Yesterday we came up, Tata Motors came up with its news that it has launched Harrier EV on its new Active Plus platform. And if we look at the charts, so Tata Motors have been, consolidating. And so are we looking for a breakout or a breakdown ahead?
See, breakdown already happened long back, and I will congratulate him again for having that patience. If you are buying at 1200 rupee, good stock, a good company, India's topmost, one of the topmost companies, if you're buying the correction, you're always at least safer than the guy who bought maybe a 900, 1000, 1100, somewhere who bought close to the top, because there were deliveries going at that time as well, and the volumes were brisk. So definitely, I think he's in a much better position than anybody else. He needs to keep some patience, because I think the clear-cut signals will come on the quarterly charts. So we still have another 25 days to go where those charts will mature. But I think as of now, monthly, quarterly setups look decent. After this big fall, definitely a decent pullback. If not a new rally, a pullback is definitely in store. So I would say 880, 900 is possible. He'll have to give it 6 to 9 months. And since it's a good delivery trade, he should hold.
Okay, thank you so much for that. And Mahesh, I'd like to come to you also. Talking about the auto space in particular, what are your top picks for long term for somebody who wants to invest right now?
Definitely, Tata Motor can be low, but from a upside potential perspective, I think M&M will be preferred. M&M data of M&M, if you are taking from last 2 to 3 years also, their number of sales also. So I think from in auto, my specific M&M and TVS Motor along with, because TVS is also gaining the market share. So I think both the TVS Motor and M&M are preferred. From Tata Motor perspective, I think Tata Motor is still facing some more challenges in their vertical, but demerger on card, that will be value unlocking, I think. So from my perspective, 820 to 850 range for a upside potential from a current view. So yes, some upside potential is there, but that is kept near 820, 850 range. So don't expect much more return from a current perspective from Tata Motor, but yes, M&M and TVS Motor, that can give you good return from in auto space.
Right, thank you so much for that view. And viewers, with that, we'll have to slip into a short break, but please keep sending in your queries and call us on WhatsApp. You can send us your queries on WhatsApp and call in. We'll be right back with Ask Profit on NDTV Profit.
Markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Hello and welcome back to Ask Profit only on NDTV Profit, a show that gets all your stock related queries answered. Today we're being joined by Mahesh M. Ojha on the fundamentals and Sarvendra Srivastav on the technicals. Welcome back, gentlemen. Let's talk to our very first caller right after this very short break. Nilay is on the phone line from Patna. Hi Nilay, good evening.
Good evening. I would like to know, I have a view about Bajaj Finance.
Okay.
I'm board of purchased 12 shares at 9,060 rupees.
Okay.
Only recently. There is a bonus and split issue announced. What should be the strategy on this?
Okay.
Both short term and long term.
Okay. And when did you exactly purchase these shares?
Around 4 or 5 days back.
4 to 5 days back. And what exactly motivated you to purchase them?
It has fallen and plus bonus and split has been announced.
Okay, so bonus issue. Understood. And now you want to continue holding for how long, Nilay?
That's what I'm asking, whether it should be long term or short term.
Or short term investor. Sure. Let's get you some help, Mahesh. Our caller Nilay from Patna currently holds 12 shares of Bajaj Finance at 9,060 rupees a piece, and he bought them a couple of days ago, solely perhaps motivated by the bonus issue that attracted him to the stock. But the fact that it is trading around its 52-week high, somewhere nearby those levels, do you think there's more leg room for profits for Nilay to make?
I don't think much more legroom for a Bajaj Finance from a 1 year perspective. From a 1 year perspective, I think 9,600, 9,800 could be capped from a current perspective. So I don't see much more upside potential from a 1 year horizon perspective. So if anyone buying on higher level, then I don't think they will make good money on Bajaj Finance perspective. So if any upside, my suggestion, try to exit if your horizon is very near, very medium term. From 1 year perspective, I think 9,600, 9,800 level could become for a Bajaj Finance.
Okay, thank you so much for that. With that, let's go across to a caller joining us from Gujarat. Hi Shivam, good evening.
Good evening, ma'am.
Yes, how can I help you today?
Yeah, ma'am, I'm having query with one stock that I purchased a couple of days ago.
Yeah.
Hero MotoCorp is the stock.
Yeah.
I bought a 50 stock at price of 4224.
Understood.
Okay, ma'am. So my view is short term to mid term, but I want to know the chart pattern and is that a right pick for a two-wheeler auto sector or how?
Okay. So rightly said that we were discussing, about the auto space, but talking about Hero MotoCorp now, Mahesh, for somebody who has bought it recently, what advice would you give to him? And, is Hero MotoCorp one of your top picks?
I think a number of monthly data number came good from Hero Moto perspective, but stocks is trading slightly low because we have earlier seen 3,600 level to 4,300 odd level from an upside perspective. So slightly consolidation could be here nearby. So I think from a medium to longer term perspective, I think stock has a potential for upside that could be nearby 4,900, 5,450 level. So from a longer term perspective, still they can hold further. From a medium term perspective or a very shorter term trading perspective, I think stock can consolidate here some more time.
Okay, and Sarvendra, I'd also like to take your technical view on the counter. Are you positive on Hero MotoCorp, and do you suggest investors, to be investing in this particular counter at this particular time?
See, within the short term, I think we had a nice little move from 3,500 odd till around 4,500. So we are trying to digest that particular move itself right now. Yes, the stock has posted a very decent correction. Again, something which was around 6,000 plus, we fell close to 3,500. One tick was slightly lower than that, but around 3,500 is a decent 40-45% correction. The stock has regained the long-term 200-day over the last 1 week. We are just trying to whipsaw that number slightly lower this time around. But I think, this bounce could be decent. I would expect that within this short-term decline, if you get it around the 4,000 mark, then for the next 1 to 3 months, I think you would get a good risk rewards back towards 4,600. So around 4,000, I think the short-term risk rewards would be more bullish than what they currently are. But yes, the stock has got a potential to go back towards 4,700 levels.
Okay, interesting. Now we have Veer joining us on the phone line from Mumbai. Hi, Veer.
Hi.
Hi. Good
I wanted
evening.
to know about
RateGain
Technologies.
Okay.
So should I buy it right now? I was holding 70 shares at 728. Should I buy more? I wanted to know a long-term and short-term both.
Okay, and could you help me with the timeline of when you bought these shares, Veer?
I guess 6 months ago or something.
Okay. Understood. Got it. Sarvendra, our viewer Veer from Mumbai currently holds 70 shares of RateGain Technologies at 728 rupees a piece, and he wants both technical as well as a fundamental view. I'm going to you first because I'm really, confused by the way the stock really is moving, and therefore I wish for you to give us some clarity. The fact that it has the nature of making a dramatic move and then going into a range-bound, reclusive, trade, and then again making a dramatic move and again becoming range-bound, testing so much patience of investors. What do you think from a technical perspective and looking at the nature of the charts, the next move is going to be, and do you think it will go back to the range at which our viewer bought them at?
See, these are high beta names, and they will definitely give you more. They will give you more volatility, and that is where I think the challenge remains. If you are trading this, then you are slightly a higher risk profile trader. You need to know which kind of stocks that you are trading. So if you are comfortable doing these stocks, I think fair. But I think the timing here may be a good stock, but wrong timing, I would say. So his timing possibly missed him, and definitely there would have been some news. I don't track it on a regular basis. I'm just looking at those charts, but I assume that there was something negative which came in the price, the way it broke the 200-day and fell sharply. Definitely there would have been something here. But right now, I think we have had a very decent correction. As I said, within this stock, I think you from 900 to 450, you are already 50% lower from the all-time highs. I would say as long as we hold the 420 mark, and as long as we are doing that, 410, 420, I think the worst possibly for the next 3-6 months could be over, and I would be very surprised if we make a newer low going forward over the next 3 months. So I think with 410 as a stop loss, I think he should firstly stay in whatever he had, because very difficult to tell him at half mark point to book out. So I think with 410 as a stop loss on a closing basis, I think he should stay put in the position whatever he is carrying right now, and wait for more clarity to add. Adding, I would not suggest at the moment. So just hold what you are holding, and for the next 15-20 days, 1 month, more clarity will emerge.
Okay. So Sarvendra, where you suggest that, looking at how the charts are currently performing, you would not go ahead and advise investors to take fresh positions in the stock. My question is, why do you think it's a good stock but bad timing when it has already corrected significantly? Because number one, as a SaaS provider to the hospitality space and the tourism industry, which has so much demand for a country like India especially, what reasons are you seeing for a potential pullback or a conservative approach?
No, I said maybe a good stock because see why I said maybe because I've got very less data. I've got data only from 2021. So this is a stock which is not very recently listed, but also does not have sufficient technical meat to bite into and see what has been the historical patterns or something like it. It is just had got one rally and one correction in its entire lifespan of technical prices that we have on chart. So in that sense, I said maybe a good stock because I've not tracked it on a so regularly, and the data, as I said, it only from 2021, and not much to call beyond those two moves. And why I said you have to wait, for one caller prior to on the show also I said wait for the quarterly close. So there is still 24 days left for that. Then you will have more clarity. If the quarter closes green and we have a bullish pattern on candles, then I might go out and tell him what to do with more clarity. So right now, just wait for 24 days.
Okay, thank you so much for that. With that, let's go across to a caller joining us from Hyderabad. Hi, Dheeraj. Good evening.
Good evening, ma'am.
Yeah.
So I would like to invest in KPIT Tech and Power Finance Corporation at current levels. Is it okay to invest at the current levels, ma'am?
Okay, and Dheeraj, are you a long-term investor or a short-term investor?
I'm a short-term investor, ma'am. I'm looking for the next 2 months, ma'am.
Okay, okay. So KPIT Tech, Sarvendra, we on our show, viewers keep asking us about KPIT Tech. This is one of the stocks that we keep talking about. So currently it's trading at 1318. So, and when I look at the charts, it's a bit topsy-turvy also. So what are the key resistance and support levels according to you?
See, short term, 2 months, the stock has already gone from 1,000 to 1,400. So he's again already missed the momentum bus. The short term bus he's already missed. Better to stay away if that is the time horizon. And broadly, the stock is still trades below the long term markers, the 200-day, which is not a good. It's not a good pick for short term trading. You want stocks which are holding their long term trends, long term supports, long term trend lines, long term setups, long term support areas, which I see none of happening here. So right now we trade below a long-term marker. As long as we trade below a long-term marker, the stock never comes into my short-term trading list on the long side. All I can say is that if you want, this is a short candidate.
Okay, KPIT Tech is a short candidate is the word coming in from Sarvendra Srivastav. Now we have Ramana calling us from Hyderabad. Hi Ramana, good evening.
Good evening, madam. This side is Ramana.
Yes,
and
please.
I bought KFin Technology last week.
Okay.
At the price of 1,066, 2,000 shares.
Okay.
I want to know technical perspective and its resistance level.
Sure, sure. Again, Sarvendra, our viewer is sitting on a handsome profit of 2 lakh rupees on KFin Tech. He holds 2,000 shares at 1,066 rupees a piece. He is wanting to know something really specific from you. What do you think is the resistance level of KFin Tech?
See, IT stocks are definitely high beta. There's no doubt, and especially the smaller IT names, mid-cap names, the smaller ones. Resistance definitely last two, if I go and look at last 2 months, I think clear-cut resistance areas between that around that 1,330 price area. So those areas are definitely strong hurdle areas. And I would assume that as long as you don't go below that number, that's the upside cap for him. So if he's doing a short-term trading, short-term view, that's the cap for him. Again, just like the previous stock, the data is only available from 2022, and that is just a vertical move. There's been no major correction or a time-wise or a price-wise decent correction on this stock. So, and it's fairly overbought. So the risk element on longs is definitely higher than possibly something which has already corrected 50%. So being high beta, low volumes, slightly spiky trades, sometimes good volumes, sometimes not so good volumes on daily charts, I think it will be slightly risky trading this. So I would tell him to book profits on the bounce. So if he gets slightly higher levels, around 1250, 1280, I think he should get out. If at all we break past 1330, then possibly we can look at again with a bullish lens. But till that's not happening, again, this possibly could be a short candidate.
Okay, okay. Thank you so much for that. Now we are joined by Vikram from Baroda on the phone line. Hi, Vikram. Good evening.
Yes, yes.
Yes, please.
IRFC.
Yeah. Please go ahead with the query. IRFC.
Yes, yes.
So, Vikram, are you asking about IRFC?
Yes.
How many shares are you holding?
10,000.
Okay, and at what price did you buy?
More or less 110 rupees average.
Okay. So are you looking for a long-term outlook or a short-term outlook?
Yes, at least for 1 year.
Okay.
But is there any possibilities for betterment?
Okay, okay. And firstly, I'd like to congratulate you, Vikram, that you've made significant profits there, 3.5 lakh. Kudos to you, congratulations. And talking about IRFC's fundamental performance, obviously it's a leader there. But Mahesh, currently it's trading at pretty high valuation. So do you suggest Vikram to keep on holding the stock, or should he be partially booking his profits with the counter because he wants to stay invested in for 1 year in this counter?
From my perspective, still they can hold, but if they are getting something, then they need to book at least something 50%, 60% profit on their pocket. As government capex is also in line for the railway sector, and I think stock market has already consolidated in lower range. So from these level, I think IRFC could also do well. 160 will be first level, and after that, what we can see up to 175 zone. But yes, some profit booking is advisable on these levels if they have bought in 110 and they are getting handsome profit. So partial profit is advisable, but yes, they can hold further. 160, 175 level could be come in 6 to 9 months onwards.
Okay, all right. Thank you so much for that, Mahesh. And now we are being joined by Sandeep from Bengaluru. Hi, Sandeep. Good evening.
Hi, good evening. I have Enviro Infra, 1,000 shares, averaged out at 249. I want to know the short-term outlook for this in the next 1 month.
Okay, got it. Sarvendra, our viewer Sandeep from Bengaluru holds 1,000 shares of Enviro Infra at 249 rupees a piece, and he's already slipped down and made some loss for himself. 17,000 is the figure that he's sitting on, and he's interested to know the next 1 month outlook on Enviro Infra. I know the technical data bank that you have is perhaps insufficient, but would it be still possible for you to give us some guidance?
See, it will be very, very difficult, and I will say a polite sorry here because can't do anything with this stock. Very little data, nothing much to look at.
No issues, no problem. I guess so. But then, Mahesh, you're a fundamental expert, and with the fundamental insights that you may have on the stock, do you recommend Sandeep to continue holding his positions for the next 1 month? And more importantly, do you think he'll be able to reverse his losses in such a short period of time?
From one perspective, I can't tell much, not suggesting much more data. But if you are looking last quarter number came good for Enviro Infra. And from a longer term perspective, I'm still bullish on Enviro Infra because we have earlier suggested our client in lower level, and we have booked partial profit booking on a higher level. So I think yes, from 1 year perspective, they can hold 320, 325 level could become in Enviro Infra. Fundamentally, stock is good, and it's a recent listed IPO. So I think some time you need to give on the stock if you are betting on high beta type of stock, and especially if you are betting on a new listed IPO type of stocks. So yes, from 1 year perspective, I think 320, 325 level could become. From shorter term perspective, I think if you are looking from a technical perspective, I think 214, 216 level could be a stop loss. Upper side that could be a tapped for a 255, 260 zone. So if any level could be starting, then we can see 255, 260 level onwards for Enviro Infra.
Okay, thank you so much for that view. With that, let's go across to Snigdha joining us from Hyderabad. Hi Snigdha, good evening. Snigdha, are you there on the phone line? I think we've lost the connection there, but we have Snigdha's query. So she wants to invest 4 lakh rupees in either Havells or Aurobindo Pharma, but she hasn't mentioned the time horizon. So I'd like to take both technical and fundamental view on the counter. Firstly, coming to you, Mahesh, what would your pick be between Havells or Aurobindo Pharma? For one is from a cable space, the other is from a pharma space. And if we look at, the valuations of both the companies, P ratio of Havells is a bit stretched as compared to Aurobindo, but when we compare it to its peers, so it's decently positioned. So what would your pick be?
Havells would be my pick, and I think last quarter number has come good. So Havells is a good pick from these level. We can see some smart pullback if you are looking for a longer term perspective. So Havells could be a good pick in the particular sector, and P is quite reasonable from shorter term perspective. There we are getting also near a lower range. So on these range they can accumulate further. If any downside, they can accumulate in this staggered way in Havells. From pharma space perspective, I think Cipla and Sun Pharma would be preferred. From my perspective, Cipla could be good over a Aurobindo Pharma.
Okay, and Sarvendra, according to you, which stock is more attractive, either Havells or Aurobindo Pharma?
See, I'll tell her that cash is king right now. If she has some patience, she can wait 3-6 months. I think both the stocks she'll get at better prices, possibly. And to me, both look slightly oversold and weak. So I think Havells already turned weak, and as I was saying, on quarterly, monthly setups, we have already have weak setups, and the stock possibly there could be one small bounce. But since she wants to invest, and that would be 12-24 months plus, I think she can get better rates for both the stocks. So cash is king. Preserve it for 3-6 months, you might get better risk rewards going forward.
Okay, cash is king, and thumbs up on Havells. And now we're being joined by Nitin from Ahmedabad. Hi Nitin, good evening.
गुड इवनिंग मैम मेरा सवाल होगा महेश ओझा जी से। महेश सर से मेरा सवाल होगा, मुझे BLS इंटरनेशनल खरीदना है नेक्स्ट 5 ईयर्स के लिए, तो क्या ये स्क्रिप्ट सही रहेगी, मेरा डिसीजन सही रहेगा BLS इंटरनेशनल?
एकदम, चलिए जानते हैं कि महेश एम ओझा इसके बारे में क्या सोचते हैं. महेश, our viewer Nitin from Ahmedabad wants to know whether this is the right time to enter BLS International, and can I please request you to reply in Hindi because he's comfortable in the language.
डेफिनेटली ये काउंटर को आप खरीदी कर सकते हैं. ये भाव में नीचे का एक स्टॉप लॉस जो रेंज है 355-360 के करीब करीब एक स्टॉप लॉस बन रहा है, बट फंडामेंटली मुझे ठीक लग रहा है. 460 पहला पड़ा हो सकता है, अपर साइड में 540 का एक टारगेट जो है आप एक साल के नजरिए से रखिए. स्टॉक फंडामेंटली ठीक लग रहा है. मेरे हिसाब से ये रेंज में भी एक्यूमुलेशन किया जा सकता है. कोई भी नीचे की डाउन साइड आती है 350, 360, 380 की रेंज, वहां पे भी थोड़ा बहुत एक्यूमुलेशन किया जा सकता है. एक साल का नजरिया रखिए, 500 प्लस के टारगेट रखिए, 540 तक के टारगेट आ सकते हैं.
Okay, thank you so much for that. Let's go across to a caller joining us from Bengaluru. Hi Murli, good evening.
Good evening, and thank you for taking up my query.
It's our pleasure. Please go ahead with the query.
And my thanks to the analyst also for answering. My query is to the fundamental analyst.
Yeah.
I bought 600 shares of Mahanagar Gas
Okay.
recently
Okay.
at a price of 1,329, say 1,330.
You've bought it at
1,330 rupees per share.
Oh, all right. 1,329. Am I correct?
Yeah.
Okay.
Yeah.
Yes.
So I'd like to know whether I can. I bought it on the max. The highest price was 1988, and it is come down by at least about 1/3.
Yes.
So and it has APM gas allocation, I am told, has been reduced. That's why it has come down. But still, it offers a decent growth of 8-10%. That's what management has set the tentative interview for the coming year, and a reasonable dividend yield. Should I hold, or there's a better option to give a return of at least 15% in the next 2 years?
And firstly, Mr. Murli, when did you buy these shares?
Recently, after the results, and the dividend was announced.
Okay.
And May.
I can see that sitting on a loss of 17,000. So, so for how long are you planning to hold?
2 years.
2 years.
Problem.
Okay. Mahesh, talking about the fundamentals of Mahanagar Gas, do you advise Mr. Murli to stay invested in this counter for another 2 years, or do you have any other picks, or he should be switching to some other counter?
See, MGN is very good counter from my perspective, but as MGN is affected by government policy and many more triggers, so some ups and downs could be there. But overall, particular sector demand will be in very focused. So slightly downside, if you are getting slightly downside up to 1,260, 1,240 level, then don't be surprised because it's a trend of the particular stocks. But yes, from a 1 year perspective, I think minimum 1,500, 1,550 level could be come. But yes, from a longer term perspective, 2 to 3 years,